After OPEC Plus surprised the markets by increasing output more than anticipated in August, raising concerns about oversupply. Meanwhile, gold prices have also declined as the US tax cut bills ignite fiscal worries and over these tariff uncertainties. And in some first quarter business updates to track, IndusInd Bank reported a decline in both advances and deposits for the June quarter. Meanwhile, Godrej Consumer says it expects to post double-digit consolidated revenue growth for Q1 FY26, and good performance continues for Jubilant Foodworks as well. It's the start of a brand new week, and you're watching Power Breakfast right here on CNBC-TV18 in the Mumbai News Center. I am Hormuz Patakia. Let's first take a look at how the Asian markets have started off, and it's a slightly cautious tone that the Asian markets are currently trading with. 0.7% lower on the Hang Seng, a 0.6% lower cut on the Taiwanese index as well. The Nikkei in Japan is down 0.5%. The Kospi is the only index in Asia that is currently trading above the flat line, as has been an outperformer all through the week, and it continues to do so. But still, holding on to some bit of gains is the Kospi, but the rest of the markets, including the Shanghai Composite, trading below the flat line, the Hang Seng being the biggest underperformer. So it's a cautious start to the Asian markets as of now. We'll pull up the GIFT Nifty as well. That will give you an idea of how our own markets are likely to start off, and a similarly cautious tone as was the case all through last week as well. Still awaiting more contours on the deal that is likely to be struck with the US. The implied open currently suggesting just a 7-point downtick as of now. But the big story this morning is Donald Trump's tariff deadline. The US president has said that he has signed several letters detailing the tariff rates the countries would face on goods exported to the US. Now, describing them as quote unquote take it or leave it offers, Donald Trump said that the letters would be sent out on Monday. Here's what he had to say.
Sending letters out on Monday having to do with the trade deals. It could be 12, maybe 15. You know, Secretary of Commerce right here. And I guess, Howard, I would say it could be maybe as many as 15 or so. And they'll be going out on Monday, and some will go out on Tuesday and Wednesday, and and we've made deals also, so we're going to have a combination of letters, and some deals have been made.
Well, now the U.S. Commerce Secretary, who was alongside the U.S. President, also told reporters that the higher tariffs would take effect on the 1st of August. Listen.
But they go into effect on August 1st. The tariffs go into effect August 1st, but the president is setting the rates and the deals right now. Well, the president is right in the midst of discussing all sorts of deals with all sorts of countries, and the gentleman to my right is going to decide, and I'm going to be with him when he makes that decision.
Staying with tariffs and trade deals, sources are telling CNBC-TV18 that India and the US are set to take a final decision on a mini trade deal in the next 2 days. Parikshit is joining in with more details on this. Parikshit, what are your sources telling you?
We believe that negotiations on the mini trade deal are now over. There are no more negotiations before the 9th of July, and India and US are now likely to take a final call in the next 24 to 48 hours whether to sign off on it or not. Essentially, both sides have proposed whatever they could, and now a political call has to be taken by Prime Minister Modi on the Indian side and Donald Trump on the US side. Sources are also saying that India has proposed a fair deal which would be a win-win for both sides and which will also protect interests of India's labor-intensive sectors and MSMEs. At the same time, the early harvest deal is likely to have annual quotas for lower tariffs on certain labor-intensive products from India. This could be textiles or footwear for that matter. India has also protected its red lines. We're told that any concessions on wheat, rice, maize, dairy, genetically modified crops have been completely rejected, and India has declined to offer any market access for these areas. Certain U.S. agricultural items which are not used extensively in India, such as pecan nuts, blueberries, they may be provided lower tariffs as part of the deal. India's proposal on automobile tariffs, this is of great interest to the automobile industry. We're told is very similar to what India has been offering to other nations in FTA talks. Currently, talks have only been completed for the interim trade deal or the mini trade deal. Negotiations on the larger BTA or tranche 1 of the agreement, which is set to be signed during fall during President Trump's visit, those negotiations will begin after the 9th of July. We're also told that the average tariff under the deal could be around 10%. Also, India was asking for an exemption from U.S. tariffs on steel. That has not happened because U.S. has imposed these tariffs on everyone and has maintained them despite deals being signed with other nations as well.
Parikshit, thanks a lot for that important update with regards to the trade deal that could be signed between India and the US, and an announcement could be made in the next 24 to 48 hours. Now, amidst this tariff deadline effective date seeing a delay until the 1st of August, HSBC's Frederick Newman believes that the new date offers the US and other countries some scope to complete pending negotiations.
I think we really have to look at the texts that ultimately come out, because even last week we had announcement around the US-Vietnam deal, but it doesn't seem to be really the final word. We don't have the final text yet. And with trade agreements, a lot of it is about the fine print, right? And so it's very hard to say exactly where we are at this point. I do think that the new deadline suggests that the administration is giving itself a bit more time just to get some of these agreements over the line, because some of them seem to be stuck. I mean, we've been talking with Japan for all these weeks, and yet we can't get it over the line. So I think there's a bit of wiggle room. But also, I'm struck equity markets are just shaking it off. I mean, you look at the Japan market, right? It's just, yeah, equity markets don't seem to be bothered by all of this. On the fiscal side, we probably now have a bill. We kind of know where we're going. It's not great in terms of fiscal dynamics, but at least we know we can put it under models and kind of discount it and so forth. On the trade stuff, yeah, you're right. I mean, it's not 200%, 150%, but it's still very substantial. And when we hear that things could go back to April 2nd, remember that was a trigger for a major sell-off. And yet the suggestion that we could go back to that seems investors to leave them completely unimpressed. But I do wonder whether we're a bit too confident going into the next few weeks, because there's a lot that could happen. Not necessarily on a global scale, but with individual economies. There might be some economies get picked on, quote unquote, suddenly coming with much higher tariffs than expected, and that would have an impact on the growth trajectory.
Well, in the CNBC-TV18 exclusive, my colleague Abhimanyu spoke to Commerce and Industries Minister Piyush Goyal on these FTA negotiations. Listen to his comments.
Well, we are trying to create a trading environment and trading arrangements and agreements which will help two-way trade. Our handicrafts, our handlooms, our various agri-products from here will also get a market worldwide. So it's always a benefit on both sides that is being balanced in a free trade agreement. After all, there are lakhs of handloom and handicraft persons here also. So we will be balancing everybody's interests when we are looking at free trade agreement.
So my final question to you, any new markets or products being looked at for exports?
Oh yes, our government at the center and the state is focused on new products, new exporters and new markets, and we will always be wanting and will encourage newer and newer exporters to come into this field. We'll try to encourage new products being exported. We just saw cherries being exported, Kashmir cherries being exported to other parts of the world. We would like to encourage newer markets being opened up for the delicious products of Kashmir.
We'll take a short break, and on the other side we'll tell you how will all of these cues impact our own markets in our Power Prep segment. Stay tuned, we'll be right back. Welcome back. Our research team is now joining in to set you up for the trading session today with the trade setup, stocks to news, and of course the setup on the FNO side as well. First up, Vivek is here to get us all the market cues we need to watch out for. Vivek, good morning. Devoid of global cues over the weekend, but what are some of the important things that you're watching out for today?
That's right, devoid of global cues. July 4th was a holiday as far as US markets are concerned. But remember, commodity markets, especially crude markets, are something that are pricing in the higher production that the OPEC plus countries will actually go in. So on the back of that, crude oil prices slightly lower in the session today. Well, Indian markets, Friday, throughout the trading session, you did see pressure. But what actually transpired was that in the last hour of the trading session, you did see some recovery come in. And on the back of both the Nifty as well as the Bank Nifty managed to end the session with gains. The IT Pack and ICICI Bank were among the key gainers. However, Friday, the last story or the big story was the impact as far as the restriction of chain trade in the Indian markets was concerned. On the back of that, you did see some important stocks taking quite a big knock. So BSE, Nuvama Wealth, Angel One, all of these stocks among the top drags. And remember also, as far as the oil and gas space was concerned, PNGRB tariff update, especially in terms of gas lines, is something that did come about. On the back of that, you did see GAIL, IGL as well as MGL. These three stocks react, especially IGL, positively impacted. Quarterly updates, whole host of stocks, especially the FMCG pack, will remain in focus. GCPL, Dabur among the top names. And in the BFSI space, IndusInd Bank and Bank of India will remain in focus on the back of the quarterly update. So overall, especially when you're looking at Asian markets and Indian markets, a largely flat start is what we're anticipating.
A whole host of business updates that we need to track. Vivek, thanks a lot for that. Since we were on the subject of markets, let's go across to Sudarshan, who is here with the cues that you need to keep an eye out for from the FNO side of things. Sudarshan, good morning.
Good morning, Omar. So first, the data overall is looking largely on the short side, but market also factor in all the updates, quarterly updates that we are looking at, because stocks will be reacting on that. As far as Friday's session was concerned, last hour recovery helped both Sensex and Nifty close in the green, while mid-cap index had closed with minor cuts. For today also, GIFT Nifty is indicating a muted start. On the flows front also, we have seen both FIs and DIs selling in the cash market. FIs have sold more than ₹700 crore, even FIs have sold more than ₹700, DIs have sold more than ₹1,000 crore. And in the futures market too, FIs have sold 747 crore in the index futures, and they have added more short positions than long positions. And now FIs long exposure has reduced to less than 23%. On the option front, 25,700 call has seen maximum addition. Their addition was more than 17 lakh shares, and the put side, 25,200 and 25,300 put were the healthy ones. One stock that remains in the band is RBL Bank, and apart from RBL Bank, two stocks that I'll keep an eye on. First is BSE, because now most of the brokerage reports are saying that FI's contribution to the volumes of BSE are very low, so there should not be much impact because of SEBI's order on Jane Street. And second stock that I'll keep an eye on is BPCL, because over the weekend we have seen a sharp drop in crude after OPEC plus order. Now, lastly, support for Nifty remains around 25,330, and if that breaches, next support comes around 25,160. As far as resistance is concerned, 25,600 first, and if we cross that, then 25,700.
That 25,600 level continues to be a bit of a barrier for the index, and it has failed to cross that all through last week. Sudarshan, thanks a lot for that update from the FNO side of things, and some important stocks that you will have to keep an eye out for today. We had a whole host of business updates that came in on Friday evening and over the weekend as well. We start off with Dabur, then for the Godrej Consumer Products. Let's start off with that first. Now, they said that the standalone business is likely to deliver a high single-digit value growth on the back of a mid-single-digit underlying volume growth that they have seen during the quarter, and as a result of which the volume growth has been strongly competitive and is improving sequentially. So they are expecting a consolidated double-digit revenue growth during the quarter. Now, on the flip side, Dabur has said that their consolidated revenue is likely to grow in low single digits, and that is because of the underperformance of their beverage business, which has weighed on the top line. And they're saying that this consolidated operating profit growth is expected to marginally lag revenue growth. So if revenue growth is going to be in the low single digits, the operating profit growth is likely to be either similar or maybe even lower. So that's Dabur for you. Bank of India, some of the PSU banks came out with some updates. Absolutely flat in terms of global deposits on a year-on-year basis. Advances too were up 12% compared to last year. That is for global overall. And IDBI Bank saw a 7% deposit growth, CASA deposits were down 2%, so it's a mixed bag that IDBI Bank reported during the quarter. But Senco Gold on the flip side, though it's a strong update from them, retail revenue was up 24% and revenue growth overall was 28%. Same-store sales growth was strong as well, and they said that they are on course to achieve their annual target of 20 showrooms, and this quarter is likely to be boosted by festivals like Raksha Bandhan and Onam. Keep an eye out on IndusInd Bank, though. It's been in the news all through the quarter, and this time around advances were down, deposits were down, both on a year-on-year as well as on a sequential basis. So keep an eye out for that. Morgan Stanley too said that they remain underweight because of all of these uncertainties and the lack of clarity over their new CEO. So keep an eye out on that. Jyoti CNC, they've acquired 20 acres of land at Tumkuru Machine Tools Park in Karnataka. And Shilpa Medicare is the other one, where Anvisa has completed their good manufacturing practices inspection of its arm, and that inspection has been concluded with no major observations. Well, Tata Steel has received a demand letter with respect to the minerals dispatch from the Sukinda chromite block. Mahindra Life Spaces has launched a new project, and BEML has won an order. So a lot of stocks that you need to keep an eye out for today. But moving on then, Labour Secretary Vandana Gurnani has said that only manufacturing sector will be eligible for incentives under the new employment scheme for a 4-year period. Now, speaking to CNBC TV18, she added that the incentives under the scheme will be limited to 2 years for other sectors. She also clarified that there is no per month or per annum target for companies to avail this scheme. Listen in.
In terms of sectors, I would say it is a very broad-based scheme. It is applicable to all sectors. There is, I would say, an additional incentive, a longer incentive for the manufacturing sector to give a special boost to that particular sector. So all sectors would be eligible for incentive for 2 years after the employment is generated. However, manufacturing sector would have an additional 2 years. It would be eligible for incentives for 4 years. Any company which has less than 50 employees has to hire 2 additional employees. So over the baseline of employment that they currently have, just 2 more people hired makes them eligible for the incentive. And if they hire 10 people, 15 people, 100 people, they get incentive for all of them. Similarly, for companies which have more than 50 employees, they have to hire 5 additional employees. So there is no such per month or per annum target that is there.
We take a short break. Up next, we get you cues from the commodities market. Stay tuned. We'll be right back. Welcome back. Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. A higher than expected hike from OPEC and its allies.
Oh, absolutely. And, the markets were not anticipating this. 411,000 is what the street was looking at. You have 528, and this is way higher. And the expectation that not just for the month of August, but September and October could be looking at these higher highs as well has put pressure on the prices, but not so much yet again, because you're looking at better Chinese manufacturing data. The services numbers have come in on the positive side as well. But you know what, Hormuz, all of this is going to go down, especially as the markets await the U.S. FOMC Fed meeting minutes that are going to be released in this week. And then those tariffs The 9th July is yet another thing that the street will watch out for. But it's not just the crude oil prices, because when you look at the metal space as well, there is a bit of a profit taking coming in here. The copper prices have gone down. Rubber has gone down because of crude oil prices declining. Iron ore and steel is off its highs as well. And so is the case with aluminum, zinc, gold. All of that seems to have declined because of a bit of a strength in US dollar index also coming back.
Manisha, thanks a lot for that update. Now, a day after US President Donald Trump signed the One Big Beautiful Bill into a law, billionaire Elon Musk, who has strongly opposed the bill, announced that he would be launching a new political party in the US. Now, on his social media platform X, Musk revealed the formation of the America Party, which aims to give you back freedom, quote unquote. Now, he stated that the party would seek to challenge the existing two-party system dominated by the Republicans and the Democrats. Remember, Elon Musk had announced his departure from Trump's administration in May, citing completion of his scheduled time. However, the relationship between the two has soured ever since Trump pushed for the mega tax bill. In fact, let's listen in to what the president had to say about the new party.
I think it's ridiculous to start a third party. We have a tremendous success with the Republican Party. The Democrats have lost their way, but it's always been a two-party system. And I think starting a third party just adds to confusion. It really seems to have been developed for two parties. Third parties have never worked. So he can have fun with it, but I think it's ridiculous.
Well, in some other news then, at least 78 people have been confirmed dead in central Texas and another 41 are missing following flash floods on Friday. Officials say that the death toll is certain to rise more. Now, more storms are expected in the next 24 to 48 hours in the region, which could hamper rescue teams who are already facing venomous snakes as they sift through mud and debris. President Donald Trump signed a major disaster declaration on Sunday for Kerr County, activating the Federal Emergency Management Agency to Texas. He also said that he would probably visit the state on Friday. With that, we'll call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call on the other side to set you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, starting a new week, an important one. Lots of news as we sort of come into this Monday morning, and lots more to track over the next few trading sessions. This is Bazaar. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, good morning, Prashant, and welcome back. Morning to you, Nigel, as well. So finally, the original trio is back here. And I think we wanted to ease Prashant into it, right? That's why we got him to give us a bit of a guest appearance on Friday, thanks to the Jane Street saga as well.
It was Friday, huh? Seems like so long back.
But yeah,
And
interesting
the week
times.
has just begun, so welcome back.
Actually, you know, it's proven management strategy. You should always come back on a Friday. Kind of, you break in.
Ease into the reality.
Saturday and Sunday, and then you come back on Monday. So,
Well, interesting times for the markets, and welcome back, Prashant. But I'm still high after last night's victory, right? India conquering England. The boys in white, young side, you know, coming out trumps. Wow. I mean, amazing. That too, we did it without Bumrah. So kudos to the boys. Quite pumped on that front, but we've got the trading cues to get to.
Absolutely. And I think we'll see if we see some fours or sixers this week, right? In terms of the markets as well. At least in terms of headlines. Markets, I'm not very sure, but in terms of headlines, will we really see some action. Now, let me just take it from the top in terms of what you need to know. So all eyes, of course, on the Trump tariff deadline, which is on the 9th of July. So when I say 9th of July, it's basically the evening of the 8th into the morning of 9th. That's essentially what you're looking at. So that's the deadline, the tariff deadline. This is the reciprocal tariffs which were first imposed. Then there was a 90-day extension which was given. Then, I mean, for many it moved to 10%. By the way, there have only been two deals struck so far. One is the UK, the other is Vietnam. You know, will that be the template? We'll see. But sources tell CNBC-TV18 that with regards to India, the final decision on India-US mini-trade deal is in the next 24 to 48 hours. I mean, actually, you only have that much time. If you're to believe that this is a sacrosanct, the 9th of July is kind of a sacrosanct kind of a deadline, which I don't think it is. But before that, Treasury Secretary Besant over the weekend has said that tariffs start August 1st for countries that haven't finalized an agreement with the US. So in a way, are they already kind of starting to push the deadline out a little bit? Because, you know, and he was, I think Besant was asked this specifically, said, well, it's not an extension, but in a way it is, right? I mean, and I think that's very, very logical that the Trump administration will be pragmatic about it. And we said this earlier as well, many weeks ago, that with countries that they think they're hopeful of getting to a deal, a good deal for the US, I mean, they're not going to be hamstrung by sort of, you know, the self-imposed deadline of the 9th of July. While the deadline is important, I think, you know, there is enough leeway for deals to be struck before, but more importantly, after the 9th of July as well. So that is essentially the point. Markets anyway assume the 9th of July deadline is largely symbolic, and we've not seen any jitters at all as far as the markets are concerned, based on the tariff negotiations, etc. So that's the tariff bit, which we'll sort of come back with discussions, etc. a little later. Now, two key events last week in the US, out of the US, passage of Trump's spending bill that went through, and of course the US-Vietnam deal as well, which was agreed upon. Is Vietnam really a template for other deals? I don't think so, because, you know, there is the issue of transshipment, etc., which is not relevant for many other countries. It's only kind of relevant for the ASEAN economies, Philippines, Thailand, Vietnam, etc., not for the rest of the world in that sense. Now, the S&P 500, you know, hit a new all-time high of 6279. This was on the 3rd of July. Remember, the 3rd of July was a shortened trading session in the US. That was Thursday. And, of course, both equity and bond markets were shut. But, you know, no stopping the S&P, which continues to rally hard and higher. Oil prices are slightly lower this morning. Over the weekend, OPEC has increased production by more than what was expected. So that is something to take note of. The oil prices down about 1% or so. First quarter earnings season here in India is going to be in focus as well. Expectations, mind you, are modest. I mean, you take any sector, banks, for example, which is 30% of the weight. NIMs are expected to decline over Q1 and Q2 anything between 10 and 30 basis points. So generally, it's not going to, expectations aren't for any a big banger of an earnings season at all, actually quite modest. SEBI's Jane Street order, and we'll sort of continue to talk about this in terms of there are so many angles to this, but from a pure market standpoint, will the impact show up with regards to quieter markets, quieter volumes? I mean, you've had wild moves up and down without reason, and suddenly the screen would be on fire. Will all of that sort of start to quieten down quite a bit? And, the impact of Jane Street perhaps is the signaling impact could show up at other HFT firms, etc. as well. Jump, Citadel. There are Indian firms like Graviton, etc., etc. So, that entire segment, which has been driving market volumes in a big way, I think will be in focus. Remember, BSE was down sharply on Friday, and of course, Novama was the other one, which lost quite a bit as well. More on that a little later. So just to tie in the levels here now, I think it's going to be a little quietish as far as markets are concerned. So I don't expect any big moves, big fireworks in that sense. Support for the Nifty 25,165, which is the 20-day moving average, and the resistance, which is last week's high, which is 25,650. The Bank Nifty support is Friday's low, 56,623, and then last week's high for the Nifty Bank was 57,628. So these are very, very near-term levels, which we are working with. Gift Nifty will give you a quick sense of how we are likely to start this morning. 23 points lower as far as the indication is concerned. Surabhi.
Yes, absolutely, because most of the Asian markets more red than green, and that's because of this whole trade uncertainty weighing on markets' minds. Now, what did Mr. Trump last say? Last, he said that he signed several letters, and he said that at least 12 at last count. And he said they will start going out on Monday. Now, who gets what tariff, what rate? That's pretty much what's bothering markets right now. In fact, if we look at Wall Street futures, because of this whole new tariff specter, even Wall Street futures are lower. Between about 0.25% to as much as 0.5%, depending on which market you are looking at. Now, on the India-US trade deal, like our colleague Parikshit has been reporting, the team came back from the US without any conclusive agreement. So there were no big headlines. But what he's picking up through the back channels is that this mini deal could happen maybe over today or tomorrow, and that's the hope. Now, this is going to be a mini deal. The real work on the bilateral trade agreement will only happen after the 9th. But there have been sticky issues, and we know that. India's position on agriculture and dairy has been very, very firm. And not just this, let's remember the other weekend development, that India has now moved the WTO against the US on tariffs that are coming in on automobiles as well as auto components. And this is in response to the 25% ad valorem duties that the US had levied. India has basically gone to the WTO and said that these are not compliant with the GATT agreement of 1994, which is a general agreement on tariff and trade. So all is not well in paradise, but they're trying to get through the differences and get at least the mini trade agreement going. So that's the single most important point to watch. Coming to the market, it was consolidation, but consolidation with a negative bias. The Nifty ended up losing about a little over 0.5% last week, but we didn't break the lower side of the trading range. So that's the good news. The FPI flows have been patchy through the week, and we saw more of that on Friday as well. A small sell number, not very big actually, but 760 crores of selling. But even domestic institutions, at least on Friday, were on the sell side, sold off cash market stocks worth about 1,000 crores. There are lots of updates in focus, and I've just picked out 2 or 3 which the market will have its eye on. IndusInd Bank, we know it's going through its issues. But how deeply has it started impacting the business? And I think that's something the market will focus on, irrespective of the kind of notes that are out there. Because the advances are down about 4% year-on-year, 3% quarter-on-quarter. More importantly, the worrying point is the fall in deposits. The bank's CASA ratio has come down from 36.5% last year to just about 31.5%. So this needs to be tracked very, very carefully. A lot of FMCG updates have come, some good, some bad. Dabur, they're saying the consolidated revenue will be in low single digits because the beverage portfolio continues to hurt Dabur. There's some overall positive statements they've made as well, but that's the big headline to focus on, that the beverage portfolio is still hurting Dabur. Godrej is actually pretty okay. Godrej is saying standalone business could be delivering mid-single-digit volume growth and double-digit revenue growth at a consolidated level. So that's sounding better. Jubilant Foodworks update is actually pretty good. 17% revenue growth, like-for-like Domino's growth of over 11%. So mixed bag out there, but yes, Dabur and Indocent to watch out for specifically. Nigel, what else are you tracking?
Well, on the domestic front, we'll be keeping an eye out because the earnings season does kick off. So that's going to be important. On the global front, the FOMC minutes, that's the other one that I'm going to be looking at because that will have its own repercussions with regard to flows and the fundamentals of the US market as well. And besides that, the progress on the tariffs, that's going to be the other important point. So those are the top cues on the global front that I'll be looking forward to in this week. What about Friday's trade? Well, FI participation in the cash market itself was 40% lower. Remember, the US markets were shut because of Independence Day out there. And on the back of that, you had participation that was much lower in Friday's trade. What did the FIs do in the F&O market, though? And before that, we saw a bit of a recovery from the lows of the day, both on the Nifty as well as in the Nifty Bank. And it appears for the markets on the whole, there was a bit of a short covering bounce that did take place. What did the FIs do in the F&O market? Well, they added some mild short positions, close to 5,000 short contracts on index futures. On stock futures, they added more shorts than long. So there were some shorts that were getting added into the system. But it appears even the FIs are not expecting a big fall from here on because they wrote more puts than calls in Friday's trading session, telling you that there could be some kind of a base, in the near term on the markets, and we wouldn't be looking at too deep a correction. So that's what the FIs did in the F&O markets. Moving to positioning. In the past week, the FIs, they went ahead and they added short positions. So from the start of the series, actually, the FI short positions have doubled. Just take a look at that. And even if you look at the clients, they're doing a thing of their own. Their long positions have doubled. At the start of the series, we were saying this market is missing out on some shorts, in the system. Now, that's gradually coming back. So the FI short positions at around 66,000 contracts. And in terms of percentage, well, it's more than 70% of their positions are on the short side. Moving to the options data, the 25,400 call, that had a fair bit of open interest. And you had the 25,200 put as well. There was a mix of activity with the premium at around 50 rupees or thereabouts. So which brings us to the levels. Friday's low needs to get protected. And that's going to be the important mark. You don't want that to get breached on the downside. So that 25,331 level, that's going to be important. And the bulls will want to guard that on the downside. So that's going to be an important mark. On the upside, the resistance comes in, if you take this level of around 25,400 call and you add around 175 rupees, that 25,575 is going to be the important mark in terms of a resistance level that you're looking at. Well, OPEC Plus, they went ahead and they, declared their verdict with regard to what they are planning on with regard to crude. And the amount of crude that they will be releasing in the system is going to be around 570,000. The sheet was bracing for a number of around 410,000. So the effective release of crude in the market is going to be nearly 30% higher than what was estimated. It'll keep a lid on Brent crude prices, and I'll keep an eye out on OMCs from here on. There is valuation comfort. State elections are a distance away, and crude oil prices remaining subdued is a tailwind for them. So these stocks continue to remain on my radar.
Okay, all right. So plenty of stocks to watch and, of course, the overall headlines on the tariff front as well. So let's get started. We have the equity call of the morning coming in. This one is from Chetan Sheth of Nomura, who expects markets to remain volatile into the July 9 deadline when the 90-day pause on President Trump's reciprocal tariffs expires for non-China trading partners. He says while uncertainty remains high with multiple possible scenarios, he believes that greater clarity on trade tariffs might actually help markets eventually grind higher. In general, as this could reduce one aspect of uncertainty, allowing investors to focus for now on other positive developments like the passage of the US budget, Fed rate cut theme, benign US long and bond yields, resilient US economy, and the ongoing AI narrative.
Okay, well, Mark Matthews of Bank Julius Baer and Company is with us. Mark, good to have you with us here on the program, Prashant, this side. Markets, in a way, kind of unbothered, so far at least, with regards to the tariff news flow, which was all that was singularly driving markets around Liberation Day, pre and post that. But now, not so much. What's your sense, Mark? And start with this 1st of August date which Secretary Besant put out over the weekend, saying, well, tariffs will go into effect on the 1st of August. So actually, in that sense, you have a de facto kind of extension. In any case, as I was saying, markets were kind of thinking, well, this is largely symbolic. and there will be extensions if necessary. What's your sense?
My sense is that the tariff talk is vastly exaggerated, and there's no better indicator of that than Walmart's share price, which is less than 6% away from making a new high. Walmart is obviously where all of these imported goods are sold to consumers in America. It wouldn't be 6% from an all-time high if the tariffs were going to be the kind that Donald Trump held up on his whiteboard on the 2nd of April that Besant says countries are going to get hit with on August 1st unless they do deals. So I think either that means there will be deals done in between now or then, or there'll be extensions. But one thing I would like to let you know, which I found somewhat surprising when I discovered it, but I checked and double-checked, so I believe this to be true, is that imported goods are only 10% of the consumer's basket of goods in America, goods and services, excuse me. So housing, transportation, healthcare, insurance, education, all those things have much bigger weights. And when you think about it, how often does somebody buy, I don't know, a new television, for example, or a new washing machine? It's not that often. So I think that if the oil price suddenly went up $10, that would be much more detrimental to the U.S. consumer than these tariffs. And the market seems to feel that too. So the market could get a little rocky with the tariff talk, but I think that it realizes, and rightly so, that this is vast majority of it is noise and not that impactful.
And perhaps that could be the reason, and maybe the market gets proven right. Market's been rallying through and through, despite all of the trade uncertainty, Mark. So yes, we take your point on board. So what then? I mean, if for a second we park the tariff issue aside and expect it not to be as disruptive, like you described, otherwise all indicators have been holding up. Look at the jobs report. I mean, it was ripping higher above estimates. So would you expect further highs for the U.S. market in the months ahead?
Well, typically the summer, as you know, is a time when many people are not in the market, and so it can get less liquid. And typically when things are less liquid, they can become more volatile. And historically, you don't see good returns in the summer months. But there's a number of technical indicators we can look at that do suggest the market should be higher 12 months from now. One that I can tell you is that there were 5 other years since 1950 when the S&P went down in the first quarter and then rose 10% or more in the second quarter. And in all 5 of those, 12 months later, the stock market was higher. In fact, both on a second half basis, but also in each of the quarters, the third and fourth quarters of those years, the stock market was higher. There was never a down quarter. So for whatever reason, that's quite good. And then the golden cross, which is when the 50-day moves above the 200-day moving average, that happened on the 30th of June. And it doesn't work very well for prices that are volatile. But for the S&P, it has a pretty good track record. And if we go back to the 1970s, I think there was 25 times when there was a golden cross in the S&P, and in 22 of them, it was up 12 months later. So the technicals are telling us that we should be higher 12 months from now.
All right. Hi, Mark. Good morning. Good to see you. When we've got some comments coming out from President Trump. He's indicating that there could be an additional 10% on BRICS nations, and no exceptions on that front. So India's at 10%. Another 10% would be around 20%. Do you think that's par for the course from an India market standpoint? Some were expecting a more favorable deal for India. Your view on that, and also where do you see the Indian markets headed? One would argue that relatively we're expensive, but otherwise earnings are expected to pick up from year on. So your take?
Well, I can't recall ever in my career talking about the importance of imports to the United States from India for the Indian economy. I never remember that coming up in conversations. It's not a driver of the Indian economy. What drives the Indian economy is its own domestic consumption. I really wouldn't worry about it. And the Indian market is fine. I think that the the trend will remain, positive. The most important thing will be the earnings, which were disappointing last year, of course. So we need to see better earnings coming in from companies, and I think we will. I think it's a fine market. Nothing the matter with it.
All right, Mark, we'll leave it there for now. Thank you very much for joining us. It's always a pleasure having you here on the program on CNBC-TV18. Thank you. Let me just quickly run you through the interactions which are lined up here over the show over the next 2.5 hours. So 8:35, we will have Amithendu Palit of the Institute of South Asian Studies at the National University of Singapore joining us to discuss the possibility of a mini trade deal between India and the US. 9 o'clock, we'll have Harshit Kapadia of Elara Capital to talk about the key trends in the defense sector. 9:20, Manish Sonthalia of MK Investment Managers will be the market master of the day today. 9:30 a.m. You'll hear from IKS's management and demand trends, what's happening in the US. Interesting space that. And of course, HAL management, DK Sunil of HAL, Hindustan Aeronautics, will be speaking with us at 9:40 on recent order wins and their F526 outlook. A little later at 9:50 will be the IPO, which will be in focus. Travel, food services, Varun Kapoor and Vikas Kapoor join us for that towards the end of the program. It's, Economy Unpacked. Lata speaks with Sajid Chenoy of JP Morgan, Rajkiran Rai of National Bank for Financing Infrastructure and Development, Indranil Pan of Yes Bank to discuss if credit growth will grow strongly this year due to RBI's liquidity and rate cuts.
Time to slip into a short break. We've got a lot of stock-specific action to track for you. Get at that in just a bit in our special Top 10 segment. We're looking at Godrej Consumer, Jubilant Foodworks, Kalyan Jewellers and Senco Gold. They'll be reacting to positive news flow. On the flip side, you have IndusInd Bank, Dabur, Nykaa and Shyam Metallics that will be reacting to negative news flow. You'll also have Bank of India and Borosil Renewables that could see a mixed reaction to their respective news updates.
Welcome back. So markets across Asia are, pretty cautious this morning. Some of them, like Japan, down about 0.5%. Hong Kong's also lower by about 0.5% right now. So is Taiwan. So caution as we have more clarity on what happens with trade. The implied open is telling us that we'll probably start around 20 odd points lower. Let's get the implied open back up on the screen. 40 points lower now. So, yeah, this is going to be exactly at the lowest point of last week's trading range. And then we'll pick it up from there. Well, there are lots of individual stocks and important ones at that to go over with a lot of the Q1 updates pouring through. So let's straight away get to our team with the CNBC-TV18 list of top stocks to watch. I think it's going to be a toggle between Gaurav and Mangalam for the most of it today. I'll start with Gaurav. Gaurav, even I noticed IndusInd Bank, the fall in deposits looked, and that CASA ratio looked a little concerning. But you tell us more.
Right. When you talk about IndusInd Bank, we have already seen the weakness which was anticipated by the market. And when we talk about the numbers, we are seeing the weakness in the numbers as well. Now, loan book growth has slowed down almost by 4% on a year-on-year basis. And this is specifically because of the corporate loan book, where we saw a decline of around 14% on a year-on-year basis. On the deposit side, when we look at the markets and overall sentiments, the deposit was actually expected to remain stable. But now, bank has reported around 3% decline on a sequential basis in terms of deposits. This is actually led by the wholesale deposits because retail deposits have remained fairly stable on a year-on-year basis. Let's also not forget that now India Ratings has actually removed rating watch and with negative implication as a remark from IndusInd Bank, and they have affirmed AA+ rating with a negative outlook. So this could be a little positive for the stock today, but definitely on the back of the weak set of numbers in terms of the quarterly updates, we are watching out on IndusInd Bank today.
Okay, all right. Thanks a lot for that, Gaurav. Let's hop across to Mangalam. He's tracking a few of these consumer names, Dabur as well as Godrej Consumer. Mangalam, tell us more.
Well, for Dabur, you know, it's a soft update that has come in, and the large part of the softness is because of the unseasonal rains that we saw. Their beverage portfolio not doing too well. So the company said they witnessed sequential recovery in demand with uptick in volume growth, but the beverage portfolio was impacted due to unseasonal rains and short summer. And because of that, the consolidated revenue is expected to grow in low single digits, and operating profit growth will also lag, revenue growth, which means that margins will compress this time around. No problems with the home and personal care as well as the healthcare portfolio. The company believes that revenue trend will regain momentum. So the stock opens in the red. Let's see whether it sees recovery from the lows or not. Godrej Consumer, the results tell you that the worst is behind the company. Consolidated, overall revenue seen in double digit on the back of high single digit underlying volume growth. Standalone business, which is the India business, will deliver high single digit value growth driven by mid single digit volume growth. And the volume has been strongly competitive, sequentially improving as well. What is it that has led this business? Home care business, double digit underlying volume growth, as well as personal care, which is likely to grow in low single digit. Here as well, margins are seen slightly compressing, but again, the company believes that in the second half, there would be improvement because of the lower palm oil prices. So all things point northwards for Godrej Consumer. Remember, the stock had already rallied and ended at the high point of trade on Friday. So some part of the street was expecting this sort of an update.
All right, Mangalam, thanks very much for that. Let's move on to the next one. Bank of India should be in focus, and Gaurav is here to tell us why. Gaurav, morning.
Well, yes, Bank of India, once again, we can call it as a weak order, and the reason being that advances growth was actually in line with what the bank had guided in the range of 12 to 13%. It came just at 12%, but on the deposit side, we are seeing this growth was at just 9%, which was guided by the bank in the range of around 11 to 20%. So that is something which is concerning at this moment, because when we look at the CD ratio as well, for Bank of India, CD ratio is a little bit higher at around 80% if we compare it with other PSU banks. So definitely this area is one of the concerns for Bank of India in terms of deposit growth. But in terms of advances, we saw decent quarter with 12% growth on a year-on-year basis.
Okay, all right. So that's Bank of India. Back to Mangalam then. I think we've got numbers from Nykaa, Domino's. I think the pizzas were selling well this quarter, Mangalam.
Pizzas sold well, as did makeup and fashion. You know, in fact, discretionary consumption is one pack which has been doing well over the last few quarters. And that continues this time around as well. Jubilant Foodworks, consolidated revenue growth of 17%. That includes the international business as well. So standalone business of 18% is actually a shade better. And that's led by Domino's India like-for-like growth at 11.6%. So it's the third straight quarter of good like-for-like growth coming in for Domino's. And on the back of that, they've added 61 new stores as well. Total standing at 2240. Domino's Turkey, the like-for-like growth has seen a decline of 2.2%. They've opened 7 stores, so see some green on Jubilant Foodworks. Even Nykaa, remember the company has been saying that, you know, the fashion business is likely to break even this year. Out there, the overall revenue will be at the lower end of mid-20s. Not particularly bad in a sector which is not growing as much. The beauty business will actually show mid-20s sort of net revenue growth. Gross merchandise value expected to be higher, crossing mid-20s. And fashion vertical, net revenue expected to improve sequentially to mid-teens. And that is a good performance after many quarters of weakness that we've seen in the fashion industry. So that's where I expect some green on Nykaa. The stock was slightly under pressure on Friday's trading session.
Okay, All right, Mangalam, but you have tracking more updates. Kalyan and Senco as well. Tell us more.
Good performance coming from the jewelry companies as well. I'll await Titan shortly, but for Kalyan and Senco, look at Kalyan, consolidated revenue growth of 31%. The whisper on the street was close to around 30%, so it's better than that. Demand, they say, has been driven by robust performance in Akshaya Tritiya as well as the wedding season. Same-store sales growth for Kalyan Jewellers coming in at 18%. Middle East, the revenue grew at 26%, and the digital-first platform, basically the carrot lane version of Kalyan, which is Candier, grew around 67%. They've launched 10 showrooms in India, 1 in the US, and 8 Candier showrooms in India. Senco as well. The company said, for this entire year, they're looking at 18 to 19% growth. The first quarter itself, they've done 28% growth, retail revenue 24%, and 19% same-store sales growth. Out here as well, the diamond jewelry volume growth came in at 35%, implying that the studded ratio was maintained. That's positive for the margins. They've opened 4 new company-owned outlets and 5 new franchise-owned outlets. Remember, the second quarter is seasonally weak for jewelry companies. But here as well, you do have Raksha Bandhan and Onam, which will see consumer demand, improving. But more importantly, I'll be watching out for this underlying trend of consumers looking at 14 and 18 karat gold jewelry at a time when gold prices are so high. So these would be margin accretive for these companies.
Okay, all right, Mangalam, thanks a lot for that. Well, I'm looking at Shah Metallics. They came out with their quarterly update. It's not a big mover, actually. For none of these companies, it's a big mover. But we're just highlighting it since it did come out. And they look a little bit softish. And since it's monsoon season, going with a tinge of red. Well, specialty alloys, it was a little bit higher on a sequential basis. The realizations were a little bit lower. While for the other products, actually, they flipped it around. Stainless steel volumes, so that was down by close to 18% on a quarter-to-quarter basis. But you did have that the realizations were a little bit higher. And on aluminium foils as well, there as well, volumes a little bit lower by around 3%, but realizations were higher on that front as well. So maybe a tinge of red on this one, though, as I mentioned, not a big mover for the stock. Vivek joins in, though, to tell us about Borosil Renewables. Hey, morning, Vivek.
Good morning. Well, decisive action taken as far as Borosil Renewables is concerned. This is regarding the European operations and the subsidiary that is known as GmbH. So what's actually transpired is that the company has gone ahead and the German subsidiary GmbH has filed for bankruptcy at a German insolvency court. What the company was facing as far as European operations were concerned were very similar to what the Indian operations were facing. Chinese dumping actually going ahead and reducing the demand for German-owned manufacturing. Remember, since January, the furnace has been cooled down due to demand paucity as well as depleted market conditions. What will be the financial impact? The company says the exposure to the German subsidiary is close to 350 crore. They were making a cash loss of close to 9 crore rupees a month, and that is something that will stop effective immediately. Along with that, the company says expenses and cash flow of GMB will now be managed by the insolvency administrator. Just to give some perspective, this was a material subsidiary. 22% of the total top line of FY25 actually came in from this particular subsidiary, but it was loss-making at the EBITDA and PAT level.
Okay, so maybe, the insolvency at least starts, putting things in motion, some sort of logical conclusion. Thank you for that, Vivek. Let's quickly recap our list of top stocks to watch. The ones that have positive news flow would be Godrej Consumer, Jubilant FoodWorks, Kalyan Jewellers, Senco Gold and Nykaa. The ones with negative news flow would be IndusInd Bank, Dabur and Shah Metallics. Bank of India and Borosil Renewables could see a mixed reaction depending on the news. That's our stock list for the morning. Let's do a roundup of all the commodity market action as well. We have Manisha Gupta joining in. Manisha, morning. It's going to be those tariff and trade headlines that will dominate the market's mood. But you tell us, there's also the OPEC meeting. So what's top of mind?
Oh, well, absolutely. I'll start with the OPEC meeting first. And OPEC Plus has accelerated production hikes, citing stable economy and low oil inventory. So you have a number which is much higher than what we were dealing with for the month of May, June and July. So versus the 411,000 barrels per day, you have it at 548,000 barrels per day. The street was absolutely not anticipating that. There was no chance of this number coming in. And that is the reason we've seen the crude oil prices react the way they have. And as you mentioned, it also is going to be about the U.S. tariffs that will take effect from 1st of August. Let us go into how many countries with what tariffs is something that the street will watch on. And then it also has to do with the weak China services activity. That seems to be weighing on many of these commodities. So it's not just the crude oil prices which has started the day on a weaker note. You have rubber prices declining because of the fall in crude prices. Even the gold prices have seen a decline after that weekly gain of 2% in the previous week. Silver is trading lower. Copper, aluminum also have seen a bit of a decline. So hardly any commodity which is trading in the positive at this point in time. We've started Asia slightly jittery.
Okay. All right. Manisha, got it. Thanks for that quick wrap up. Well, now let's revisit, of course, the big story on trade, what impacts us and where we're positioned with respect to our conversations with the US. We have Parikshit joining in. Parikshit, we know that the Indian delegation, the Indian team, I guess, came back from the US. But you tell us, because you've been reporting that there could be some sort of maybe an interim or a mini trade agreement. Is that right?
What we're looking at right now is only an early harvest agreement before the 9th of July. The negotiations on the larger BTA or even the first tranche of the bilateral trade agreement will only begin after the 9th of July. And that's going to be signed during President Trump's visit to India during fall. So what we're hearing right now is that negotiations on that mini trade deal or that early harvest deal are over. Our negotiators have returned. There's no more talking to be done. The ball really now is in President Trump's court, the White House court, and they have to take a call. From the Indian side, we've proposed a fair deal, which would give good market access to India's labor-intensive sectors and MSMEs as well. We've drawn our red lines. India has refused to grant any concessions on core sensitive areas such as wheat, rice, maize, dairy, GMO crops. India has refused to give any kind of market access in these areas. So given that, let's see if President Trump and the White House accepts India's proposal as well. There could be certain agricultural items which are not used in India extensively, like pecan nuts, blueberries. These could be allowed access. As far as automobiles are concerned, we believe from sources that India has offered the same sort of concessions that it has offered to other nations, including UK and European Union in talks. So nothing different. India has made the point that whatever we've offered in terms of automobile tariffs to other nations, such as a reduced tariff of 10% on certain category of high-end vehicles or electric vehicles, as per a quota system, only that is going to be given. We're also learning that in case this deal happens, there will be a mix of both quotas and tariffs. So, for example, India's labor-intensive products, such as textiles and footwear, they could be subject to quotas for a lower tariff, maybe 0% or 2% for a certain number of items for annually, and beyond that, a higher tariff would be imposed. So let's see what kind of contours the deal takes and whether President Trump and Prime Minister Modi even sign off on the deal.
Okay, all right, Parikshit, thank you very much for that. That's an important story for the markets, but of course for the economy as well. We'll continue to get you latest updates on that. We'll take a quick commercial break here. More on the India-US trade talks, and we take some of that forward with Amithendu Palit of Institute of South Asian Studies at the National University of Singapore, coming up in just a bit.
Welcome back. So the big global headline is what happens next on tariffs And, from our context, whether we can get at least some sort of an interim or a mini trade agreement, as Parikshit was just telling us. So let's discuss this forward and India's positioning and stance. Amitendu Palit, Senior Research Fellow at the Institute of South Asian Studies at the National University of Singapore, is with us now. Mr. Palit, thanks very much for joining in. And I don't know if you could listen in to our colleague, but a brief summary for you. What we're picking up from our sources is that big bilateral trade agreement, perhaps those discussions will continue. There might be a small, interim deal, but there are sticky issues, and agriculture and dairy, and the US's thrust to ask for total market access, including GM crops, these continue to be sticky grounds. Your first thoughts on how things stand?
Firstly, Subhi, Prashant, Nigel, great to see all of you guys again. Thank you very much for calling me on the show. This was expected in the sense that if we look back at the timeline of events, when Prime Minister Modi visited the US in February, there was confirmation about the fact that India and the US would negotiate a bilateral trade agreement. The reciprocal tariffs came later. And in the first announcement between PM Modi and Trump, the idea was that a deal will be concluded by the fall of the current year. Now, the reciprocal tariffs, when they were announced on April 9 and then subsequently paused, brought forward the timeline to that 90-day period. 90-day period, and for the United States, it's dealing with some 100 countries at the same time. I think it was impossible under any circumstances to expect that by that period of time, there will be a comprehensive trade deal worked out. So what we are very likely to see is at what you have shared, and I think what Parikshit also mentioned, there's basically going to be a list of items which will be identified on the basis of the tariff rates that have been agreed upon by both sides. There will be negative lists cut out from both of these. On India's side, the concerns have been very well mentioned. On the other side, I'm not sure whether India has been given access over and above what its other competitor partners are going to get in the US economy. Because looking back at what has happened with Vietnam, Vietnam's tariffs are getting a 20% deal, which is not too different from the 26%. And there's a transshipment of 40%. So these are all very vague and gray areas to be worked out. But Subhi, if you could allow me to say that, my anxiety on this is that once you have a deal agreed upon by both sides, there's not going to be any giving up by the US in order to continue to extract market access concessions. And that is where I feel that the US focus will now shift to non-tariff approaches for extracting market concession.
But Mr. Palit, Mr. Palit, sorry, before we come to the non-tariff barriers, and that's something that the US has been highlighting, time and again. Before we talk about that, on tariffs itself, let's also place on the table what's been happening simultaneously. We have moved the WTO on several issues already, in the last 2 odd months, including the latest salvo being on auto tariffs, the 25% ad valorem auto tariff. So there is that simultaneous process going on where India is going ahead and registering, so to speak, its protest while it's negotiating, trying to negotiate a bilateral agreement. So how do we tie in the two?
Problem, Subhi, is that most of the other tariffs, the generic ones, steel, aluminium, auto, the US is bringing in under a section called 232, where it is advancing the national security considerations and the fact that they need to be sorted out on those grounds. What is happening between India and the US separately, like the US and many other countries, is a separate FTA. I think this is exactly where what you mentioned is going to become important. India would want those other generic tariffs not to be imposed on it under the ambit of the FTA. Now, whether the US will agree to that or not depends on what India is offering. So I'm not too sure whether an equivalence will be established there.
Got that. Mr. Palit, hi, good morning. Prashant here.
Good morning.
So, good to see you again. In the very near term, then in this, when we talk about this mini deal, right, could we basically look at, for the sake of argument, like a 2-page document, which kind of agrees on, which keeps the existing tariffs in place, but pushes many things down the road, and for later in that sense. Is that what we're looking at in the near term?
Prashant, we might not even see a document at all in the first place. What we might just see is a convergence of interests, a declaration coming out from both sides that the US and India have agreed to do so and so in the first round with, negotiations to continue. Now, what I think is important to take note is that the United States is doing this with not just India, but a number of other countries. Even if you look at what they finalized with the UK a couple of months ago, was something very similar. Just an expression of interest that do a little bit here, do a little bit there. Whatever India has already done autonomously in the last union budget, reduced a number of duties, anticipating that there will be US pressures. I don't really expect there will be too much over and above that, at least in those sectors where India is keen on guarding its market. I don't see that is going to happen. But again, as I was sharing with Subi, I think my concern is over the fact that what kind of pressures you might expect from the United States through other policies now, including monetary policies, exchange rate management policies, which might be a way of getting more concessions under the belt.
Could you just very briefly detail, one is the foreign exchange route, could you detail sort of 2 or 3 of these routes through which more pressure could be put that you're worried about?
My first concern over is the quality control measures that India has for a number of exports, on which the United States has already mentioned in its foreign trade barriers report that these are very ad hoc and arbitrary. They might want these to be taken out. But more importantly, Prashant, you will recall that the United States has been very sensitive to any efforts which they think is contributing to de-dollarization. Now, the Indian position on this has been pretty much clear in the sense that while not going for de-dollarization, India would want to trade that much more in other currencies, including its own currency. There are groups like the BRICS, where it continues to play an important role for encouraging interoperability of currencies. And the BRICS is on the quote-unquote hit list of the USTR of a large, a gamut of tariffs. I think the pressure will basically now come on India to maintain its foreign exchange rate management policies in such a way that the dollar does not lose its place of prime in any respect.
Okay, so yeah, I mean, these things have an interplay, and now how India sort of deals with that sort of a pressure. We've had an absolute hands-off approach in terms of exchange rate management, driven only by the country's interests. So we'll have to see how this plays out. Thank you very much. Short chat.
You're welcome.
But I think there'll be several ahead as we understand the final realities and the granularities of the India-US trade agreement. By the way, Prashant, when you were saying what will be the format of this mini deal,
I'm very interested in the format.
Could it be the two-page? You know, what's the image that came to my mind? Right. Remember President Trump holding up his placard? Maybe Prime Minister Modi holding up his, saying, hey, this is what we're giving you.
Well, I don't think we'll see theatrics like that by Prime Minister Modi.
Unfortunately.
But yeah, I think kicking the can down the road on many things, and maybe just like a broad structure. And as Mr. Palit said, maybe not even a 2-page document, maybe just sort of some sort of a understanding that, well, this is what we need to do, and this is where this is what we are in agreement with in that sense. We'll see. We don't have to wait very long, as sources were telling Parikshit that over the next 24 to 48 hours, a final decision will be made on whether to sort of, go ahead with that sort of mini deal, if they have that mini trade deal or not. I think Prakash Diwan is with us with what, he's making of things. Prakash, good morning. Great to have you with us here. From a market standpoint, I mean, I was making this point earlier, unless very disruptive, markets are largely unbothered. But what's your sense if you were to kind of sort of pick a sector or two where this will show up and you could see some price moves? I'm talking about the tariffs.
Good morning, Prashant. You're right. I think we could keep discussing what could happen on the tariffs till the cows come home, but the markets will do their own bit. And remember, you just have a few days before the result season starts to kind of emerge, and the market will kind of get to be enslaved with that. From the tariff potential disruption perspective, I think if nothing happens on auto ancillaries, that's an area that could kind of, there's been a lid on most prices, most price volume action, and that could kind of change. We saw how, some of the local triggers for Bosch and all, Gabriel, was kind of playing out last week. and that could kind of, percolate to a wider basket of auto ads. That's one area. The other thing which has not been discussed when we talk about tariffs in the same breath is the pharma pact. There was likelihood that there could be some restrictions on pharma companies which haven't come about. Now, if there's some emergence of that, we'll probably see a little bit of softness there. But by and large, I think the market will continue to march ahead on the anticipation of improvement in numbers. The June quarter updates, while they might be a mixed bag for the banking sector, for example, but some of the gold jewelry companies, some of the FMCG plays, they have started kind of giving some sort of a promise. And if that were to happen, you'll probably see a very strong sector rotation as well, because there are sectors which have still not kind of participated in this up move in the last 2 months. And my sense is the market will probably look for opportunities there.
Okay. Prakash, hi, morning. Good to have you on. IndusInd Bank. So we all know, actually let's pull up the long-term chart as well on the IndusInd saga. The thing is that the business is getting impacted with all of this, and that's what the stock has done. Let's pull up an even longer chart. Yeah, that's 3 months. Now, this is the issue. The stock has continued to rally, and then you get an update which is giving you the harsh reality that all the ongoings of the last couple of months, they're impacting the business, not just advance growth, but look at the CASA ratio. It's fallen 500 basis points in the last 1 year. Your thoughts?
Good morning, Surabhi. So this is quite understandable. We've had a fallout which has been fairly drastic in terms of what impact it has. And the ship has been rudderless of sorts for the last many months. So it's no surprise that some of the metrics will start deteriorating. But what's interesting is that the market is penciling in a hope trade here, that nothing more could go wrong. There's not much of worse news flow that could hit the stock. And whatever happens is going to be incrementally positive, right? So that's the reason why the short-term moves probably look a bit deceptive. But as I told you last time, these things need much more effort, time, resources to repair. We've seen how Yes Bank took so long to really come into the reckoning, where a suitor started wanting to look at it. So I think IndusInd will also have to go through that grind. Don't expect fireworks just because some new CEO gets appointed. I mean, you will have to have a CEO, right? But it won't make such a big difference till the organic improvement happens. So not something which I really like, especially when you have much more promising plays in the same space available, in the same size available. So I would give it a pass.
All right. Hi, Prakash. Good morning. Good to see you in. Prakash, what's the view on Godrej Consumer? In the last few weeks, you're suddenly hearing about positive sentiment on consumer stocks because the street is bracing for a far better year in the second half of the year. Now, Godrej Consumer, their Q1 update itself is a little better than what the street was working with. I'm reading a note coming in from Nuvama. They are saying that they're expecting the gradual recovery from year on. The numbers are a beat. What's your view on the stock?
Good morning, Nigel. No, so absolutely. As I was mentioning to Prashant earlier, that some of the early signs from the June end, updates are looking very positive from a demand revival perspective. Okay, Dabur probably has it, worse off because of the early monsoon, because they have a beverage portfolio which is significantly active and large. But that's not the case with the Marico, Britannia, HUL, even Godrej. So what it does is that if the monsoon is early and widespread and is adequate enough for this timeline, it sets a base for a much longer, much stronger festive season or post-harvest season, right? And that's exactly what most FMCG companies badly need. The other thing that's very interesting is that we've not had any raw material disruptions in terms of price hikes, in terms of grammage reductions, all of those related things which we saw 18 months back. So the companies have digested all of that, tightened the belts. They've learned to live with the realities of poor demand or tepid demand. And now I think the margin improvement will be fairly smarter than what we expect. The volume growth will take some time to come, as I said, post-monsoon, but the margin improvement will be fairly sharper. And that's exactly what will start getting worked onto the prices. My sense is FMCG is not performed from a sector rotation perspective, especially the larger ones. We'll probably see a lot of money getting allocated to it over the next couple of months.
Absolutely. FMCG, consumer, so that's a space to take note of. We'll talk more about this. Prakash, stay with us. What we're going to do is take a quick commercial break here. 8 minutes to pre-open session. Chandan Taparia and Mitesh Thakkar will be with us with some technical trading ideas coming up.
Welcome back. Well, as promised, we have our technical experts, Chandan Taparia as well as Mitesh Thakkar, who join us for a technical check on the markets. Good morning, gentlemen. Mitesh, you go first. In Friday's trading session, we went down to around the 25,330 mark and we saw a good bounce from there. What's your view on the markets from here on? Do you think we have more to go on the upside? The problem is there's still plenty of uncertainty on the trade front.
Morning, Nelly. So my understanding is that in the immediate term, the upsides will be capped. Getting past 25, 650, 700 zone would be difficult. And having said that, I think good chance that we'll see some consolidation in which the markets could either decline to 25,400, which we have already done, and even to about 25,200. So I think preparing that, there is a chance of us possibly testing 25,200. Only beyond that, if we start declining, below these levels, then we'll be worried about the trend in force.
Got that, gentlemen. Morning, and good to see you both. Chandan, you go next. What's the call and what's the overall view from here?
Yeah, good morning, Prashant and Nigel. Thanks for having me. So we witnessed some profit booking decline in last 3-4 trading session as index has been making lower top, lower bottom on the daily chart. But major trend is intact to positive as we have seen a decent run up in last couple of weeks. A couple of days back, index gave a breakout about 25,200 marks, and after that, it rallied well by more than 400, 500 points. And now it has come to the same zone. Even on the Friday, it formed a hammer sort of candle, which indicates the declines are being bought. So I believe that 25,200 could act as a major support. And with this support, we will continue to be with buy on decline stance. And if market negates the lower top, lower bottom, then again, it can rebound to 25,650 to 25,800 level. So with the support of 25,200, I would suggest to go with buy on decline stance in the market as India VIX is holding near 12.5 levels and put call ratio is clearly getting stability apart from other data internal. Looking at the bank Nifty index that is slightly underperforming, but holding the key support zone. It took hurdle at the upper band of the trading band, but at the same time, 56,500 could provide as a key support for a recovery towards 57,500 to 57,750 in the banking index.
Okay, all right, got that. Hi, Chandan. Good to see you as well on the show. Mitesh, you go first, though, with regard to stocks. What's on your radar?
Yeah. I have a mix of buy and sell calls. On the buying side is BPCL with a stop at 340 for targets of 360. GMR Airport is a buy with a stop at 88 for targets of 94. And IIFL is a buy. keep a stop at 468, look for targets of 485 here. And one sell call, that's Angel 1. Sell with a stop at 2105 for a short-term target of 2700.
Okay. Chandan, what about your trades?
Yeah, so for my side, first is buy on IOC, Indian, or positive on the oil marketing company. So Indian Oil is the first trade with support of 147, expecting the target towards 159. It has given a range breakout on the daily chart and witnessed higher than average trading volume with sustained buying interest. In fact, we have seen support of 50-day exponential moving average and longs are being added. So expecting 5 to 7% run up in the counter, apart from some buying in HPCL as well. Second trading idea, that is buy on Muthoot Finance. It has seen a consolidation breakout of last 14 trading session. Longs are being accumulated with sustained put writing. So one can buy with support of 2600 for an upside target towards 2800. Last trading idea, that is buy on HL, Hindustan Aeronautics Limited. We have seen positive price setup in most of the defense companies, and HL is one of the strongest counter, which has given a consolidation breakout on the daily and the weekly chart. In fact, it has given a decisive hold above 5,000, which could see the next leg of rally towards 5,200 to 5,350. So one can buy with support of 48.85 for an immediate target of 5,200 marks.
Okay, all right. Thanks a lot for that, gentlemen. For the time being, though, we'll slip into a short break. You come back, we'll get you the pre-open rates. We'll also be discussing all things defense. Harshad Kapadia of Elara Capital will be joining in.
Okay, welcome back. There's what 14 minutes to go for the market open, and we are just getting into it. Prakash Diwan is still with us. Prakash, we had Mitesh with a sell call on Angel One earlier, a technical trade, but I mean that kind of sort of gets me to the capital market pack of names. Novama was down sharply, BSE was down sharply, Angel lost about 5-6% on Friday. What's your view? The Jane Street impact. But it's not just Jane, right? I mean, other similar players perhaps could also not be under scrutiny. We don't know for sure for now, but they could pull back in terms of activity. What is your sense?
No, I as I mentioned on Friday when the news broke out, there will be an impact on this because the activity levels will drastically get subdued, and there will be a shift into other asset classes or other sub-asset classes, if you will. Which means that some of the brokerages will get directly impacted. But, the entire complex of capital market plays has much more to offer than just brokerages. And those are the ones that are getting exchanges. Brokerages might get impacted because of volume shrinkage. But if you look at the mutual fund side, it continues to be very steady. It gets much more efficient. You have funds now launching international funds as well out of the GIFT City. So, that's the space you could probably latch on to. So whether it's a CAMS or K-Fintech, it's your choice in terms of what you like. They have different portfolios and there is differentiation. So depending on what an investor likes, you could choose out of that. But my sense is AMCs and all of these activities will continue to offer very good opportunities, which are long-term, secular, and fairly undisturbed. So it's just one pocket of the market that's likely to get impacted, but the other opportunities continue to be strong.
Okay. All right, Prakash, we'll leave it on that note. Thank you very much for joining in. Good to get all those thoughts in today. It's just about 9 a.m., so we'll start reflecting the pre-open rates. In fact, let's pull up the implied open. Nifty is down 110 points right now, which is a little worse off than what the implied open was telling us. That was showing a 50-point downtick. Let's see. It'll settle. In the meantime, let's put the spotlight on the defense sector. Now, we remember the news on Friday. The Defence Ministry has cleared 10 different proposals worth over 1 lakh crore rupees, 1,05,000 crore rupees to be precise, to buy weapons, military equipments, a lot of the surface-to-air missile systems, a lot of different procurement. Now, what does this mean for, again, stocks? And stocks are also getting quite excited with this news on Friday. We have Harshit Kapadia, Vice President Defence at Elara Capital, joining in with some perspective. Harshit, thanks for joining in. If you had a chance to look at the nature of these defence acquisition proposals, who are the likely beneficiaries? I mean, it's the usual names, I guess, Bharat Dynamics, etc. But tell us more.
Yeah, morning. So in this 10 proposals, there are 3 major proposals which has caught an eye of this 1 lakh crore. First is the SAM missile, which is surface-to-air missile. Though it is not explicitly mentioned what category of the SAM missile is, we understand this is quick reaction SAM missile, QRSAM. The size of the order is estimated to be 30,000 crores, and the key beneficiary of this particular project is Bharat Electronics, Bharat Dynamics, and Astra Microwave. Apart from that, there is a mine countermeasure vessel, that is MCMV. That is another project of upwards of 40,000 crores, and we have shipbuilding companies who could be beneficiary. Goa Shipyard could be leading this entire pack of 12 such MCMV. Apart from that, 2 smaller projects, which is armored recovery vehicle, that is close to around 4,000 crores, and here the biggest beneficiary would be BML, followed by AVVNL, and would be Bharat Forge. Apart from that, there is other weapon system called as Mood Mines, where we think the beneficiary would be 2 companies, Bharat Dynamics and Apollo Microsystem. Here the size again would be around 4 to 4,500 crores. So these are some biggest projects which have been announced of this 1 lakh crore. Apart from that, there are smaller size projects coming from electronic warfare systems, etc., where Bharat Electronics could be the other beneficiary along with Data Pattern, Astra Microwave.
Harshit, good morning. Is this all new? When I say new, I mean, was some of this penciled in by the street that this was coming and has been announced, or this is all kind of new in that sense, and it'll lead to earnings upgrades?
So this Defence Acquisition Council, meets once in a month, and this is where we get to find out all the proposal which can come in or can become an order inflow in future. It generally takes around 12 to 18 months. Out of the list of 10, QRSAM was anticipated, but others were not anticipated. We just heard that these would be coming in future, but most of this were most of surprise for us, as far as the list is concerned. But QRSAM was anticipated within the 10 list.
So which companies will actually see estimates change because of this?
So 2 companies may see an estimate change. Bharat Dynamics, that would see a much more positive order inflow momentum from here on. Apart from that, Bharat Electronics may see some upside because of their role in most of the system, whether directly or indirectly. So these are the 2 names which will be the biggest ones.
All right. Hi, Harshit. Good to see you again. Harshit, what's your top buy call from the sector?
So my top buy call is Hindustan Aeronautics from the defense sector, and on the private side, it is Zen Technologies as far as defense is concerned. But apart from that, we also like Bharat Electronics on the PSU side. As in on the defense side, though we don't cover it, but we still like Data Pattern and Solar Industries on private side.
Right. The private side, Zen Technologies has been a stock that's done very, very well. However, the cash from operations are still negative. They've been promising that will turn around this time around. What are you penciling in terms of earnings, cash flows as well for this year?
So I have penciled in around growth of around 10% as far as revenue is concerned, given that the ministry was not able to give out orders which was anticipated in Q4, and even in Q1 we are not expecting a lot of orders to come. Probably in Q2 is where the order inflow will come, and hence the execution may be a bit slower in the second half because of not high order inflow base. So that could be a bit of a challenge for Zen. But the two technologies which they are largely involved in, the simulation and anti-drone system, is in high demand, not just domestically but also globally. And we will see the order inflow rising probably the second half of this financial year, and that may see a further upside for Zen.
Harshit, did you see this news report? It says that the government is going to launch about almost a $250 million incentive program for drone makers. Did you sort of see this one, and any thoughts on this?
So yes, so government is looking to incentivize drone, because drone equipment had some of the other way component coming from China. And given that we are in the midst of two great wars which have happened, and what we have learned from the war has been what new systems or new age system is the requirement, and hence the government is looking to further incentivize apart from the earlier PLI which was given for the drones manufacturing.
The problem with drones, though, Harshit, has been that there is no way to estimate like a TAM, right, for the sector. I mean, can you estimate the size of orders every year? It's not possible. I mean, it's kind of ad hoc, right?
Yes.
But this does show focus for the government is, and of course, I mean, the other one was, I don't know if you saw this again, that the unmanned aerial vehicles, some $470 million on UAVs. I'm not sure this is. I think this was another program for local industry, etc. So we're talking about some pretty large numbers here.
Yes. So see, the kind of the wars which have been fought, and what the equipments which have been used, the government is trying to revamp its overall modern equipment portfolio, both on the unmanned aerial side as well as on the underwater weapon system as well, which could be autonomous. So on both front, government is looking to add more numbers. The recent conflict also showed us that this is the future of the war. There is no one single product category within the drones where one can say and try to estimate a size. So TAM would be something which is very difficult because it's only a rising market. So nobody is not sure on the TAM side, but it's going to be a big market for sure. And given that there are many manufacturers of drones in India, so it would also be difficult to pinpoint only one company who's getting majority of the order. So there will be a new company who will always be getting one or the other order. That's why drone has become more of a commodity market.
Yeah, okay, that's interesting. And you said that Zentech and Solar are your top picks in the private sector side, and on the PSU side, it's BEL. If you could just recap the name.
So on PSU side, it is Hindustan Aeronautics and Bharat Electronics are top picks. On PSU side, it is Zen Technologies followed by Solar Industries.
Got it. Those are the four top names as the defense juggernaut continues. Thank you very much for that. Good conversation as always, Harshit. Good to get that perspective. Okay, let's get back to the market now that the pre-open has settled. And well, starting with a 100-point drop, now the Nifty in the pre-open is down just about 10 points. So let's see how this plays out. We have our trading experts back with us for some ideas. Mitesh, your 9-10 call?
Yeah. I'll go with the BPCL as a buy recommendation for targets of 360.
Okay, got that. In fact, I'm just checking if there's anything else noteworthy, what's sort of really pointing out in the pre-open. Not really. Trent, Nestle, some consumer stocks are doing pretty well. Actually, speaking of consumer, let's just revisit some of the key updates as well that came out. Dabur, Godrej, Jubilant, etc. Mangalam, run us through the most important ones again.
About Dabur as well as Jubilant Foodworks, because those were the most important ones in terms of what the street was expecting versus what these companies have delivered. Dabur, they've said that, they saw sequential recovery in demand along with an uptick in volume growth, but the consolidated revenue was impacted by the beverage portfolio, which saw a big gash on account of unseasonal rains and a short summer. Remember, beverages account for around 10 to 12% of their overall revenue. So if that has fallen a bit, that has led to the consolidated revenue expected to grow in low single digits as against mid to high single digits, what other companies have reported. So to that extent, we'll expect Dabur to see a red opening. But thereafter, could there be recovery? Because the company believes that their other verticals, home and personal care as well as the healthcare business, have done well, and they are likely to improve going forward as well. So will there be a dip, and will that dip be bought into, is something I'll watch out for. The other one is Jubilant FoodWorks, 11.6% like-for-like growth, 18% growth in the India business, and them having added 60 Domino's stores in the country bodes well for them. This is the third straight quarter of good growth coming in for Jubilant FoodWorks. The stock has seen a rally already, very close to all-time highs, previous all-time highs. Will there be enough valuation headroom for the stock to move further higher on the back of these numbers is another thing that I'll be tracking today.
Okay, all right. Thanks a lot for that, Mangalam. Let's hop across to Vivek. He had that big exclusive break on Friday. Let's revisit that story. Vivek, take it away.
Well, a quick follow-up, to the story we did towards the closing as far as Friday was concerned. Remember, on Friday we had reported that the listed Bosch entity in India was looking to fold into itself two key unlisted entities. The two unlisted entities were Bosch Chassis Systems, which holds the key ABS systems or the anti-brake, anti-skid braking systems business in itself, and the other one was Bosch Auto Electronics. Now remember, Bosch Chassis Systems actually has the highest market share as far as the key ABS system was concerned. We had written to Bosch, while they did not respond to us on Friday post-market hours, Bosch uploaded a response to the exchanges where they have said that they do continue to evaluate various strategic opportunities in the ordinary course for growth as well as expansion of its business. They said that there is no material event or information that requires disclosure at this particular stage, but we'll continue to track for any developments on this particular front.
Okay, all right. Vivek, thank you very much for that. So that is Bosch for you. Just about, a minute to go for the market open, which should come up in just a bit from now. So we'll just track some of these stocks in the pre-open and where they've left off. Maybe just look at the capital market plays as well, if you can. If you have time to pull them up, BSC, Novama, Angel One, etc. And I think we should be going into market opening quickly. Angel is down about a quarter. And Novama is absolutely flat. You've got, I think, BSC, which should be unchanged as well. So nothing very much big impacts, though, on Friday. What do we have? First rates coming through. Before we go any further, we'll have this. We'll have the index rates coming up. Nifty 25,460, absolutely flat. The Nifty Bank is down about 0.13%, 56,960. Sensex 83,300 and 83,350, 340. The small cap index is absolutely flat as well. You've got very, very subdued kind of rates coming through. So a quiet start. Will it be quieter markets is the question as we go forward. We'll see. But for now, it's not very much at all coming through. The Nifty heat map will give you a quick sense of what's up and down in the Nifty. I mean, the majority is down in the red, and you got a few winners up in the green as well. HUL trend reliance. For the Nifty, it's about 20-point cut right to the word go. Surabhi.
Actually, some of these Q1 update results are very, very interesting. Godrej is getting the full marks. It's the best performer in terms of all the weekend Q1 updates that came in. Almost 5.5% higher. Keystone's numbers are very good as well. Keystone's up 4%. But look at Jubilant. Jubilant, the numbers looked okay. Q1 update, 11% Domino's growth, but stocks down about 2%. Anyway, more on the updates in just a bit. Let's talk about what's moving the large cap screen. We're 40 points down on the Nifty. BEL, Tech Mahindra, IndusInd Bank lower by about 1%. IndusInd Bank also lots of issues on the business side. I mean, the stock's fairly resilient actually. If you judge by the metric of just what they've done in the first quarter. But anyway, that's IndusInd. HCL Tech, Shriram Finance, Bajaj Finance. Financials are again weak. I mean, banks and non-banks. ICICI Bank, lots of weakness over here. Early weakness that we can spot. Tech Mahindra, Wipro, Infosys. So even IT is not really firing up for the bulls today. At least not at this point in time, early in the morning. So let's see what's holding up the green side. It's actually all consumer. That great consumer trade has begun, and this is what we discussed a lot, even in the editors' roundtable yesterday. Nimesh had put out a piece. Now the question is whether this trade will really reach its logical conclusion. HUL, Asian Paints, Trent, Nestle, Tata Consumer. I'm reading on the top 5 names on the Nifty, and they are all consumer. So that's where the market focuses. That's where the expectations are running high, and we'll have to see if the companies can deliver.
Well, that's right. And let's focus on a few names then. The OPEC Plus cut was actually OPEC Plus hike of crude production was 30% higher than what was expected at around 570,000 tons barrels per day. In fact, the expectation was around 410,000. So you have HPCL actually that's open gap up. So keep an eye out on that one. Besides that, Godrej Consumer, Nuvama said that they were quite positive on the revival, and the evidence was in the numbers as well. They're expecting things to bottom out. That stock's clearly flying away. Dabur, with the numbers didn't look so good, well, that stock as well is higher. Dream folks, we did see some fund-based selling. And that stock, in fact, has now gone to around 180 rupees, falling on massive volume, 6.5% lower. In the last 45 days or so, the stock has lost close to around 30% of its market cap. So big downtick is what we're seeing on that one. Kalyan Jewellers, well, the numbers look pretty okay, but the stock has come in for some profit taking. So that's down close to around 2%. DCX Systems from the defense names, well, that's moving higher in relatively large volumes. Close to around 3% higher. Volumes much higher than what we normally see. So big up move is what we're seeing on that particular name. The other one that's moving well, Sirca Paints. We don't normally talk about this name, but that stock, in fact, is higher. And Axis Gates as well is up close to around 5%. And that's been moving on a periodic basis on circuits. Keystone Realtors, Rustam Ji, the reason that the stock is higher is because the pre-sales have grown by 75%. Remember, they've already clocked 1,000 crores. Last entire year was around 3,000 crores. So the street likes that. Also, business development in the first quarter, they've added 3 new projects, GDV of around 7,700 crores. That's surpassing the entire guidance for the year as well. So on the back of that, that's holding with a gain of around 3.5%. Thumbs up on that name.
Okay.
By the way, Nigel, do you mention Borosil Renewables?
No.
Very interesting, and that's what we were pointing out. There is the German subsidiary that's filed for bankruptcy, but why is the stock still up? Because it's a sense of relief and maybe a sense of completion, and let's move on beyond this, because it was a loss-making entity. I think Borosil's exposure was over 300 crores to this, and maybe the market is seeing as some finality and then moving on to the repair work. Prashant.
Absolutely, and more on Borosil, and we'll of course try and get in touch with the management as well as we go along. What do we have on the downside? It's interesting. BEL is the top volume-led loser. It's down 2%, and Paras Defense is down about 5% as well. Now, it's not. I mean, defense in every country is very different. But last week, the best performing defense pack in the world has been Korean defense companies. They were all down. There was that entire pack, the index was itself down some 8%, Friday to last Friday. So, we'll see. Here, of course, news flow has been positive, but stocks, of course, have run up in some cases far ahead of the news flow. In any case, there's this order-related tailwind here. We'll see. Angel is down 2%. There was a call from Mitesh which came in earlier. Kalyan Jewellers is down 1.5%. Jubilant Food is down about 1.7%. Indus Tower is down about 2.5%. Garden Reach is down about 1.5%. Dream Folks, Nigel mentioned 180, down about 5.5%. Credit Access is down about 1.33% or so. Deepak Fertilizer is down about 2%. But then after that, volumes really fall off a cliff. So just there's serious volumes, at least out of the gates, in about 10, 12 names. That's it on the downside, but more on the upside, but not really that much. IIFL is coming up. It's almost nearing that 500 rupee mark after a while. So IIFL has seen a fair bit of repair and recovery over the last few months now, actually, last 4 or 5 months now. Relaxo is coming up. That's the chappal maker, 6% higher, 492 on Relaxo. It's the 4th largest volume-led gainer on the NSE. So it's price gains plus volumes. Shipping Corporation of India is up 3.3%, and Godrej Consumer is up 5%. That's the largest volume-led gainer, which is coming up right now. So more on this as we go along. But for now, it's Nifty back in the green, but just about 10 points or so. Still pretty quiet, 24,472. Manish Sontalia is with us now, Chief Investment Officer at MK Investment Managers. Manish, good to have you with us here. Thank you very much for your time. let's just sort of dive straight into the capital market plays, which has been such a darling for the street for obvious reasons. Do you think that trajectory, especially not for all, but for some, not obviously for the wealth guys, etc., but for some gets dented because of the regulatory actions we've seen? It of course started with on the F&O side, but now we're seeing it on the Jane side, etc., as well, and I think needed. But there are secondary implications as well. What's your sense?
So, Prashant, I think it's just a blip. Capital market plays a strong place going into the medium and long term. Of course, there's a knee-jerk reaction on the downside. Exchange volumes are going to fall 4-5%, to say the least. But I think newer players are also going to enter the F&O space now that this one entity, would be out, and there'll be normalcy in terms of the trade patterns, etc., on the exchanges. And given the fact that March onwards, you have seen a very strong capital market rebound, which is going to have a rub-off impact on your earnings for the first quarter as well. All capital market entities are going to report better than estimated numbers. That was the case in the fourth quarter when the markets were really down. So all in all, I think the capital market plays are a very good buy on dip, and obviously the RTAs, the online brokers, the depositories, they would all be fantastic plays. The wealth management guys, yeah.
Okay. Manish, hi. Thank you so much for joining in. I want to straight away get to you on this whole consumer debate, right? Because we were just saying this, and this has been building for a while. The market's big hope on the return of the great FMCG juggernaut. I mean, if not FMCG in some format, I'm saying, bottom or middle of the pyramid consumption, because till now consumption is only top of the pyramid. Expensive watches, jewelry, top dollar apartments, etc. Do you actually see the bottom of the pyramid consumption coming back? And if you do, then what sort of stocks would you be looking at?
So, I've been maintaining for a while that consumption is going to make a comeback. The pendulum is going to shift away from investment-related themes to consumption-related themes, thanks to the government's impetus on providing income in the hands of the middle class. That was not the case over the last 2 years, where they have been beaten down heavily by inflation as well as very high taxes. Come this financial year, obviously you have 1 lakh crore savings in income tax, which will create a multiplier on the consumption side, more on the discretionary consumption side, and also on the rural consumption side, that we are seeing that, rural economy has turned a corner and monsoons are pretty decent. So even that is going to have a positive rub-off impact. And obviously the consumer names, you can deal with anything. Of course, one needs to figure out where the consumer would primarily have preference first. So it could be your, travel, it could be your hotels, QSRs, you could be dealing with automobiles, personal vehicles, health insurance. These are some of the consumer discretionary gains which are definitely going to benefit. Of course, you have another added impetus coming from 1st April 26, which is the 8-day commission. So all in all, the consumption names have not done well over the last 2 years. Now it's the time to actually, for them to actually have an outperformance going forward.
Hi Manish, good morning. Good to see you, Ben. You don't shy away from stocks as well at times, and on a periodic basis, every conversation you've given us one. Star Health, I recall, it was the one that people were not looking at. You said, post the correction, valuations and the business itself seems to be looking up. And that's been actually a contra call that's worked very, very well, if someone heard you. But the question is, today, what are you going to be telling us? Which is that stock that you're actually looking at, which, could have underperformed, has valuations in favor, and prospects look up from here on? Please go ahead, Manish.
So, Nigel, ever since RBI has given a front-loaded rate cut, pretty heavy dose of liquidity, I think some of the, the capital market players, and we alluded to the names, the all well-known names, these would do well. You will have the real estate. So the whole thesis is that markets are going to overshoot fundamentals. And obviously, we are closer to now all-time highs, and they'll be overdoing things. So asset price inflation is basically the major theme going forward. Plus combine that with consumption, which is basically having a fundamental thing. So all the real estate names, the NBFCs, you have many of the NBFCs, the housing finance companies, not the PSU ones, but the private sector ones, which are projecting 20% sort of a growth available at, let's say, 1.5 times PEG, so on and so forth. Or you'll have, let's say, the public sector banks per se, which are available at very decent valuations. You'll have the infrastructure need, which gets boosted due to lower cost of capital as well as benign commodity costs. So these are some of the areas where I think, the new underlying bullishness would come through just because of the RBI's action very recently.
In each of these themes, you want to give us one particular name?
That's difficult, Nigel. You know the regulatory constraints.
Manish, just to go back to that point on consumer, since you're convinced that there is indeed going to be a pickup again, but what would be the best ways of playing it? Would it be plain vanilla FMCG? Should it be, two-wheeler companies? What else are you looking at? Could it be QSRs, for instance?
Hotels, consumer tech, look at QSRs, you look at fast fashion, retailing, whether food retailing, whether apparel retailing. These are some of the names where you have fantastic names available. Jewelry retailing, to say the least. Ethnic wear retailing. These are some of the names which will benefit. And as far as FMCG side is concerned, let me give you some insights. One insight, basically, which I have gathered over the recent interactions, is that, D2C is hitting the incumbent FMCG companies in the urban markets. And, there is heightened competition in the urban, because FMCG broadly are areas where things are very, very penetrated. You have the soaps, the toothpaste, etc. So how do you beat the D2C, which is really competing in the urban space? So FMCG, those players which are actually focused on the rural space would tend to benefit more. Because there you have lesser competition from D2C per se. And, if the rural economy is turning, then FMCG players focused more on rural areas are likely to benefit.
Yeah, no, okay. FMCG players focused on rural areas where there is lesser competition from some of the D2C players is what you're focused on. Actually, my question was consumer. Anything else consumer apart from FMCG? If there is this consumer pickup, which has been long awaited, but which is not really materialized, anything else? Any other segments you're focused on?
Hotels. Hotels are going to benefit magnificently. Anything to do with travel, and hotels basically are the business of managing sleep. A guy has to sleep at night, and look at the number of passengers traveling every day. 5 to 6 lakh passengers traveling by air. You have 1 crore passengers traveling by train, and you have 1 million passengers traveling by road. Now, assuming half of them actually stay with the relatives, the balance half have to sleep at night. And this would include all the unorganized guys, the Oyos of the world, the Airbnbs of the world. Plus, you have just the number of organized hotel rooms in the country, anywhere between 3.5 lakh rooms. And supply of hotel rooms can't exceed more than 5 to 7% every year. Just you see the demand and supply gap that is existing as the economy grows between 6.5%. We are not only talking about leisure travel, we are talking business travel. And look at the occupancy rates, 70% plus. Tariffs are on the up move. And, you have the ARRs, which are...
Yeah.
No, and you just got to...
No, but Manish, the story, no one can debate the story and the potential, because I think it's a reversible change. When we talk about where we want to spend the money, I think taking a holiday or a short trip is the first thing that comes to people's mind. The question is on valuations. Where do you see valuations? Are they comfortable, not? Indigo's, for instance, at all-time highs.
No, so Surabhi, you got to actually figure out the certainty of the earnings coming through. And in the case of hotels, of course, you could debate that last 2 years rate of growth might not come through in the current year. But can you see the next 5 years of growth come through for the hotel space? It is a given that given the demand and the supply mismatch, I don't really think valuations are going to come off very, very easily. So you'll have to basically have a waiting game as far as you're making money from the current price levels. But there is higher degree of certainty that valuations won't correct massively. So you'll have, let's say, the leader in the pack, then you have to figure out the discount vis-a-vis the leader. But it all boils down to growth, the margins, and I think margin certainty looks pretty okay in the current scheme of things. So, yeah, the valuations are not very cheap. So is the case with, let's say, hospitals. The demand and supply gap is just too big. Are you seeing any comfort in terms of near-term valuations for hospitals? No. But are you seeing growth come through for the next 3-4 years? The answer is a yes. We'll have to wait.
Hotels and hospitals, huh, Manish?
Yeah,
or both,
absolutely.
or hospitals like hotels?
Yeah,
Just joke.
both of them
I'm
are
just joking.
business
It's,
of,
but,
setting out your real estate.
no, real estate. And you got to sleep, as you said. Interesting conversation. Thank you very much, and we'll sort of pick up on some of these points as we go along in the future as well. I think we have the next management. IKS Health Services is with us. They've done an acquisition, and now the company is with us to talk about that acquisition. So let's bring in Sachin Gupta, founder and CEO at IKS. Sachin, good to have you with us here. Good morning. Just take us through this acquisition. Is this a different segment than what you do? Because what I read is this: they kind of sort of upstreams the alignment with physician group via what is called the MSO, which is what you've acquired, Management Service Organization. So very simply, what you do and what this company that you've acquired does, and what are the benefits? Go on.
Good morning, Prashant and team. Thank you for having me. So essentially, this is a joint venture where we have acquired a 48% stake in this management services organization that essentially is going to provide all the administrative services necessary to run this about 100-odd doctor physician group that is in the Pacific Northwest, just outside of Seattle. And it really is a part of our larger strategy to go upstream. And if you don't mind, I'll take a minute to explain why we even came up with that strategy. But if you really think about it, the US healthcare market has consolidated rapidly. The physicians, there's about 950,000 physicians in the country. And it was a highly fragmented market when we started the business. 60% or of those 950,000 physicians existed in groups of 5 or less. Fast forward 18 years, more than 60% are now in consolidated entities, either owned by private equity or owned by large hospital systems. Unfortunately, the key drivers of those consolidation, which is to lower total cost of care, improve quality of care, improve access to care, and improve the patient experience. When you look at those metrics, the consolidation hasn't been able to truly service those key metrics that would improve healthcare. In parallel, IKS built our platform, where at the deployment of our platform, these physician groups, one, are able to reduce provider burnout, improve physician-patient engagement, and hence quality of care, and fundamentally transform their own economics by deploying our platform, which produces nearly 1,000 bips of incremental margin over what they are able to produce after paying for the platform. So, by the courage of conviction that we got from the transformational impact of our platform and the macro in the industry where consolidation hasn't really worked, this is our first attempt to go upstream and say, not only will we deploy our platform in the physician group, but we will now create a second pool of economics for ourselves where we will participate in the upsides that are going to be created through this joint venture entity. And in this entity, what will happen is we will own about 48% equity, and the overall revenue of the medical group will be split in a way where nearly 63% of the revenue accrues to this MSO, in which we own 48% stake, and the balance 37% will be going directly to the physicians to pay for their compensation. And then as we deploy the platform through the MSO to the medical group, we will then start seeing the benefits of the platform accrue in the MSO. And hence, now the one pool of the economics is the economics created in the MSO entity, and the second pool of economics is the traditional economics that we will create in the IKS P&L through the deployment of the platform via the MSO.
All right. Hi, Mr. Gupta. Thanks a lot for joining in. Just a simple question. IKS has been focusing on improving margins. I think they scaled past the 30% odd mark. With this MSO that you're talking about, how does it change the margin trajectory from year on? And will it contribute to the upside?
So, Nigel, what we've essentially always said is that we are on this journey post our acquisition that we did in October 2023, prior to which our margins used to be north of 37, 38% EBITDA, which came down to blended margins of about 24. We said we were back on this journey to bring the margins towards the early to mid 30s. If you see our Q4 results for the last fiscal year, we'd already hit a north of a 31% EBITDA margin. So we were ahead of that plan. We think there's still a little bit of runway left in that plan, which I've said publicly in the past. And so there's nothing new that I'm saying here, and we're in the quiet period. But I think we're in that journey of sort of settling somewhere between the early to mid 30s in EBITDA margins. And this deal doesn't fundamentally impact that trajectory. This deal, obviously, there'll be another set of economics created in the MSO in which we own 48% interest. But the traditional margins for IKS will still continue to be in the range, and that the trajectory that we are going still on, which is to get to the sort of early to mid 30s in the next, say, 12 odd months, we're still very confident of achieving that.
Manish, and what about revenue growth post this acquisition?
Revenue growth, I've always said, Prashant, that the market's growing at 12%, and we look at ourselves as a 15, 20-year growth story from here in a very large TAM, and we believe that we'll continue to grow faster than the market on constant currency terms. Whether now in some, this business isn't as predictable where every quarter is going to be linear, but my whole idea is we will definitely grow north of 12% constant currency, even better on actual currency. And, some quarters will be significantly higher, some quarters will be in that range, but we're confident of that sort of long-term earnings growth trajectory of north of 12% and non-linear growth in margins relative to the growth in revenue.
All right. Mr. Gupta, quick question. I'm just looking at your cash flow. Free cash flows, they've been moving up. Your net debt number as well has been gradually coming down. So you're going to be having a bigger cash pool to spend on. What's it going to be on? What kind of initiatives are you going to take? Is it going to be on technology as well? If you could give us some kind of insights.
Yeah, I think the two drivers of investment, Nigel, will continue to be, of course, we are continuously increasing our technology spend, even though we don't, for the most part, capitalize our R&D spend. If you see our R&D spend over the years, above the EBITDA line even, it's gone up from the 2-3% moving towards 5%. As we continue to make our big investments in AI, that spend will continue to go up even as our revenue increases towards the 5-6% mark. The other big investment really from a cash perspective will be strategic initiatives like this, right? We've invested $17 million in this deal to acquire the 48% stake. We will have the ability to invest more if we want to in this deal. And our idea is if deal constructs like this truly start to work out, we're going to try 2 or 3 of these, then it fundamentally changes both the positioning of the business and the upstream opportunity that we create for additional growth. And so I think it's strategic alignments with customers like these, and then continued increased spend on the P&L in technology, as well as we'll continue to do some potential tuck-in type early tech acquisitions. Those would be our primary uses of capital.
Okay, all right, Manish, thank you very much. Shorter conversation, but we're on a earnings treadmill, news flow treadmill today. Thank you very much for joining us, and good luck with that acquisition. More later. Let's shift focus back to the defense space, right? Defense stocks all in focus, lots of tailwind. HAL is perhaps the most loved of the defense names, really. They've given a 8 to 10% revenue growth guidance for FY26, is aiming for 14 to 15,000 crores in capex over the next 5 years. My colleague Mangalam caught up with DK Sunil, chairman and MD at HAL, to talk about their growth outlook, and began by asking him where the company stands in terms of order inflows. Listen in.
Basically, from the 97 LCA order, which is going to be big, upwards of 60,000 crores. So that's the big one which we are now working on, and we expect to close it this year. On an average, we do about 20,000 crore of RMSO orders, which are the regular repair maintenance orders. This year, we will be shortly closing a 2,000 crore order for the Dorniers, which is in the final stages. But the year, we hope we will be able to bring in that kind of number, about 1 lakh crores.
Right. Very recently, the Defense Acquisition Council also went ahead and announced procurement plans worth nearly 1 lakh crores. Does HAL stand to benefit from that?
Yes, in fact, one of the items was the Sukhoi 30 upgrade, which is a upgrade of the avionics for about 84 aircraft. So this was earlier cleared in the DAC, but there was some clarification which got cleared in this DAC. So now the CCS paper will move. This will be a very big R&D effort for the Sukhoi 30, which will take about 5 years to complete. And 84 aircraft will be upgraded, and that will, production will, the overall and repair and the upgrade will pan out after 5 years. And it's expected to be about 65,000 crores.
All right. And you've also bagged a 156 unit order for LCH. When does execution begin on that one? And what is the annual run rate that we can expect from the Tumkuru and the Bengaluru plants for this one?
The contract was signed in March this year, March of 25. So 3 years is the start of production. So FY28, the aircraft will start rolling out. And we expect to produce at the rate of 30 aircraft a year. So the whole run will be completed in about 6 years. The split will be mostly, it will happen in Tumkuru now. Initially, a few will be built in Bangalore facility, but we will move over to Tumkuru, and the helicopters will be built predominantly in Tumkuru. We already have started producing the LUH there. So the facilities are up, and that will be expanded to cater for the LCH also, which is the Prachand.
All right.
We expect to close it in 6 years from FY28 onwards.
6 years from FY28. You did say that there is maintenance, repair, overhaul of almost 20,000 crore rupees coming every year. Not only that, you're also looking at some sort of MRO for civil aviation. So just wanted to understand your own vision on how much do you expect MRO to be as an annual business for you going forward?
I think we are still taking baby steps in the civil MRO. We have tied up with Airbus, and we are getting our facility and people certified at the Nashik plant. And end of this year, we will have this certification of both DGCA as well as the EASA certification, the European certification. So our expectation is the initial numbers will be small, nothing much to speak about, maybe 100, 200 crores. But going forward, we want to make it as one of the important verticals. So this will build over a period of time, but the initial numbers are going to be small. So the investment that we are making is essentially for the long term.
All right. So all said and done, what is the kind of revenue run rate that you will do in FY26, FY27 and FY28? I ask you this because you are sitting on an order book of roughly 2 lakh crore with an order inflow of roughly 1 lakh crore in this year itself. If you could give us a glide path of the revenue that the company will be posting over the next 3 to 5 years.
Yes, we are looking at the growth, double-digit growth. We had a setback last year because of the supplies of the engine. But definitely our growth will, going forward, be much higher. Definitely 8 to 10% or more. And we expect that as the different aircrafts go into production, the LCH will get into production in FY28. We will now be doing the procurement, and the LCA, of course, 83 is already on. The 97, if the order is concluded this year, it will get into production 3 years down the line. So we see a very healthy growth in the top line. 10% is definitely doable, and much higher than that is what I expect.
You've earmarked capex of what, 14 to 15,000 crore over the next few years. Can you break that up for us? How much of that would be deployed towards aircraft? How much of that would be deployed towards MRO? How much of that would be deployed towards something like a helicopters? If you could break that capex up for us.
A lot of it is in the R&D. We are spending almost 4,000 crores for the IMRH program. We are spending the capex in the Tumkuru plant is going to be of the order of 2,000 crores plus. And we are also investing a lot of money in other projects of R&D. So predominantly over the next few years, the investment in the facilities, investments in software, investment in test facilities, this would be of the order of, for the next 5 years, of about 8,000 crores. And the balance would be mostly in R&D projects going forward, which are all big ticket items like the IMRH or the CATS Warrior, HLFT, These are all big ticket projects where the funding is from HAL.
Drones. You said that there is a test that you're working on. Do you see orders coming in for UCAVs? What's the opportunity size here for you?
Definitely. As has been demonstrated in the Ukraine war or the recent conflict between Israel and Iran and so on, we're seeing that drones will play a big part in these conflicts. However, we are focusing on the bigger UCAVs, which will be, the UCAV that we are working on is 3 ton, and we expect it will be higher in the future years. So this UCAV business is going to be big in the future. Right now we are working on the design and development of the UCAV, and we are at a stage where we are integrating the test engine and going forward. But my expectation is 10 years down the line, this will be a very significant chunk of our portfolio.
And also SSLV, because the street believes that space will also be a big part of your overall scheme of things in the next 5 to 10 years. If you could give us a potential market size here.
The SSLV, as you know, is a very heartening development that we have won it against competition. We expect conservatively to do about 6 launches a year. 2 years, the first 2 years we'll spend assimilating the technology and building a couple of prototypes. Subsequently, we look at conservatively 6 launches a year, which would easily add about 1,000 crores to the top line, and going up to maybe 15 launches a year based on how we are able to market it and get space. So I think in the next 5 years, we should have at least 1,000 crore turnover from this business.
You do believe that, revenues can compound at over 10%. You are looking at over 180 aircraft to be delivered over the next 5 to 6 years, which implies that at some point, all the 3 lakh crore of your order book that you will get over the next 1 year, including the orders that you have in hand, will be executed over the next 5 to 7 years. What kind of margins will you enjoy each of these years? Will you hold on to this 31-32% band, or do you have the wherewithal to go higher from here on as well?
No, I think we will maintain our current EBITDA. That is what I would like to say at this point. Definitely we'll be able to maintain this. And as you have pointed out, this 3 lakh crore will play out over slightly more than 7 years. It will be about 2033, about 8 years. But we expect to maintain the EBITDA, the current EBITDA that we have.
Have you heard from the government on them looking to further pare their stake, or you looking to raise some money via an offer for sale or something? Is there any opportunity?
No, right now I think we are at a comfortable level. There is no discussion on that. No discussion about dilution of the government stake.
Okay, well, that's the management of HAL, and we'll sort of play out excerpts of that interview. As I said, perhaps the most loved defense stock out there in the market, really top of the league. Well, I think 20 points lower on the Nifty, so it's turning out to be a pretty quiet start to the week. We'll take a quick commercial break here. Primary market action next in focus. We'll have Varun Kapoor and Vikas Kapoor of Travel Food Services Limited. It's a 2,000 crore IPO offer for sale. So that conversation coming up in just a bit.
Welcome back. As promised, let's talk about the primary markets now. Travel Food Services, 2,000 crore rupee IPO opens the subscription today. This is entirely an OFS. The promoters and the company have raised close to around 599 crore rupees by the anchor investors, and some of the notable names could come up for you on the screen as well. But let's talk about the business in detail as well as the IPO offering. Well, let's understand the business. We have Barun Kapoor, the MD, as well as we have Vikas Kapoor, the Chief Financial Officer, who joins us. Hi, gentlemen. Thanks a lot for joining in, and looking forward to interacting with you all more often. Well, let's talk about the financials a little bit first. I'm looking at it over the last few years. Revenue growth has been in the vicinity of the mid-20s on a CAGR basis. And EBITDA margins, could include the rent as well. So I'll stick to the PAT margins. PAT margins have been in the vicinity of around 22% or thereabouts. Right. Do you believe this sort of a momentum can continue?
So thank you, Nigel, for that. And thank you for having us in your studio today. So yes, our business, we focus on travel, QSR and lounges as a business. In aviation, we've built the business over 16 years, and we are today looking forward to accessing the public markets. In terms of our business, the business has grown quite well over the last few years. It has continued actually over the last decade or so, but last few years, you can see that trend very much being there, where we've grown strong in the business, and we expect that we're in an industry that's growing quite strongly as well, expected to have a CAGR of about 20% over the next decade or so. And with the, as you could say, the drivers of passenger growth being a key area of growth behind us, the tailwind that actually allows our business to grow consistently forward. In terms of margins as well, we have achieved margins of 21 to 22% levels over the last 2 years.
PAT margins.
PAT margins at our business. We do believe our teams are very focused on driving that. Our teams are very focused on initiatives. Our teams are very focused on driving those robust margins. And those efforts will continue. I mean, just to give a perspective, what drives that as well, our business is investing upfront. ROC is a big part of our business. We've achieved about 50% ROCs consistently over the last few years, including the last year, which we disclosed recently in our RHP as well.
Okay, all right. Just one more question before my colleagues come in as well. We talk about the unit economics as well. One big issue over the last few weeks has been what happened with regard to Dreamfolks. And it appears, they were the aggregator with regard to airport business. Right. Could you tell us, is there any kind of risk? Because their call was, the airport operators are putting pressure and various other claims were made. Is there any that sort of risk on your business, or do you think you'll protect it?
So our business, so we are the operators of the lounges.
Yes.
We work closely with our airport partners to create value for consumers, consumer delight. That's by designing, by building, and actually operating these lounges. Where we work with multiple partners, lounge access partners, whether they're airlines, they could be card networks, bank companies, or lounge access programs or loyalty programs like a Dreamfolks would be. Ultimately, the consumers coming to the lounge would come to any of these partners for us. So we are agnostic, and in some sense, what's happening recently where they're actually tying up directly with us tends to be an advantage. Tends to be that customers are directly coming. We can communicate, we can actually create different levels of experience directly with partners as well. So, that's what's, in a sense, occurring today in the industry. So, in a sense, it probably occurs as a positive for the development of the industry.
I just want to also tell our viewers that yours is a very touch and feel business, so that to make it easier for people to understand, all the idli.com and the cafecinos that we see at a lot of the big airports, run by, of course, Travel Food Services, TFS. Vikas, just come in on this point on lounges, because that's a very big part of your business. Your current revenue mix is almost evenly split between your own brands and the food courts that you're running with your partners and this lounge business. Just if you could supplement this, if there is disruption and say the lounge business is taken away from Dreamfolk, how does that impact your lounge revenue, if at all?
Thanks for the question. What exactly happens is the lounge business by default is, like Varun mentioned, is supplemented by multiple layers of like airlines, loyalty access programs and multiple. So what tends to happen is, if suppose there is a challenge on one lounge access program per se, typically you would either get the customers directly, or you would get a new access program provider who would be providing that services to you.
Dreamfolks accounts for how much of your overall lounge revenue, which in the last year was around 830 odd crores. How much of that would be from this one lounge service provider?
So from that perspective, yes, they would be sizable portion from that perspective, but the way it is happening is that most of the banks are directly tying up with us to provide the lounge access. So for us, there is no impact.
Those negotiations and that changeover period is already on.
Right.
Yes,
and we work as well, a big part of the business as well as airlines. Airlines has been the part, especially international when you fly, no doubt, that tends to be a big component.
Varun, Vikas, great speaking with you, and congratulations on the issue. So for a lot of viewers, a little confusion. Many are asking us online whether you are in the same line of business as Dream folks, which you're saying you are not. They are an enabler, an aggregator, whereas you're the operator.
That's right. It's a very different business. They would be one of many lounge access programs we work with. We are the actual players who build the lounges. We actually operate these lounges. We take the real estate, and we have these long-term contracts. So our contracts are about 8 to 9 years. We work closely with airport partners. As they look at upgrading the whole experience at airports, we work very closely with them in that. So we're actually building these lounges.
Right.
Ensuring that the sambar is piping hot every time you
That's
what it is. And I'm very particular about my food.
But don't get me started on the sambar, because I'll go on about the cost. And of course, online, you guys must see, right? People, there'll be the cup of chai which will come up and priced at whatever 800, 700 rupees, and
it's about different experiences.
It's a raging debate out there, right? But on the lounge business, the number of flyers has exploded over the last few years, right? So it's been a different league in that sense. But access to lounges is also pretty democratized now. So many, it's not that hard in terms of the number of cards which are accepted, etc. How do you earn revenue in the lounge business? One is of course what you sell in the lounge. Right. Is there anything else at all?
And if I can supplement that question, because in between over the last couple of quarters, there was also a phase where banks were pulling back from this business because it was just not profitable, because every card could get you a lounge access. So your thoughts, going back to Prashant's question.
Right. No, exactly. And you see, ultimately it's about the consumer experience. You had restaurants and airports. Today I probably say, I think the way airport operators in India have approached airports, I think they made it in some cases better than malls on the high street in terms of the brand mix that you see. And we're focused on delivering that. We're focused on creating those experiences. So both, whether it's travel QSR with some of the brands you see at the airports, and lovely to know idli.com is one of your favorites. So that's a great testament. But in addition to that, lounges as well. Lounges are a place, you're traveling, you have high dwell times. You want a space of comfort. You want a space you can spend some time. It creates an environment, or oasis of a cutaway from the rush of moving.
But you're contingent on banks being solid partners and bringing in the footfalls, right?
Completely. So whether it's a bank, whether it's an airline, whether it's a card network, and you're seeing more and more consumers appreciate that. And exactly to your point, and not only that, it's happening globally. India, no doubt. You're seeing that every time. Lounges, many times, are asked as one of the top reasons of we're partnering with the card companies, banks, because the level of service every year is going up and up. Every lounge coming up.
If a consumer spends 100 rupees at a lounge that's operated by you, how does it split across you, the bank, and others?
So, Prashant, the way it works is we tie up with these access programs, and they pay us per user coming in. So we get paid per use. And I think what's happening as well today is, one is that is a part of the revenue. You have walk-ins as well. But in addition to that, you have people who come to a lounge, and today you see a spa. So, so additional services as well.
The value-added services.
Value-added services. So spa. Today you see, bar in a lounge.
So if you could give, numerically, if you can just sort of disaggregate that number, Varun.
So the larger portion would be the walk-in. The customers who come through the
card programs.
The card programs, the banks, the airlines. For example, international, you'd imagine airlines, business class, you're a first-class traveler, you come to the lounge, you have a separate zone for the first class, separate zone, for business class as well. So that tends to be a large portion of it.
And which business fetches you better margin? The lounge business, where all these tie-ups are vital for that business to thrive, or the regular food court business? Right. Which gives you better margin?
That's a great question. In reality, for us, it's materially both the margins. Ultimately, we're delivering from both of these consumer delight, and margins are quite similar across both businesses, not materially different. And a lot of synergies between both.
Right.
You have central kitchens, central stores, procurement is together. So a lot of these type of comments.
All right, just to wind things up, so you're confident with regard to the revenue growth momentum, profitability can be maintained, return ratios can be maintained, and you don't see any kind of risk like what's happened with regard to Dream folks, because your business itself is totally different. Is that fair?
That's fair, Nigel.
All right, we'll let you all go at this time, and all the best for your IPO opening. on listing, we re-invite you all on the channel.
Yeah, sure.
At that point in time, we'll squeeze you a little bit more for some numbers.
We love that. Maybe a few recipes we could discuss.
Yeah. And I'm a customer both, lounges as well as the other business. So
Okay, super.
I can quiz you on everything, on the operational front.
And one suggestion, maybe you could introduce a frequent flyer program for idlis and sambar.
That would
Like a
really,
coupon.
like a loyalty card. Absolutely.
Something like that is going on in the mind. So,
Nice.
Thanks, gentlemen. Thanks for coming down.
Thank you. Thank you so much. Well, that is TFS, a new issue that is coming to the street very, very soon. But let's go back to some important updates that we got from Borosil Renewables. Let's pull up the stock. Last I checked, it was still up about 3% or so. Now, the news is that one of Borosil Renewables subsidiaries, in particular, this is the German subsidiary, it has filed for bankruptcy, citing demand paucity and market conditions. The stock, however, has been holding up 4%. Perhaps the market feels a sense of relief that there's a finality to this, and now one can move on with the repair work. Let's discuss this with the company's management. Pradeep Kheruka, Chairman of Borosil Renewables, is joining in. Mr. Kheruka, thank you so much for taking this call, sir. So that's exactly what we need to understand. We believe that your exposure to the subsidiary was around 350 crores. But what is the debt remaining? What happens in the bankruptcy? And to what extent can your exposure be impacted? If you could just walk us through.
Sure. Thank you for having me. The debt in the company now is from Borosil Renewables itself. We have no external debt with banks or any other lenders. So to that extent, we are not facing any hostile action by any third party. The fact is that there has been a demand constraint, significant demand constraint, because of a stoppage of manufacture of solar modules in Germany. All of these are now being imported from China. And the government has just taken office a short time ago, sometime around the 10th of May only. And I think they have so many issues to grapple with at this time that it's just going to take some time before they wrap their heads around the solar industry sector. But in the meantime, we have been losing money to the extent of nearly 900,000.
Oops, I think we've just lost that line with Mr. Kheruka. We'll try and get him back. But, that's essentially the thing that we need to understand. At least the bleeding stops, because this was a loss-making entity as well. So the market just seems to be relieved that for starters, at least that bleeding stops. And then it's a question of recovery of investment, whether that happens or not, in what form. That's something we'll try and understand.
So the only thing that I was surprised is that, as Mr. Kheruka, before he got cut off, said that there's a new government in place. And they've got lots of things to deal with.
Yeah.
But they're sort of getting out of this business in Germany at a time when you've got a new entity which is expanding, the fisc, etc., in a very substantial way in terms of increasing spending, state spending on a lot of things. So why now? I mean, if anything, you'd probably wait for a bit longer, or were there other circumstances as well which kind of sort of forced them and forced their hand? I think Mr. Kheruka is back. Mr. Kheruka, you got cut off there, sir. Please continue.
Sorry about that, yes. Swiss connectivity is not as good as Indian connectivity.
Indian connectivity. Go on, sir. Go on.
Okay, so I was just saying that the government probably needs some time to wrap its head around how they want to restructure the solar manufacturing in Germany. But in the meantime, since we were losing money at this very high rate of nearly 9 crores every month, we thought it was not fair on Indian investors for us to continue to bleed in this manner. And we decided to just we decided to stop funding them. So the application has actually been made by the German managing director under German law when they see that there's no visibility of funds in the next 2 weeks, and then they must compulsorily file for insolvency, which is what they've done. And so we at this time there's an interim administrator who's been appointed, and he'll make a report. And then he's going to go back with his recommendations, which might take about 3 months. If in the meantime there is some movement and there is clarity about how the German government is going to support German industry.
Mr. Kheruka, if I can just come in, is there like a one-time write-off here? One. Second, can you kickstart this if there is clarity on the positive side?
You see,
Restart rather. Sorry. Go on.
Right. So let's look at it from two aspects. One is the technical aspect. Technically, all you have to do is start firing the furnace. You switch on the gas and you switch it on and you're back to production. Technically, that is the story. We have a full complement of workers there who are experts. They know their job and they are very dedicated, strong people. I have a lot of respect for the workforce there. They would be available, I believe, at short notice to resume work should the circumstances allow them to do so. And as I've seen before, the investors looking at visibility. If the investor sees visibility, there's no shortage of funding. So I suppose that this is going to follow the same pattern. So we do have a 3-month period in which we're going to see what kind of a response the administrator is able to generate. Right now, it's outside our hands, number one. Number two, the clear thing is we've stopped funding this. I mean, in future, any demand for any money will go to the German government and not to us. So we have sort of, we have ceased to be responsible for the expenses.
All right, sir, that point, will that be a one-time that will be seen in one of these quarters? If yes, what could the quantum be?
See, our exposure is 35 million euros altogether. We have funded about 20 out of this was 27 million was funded by us. So the exposure is not something which I can speak about now because we have sizable assets. There's a very large plot of land. There's a very strong construction. There could be other uses to which this property could be put. And there might be customers for the property itself. There are, of course, plant and machinery for which we could be one of the customers, that because a lot of it is brand new. So it's not necessary that the entire amount that we've invested will be written off, but this is just something on which I simply cannot make any comment at this time.
Okay, all right. So I think the street views it as a positive that now you can focus on the core India business where you have some protection as well. And the margin difference has been substantial because the entity that we're talking about in Europe is loss-making, while India business is expected to improve from year on. So purely for the India business itself, could you tell us what is the realization difference if I look at it, on an average today in comparison to, say, Q4, very, very roughly? And what kind of a CAGR can you look at on the India revenue from year on and margin trajectory as well? I recall you doing 30%. That came down to mid-teens, but that's expected to improve as well. Please go ahead.
Yes, please. Margins are definitely on the way up. Demand is robust in the country. We are focusing on maximizing production and we are focusing on
again, we've lost
demand and getting ready for that. So the picture here is very positive. Yeah.
Mr. Kheruka, just a...
Are we back?
Yeah,
Yes,
we
sir.
can hear you. Please go on, sir.
You were giving us a number. What kind of revenue CAGR can we look at and margin trajectory from year on for the India business?
The margin trajectory is only going to improve. It should not deteriorate from what I can see. The demand is very robust in our country and we continue to meet the demands of our customers. So we're looking at a 60% expansion and this will allow us to devote our full time to this. In the past, we have been devoting time to things that were not productive. And I must take out time to comment about the government. Our own government is very proactive. And when I see the difference,
Mr. Kheruka?
Headed, yes.
Yeah, sorry. Paucity of time, so just trying to squeeze in one last question. So you're, since the company's filed for bankruptcy, your German subsidiary, you ceased to be promoter immediately, and this was contributing 22% to your revenue. Will that be made up by the India business this year itself? I mean, in the interim, suddenly the 22% is gone, right?
Yeah, the revenue has gone, but the profits have gone up.
Yeah.
I mean, to the extent maybe nearly 27 crores per quarter is going to rise. So that revenue was not giving us anything. It was taking it up.
Sure.
They won't lose money on sales now.
And 27 crores of additional profit every quarter. That's an important, of course, something that your shareholders will like.
All right, Mr. Kheruka, we'll leave it there, sir. Good speaking with you on a patchy line, but I think on a firmer line next time you're here. Look forward to our next conversation. Appreciate you joining us here for that chat. We'll take a quick commercial break here. Commodities in focus next, and of course, the chat on the economy with Lata coming up as well.
Welcome back. Let's quickly do a roundup of the commodity market headlines this morning. Manisha is here with us. Manisha, fill us in.
Thank you for that, Surbhi. I'm looking at the crude oil prices because the previous week wasn't such a great one, and we've started this week as well on a weaker note. And this has led to week-on-week, month-on-month crude oil prices trading into the negative. And in this year, until now, we are 8% in the red as well. Well, the major cue really comes in from the OPEC Plus meeting that happened on Saturday and the kind of statements we heard from therein. So OPEC Plus has accelerated production hikes, citing stable economy, low oil inventories, and sustaining demand in most parts of Asia. What OPEC has done is that it has hiked production by 548,000 barrels per day for the month of August. And the expectation is that this is the number you could be looking at going forward as well. What we saw for the month of May, June and July was 411,000 barrels per day of an increase in production. So you have a big number coming in for the month of August. And this clearly has been rising as we've seen in the previous months as well. So that is what really seems to be bothering the screen. Apart from that, it is OPEC Plus unwinding. Remember, 2.2 million barrels per day. This is over and above what the OPEC and OPEC members have been withholding, looking at the kind of supply that they have been seeing in the global markets there. Well, apart from OPEC, it also has to do with the US tariffs, where the street expects that it would take effect now from 1st of August. That doesn't do very well for many of these industrial commodities with the kind of impact expectations from there. The other is the US finalizing rate amid ongoing negotiations, and the street is also looking at the weak China services activities, surprise build-up in the US inventories. All of those things have continued to weigh onto the markets there. The US crude inventory in this week, if you see a hike, would be an 8th straight week of hike coming in, and that doesn't augur well for the price increase there. What the street will watch out for going forward now, of course, is the FOMC Fed minutes that's going to be released on 9th of July. And apart from that, all the tariff conversations that you will be seeing will impact many of these commodities.
All right, Manisha, thanks very much for that. That's commodities in focus. We'll take a quick commercial break here. It's the economy in focus. My colleague Latha will come in for the conversation. And we'll have three top gentlemen joining us, Sajid Chenoy, Rajkiran Rai, Indranil Pan, on that discussion. Coming up in just a bit.
Welcome to Economy Unpacked. The Reserve Bank has infused 9.5 trillion rupees of liquidity since January and has cut repo rates by 100 basis points. The call rate actually has fallen more. It's fallen from 6.75% in January to 5.25% in June. Now, the question we're asking is this enough to increase credit growth, which had fallen to a low of 9% in year-on-year terms in June? A JP Morgan study argues that higher liquidity can pull down call rates by a quarter basis point below the repo rate. But higher liquidity by itself cannot increase credit growth, which depends on other factors, maybe they mean factors like animal spirits of businesses. Separately, historical evidence shows that the Reserve Bank lowered rates from about 10% in FY98 to 6% in FY 2004. But for the 4 years from FY 2000 to FY 2004, credit growth remained muted. At that time, 15% was considered muted. However, it raised interest rates from 6% in FY 2004 to 8% in FY 2008, and credit growth rose in those years by around 25 to 27%. So the question we are asking today is, should we expect strong credit growth given the high liquidity and credit rates announced by, rate cuts announced by the Reserve Bank? Joining me are Sajid Chinoy of JP Morgan, Indranil Pan, the economist from Yes Bank, and Mr. Rajkiran Rai, Managing Director of NABFID, and of course, former Managing Director of Union Bank. Gentlemen, thank you very much indeed for your time. Sajid has just published an extremely erudite paper on this. Sajid, in simple terms, why are you arguing that liquidity is not enough to boost credit growth?
Thank you, Lata. The motivation for our piece was, over the years, there's been a rich debate about what role liquidity plays in addition to rate cuts or rate hikes in the monetary transmission process. Should the surplus or deficit be 1% of NDTL? If you inject more liquidity during easing cycles, do you get more transmission? Will that help credit growth? And there are two main channels of transmission that the debate is centered around. Does more liquidity result in higher interest rate transmission? So it pushes call rates down, as you said. But beyond that, does it push lending rates down for banks if you inject more liquidity? And the second channel, in fact, is more important, something that Ben Bernanke argued over the last 20 years, what's called the credit channel of transmission. That if there is a lot of availability of liquidity, then banks tend to lower lending standards, lower risk standards, and credit growth picks up irrespective of interest rates. So what our study did was, over the last 10 years, look at both these channels quite rigorously. What did we find? Number one, that liquidity clearly has an impact on call rates, about 25 basis points, as you said. But beyond that, once you adjust for the call rate or hold it constant, there is no incremental impact of higher liquidity on lending rates. So all the transmission works through call rates. Number two, and this was the interesting finding because in a way it's slightly different from what the RBI had found back in 2012, that really liquidity by itself does not cause higher credit growth. We've looked at this in many different ways over the last 10 years, and we find no evidence that just injecting liquidity by itself does not boost credit growth. So there is no evidence in India of a credit channel of transmission. The third and final finding was, when we talk about what's driving what, does deposit growth drive credit? Does credit drive deposit? And we find it's the latter. It's really credit that's the initial mover. It's credit growth that drives deposit growth, which in India's context is good news because it means the credit deposit ratio over periods of time tends to mean revert. Now, I'll make one final point. This is not to say that credit growth will not pick up in this cycle. As you pointed out, call rates are down 150 basis points. We find in our work that there's an 80% transmission on average to lending rates. So over the cycle, expect lending rates to go down by 100 basis points. That should, of course, help credit growth. But as you also pointed out, what we find is this positive correlation between lending rates and credit growth, which is very intriguing and interesting over the last 20 years. That is really, credit growth seems to be associated with higher lending rates, which tells you that apart from movement down the demand curve, what matters in India is whether the credit demand curve itself moves out, which is a function of growth prospects, private investment prospects, animal spirits, and the like. So these were kind of the findings that we concluded.
Okay. But let me tell you a story that I heard from bankers around the time when you presented the inflation targeting report along with Urjit Patel. You were part of that committee. The Reserve Bank at that time, because of the Urjit Patel report and the Mohanty committee report, said that to keep repo rate at keep the call rate at the repo rate, we have to keep liquidity slightly less. Only then the policy rate aligns with the repo rate. But because of that, people were not cutting rates. When the Raghuram Rajan RBI asked bankers, why are you not cutting? We have cut rates. They said, see, as long as we are borrowing from RBI, our psyche is there is not enough money. So we are not cutting deposit rates. So you keep liquidity in plenty, then only I will cut deposit rates because I feel, okay, I'm not borrowing from RBI or from call market. This was the psyche that bankers explained to RBI. Those two bankers, Hitendra Dave and Anant Narayan at that time, now in SEBI, said that even on our channel. So Rajkiran Rai, is that the argument that bankers want liquidity and otherwise they won't cut rates? So liquidity has a role in rate transmission.
Definitely, yes. Actually, see, liquidity is very important because you would have seen the deposit growth in the system moderated a lot actually because there was tight liquidity in the system. Another factor is actually when the credit growth slows down, the deposit growth also slows down. So I think these are all very interlinked. Sufficient liquidity in the system has already brought down the short-term interest rates, is already helping in cutting the deposit rates. You would have seen the banks have cut deposit rates substantially now. So now actually it will play out. It takes time. But then the argument is right that bankers will always look for liquidity, tight liquidity conditions. Actually, banks compete with each other for bulk deposit, for deposit growth. And when the deposit rate goes up, the interest rates are always kept high.
Okay. No, I think we are not just, tight liquidity obviously will not push up credit growth. But what Sajid is arguing, I guess, is that just surplus liquidity is not enough. Sajid, I'll come back to you for your rebound reaction. But Indranil, where do you stand? Do you think surplus liquidity gives bankers the psyche to pass rate cuts, and that in turn should logically increase the demand for credit? You're on mute.
Hello. Sorry, I think the context here is more in terms of what is the extent of liquidity that you are talking of. Now, for example, in the current scenario, we are almost a 4 trillion surplus in terms of liquidity, and the RBI has absorbed only about a 1 trillion through the VRRR. Now, again, I think that going back, the whole argument boils down to whether you operate at the lower end of the corridor. And in that case, it is only the near-term securities in terms of the T-bills or etc., which actually get the transmission at the highest level. The credit growth possibly doesn't happen, and the credit growth will depend a lot in terms of the type of demand for credit that is there. Now, in the current circumstance, I'm not sure whether a 2 trillion or a 4 trillion can push up credit growth very significantly, simply because of the cycle where we are in. First of all, I think the FSR report also did point out that there is an increase in per capita debt for the subprime category borrowers. And therefore, to that extent, the credit demand, which is basically the housing sector, obviously is the prime category and the super prime category, but more in the middle segment where you still have a stress in terms of the post-COVID debt weight loss. Okay. That is the zone where credit has been increasing the maximum. And that's possibly where the banking sector had also been hurt in terms of the incremental NPAs over the last couple of years. Okay. So in terms of credit standards or the risk undertaking that the banks are willing to take even for that segment may actually be relatively lower. The RBI also had increased risk weightages over there. Okay. So I think there's a lot of things. It's not only liquid that impacts the credit growth cycle. It also depends significantly in terms of both banks' risk-taking capability as well as the demand.
Got it. Mr. Rai, you wanted to react?
Yeah, actually, let us expand this discussion because we are trying to connect liquidity, interest rate, and credit growth. Now, you cannot limit the credit growth only to the scheduled commercial banks because growth is happening somewhere else. Because infra space where I operate, the scheduled commercial bank number, if you see, they are minus 1%. But if you look at the NBFC and AFI space, they have grown 15%. Look at the InvIT assets under management. Okay. Now, today, they are 7 lakh crores. They have grown 10 times in the last 5 years. Okay. They are expected to be 20 lakh crores. Okay. The flipping of the assets from the scheduled commercial bank.
That expands beyond. I'll come to that. We are at the moment looking at whether bank credit can grow. Right. Sajid, you wanted to react. I mean, liquidity does give bankers a psyche of being able to cut deposit rates. Although you are not lending the reserves, but it gives you the comfort.
There's no doubt about that. And I think the point here is that we've recognized over the years that the first leg of monetary transmission, as the Inflation Targeting Committee report had laid out, was to ensure that the operating target of monetary policy, which is overnight money market rates, the call money rate, the TREPS rate, align more closely with the policy rate. Now, it's turned out that that typically involves keeping liquidity in a modest surplus, right? That if you keep liquidity in a deficit, you will not achieve that transmission, because typically, given the distribution of liquidity between banks and non-banks, overnight rates will be above policy rate. So I think the system has recognized that keeping liquidity in surplus is almost a necessary condition to keeping overnight rates towards policy rates. The simple point that we're making is once that minimal objective has been achieved, the incremental impact of adding more liquidity, once it's already in a modest surplus to overkeep, doesn't give you much efficacy. It doesn't give you much efficacy, at least in the data, either on lending rates to get lending rates to go down more or deposit rates to go down more, or it doesn't give you more efficacy on credit growth itself. And that was the limited point we were making.
Okay, I have more questions in terms of, worries about IBC, worries about asset quality, which may also hamper banks from giving loans, which is, at the moment, that's positive. But I'll come to those questions in just a bit. First, give me a rapid fire number. At the moment in FY26 itself, what is the kind of credit growth you guys are expecting? First, Indranil.
9.5 to 10%. High base of the last year will bring down the YOY number.
Will bring down the YOY base. Okay. But the YOY base for June is 9%. I mean, at the moment, we're running at 9%. You expect that through the year, it's going to remain around 9.5, 10?
9.5 to 10.
Okay. Yeah. Sajid?
So typically, it's about 1.1 times nominal GDP. If you assume nominal GDP of 10, we should be looking to take credit towards the, somewhere around 11% or so on a sustainable basis for this year.
So we should have 11. Mr. Ra, you have a guess?
Yeah, it is around 11 to 12%. I'll also give you another logic to this. See, we were in a monitoring tightening cycle, particularly NBFC lending and unsecured personal loans and all that. And only like last few months, this is being relaxed. So this will play out, and I think we'll end up with 11 to 12% growth.
Okay, fine. So I have a 9.5 to 10, and I have a 11, and I have a 12% over here. But it is still not 13 or 14, as some would like it to be. After the break, I have two very important questions for you. One, whether there is animal spirits enough in the market for credit to, take off. And separately, the fact that banks have clean balance sheets, does that make them more risk-prone? Those questions after the break. The entire show will be available on CNBC Access. For Bazaar viewers, it's now time for Chartbusters.
Godrej Consumer, among the top gainers today, up 4% as the first quarter business update indicates strong volume growth. The company also expects revenue to grow in double digits going ahead.
Purankara shares surge over 4% after it bags a redevelopment project in Mumbai with gross development value of 2,100 crore rupees.
Shares of Dabur rally nearly 4% as the first quarter business updates reflects a sequential uptick in demand. The company also expects revenue growth to regain momentum in the coming quarters, even though the previous quarter was impacted by a short summer.
Jubilant FoodWorks' good performance continues in the first quarter. They register 17% growth in consolidated revenue. However, the stock comes in for some profit taking, down 2.5%.
Good updates from a couple of the jewelry players as well. Senco Gold up nearly 5% as it registers revenue growth of 28% in the first quarter. Kalyan Jewelers as well recovers from lows after registering a 30% plus growth in the first quarter, led by near 18% same-store sales growth.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And to kickstart the week, well, we're starting on more or less a flattish note. Remember, we're waiting by in terms of global cues. What's President Trump going to do next with regard to tariffs? Is there going to be a deal with India, or at least a mini deal that will be officially announced? That's going to be important. And also the Fed minutes is something that we're looking forward to. Hey, Mangalam.
Nigel, you know, even as the frontline indices do reflect this global uncertainty, what's definitely doing well today are the domestic names and the broader markets itself. We have a lot of stocks doing well in that HUL because of the slew of updates that came in over the weekend. All of them suggest one thing, that, you know, demand has definitely recovered. And if the demand has recovered, then who benefits more than the leader of the industry, that is Hindustan Unilever. And mind you, the stock hasn't done much for the last 5 years. So maybe the street is betting on the gains of the recovery to accrue for the industry leader. That explains why HUL is up around 2.5% among the top Nifty gainers in today's trading session. But be that as it may, the frontline index still absolutely flat. Shivangi Sarda of Motilal Oswal Financial Services joins in for a quick technical check on the market. Shivangi, there has been volatility, but it's been range bound. Do you think that continues for the frontline indices? And would you bet more on individual stocks than either the Nifty or Nifty Bank?
Very good morning, Mangalam and Nigel. Thank you for having me. So we've seen a roller coaster ride in Nifty, of course, with support-based buying, but then the pressure at the higher zones is intact. So even though bulls are reinforcing themselves at the support levels, the lack of follow-up at the higher zones is making the index quite lackluster and consolidative. So we're looking at 25,350 as an important support level for the next up move towards 25,750 marks for Nifty. Of course, all the other factors are indicating that, you know, this bullish biasness would continue over here in the indices. Although there is some underperformance in the bank Nifty, we've seen that there has been some very lackluster move from the last 3 trading sessions. And we've seen that the heavyweight banking stocks have actually given up, which is making the entire index dull. Although the smaller banking names and the PSU names are looking quite attractive at these levels. Talking about the index per se, we are going for buy on decline, but of course the conviction in Nifty is more than Bank Nifty. Talking about levels, we are looking at 57,850 as the next upside for Bank Nifty with a support of 56,650 levels.
Okay, all right. By the way, we had some flashes on the screen. I think we should pull that up. I think that's with regard to InfoEdge. They've given their quarterly update and it looks quite good. I was looking at the revenues, you know, the recruitment for solutions. That has registered a good growth of close to around 10%. I think we should get that one up for you on the screen. Q1 billings is up by close to around 11.2%, which is fairly okay. And I think 99 acres for real estate as well has moved to around 94.4 crores. That compares with around 81 crores. While you have recruitment solutions itself, that's around 470 crores, which compares with around 431 crores or thereabouts. So it looks pretty okay. Double-digit growth is what we are seeing in terms of a growth. Shivangi, any view on InfoEdge in terms of how is it looking on the charts, and also fill us in with a fresh couple of calls?
Looking at InfoEdge, Nigel, we've seen that this stock has consolidated from the last 11 weeks. Quite a lot of call writers which are yet to, you know, unwind their position. So even though the stock might be up, you know, on a month-on-month basis, but overall there is lack of momentum and lackluster here. So I would, you know, recommend a wait and watch here. On the other hand, stock-specific ideas, some of the Capital market, exchange-related counters, power names, and IT names are looking quite attractive. But my preferred pick for the day, which will include first up, is CDSL. This one has been one of the strongest in its space. And we've seen that on a month-on-month basis, this has performed and higher top, higher bottom from the last 4 months. Even on the daily basis, we're seeing volumes have added up at the lower levels where the support-based buying was quite strongly seen on Friday's session. Which gave a quite great closing on the weekly basis. Even on the weekly basis, we've seen it's trading in an upward sloping channel and of course looking quite positive. So recommending a buy here with the next target of 1850 levels with a support of 1750 zones. And the second one would be LTF. This one has also been very strong in consolidation. A breakout from the last 8 trading sessions, so looking quite positive for the next target of 218 levels with a support of 203.
All right, take that point, Shivangi. Thanks a lot for that. The sector to be in this morning definitely is the consumer space itself. We've been talking about Nykaa, how they've reported a decent number as well. That stock's moved to the high point of trade right now, and we are seeing continuous traction in names like Dabur. Meanwhile, don't lose sight of Bajaj Consumer. This has been an underperformer in the consumer space, though they've reported a management change 2 weeks ago, and since then the stock has rallied about 35-36%, currently at the high point of day for Bajaj Consumer as well. We'll take a short break on that note, but as we do that, let's get you some good news for our viewers. The mid-cap index has moved into the green, and India's business news leader, CNBC-TV18, is just a click away through the CNBC-TV18 mobile app, which gives you access to breaking news, in-depth articles, and financial world updates, all of them at your fingertips. You can download the app from either the Apple Store or the Google Play Store, or just scan the QR code, which is up for you on the screen. Welcome back. You're watching us here on Chartbusters on CNBC TV18. We've been talking about the auto sales having seen a recovery in the month of June. However, passenger vehicle sales have remained muted. Automakers are also grappling with the issue of non-availability of rare earth magnets, as a result of which the EV space may face some issues in the very near future. Will they or won't they? We have C.S. Vigneshwar, who's the president of the Federal, the Automotive Dealers Association, as we know it as FADA. Thanks a lot for joining in, Mr. Vigneshwar. The obvious question, while passenger vehicles are soft, two-wheelers are doing well. What have you seen in the month of July so far? How have inventory levels been for both passenger and the two-wheelers? And at the same time, what's your view on e-vehicles? Because the rare earth issue could cause some sort of supply chain issues, right?
As far as we got to understand from the manufacturers, I think the rare earth metals will affect ICE as well as EV vehicles, hybrids including. But however, we haven't seen manufacturers stop any vehicle production or tell dealers that they need to stop selling a particular variant of a vehicle as yet. There have been certain variant unavailability issues, but that is much before the issues of rare earth metals and magnets have been there. So we have to watch that. However, it's too early to call July, how the month is going to go. The month of June was quite decent. We've been having positive growth in every sector, whether it's two-wheeler, three-wheeler, commercial vehicles. The commercial equipment has done really well. I mean, they've grown nearly 55% last month. So it's been overall quite decent. Even the passenger vehicle grew by about 2.45%. We wanted to grow much faster. But even the early, during the beginning of this year from FADA, we had predicted that the passenger vehicle segment would be growing in the lower single digits. Most of it is on track. However, we could do without the Trump announced trade wars or also in terms of the rare earth metal availability. If this happens, probably we need to revise the growth figures lower.
All right. Hi, Mr. Vigneshwar. Good morning, and thanks a lot for joining in. Nigel on this side, we would all wish for a more rational Trump. Hopefully, we'll see signs of that in the coming days. That said, give us a sense in demand. As you said, there's a little bit of a perk up in demand in the month of June. How are you seeing the trends emerging? Rural doing better than urban?
The rural has always been doing well for us in the last couple of years. And that's been the Bharat, which is really driving India. Apart from that, we've also seen that the walk-ins are quite decent. We also checked on the sentiment survey which we have every month with our dealers. It's quite muted. It's a little bit damp. But having said that, we've been having great monsoons. The kharif crop has been great. The stock market has been doing decently well. So when you look at the macroeconomic and anything which contributes, it's been doing decently well. So we're not too scared about it. And we also have seen that government capex expenditure from whatever signs we have seen is going to go up in the second financial quarter. So things are looking pretty strong for the auto sector, and hope this translates into retails.
All right. And what about commercial vehicles? They have been not so good, even as we've seen some recovery across the board for passenger vehicles, a lot better for two-wheelers. The commercial vehicles usually depend on how the capex cycle is likely to come by. What is your view? How is that likely to do in the latter part of this year?
As I mentioned before, we are seeing signs of the government capex expenditure improve in this current quarter, which is already translated into the the construction equipment has already gone up, really about 55% over last year. And this is fantastic. This is really good because these are early signs. Usually the construction equipment goes up when capex is being spent, and then the commercial vehicle goes up next. So this all goes well. And if government capex goes up, there's going to be a good effect on the economy of the overall auto sector.
What about tractors as a segment? We have had a fairly good monsoon. I mean, at least the start has been good. And probability is that we have a decent showing in the monsoon season. What kind of trends are you observing for the tractors?
The tractors been doing well. It's been growing at about 8.08% year on year. In the month of June. But when you take the first 3 months into consideration, the tractor has again grown at about 6.28%, which is great. There's a decent growth. And with the kharif season coming and the monsoons playing a good part, things are only going to improve here. So the rural sector will grow.
Finally, can you give us an updated number on what's the kind of inventory that dealers are sitting on for both two-wheelers and passenger vehicles? How does that compare with earlier?
Yeah, two-wheelers, we are at about a month's inventory in most places. But in the passenger vehicles, that's where the pain is. We are at about 55 days. It's been slowly inching its way a few days a month in the last couple of quarters. we really need to look at this in a more detailed way, because last year it was a disaster. The number of days went up to about 85 days, which was awful for dealer profitability, because it's a complete waste of money in terms of interest. I hope that I hope the OEMs are a lot more aware this year, and it doesn't happen again towards the festive season.
And you don't believe that the companies will have to push the channel pipeline, right? Given the sort of growth expectations that the street has, with them sitting on 55 days of inventory already versus 85 days last year, the companies will not be pushing the pipeline much, right?
I hope not. We've been talking to them, we've been liaising with them, and we've been asking them not to do that. It doesn't help anyone. 21 days stock is more than enough. It's an inventory-proved number. 21 days stock is more than enough for giving the customer every option possible.
Appreciate you joining in, sir. Thanks a lot for speaking to us. Looking forward to catching up with you and understanding the trends emerging in the auto sector. Well, remember to tune in to our special offering, the all-new CNBC TV18 Prime. We bring you insights from policy makers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, where commodities, currencies, as well as cryptos are in focus, and Global Lens at 8:30 p.m.
Well, the Nifty has moved slightly into the green. We were talking about HUL before going into break. Just keep an eye out on ITC as well. So if the belief is that consumer sentiment is improving, a lot of these spaces would do a lot better. ITC has moved higher, and we are also seeing some traction in names like Asian Paints. But sticking with the consumer space itself, we also got an update coming in from Dabur, which has actually seen good traction all the way since morning, and this despite the weakness that the company has shown in their beverages portfolio this time around. So if you just look at their first quarter, update, the good part is that demand has recovered. They're seeing sequential recovery with uptick in volume growth. However, the first quarter was impacted on their beverage portfolio on account of unseasonal rains and a shorter summer. That accounts for nearly 10 to 12% of their of their overall revenue. But the other parts of their business did a lot better. That was home and personal care as well as healthcare, and some of the portfolios plays in healthcare actually showed growth of over 40%. The Honitus portfolio in particular. Consolidated revenue expected to grow in low single digits, but we will see some margin compression. The company believes that's very temporary in nature because of the unseasonal rains. Going forward, because of the improvement that we're seeing in demand sentiment, the subsequent quarters are likely to look a lot stronger. That's the word coming in from the management of Dabur, which is why after underperformance of the last 3 or 4 quarters, the stock has taken this positively, currently sitting at the high point of trade. With that, we'll wrap up on this edition of Chartbusters. Thank you so much for watching. You stay tuned to CNBC TV18 as Trading Hour comes up next.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar, and let me welcome the new Trading Hour team. We've got Sonal and Hormus, and three of us are going to be with you every day from 11 o'clock to 12 o'clock. Unfortunately, as we begin the straight and the show, the week and the show, is that this holding pattern for the markets continues, right? Pretty much unchanged from what happened last week. Consolidation. I guess still waiting, right, for the big events to play out in terms of, details on tariff, earnings season. But for now, things appear to be quiet at the index level. Individual stocks, of course, are doing their own thing.
That continues to be the case, right? Hi, Hormus. Hi, Reema. It's going to be a right with the three of us. I'm sure about that. But for the markets, it's very quiet right now. As Reema has pointed out, it's a very stock-specific market. And the basic thing and the most important thing that the markets are watching out for right now is what happens with the US-India trade deal. We, of course, have the earnings which would come up soon. So we keep getting all these, okay, there's a sudden spike actually. I told you we'll be a riot, right? That's what has happened to the markets as well. There's a sudden spike and it is led by Nifty Bank. So Nifty Bank constituents should come up for you on the screen. Some of them leading to the gains from the lows of the day. So we have something like an SBI, which is spiking from the day's low. We do have Kotak Mahindra Bank. That too is in focus. Axis Bank should be the other one. These stocks are leading to some of the gains that we're seeing from the lows. But again, Q1 updates, that continues to be in focus, Hormus.
Hello to both the ladies. And yeah, at the start of the week, and it's the banking names that are working higher. And HDFC Bank is not far behind either. That too has moved into the green and doing fairly well for itself. A 63-point contribution to that 100-point move that you're seeing on the Nifty Bank. And that has led to that revival on the Nifty as well. But of course, there are a lot of other movers in the broader markets today. And we're no short of losers. Look at Info Edge. It just came out with a business update a few minutes ago. And that stock has taken a bit of a nosedive since then, almost 5% lower on the stock now at the lowest point of the day. And the other one being Endurance Technologies is seeing some bit of profit booking, and Jubilant Foodworks, after a fairly decent quarterly update, is still trading lower by around 3%. And this despite being the analyst commentary being fairly mixed on the stock. So now, since we are on the subject of Jubilant Foodworks, let's get Mangalam in to talk more about that update. And on the flip side, the stock that's doing well, which is Godrej Consumer, to shed some light on that as well, Mangalam.
Well, it's a very good performance that has actually come in from Godrej Consumer, and that's reflecting the stock as well. The one thing that stands out in all the consumer updates that have come in over the weekend is the fact that it seems like the worst of demand woes is behind. Yes, we've been seeing rural recovery come by over the last few quarters, but this time around, urban is also showing signs of recovery. The standalone business for Godrej is likely to deliver high single-digit value growth driven by mid-single-digit volume growth. And that business is led by home and personal care along with their, overall business as well. And that's largely on account of volume growth, which has been strongly competitive and sequentially improving. The last couple of quarters for Godrej Consumer were marred by high inflation in palm oil prices, which the company believes is behind, but they're yet to see margin impact of that one. They believe that will happen in the second half of this year as they exhaust all the high cost inventory that they have. So all of this with an improving outlook for domestic business seems a lot better, and as a result of which this stock is being fairly well bid up in today's trading session. Personal care expected to grow in low single digits, home care expected to grow in double digits, and standalone EBITDA likely to be slightly below normative range but expected to improve. On the flip side, we have Jubilant Foodworks. Now, the stock has been doing a lot better than all the other parts of the consumer market, and as a result of which it was fairly well bid up, and brokerages were not very comfortable with the valuations. But that's not to take away from the fact that their update was fairly strong. 18% standalone revenue growth. Consolidated growth was 17%, but that was, impacted by weak performance that the company reported in Turkey. No problems for the India business. The Domino's like-for-like growth in India has come in at around 11.6%, marking the third or fourth straight quarter of positive growth and the second straight quarter of double-digit growth in like-for-like as well. And they've opened 60 Domino's stores in India during this quarter, taking the overall count to around 20 to 40. Weakness in Turkey, same-store sales growth down 2.2%. They've added 7 stores. But for Turkey, more than Domino's, the smaller part, coffee, will be something that we'll be watching out for when the company reports its actual numbers. So on the back of a decent update, but limited headroom for valuations has led the stock to see some profit taking today.
Mangalam, what's the valuation of Jubilant?
Trades upwards of 70 times.
Upwards of FY27.
Yes.
Okay, so that is capping, the moves in the stock or the upside. But as he pointed out, the update was pretty okay. Vivek is now joining in for more on Borosil Renewables.
Well, that's right. So Borosil Renewables is in focus now. The company last evening gave an update to the exchanges stating that one of the German subsidiaries that the company has that's called a GMP. Remember, GMP is a material subsidiary, contributed almost 22% of the total top line as far as their FY25 operations was concerned. Now, due to similar issues that the company was facing in the European market, similar to what India was facing due to dumping of China's glass, is something that the company said was unviable for continuing operations as far as GMP was concerned, and the company went ahead and filed for bankruptcy as far as the German insolvency court was concerned. There will now be an administrator who will take over operations of this particular subsidiary, and the company will then engage with the government authorities to go ahead and ensure what exactly can be done. Company spoke to us earlier today. They've said that all options are on the table, and in fact, if they get some support from the government, they may even consider reopening the furnace. The furnace has been shut down since January of last year. Look at the financial impact. Number one, like we said, 22% of the total financials in FY25. The total exposure of the company clarified to us stating that there are no third-party exposure, only total exposure of close to 350 crore. Cash loss of 9 crores per quarter, which will get arrested now. And going forward, all expenses and cash flow of the subsidiary will be done by the German insolvency administrator.
Okay, all right. Thank you, Vivek, for joining in and giving us all those details. We spoke to the management as well, as Vivek just pointed out. We'll do one thing. We'll slip into a short break now. When we come back, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. Shifting focus now to commodities, and Manisha is joining in to talk about rubber. The futures were in a firm grip, but then they seem to be coming off their one-month highs, Manisha.
Oh, well, yes. There are many more fundamentals which have been supportive for rubber. But yes, after hitting a one-month highs in the previous week itself, we are trading with some profit taking at this point in time. It has to do with the easing crude oil prices, because that is what you use when you want to make synthetic rubber. And if those prices continue to decline, then that weighs onto the natural rubber prices also. Exactly what we're looking at in the markets right now. Also, even as we're dealing with slightly weaker demand in the European markets, the latest numbers also show weak demand and higher inventories in China. Remember, China is where 40 to 50% of natural rubber even synthetic rubber for that matter, is consumed. There are supply concerns because of the adverse weather conditions, whether it has been about Thailand and China is the reason you saw the prices going higher. And the markets do believe that you wouldn't be looking at prices really declining further from here, because as per the report of Association of Natural Rubber Producing Countries, when you look at the year 2025, the output is anticipated at 14.9 million tons, but the consumption much higher at 15.6 million tons. So buy on dips perhaps is a strategy you could be looking at working within for rubber.
Thank you very much for that. That's the update coming in on rubber. But let's get to the big interview of the day. Remember last week we told you the Ministry of Defence has cleared 10 capital acquisition proposals worth more than 1 lakh crore rupees. These proposals will be carried out through indigenous sourcing from Indian companies. My colleague Parikshit spoke to the Defence Secretary R.K. Singh and began by asking him about how the acquisitions will benefit both the private and the public sector. Listen in.
This particular tranche of approvals, or accord of necessity as we call it, is, the unique thing about it is that all of these, 100% of these are meant to be in the category of what we call indigenous design, development and manufacturing, IDDM. All of these projects rely on domestic technology, domestic design, and therefore the entire IPR will remain with us. Many of these are with DRDO, based on DRDO technologies. Others are with different technology sources. So yeah, it's an important sort of reaffirmation of our belief in self-reliance. Increasingly, you will find that IDDM is where most of the procurement will come from, and more importantly, increasingly you'll see that most of these DRDO technologies will be utilized by the private sector through its DCPP model. Many of these projects are also in those categories, and most of the projects, therefore, will be done by a combination of public sector and private sector industry partners, but using domestic technology, as I mentioned.
I would also like to get a sense from you on the AMCA program. An expression of interest has been issued. By when do you want to conclude the awarding of contract?
Well, you are correct. The RFI has been issued by ADA, our Aeronautical Development Agency, and I think they've had some preliminary rounds of discussions with prospective bidders. The timeline is a little difficult for me to say because, frankly, I have not checked with them, but I would imagine it will take something between 3 to 6 months to reach the contract award stage. Thereafter, the project itself of development and of an AMCA prototypes, actually taking to the skies, it should be about a 10-year program, I would imagine.
Could you also list out the major investment opportunities for the private sector and the public sector right now in areas which are going to be a priority for the government and will remain a focus of government capex, according to you?
I think we've made it clear through our budget allocations that we are going to do 75% of our budgetary outlays are going to be spent within the country. And these will cover vast areas of our defense domain, including aerospace and aviation, naval shipbuilding, where out of 60 odd ships under construction, 59 are being built within the country. Land systems of various types, where we have good capacity already. Missiles and munitions, where a lot of the systems integration is done by the public sector, but there are a large number of private sector players who play a role as component manufacturers and vendors. Also in areas like electronics and communication systems, emerging technologies like artificial intelligence, robotics, and of course drones, where there is a significant allocation available for good Indian private sector companies and public sector companies for that matter.
Speaking about the defense budget, considering our experiences from Operation Sindoor and how India will now focus a lot on cutting-edge technology in the defense sector, are we expecting the Defense Ministry to make a recommendation for a significant increase in the defense budget in the next union budget?
I think the short answer to this is that on the CapEx side, there's never been a constraint, actually. There has been a constraint in terms of our ability to actually fully utilize our budget. And we've done it last year, and we are well on the way this year of ensuring that our quarterly expenditure targets are met. So based on a faster pace of expenditure, we can ask for additional money during the revised estimate stage if it is felt that the requirements are more. So I would say that we are, it's likely that we might need additional allocations in the long run, but it really depends on absorptive capacity of the industry, of our own ability to spend money quickly, to sign contracts faster, to take procurement decisions faster. So that process now we've kind of improved significantly last year. I keep saying that we did 2 lakh crore of contract signings last year, which is the double of any previous year, and the highest previous year rather. And we intend to keep up that pace. And if we keep up that pace and we ensure that there are enough committed liabilities and ongoing purchases, then I'm sure we can persuade the finance department to give us additional capex. They've promised to do so always.
Right.
If you're asking as a longer term issue, as far as the Finance Commission is concerned, for the 5-year cycle of the 16th Finance Commission, we are going to be seeking additional allocation to the extent that our defense share in the GDP goes up from the current figure of about 1.9 to about 2.5. But that is sort of broader, longer term, or rather medium term sort of request that we intend to make.
Right. And in the revised estimates, sir, are you going to seek additional allocation, keeping in mind the current procurement cycle?
I wouldn't be able to say right now, but since we've done some additional, some quick procurements in fast track under the emergency procurement, and there could be some other fast track procurements as well. So if our pace is such that we need additional allocation at the RE stage, we'll think about it. As of now, it's a little early to say.
Okay, that is the commentary coming in from Defense Secretary. It's an exclusive interview, and we keep getting you updates from that conversation through the course of the day as well. But remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Markets absolutely flat. Very stock-specific action that we are seeing. So it's a good time to get a technical check on the markets as well. Soni Patnaik from JM Financial Services is joining us for just that. Soni, good morning. Thank you so much for joining in. Been quite volatile. We did see that recovery from the lows. That has been sold into absolutely flat on the Nifty. What is the next important level to watch out for?
Good morning, Sonal. Thank you so much for having me on your show. I think Nifty may continue to consolidate in a broad range between 25,300 to 25,700 for another week or so. And this consolidation range or any declines up to the support levels towards 25,300 to 25,000. So that range, if a decline can be seen, it's wise to initiate a long strategy. I think it has a very strong support for the series towards 25,000. It may defend those support levels and bounce back. But a fresh breakout can only be seen if it's crossing above 25,700 odd level. So I think one has to wait till the consolidation plays out. Similarly, for Bank Nifty also, 56,500 is playing out as a good support, but it is also in a consolidation range. And any fresh breakout in Bank Nifty can only be seen above 57,500 to 57,700 range. Until then, it's wise to adopt a stock-specific strategy as movement can be seen in stocks and sectors more than the indices as of now.
Soni, good morning. Thank you for joining in. What are those stocks then?
Hi, good morning, Horma. So we have two official recommendations today on the buying side. One is to buy Tech Mahindra on current declines as of today in the price range of 1628 to 1636, keeping a stop loss of 1554. A positional target towards 1720 to 1750 levels can be seen. So it's a positional play and one can accumulate in these declines. The second buy pick is in Bharat Forge, which has crossed above all its short-term moving averages and sustaining above a strong support of 1270. So one can buy Bharat Forge at current levels with a stop loss of 1254 and a positional target of 1360 to 1400 plus levels can be seen.
Thank you very much for that. Let's talk about IT because come Thursday evening, TCS will be reporting their first Q1 numbers of FY26 and IT has been an underperforming sector. Year to date, the Nifty IT index is down 10%, while the Nifty is up 7%. So it's underperformed, at the index level by nearly 17%. Ravi Menon, IT services analyst at Macquarie Capital, is now with us on the show. Ravi, thank you very much for joining in. So, just last week, you released a report where you've added Tech Mahindra to your marquee sell list and you removed HCL Tech from your marquee buy list. So let's walk us through the rationale behind this action as we begin this conversation.
Morning, everyone. Good to see you. Two things here, right? So Tech Mahindra, we think valuations are too high. It's the most expensive stock among the large caps. We think the turnaround plan for the firm, to get to peer group average growth, exceed that by FY27, and to get a 15% EBIT margin. Not easy for the management, especially given overall industry growth. It's also not been great last year, and looks like this year is also going to be tough. With this industry, you have 90-95% of your revenue coming from existing clients. So changing your book of business takes years. So I think changing profitability, changing your growth profile, that's not easy for a company with $6 billion in revenue, like TechM. Smaller firms of $300-500 million revenue, it might be just addition of a few large clients or a couple of large deals, that might be enough. But for such a large firm, I think not easy to do it in 2-3 years. That's why we think, Street is wrong to assume that the targets will be met. So we see potential for downgrades here in Tech Mahindra. So that's why we've added to the marquee sell list. HCL Tech, it's done exceedingly well since we added it in May 22. More than 80% returns, more than 20% CAGR returns in that. Now HCL is trading at a premium to TCS and Infosys. We do think that medium term HCL Tech will continue to grow faster than these firms, but over the next 12 months, this Asia marquee, it's a model portfolio for the next 12 months. So over the next 12 months, we think TCS can potentially give better returns as we see margin expansion for TCS back towards the 26-28% band, which should lead to a re-rating. While for HCL Tech, we don't see any near-term triggers like that. We do see a near-term trigger in terms of higher order wins for HCL Tech in the next quarter, but that we think is too little to justify having that about TCS.
You said Tech Mahindra. Got it.
Sorry.
TCS is a part of your
marquee buy list.
Marquee, and is that the only IT stock in your marquee buy list, TCS?
That is correct.
Okay. You said Tech Mahindra is the most expensive large cap IT stock today in terms of valuation. What does it stand at, and how much of a premium is it compared to long-term averages, and what would be the appropriate valuation multiple for Tech Mahindra?
All right. So Tech Mahindra on our numbers is at more than 30 times FY26. Compare that to Infosys at 24 times, HCL at 25 times. LTM Mindtree is trading at similar valuations. You could say marginally below that of Tech Mahindra, but we see that as a firm that can grow much faster than Tech Mahindra. Even FY27, Tech Mahindra is at 25 times FY27, more than like a 10% premium to HCL and Infosys, and like nearly a 20% premium to TCS, which we don't think is deserved. We think that it should ideally trade at a discount. So we are valuing Tech Mahindra on 20 times. So that's the right multiple, we think.
And just talk to us about this TCS. Your thesis that TCS will be able to return to its aspirational margin band of 26 to 28%. I was looking at so many consensus expectations over the next 2 to 3 years. None of them expect margins to go back to above 26% despite a lower contribution from the low margin BSNL deal. So, Macquarie's estimates appear to be a bit of an outlier here. And that is the key reason driving the potential re-rating in TCS. So explain to us, how do you think TCS will get back to these margins?
All right, Rima, as you know, they don't disclose utilization levels. We think that they have a lot of buffer capacity, which I think they've not been able to use because deals have been a little slow in coming through in the last couple of years. There are a lot of cost takeout deals right now in the market as per our channel checks. And we think, as the BSNL contract goes away, they will have that margin flexibility to take on some of this and put some of this unutilized capacity to work. So in a way, you could think about it as there is bench that is right now not utilized. And that's what we expect to help margin improvement for TCS.
Okay. Ravi, this is all about large caps. So what's your take on the mid-cap IT space? Do you think there will be a difference in how these companies perform versus the large caps this time?
I do think so. They will definitely continue to grow faster. This is a trend we've seen from 2018, 2019 onwards. With digital deals, they are smaller. So the small vendors can also actually have an equal chance of winning some of these deals that are, especially in the 20 to 50 million mark. Our topic there is persistent systems. We also like LTTS, where we think that can potentially be a beneficiary of this whole supply chain re-engineering that's happening across the world. So their plant engineering segment can see benefits from brownfield and greenfield expansion for plants.
Ravi, good morning. Thank you for joining in. What about Infosys then? There has been a lot of chatter around the fact that these acquisitions that the company has closed in the last couple of months, that would help them boost their guidance for the full year. Now from 0 to 3%, do you foresee an increase in guidance this time around? And if so, do they have the potential to meet that guidance going forward by the end of the year?
That's a very good question. Like the acquisitions, definitely that has not been factored in. So raising the guidance will be natural. But at the top end, we think it's a bit difficult. We have seen in the last 3 years that the guidance that they've revised up through the year, they've not been able to meet it for 3 years. So I would be skeptical about the top end of the guidance, even if they raise it.
Will that be disappointing? That despite an acquisition, they will not be able to achieve the top end of their earlier guidance?
That would be disappointing, and that would make it the 4th year where they would be missing guidance. I think that's why we prefer TCS and HCL over Infosys.
Okay. All right, Ravi. Thank you so much for joining in with that interesting conversation. Definitely, this is a sector we'll be watching out for closely. Earnings start this week itself. So it's going to be a busy week and months ahead for all of us. But with that, we'll slip into a short break. Management of Senco Gold will join in to discuss their Q1 update and the FY26 outlook.
Welcome back. Continuing to analyze the slew of business updates that were reported after market hours on Friday and over the weekend. Senco Gold was one of them. They saw their revenues grow by 28% and they also saw strong same-store sales growth led by festive demand. And to discuss more on this, Suvankar Sen, who is the MD and CEO at Senco, is joining in now. Suvankar, good morning. Thank you for joining in. You know, you came out with a very strong update, a 28% revenue growth this time around in comparison to what you have guided for in FY26, which is 18 to 19%. Does that give you conviction to up your guidance now for the full year, or would you wait for another quarter before you take that step?
I would be very confident to achieve the guidance that we have given, but to up the guidance, I would rather wait for another quarter. When we look at it, quarter one is one of those festive quarters. We have Akshay Tritiya, a lot of New Years in various states of the country, and the summer wedding season remains in the Q1 part of it. While in Q2, usually we do not have too many weddings, and the festivities are on the lower side. But the focus of Q2 remains to be such that we build up for the festive season that starts in Q3. So I would be, more confident on the 19 to 20% guidance that I have given. But our efforts and endeavor will always be towards, making sure that the numbers becomes better than what we can guide the market.
Okay, so looking to beat the guidance. Mr. Sen, morning. This is Rima here. Talk to us about diamonds. So you've indicated that the diamond volume growth was about 35%. What was the value growth in diamond, and what kind of margins on an average, on the whole, can you do in FY26? Can you do better than the 7.2%, the upper end of the 7.2% that you had guided for?
So the diamond value growth, if we look at it, the volume growth being at 35%, the value growth has been upwards of 45%. So, it's been a good comeback by the consumers with regards to their interest on buying diamond jewelry compared to what we saw in the previous years, Q1 and Q2, where there was a higher, I would say, inclination of the consumer to buy gold jewelry. And I think that at these high gold prices, consumers are looking at buying 14 karat, 18 karat plain gold or diamond jewelry, which falls within their budget. And there has been an effort from our side to continuously come up with new designs, create jewelry which is within the affordable budget of consumers. We've launched almost 5,000, 6,000 new designs in diamond jewelry and in gold jewelry during the Q1. And I think that it's a combination of various festivities and new design development that has led to the consumers have a need of buying such products and such jewelry. And when it comes to your EBITDA estimates, I would say that yes, around 7.2 is what we have said. And we have just ended Q1. While our efforts will be, and with the higher diamond sales, if it continues to happen, there is a probability of it going up. But for now, I think it's better to have our model with a 7 to 7.2% till we move and go closer to Q3.
Okay, so Mr. Sen, you mentioned there's growing consumer demand for 14K and 18K jewelry as well, right? How is this segment with respect to margins when it comes to this particular category? And will you be seeing more launches here? And in terms of store additions as well, will you do better than the 20 number that you had told us?
So we've already launched 9 stores, and in the Q2, we intend to launch 5 to 6 more stores. And then in Q3, the remaining. So while our efforts will be to take on the number 20 and go higher, but I think that till we are closer to 20, we might as well continue to with a focus on 20, while internally we will be focusing on driving higher numbers. And these products, which is diamond, which is these lower carated jewelry, there is a probability of a higher margin. But then again, we have to look at the overall picture. So there is this effort of balancing between growth and profitability. These products will help you with your profitability, but also in the 22 karat gold jewelry segment, since there is the discounting that happens, the gold prices are at a high level. We are offering great deals to the consumers. There are a lot of schemes that are being offered every month, every quarter. So we need to balance between growth and profitability and grow in a sustainable manner.
What about your studded ratio, Suvankar? It was up around over 11% in the fourth quarter. What has it been this time around, and what do you expect to end the year with?
The studded ratio has been close to 11%, and our effort is that to take it to 11.5%, 12%, and the growth that we are seeing in the diamond jewelry sales, we are optimistic that it will be upwards of 11% closer towards 11.5 to 12, and that is largely led because of the high gold prices. So consumers, when it comes to gifting or their anniversaries, I think consumers are looking at diamond jewelry once again. And one thing is that the fall of diamonds that we were seeing over the last 1 year, I think that the prices of diamonds have come to a kind of a bottoming out, and people are now seeing that hopefully in a month or two, the prices will start moving up once again in diamonds.
So do you think you can do better than the 20 to 25% growth in diamonds that you had earlier guided for? Q1 has been extremely strong.
Ma'am, if you ask us, do we think we can do better? We can always do better and better and better. But the question here is that, wanting it, and then the external market conditions that are there, in which sometimes it's not totally in your control. But our effort will be that we should be looking at a good, strong diamond jewelry growth of above 20%.
Last question before we let you go. We know the market conditions are not in your hands, but promoter buying stake, will that continue? Because the stake has been increasing, 64.3% in March. Any more buying likely by promoters?
We'll have to, wait for the results to come out, and only after, there are these lock-in periods. But if you ask me as a promoter on the optimism and the positivity that I have towards the growth of the company, well, that remains positively strong. I can see the market opportunities are there. Yes, one has to look at very strategic way. What is the product that the consumers are looking at? What is the budget that the consumers have to buy jewelry? So as long as we are customer centric and having the right product, I'm sure that the growth for the company will continue to happen.
Just one final question. What percentage of your gold sales or jewelry sales comes from 14 and 18 carat?
The overall percentage would be around 12 to 13%.
And what was this number earlier?
The number was around 8 to 9%. So we are seeing that there is a steady trend upwards towards the 14 and 18 carat and modern designs, Western designs. That is something that we are seeing that in the 14 and 18 carat segment, it is moving up very, very strong.
And this is quarter on quarter, the change from 8-9 to 13-14?
I would say it's more of an annualized versus what we see in the quarter.
So, Ankar Sen, pleasure having you as always. Thank you so much for sparing time and joining us. Look forward to having you after your quarterly results as well. The management there of Senco Gold. Strong business update, but would wait for another quarter to raise their guidance for the full year. The stock in an upper circuit of 5%. Take a short break. The markets continue to remain where they are. Absolutely no movement whatsoever. But we discuss the road ahead with Dharmesh Kant from Chola Securities on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Let's talk about market fundamentals now. Dharmesh Kant, the head research at Chola Securities, is joining us now. Dharmesh, good morning. Thank you so much for joining in. Well, we are just entering that earnings season. So for FY26 itself, what kind of EPS growth are you looking at? And which are some of the sectors which would contribute to the growth that we'll see this year?
Yeah, good morning and thank you for having me. I think Q1 should be again be a muted quarter for the earnings growth trajectory. It should be in a single digit kind of a zone. But for entire FY26, we are seeing around 9 to 10% kind of a growth on a base case basis. And on the upside, it can go up to 12 to 13%. And the sectors which are likely to do perform better is from the mainstream banking and financials are likely to do well. Though, I mean, a lot of catch points are there as to the NIMS compression and all, but to our mind, from Q2 onwards, the tailwinds will start paying out. And that is where the heavy lifting will be done. Apart from that, Reliance Industries, some support from the IT companies, and the automobile sector is looking pretty fine to us. So these are the headline, sectors into the Nifty 50 basket, which are likely to drive the earnings growth going forward. So Q1 should mark the end of the transitory economic consolidation, which was there in the economy for the last 1 year after 3 good years of good performance. And this is a time to do your cherry picking.
Dharmesh, good morning. Thank you for joining in. You highlighted the list of sectors and including Reliance Industries that could lend some support to the earnings growth. But which are some of the sectors that you're cautious on going into the earnings season?
Yeah, good morning, Harmesh. The sectors which we don't like at all is one is the FMCG basket. Though a lot of buzz has been made because of the tailwinds of low inflation, lower interest rate, and good monsoons, things are likely to pick up there. But look at the entire space. The entire space is available at a PE multiple of more than 50x and with ROEs of around 15 to 25% and a single digit kind of a growth. So I don't think the next decade is going to belong to them. It would be more to a growth sectors like defense, railway infra, construction, building materials, and the likes with renewable energy segment. So FMCG one basket which we are avoiding, and then the other basket which we are avoiding this entire FY26 is the pharmaceutical space. There also, to our mind, 15-17% can be the best case scenario for the profitability growth. And the valuations are already stretched for most of those companies. So there also stock price action won't be there.
On FMCG, you said you don't like it, but so far the updates are pretty okay, pointing to some healthy recovery, particularly in the rural market. Urban is also showing nascent signs of a pickup. So is it the valuation that makes you uncomfortable? What is it? And what can change your mind on FMCG?
Yeah, definitely. Yes, Rima. If you look at updates, it has been a low single-digit volume growth. And with blended realization, the best scenario can be made is around 8 to 9% kind of a value terms kind of a top line growth with some stable margins. So if you are compounding at say 10-12% kind of an profitability, valuation definitely becomes a concern if it is available as a 50-55 times 1 year forward PE multiple. So that is the challenge for the entire FMCG basket. Last decade was different. It was the time when you were looking at stable earnings growth, but going forward, the next decade would be more on the growth drivers where you can find at least 15-20% kind of earnings growth because the index itself is available at 20-21 times PE multiple, and this is likely to continue for at least 2-3 years going forward. So to our mind, it's a growth sectors with sustainable, stable kind of earnings trajectory. Visibility should be there. Those are the sectors which would be driving the growth on the stock price as well. Rather than FMCG, it can be at best a trading place. In between, you can get with such, 7-8% kind of blended realization update coming from Dow or others in the like. You can get a trading pop of 5-7%, but that should be the end of it.
Okay. Dharmesh, you have some cyclical plays as well that you're looking at this juncture where we are in terms of a macro cycle. Some of that which would immediately work out and some which would take some time to see some reward.
Yeah, the things which can immediately work out is the automobile sector, and there I think Hero MotoCorp remains our topic. The reasons are very obvious. One is the valuation comfort is there. It's available at 18x 1 year forward PE multiple. And it is just, the volume sense has just picked up on the entry level side with all the tailwinds of lower EMIs and better monsoon, with festive season coming in, with marriage season already playing on. So I think 550,000 run rate of its motorcycle sales for next 2 months is likely to be in place. And then the base effect also comes into play, because last year, if you look at July, they sold around 370,000 bikes, and August it was 512,000. So there also optically, a run rate of 10-12% kind of a growth would be there. It's already down 30% from its peak level. I think this company can easily command a P multiple of 20-21. So this is one play which we are liking from the automobile space. Other than like the likes of say M&M or Eicher Motors, so those two are the two different picks which we are liking. And the others as a segment, the theme which we are liking is the entire renewable energy segment, be it IPP like independent power producers like NTPC Green, or solar panel producers like Waaree Energy, or the power financiers like PFC. Again, everywhere there's a huge valuation comfort as well as the compounding of 20-25% kind of earnings trajectory is there. So these are the baskets which we think if you're holding it for 3 to 4 months, decent upside of 10-15% on stock price can be expected.
What about the PSUs? I was about to ask you that question, Dharmesh. Their entire wide gamut that the PSUs have, the stocks have run up significantly, right? Be it the defense names, the railway names. Where is it within the PSU basket, other than the RECs and the PFCs, where you find comfort, or you do not find comfort in any other space within the PSUs other than these names?
See, I mean, two comfortable spaces. One is defense, but that again is from a long haul. You should not be looking at from 1 year, 2 year kind of a perspective. If you are looking at the defense space from 3 to 5 years perspective, it's a very good bet. I mean, the reason being, if you look at the entire, sales of top, say, 13, 14 companies in the defense space, it is around 70,000 odd crores. You can buy 30 Rafales or, 50 nuclear submarine at that kind of a revenue. So, I mean, plenty of scope there from overall and servicing company to a shift to sub-part and part manufacturing to eventually a OEM kind of a manufacturer. So that is one space which we are lacking from a good investment perspective, but you have to be patient and keep it holding for at least 3 to 5 years. And the other space from the PSU gamut which we are liking is the railway infra space. Again, a lot of modernization and things are likely to take place in the railway space. It's not just metros and, 4-laning or multiple railway line tracks being there. It would be eventually a bullet train kind of system, as is evident in Europe and other countries. So India will eventually migrate to that. That will again entail a lot of capex, a lot of revenues and profitability building into these companies. So there, I think Ircon International looks decent compared to the valuation multiples with relative peers like RBN and all. So these are two spaces which to our mind looks very attractive, but these are long distance space. You should not be looking at it from a quarterly basis, rather look at it from 3 to 5 years kind of perspective.
Thank you, Dharmesh, for joining in and sharing your perspective. For the markets, it's quiet, but with a negative bias. IT is under pressure. Earlier we were chatting with Ravi Menon of Macquarie, and he was talking about how Tech Mahindra is the most expensive large cap IT name. The stock has slipped further. It's now down 1.8% at the day's low. The stock is trading at 30 times FY26 PE, and even FY27, it's above 25 times, so expensive to his mind. HCL Tech has lost nearly 1%. Defense stocks are correcting from last week's up move. Metals are under pressure, namely Hindalco. On the way up, it's consumer, one way. FMCG index is up 1.5%, and in the large cap space, HUL, Tata Consumer, ITC, all up between 1 and 3%. We will get into a break on that note. On the other side, we will get you more in the markets, and we'll also talk to you about what's happening with the city gas distribution companies.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, we've been talking about how this entire oil and gas space has been in focus. On Friday, we got those guidelines coming in from PNGRB. And now there are some notes which are talking about the impact. In fact, Citi has gone ahead and raised the target price on IGL specifically. They have a buy call. The target price is raised to 270 rupees a share. They say they are raising EBITDA margin assumptions from 6.5 to 7 rupees per SCM to 7.5 rupees per SCM. This is because now they're expecting a reduction in transportation costs for gas for these companies. Now remember, all these city gas distribution companies will only have zone 1, which they will consider for tariffs. That won't mean for IGL gas costs would come out, something that we had indicated earlier. This would mean that IGL would be the key beneficiary of the change in these norms, because so far company was in zone 2 and zone 3 when it came to tariff, but now it will be zone 1 where tariffs are the least. In fact, ICICI Security also says that changes in tariff zones will be positive for IGL. However, that would not be the case so much for MGL and Gujarat Gas, because for MGL it could impact their earnings by 3.9%, and for Gujarat Gas it could be impacted by 6.6%. So IGL really tends to benefit the most because of the changes in unified tariffs. Again, we need to know whether tariffs will increase, decrease from here on. That is something we are waiting. GAIL would be in focus on the back of that. But so far, whatever has been the decision by PNGRB tends to benefit IGL the most.
Does tend to benefit IGL the most. The stocks, they moved higher on Friday, not doing a great deal in today's trading session. What's doing not so well, today's Jubilant FoodWorks is now down to the lowest point of the day, 4% lower on that stock, but its peers are surging. And how? Godrej Consumer is now up 5.5, almost 5.75 now. Dabur is up 4.5, and the one that has sprung up among the top gainers is Jyoti Laboratories. That is now up almost 6% as we speak. At the highest point of the day is Dabur, and Jyoti Laboratories too at the highest point of the day, 5.5% higher. But with that, we take your leave on this edition of Trading Hour from the trio. Thank you so much for watching. Halftime report on the other side.
Stocks trade in a range ahead of a likely India-US trade deal announcement. FMCG and crude oil users gain, while metals and industrials drag.
India and US are close to striking a mini trade deal in the next 48 hours. Negotiations on the pact are mostly complete and offer a fair deal for India's labor-intensive sectors, with some concessions for select US agri products, and pencil in an average tariff rate of 10%.
IndusInd Bank sees a dip in both advances and deposits in the first quarter, but retail deposits remain mostly steady quarter on quarter, suggesting customer confidence in the bank. Analysts, however, remain divided on the stock.
Godrej Consumer, Dabur and Nykaa point to consumption ticking up. Jewelry makers Kalyan and Senco post strong Q1 growth, and QSR major Jubilant Foodworks clocks healthy pizza sales.
Defense Secretary R.K. Singh says India will up its defense spend to 2.5% of GDP from the current 1.9% in the next 5-year plan. Starting FY26, he adds that the contract for 5th-generation jets will be awarded in the next 3 to 6 months, even as developing a 5th-gen jet and taking it to the skies can take 10 years. The management of HAL confirms the same. You're watching us here on Halftime Report. Good afternoon. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Ekta Batra. If you look at the markets today, just the frontline indices, you would not be, mistaken if you said that there's no move which is taking place. But beneath the surface is where a lot of action is, underway. Most specifically in the consumer space, we do have, the FMCG stocks which are buzzing around in today's trading session. We got a slew of updates that came in over the weekend, and that suggests that maybe the consumer sentiment is improving. And not only are the related stocks moving around, but we have HUL, which is the top Nifty gainer right now after nearly 5 years of doing nothing. The street believes that maybe the worst of consumer sentiment is behind, and perhaps these are priced in. How this moves along from here is something that we'll discuss through the course of the show. We'll talk about these updates, and we'll probably get in an analyst and an expert to join in as well. But a bunch of stocks in focus, Ekta.
Hi, Mangalam. Yes, absolutely. We do have a bunch of stocks which are in focus, but really it's the market which is completely in wait and watch mode amidst the tariff deadline uncertainty at this point in time. But separately, we do have the Q1 updates to reckon with at this point in time. And remember that it is an indication that earnings are kicking off this week itself. We have TCS on Thursday, and then stocks such as DMart, which will be releasing its numbers on the 11th of July as well. So we have an action-packed couple of weeks coming up, and maybe a couple of maybe the next 24 to 48 hours when it comes to any kind of developments when it comes to tariffs. But nonetheless, let's kick off the show with a couple of stocks. Borosil Renewables, the German arm, has filed for bankruptcy due to demand paucity and depleted market conditions since January. Vivek is here to tell us about this interesting story. Vivek, over to you.
Well, that's right. Over the last couple of years, similar to what was happening in the Indian solar glass manufacturing market, demand in Europe has been muted, and also the solar glass industry itself, while end-user demand has been quite robust, the demand for the solar glass that Borosil manufactures has been muted, mainly due to the back of the fact that Chinese players have been dumping, large quantities of that particular solar glass that Borosil manufactures at much lower rates. So there has been significant dumping that Borosil has witnessed over the past couple of years, especially as far as the German operations are concerned. So taking this into account, in January, the company had pulled down the furnace, so operations weren't going on anymore. And now GMP has taken a decisive action to file for bankruptcy. Now, why is this material? Why is this important? FY25, 22% of total consolidated top line came in from this particular operations, and it was EBITDA as well as PAT loss making. Now, what is the company saying? The company was saying that in terms of financial, total exposure was close to 350 crore. On a monthly basis, the company was incurring excesses of close to 9 crores, which now immediately stops. And earlier today, we also had the management. So the management said, in terms of exposure, there are no third-party exposures. All of the debts are from the parent Borosil Renewable only to the extent of 350 crores. Indian operations are doing quite well, and in fact the company said EBITDA margins are expected to inch up higher, and also 27 crore on account of the monthly loss being arrested is something that can be added to the bottom line. So overall, on the back of the loss being arrested, Borosil Renewables is doing quite well.
Take that point entirely, Vivek, and plus the cycle is moving as well. That's what the management has been telling us for the last few quarters. In fact, this morning itself, the management joined in Mr. Shrivar Kheruka, and this is what they had to say on this matter.
The government probably needs some time to wrap its head around how they want to restructure the solar manufacturing in Germany. At this time, there's an interim administrator who's been appointed, and he'll make a report, and then he's going to go back with his recommendations, which might take about 3 months. Our exposure is €35 million altogether. We have funded about 20 out of this was 27 million was funded by us. So the exposure is not something which I can speak about now, because we have sizable assets. There's a very large plot of land. There's a very strong construction. There could be other uses to which this property could be put. Margin trajectory is only going to improve. It should not deteriorate from what I can see. The demand is very robust in our country, and we continue to meet the demands of our customers. So we're looking at a 60% expansion, and this will allow us to devote our full time to this. In the past, we have been devoting time to things that were not productive. The revenue has gone, but the profits have gone up. To the extent maybe nearly 27 crores per quarter is going to rise.
Okay, all right. Well, on that note, we need to take a short break. But remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists, shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. Well, for the markets, there's a little bit of a pressure that we are seeing incrementally at this point. So the mid-cap index is down around 0.2%. We have the Nifty, which is just about lower by around 30 odd points. So nothing really to write home about. And the Bank Nifty also, which has lost over 130 odd points. If you are talking about specific stocks, Manglam did mention HUL, which is your top gainer on the Nifty. But if you're talking about top losers, it's TechM from the IT space, which is losing out. So that's stock is down around 1.8%. A couple of the cement stocks are under pressure as well. So Ultratech Cement, Shree Cement, both those stocks are showing a cut of around anywhere between 1% to almost 2% for a couple of these. So that's what's taking place in the markets. Quiet at this point in time, just about in wait and watch and consolidation mode. So what are the F&O cues throwing up? Manglam, tell us more.
Well, not too different from the fact that there is still some consolidation. You know, the frontline indices are consolidating. We've seen rallies from lower levels of 25,330 thereabouts that we saw in the previous trading session on Friday. And we've also seen sell-offs from levels upwards of 25,670 thereabouts, which was again the high that we saw in the week prior to the previous week. So that's really the broad range, 25,350 to roughly 25,650. And the market has been meandering between these ranges itself. The frontline index down by about 0.1%, the Nifty Bank down by about 0.25%, the mid-cap index as well lower by about 0.25%, but no such problems for the FMCG space. You know, over the last few days, we've seen one IT day, we've seen one, Nifty Bank day, we've seen a lot of the cement days and power days as well. But today's day definitely belongs to FMCG on the back of good updates that have come in from the likes of Godrej and Dabur. HUL, the leader of the pack, has no update, but is taking a note of all these others which have reported the numbers. And similar is the kind of case that we're seeing for names like Colgate, Tata Consumer Products, as well as Britannia as well. We had Varun Berry join us a week ago and say that they're not too far away from double-digit growth for the entire sector. And all of this is playing out right now. But for the frontline index, consolidation continues. We have 25,400 put, which is fairly active in today's trading session, as is the 25,450 put. What's the premium of the 25,400 put? 95 rupees. Pull up the 25,450 put, you have a premium of almost 108 rupees, telling you between 25,300 and 25,350 is a strong amount of support. In fact, that's something that we've seen play out in the previous trading session as well. But around 25,600, we will see some supply. That's the story that is visible from the 25,500 call, which has a premium of 94 rupees. Apart from, the FMCG stocks, a lot of stocks, other stocks in focus belong to the capital markets play. IIFL Finance, which was lower in trade in the previous trading session on account of the decline that we saw on capital market plays, because Jane Street is now bouncing back smartly and currently seeing a lot of long positions being built up as well. But we are seeing some shorts build up on InfoEdge as well as Jubilant FoodWorks. Remember, Jubilant FoodWorks reported a good update for the first quarter, but valuations over 75 times, not giving enough room for an up move on that stock, explains why we are seeing some short build up despite a good update.
Okay, all right, Manglam, thanks very much for that. We do now have Manish Hathiramani joining in to discuss the technicals of the market. Manish, hi, welcome to the show. It's a quiet day, lot of consolidation in today's trade. What's your strategy for the Nifty?
Good afternoon to you and to all our viewers. Thank you so much for having me on the show. Well, I feel Nifty is still a little sideways, because 25,600 to 25,700 was a resistance point, which we achieved. So the index is still trying to decide on the next course of action. While the structural bias still remains on the upside, it might take a few sessions for us to understand the direction of the Nifty. If the index moves up from here, we should be looking at 25,850 to 25,900 as a target. A very good support lies around 25,300.
All right, 25,300 to 25,700 is the broad range. Manish, individual stocks, what are you liking right now?
I'm working with two buy calls. My first one is on Reliance Industries, which is for a target of 1,600, stop loss 1,475. The stock has been in a steady uptrend, and we have also crossed the highs of 30th August and 27th September from last year. These have happened on the back of healthy volumes. The second one is on a BPCL, target 370, stop loss 330. The last 3-4 sessions have seen good volumes. Apart from that, the stock has also gone past its recent high very easily, therefore signaling a positive structure.
If you're positive on Reliance, then is your long-term view on the Nifty also on the positive side? Because if the Reliance stock has to go at 1600, go to 1600 right now, it would take the Nifty to around 25,600, 25,700. Thereafter, what's your call?
Definitely, Mangalam. I still feel the structural bias on the Nifty is on the upside. As a trader, we would only like to get into the chart, get into a trade only when we have a proper directional breakout. Having said that, if we can get past these levels, 25,900 is a target that I would work with.
Okay, all right, Manish. Well, on that note, we need to take a short break with the news that the markets are still under pressure. We'll come back. But up next, we have an interesting discussion. We have Abneesh Roy, the Executive Director at Nuvama Institutional Equities, who join in to discuss the Q1 FY26 business updates of all of the FMCG stocks. Stay tuned.
Consumer stocks, they are in focus right now. Godrej Consumers moved to the high point of trade, up 6% right now. Even Dabur's doing extremely well, 4% higher. And on the back of that, we are seeing some traction in HUL. We are seeing some traction in Colgate. All the stocks actually doing a lot better. We do have Abneesh Roy of Nuvama joining in. Abneesh, the updates do suggest that the worst of demand is behind all these companies. What we want to understand is that these stocks which have been underperforming in the past, can they return to their glory days just basis this update coming in? Yes, there is a relief rally that we're seeing in a lot of these stocks, but the underlying problems, not all of them have gone away, right? While there is some sequential recovery, margins are still not back to their all-time highs. Companies are believing that there could be some improvement in the second half of this year. What are your thoughts on this entire space and the updates that have come in over the weekend? Anything that you liked in particular?
Sure, thanks and good afternoon. Yes, we were expecting stocks to do quite well, and we expect that the recovery in terms of urban will soon start. In some categories, it has started. So 4 key things. There is high under ownership in the sector. If you see the FI selling numbers which have come last 2 months, there's been a lot of FI selling in the FMCG sector. And if you see the business update, they are telling a different side of the story. So Marico, in our view, we don't rule out 9% volume growth in the Q1 for the domestic part of the business versus 7%, I think, which the consensus was expecting. Again, same thing, Godrej Consumer, HI saw a spectacular recovery in the June month versus earlier expectation of 2 to 3% India volume growth. They will end at around 4 to 5%. Even Hindustan Unilever, we expect that it will positively surprise versus the muted expectation, which I think most part of the consensus has, and the fund managers also from a HUL perspective have a very muted expectation. We expect that maybe 4 to 5% sales growth for HUL is highly possible in Q1. So we are seeing the raw material side also play out. So you asked a right question whether margins will improve. Yeah, in food companies, it will start improving. So Britannia, BKG, to an extent Nestle, etc. For Godrej Consumer and HUL, our sense is exit part of the Q2, we will see the recovery because there's a lag of PFAD versus palm oil. Coffee cost has also corrected. So except one or two like copra and maybe tea, most other commodities are under control. So valuation clearly favorable, under ownership, recovery from macro perspective. HUL in the AGM highlighted that a lot of the macro is now falling in place. I will expect the sector to do well, and consensus upgrades are also possible. For someone like a Dabur, I think still they need an answer to Campa Cola and overall Chyawanprash, how to contemporize the product to the youth. I think that's needed. But in most parts of other where non-summer is there, we are positive. Summer portfolio clearly will see challenges. So Varun Beverages, Imami, etc. will see weak numbers in Q1, but that's because of the season.
Okay. Well, Abneesh, Godrej Consumer is reacting very well to its Q1 update. What did you think of it and the fact that they've said that volume growth has been strongly competitive and they expect it to sequentially improve?
Yes, so 2-3 things the consensus liked on Godrej Consumer. So this is the second successive quarter where their slightly challenging category of household insecticide has seen a good number. So last quarter Q4 was 15% sales growth in the HI in India. This quarter again mid to high single digit, and that's not a bad number after a very weak May month. So May month was very challenging. June month saw spectacular recovery. Second, of course, the GOM part of the business, so Africa, etc., that has seen a strong double-digit volume and sales growth. So that's a key positive. Third, of course, outlook from a margin perspective, clearly worst is behind. Q2 still will be under pressure more because of the lag effect. Otherwise, if you see palm oil and PFAD are correlated, there is some lag. So in H2, we'll see very smart recovery in the margins. So investors are getting a comfort that yes, Indonesia is challenging for the next 1 year, but that's a very small part of the business, right? Ultimately, India and GOM are bulk of the business. And there we are seeing that numbers are improving both on the volumes and from a margin outlook, we'll see recovery, strong recovery in the margins in H2 for GCPL.
All right. I wanted your thoughts in particular on the consumer discretionary side. Now, it's not that we got any weak numbers from Jubilant FoodWorks. This was extremely strong, the second or third quarter of double-digit like-for-like growth. Even Nykaa, no problems out there. At the same time, Kalyan Jewellers as well reported a very strong growth at 31%. But all these stocks have been outperformers in the past and are now selling off on the back of good numbers. And which is why my first question to you, is it only because of under-ownership and underperformance that these stocks are rising? Can this outperformance sustain? Because in the case of discretionary, they aren't sustaining. At some point, valuations kick in and we see profit booking. Case in point, Jubilant FoodWorks down 4% right now from the highs.
Yeah, in any stock, I think there will be multiple things to watch out. But yes, broader theme, what we see is staples under ownership is there. Plus rural, whatever can go right in terms of good monsoon, government having a more liberal exports policy, a lot of freebies being given by every state government, etc. That obviously the discretionary companies have a much lesser play in that. So that is one more thing. Yes, from a raw material side, again, if you see the FMCG companies will have more headroom to retain that. In QSR also, maybe there'll be some benefit here and there in terms of the margins in the second half from a lower dairy cost, etc. But overall, FMCG margins clearly from a palm oil perspective, from a lower coffee cost from the Q2 perspective, or even in paint companies, if you see, we see that gross margin should improve this year and EBITDA margin also mostly. We see that the margin trajectory is much more predictable and on the upswing for the FMCG rather than discretionary. And discretionary stocks, you rightly said, last 1 year, 2 years, they have done much more better. While FMCG last 3-4 years, many stocks like HUL, Dabur, Asian Paint have not given any kind of wealth generation. So that's the catch-up which is also helping.
Staples over discretionary is the big call right now. On retail, I wanted your thoughts also, because we did get the update from Avenue Supermart. 16%, one wouldn't say is very bad, but the stock saw a bit of a sell-off post that. Trent was the big underperformer, 20% growth only versus 25% that the company itself had guided. And we saw a reaction on the stock on the downside, 11% lower on Friday. What have you made of V-Mart, Avenue Supermarts, V2 Retail and Trent? And what's the trajectory for them likely to be going forward?
Yeah, absolutely. DMart, Avenue Supermart, good set of numbers, 16%, 17%, one quarter here, second quarter. I think broadly it's in the same ballpark number. The opening store in Agra, I think that's a very key development because UP is India's largest population state. And if they're going beyond NCR, that clearly shows that UP over the next 3 to 5 years can become really, really big in terms of store addition. Store addition was also quite good for Avenue Supermart. So Avenue Supermart, overall, I will say that should do well as a stock, medium term, long term. Of course, margins we need to see because the quick commerce continues to be an issue. But quarter on quarter, we see some recovery in the Avenue Supermart because of the seasonality. Coming to the gold jewelry companies, there most of the growth is coming essentially from two things. One is very high gold prices, and second is the store expansion. So that's why I think because stocks have done reasonably well, there is a question mark that if gold corrects, then what happens? So that is the small difference. So you will not have every stock react to the good numbers every quarter. In terms of the apparel, clearly V-Mart had slightly impact of the shift of the season, right? Eid has shifted, and that's why my sense is some of the apparel companies will see that impact in some of the market. That doesn't mean that the entire year will see that impact. So it's more of a seasonal shift, festival shift in some of the apparel retailers, which is impacting them. Nykaa, frankly speaking, here the margin improvement is what investors are watching for. Of course, we had a block deal last week, which was slight supply overhang. But in their core business, I think they are doing reasonably well. Now investors are looking for overall console margin improvement, which I think once that happens, then the stock will lead it. Till then, I think overhang on the Nykaa is there from a margin perspective.
Okay. Well, Abneesh, what has really been in focus is the entire paint space. And interestingly, we had a brokerage which upgraded its call on Asian Paints as well as Berger recently after 4 years of a negative stance. The fight for number 3 continues and it's probably gotten even more difficult now. But your sense in terms of what the dynamics would be and how they would play out when it comes to earnings for these front-facing paint companies now?
Yeah, good question. Again, 3-4 things. First is here also we are seeing core paints. The volume recovery is there. If you see the second half of FY25, the core paints for the industry saw some decline, 1 or 2%. Don't measure this against the reported volume growth because the reported volume growth of Asian Paint and some of the paint companies also has non-paints like waterproofing, construction, chemical, which grow obviously much faster, putty, etc. So what we are picking up now, the core paint for the industry is seeing low single-digit volume growth. So clearly this mirrors with what HUL is seeing in terms of macro improvement leading to overall demand improvement. Marico reporting stronger volume growth. Godrej Consumer also reporting stronger volume growth. Dabur seeing mid to high single-digit volume growth X of summer in most categories. So it's again mirroring that. Paint, in our view, worst is behind on the demand side. Gradual recovery will happen. That also is reflective in terms of the very high promotional intensity which was there in the mid and premium end of paints. We are picking up that promotional intensity is now high largely in the lower end. When I say at the mid and premium, it is not as high. I'm referring to the peak. From the peak, there is a correction. It's a lower intensity. Of course, consolidation has happened. And once the approval comes, Axo will not be there. It will be JSW. So yes, in this industry also, growth is coming back. Gross margin, no problem whatsoever. So we see Asian Paint deliver 18 to 20% EBITDA margin for the full year, FY26 versus 17.5%, I think, last year. So there is an improvement on EBITDA margins for the market leader. Sector, again, very under-owned. Again, Asian Paint stock performance last 4 years, there has been wealth destruction and not much. So I would say that again, Asian Paint, HUL over the next 1 year, if the demand recovery happens, good wealth generation will happen.
All right, take that point up, Nish. Thank you so much for that. So the big headline for today is the next 1 year belongs to staples over discretionary. The last 1 year, discretionary has done well. Now it's time for staples to shine after underperforming. Well, will they be supported by commodities or not? We have Manisha Gupta on the other side of this short break. Joining in, Bimal Kothari, the chairperson of IPGA, joins in on the Commodities Corner.
Welcome back, and joining us on the show now is Chairman of IPGA, Bimal Kothari. Mr. Kothari, thank you so much for joining in. First of all, your sense on the sowing numbers itself, which seems better than last year. But when you look deeper, when you look at each of those pulses, that is where the devil clearly appears. What has been your sense on that till time?
Thank you, Manisha, for inviting me. So far, I think it's too early to predict the numbers, but whatever the information we are getting, I think for mung beans we had a good crop we had a good summer crop, and the kharif crop also looks good, and urad also is as of now it looks good. I mean, if you compare to the earlier years, I think we have a good showing so far. And tuar, of course, in Karnataka and some places we see that what we are getting that it might be down by 25%, but it is too early to predict the numbers now. There might be a little bit shortfall in tuar, but as I said, it is too early because the entire month of July is still, the window is open, so we can see the planting to grow, catch up. So I don't think this is a good time to talk about the numbers, but so far it is satisfactory, except tuar, where we have seen it. There is a little bit concern, but as I said, the window is still open, so we can still catch up.
Mr. Kothari, would you say concern is also to the point because most of these pulses have been trading below MSP? Do you see a shift of area to other crops then?
Yeah, that we have seen. I mean, that is why I'm saying the crop of tuar looks a little low, because in MP and in Karnataka also, the information what we are getting, there is some shift to the crops. And this is what we have been telling, because the cheaper import is definitely hurting the farmers. And so that's why the farmer might be discouraged to to plant these crops. So though the government has assured that they will buy the 100% of the crop, at least as far as the tuor and udar and lentils are concerned. But that is we have to see practically how far that is possible. But definitely this is a really it's a big concern because if you look at the import prices, say for example now in during the Kharif we have tuor, udar and moong. So tuor Kharif prices the MSP price is 80 rupees, whereas now the next month we will see the import taking place from Africa, and we understand they have a good substantial crop of about 1 million ton. And as of now, the lending cost is around 50 rupees. So, and whereas our MSP is 80 rupees. So definitely there is a concern because the cheaper import will definitely suppress the prices domestically. And the farmer may, they may like to then shift to the other crops, which are more remunerative. So this is a concern which we have addressed to the government several times. I'm sure that the government will look into it because the government's main concern is the inflation. But I understand now that the price of most of the pulses are below minimum support price. So the concern of the inflation has been fully taken care of. I think they should definitely look into the interests of farmers as well as the trade industry also.
Absolutely. Mr. Kothari, also, what's your sense really when it comes to imports from various other countries? Because yes, financial year 2025, we've seen record imports come in. But when I look at the data for April, May, even June for that matter, the imports have slightly come off. Is that a pattern that you see going forward as well?
Because we had a large import. In fact, it was a record import of 7.3 million tons during the last year. So we had a carryover stock from the imports. So that's why there has been the import has been has come off. But you see, now the new crops are going to be harvested in the origins. For example, in Russia and Canada, the new crop of yellow peas is going to be harvested, and the prices are coming down. Already, in fact, we are getting the price of around $325 to $330 as against $385 to $400 last year during the same period. And also as I mentioned about the tuor crop is getting harvested in East Africa, so we'll see a good amount of tuor arrivals in the festival season, and price, I'm sure price will further go down. It's already the African tuor is selling around 55 to 60 rupees in Indian market now, and I feel that this will go down to around 50 rupees.
50 as
if
well.
you look at the other pulses like lentils is also going to be harvested in August. So I see that in the coming months, and looking at the festival demand, and though we have enough stock in the with us, so I don't think we require a very large amount of imports. But because of the price parity and the origins are having very good crop, sure they will bring down the prices. And because India is the biggest market as far as the imports are concerned, so they will like to sell their crops into the Indian market. And also I will like to mention about the udar. There is a good crop of udar in Brazil also. They started just 2 years back from 5,000 tons, and we are expecting about 250,000 tons this year. So you see that all the origins, they are looking at the Indian market and they are growing a lot of pulses. And also now, as our government is also striving to achieve the self-reliance, our production also this year was good. And so that's why we need to balance the import so that the cheaper import is not hurting our farmers. So we have advised the government of India several times, and again we will keep on harping on this issue that the government should balance the prices by imposing the dynamic duty. They should impose the duty that the lending cost of imported product is not less than the minimum support price, so that the minimum support price policy doesn't become irrelevant.
Okay, all right, Manisha. Thanks very much for taking us through that conversation. Just need to get back to the markets at this point. Well, it is still static, but we do have the advanced decline ratio, which is still on the declining side. So let's see whether that worsens as the day goes along, but just about wait and watch mode currently for the Nifty and the Sensex. We'll take a short break, but we'll get you a lot more in terms of specific stock action on the other side. Stay tuned.
Welcome back. Let's focus on the primary market action then. SmartWorks Co-working Spaces will open its IPO on the 10th of July with a fresh issue of nearly 445 crore rupees. Nitish Sarda as well as Harsh Binani spoke to Reema Tendulkar about the IPO details, the company's strategy post-listing and whether they turn profitable or not.
We are technically profitable. Okay. The numbers that you see reflected on our financial statements are because of the accounting impact. Our adjusted EBITDA, in fact, grew by more than 3.5 times from about 36 crores to about 177 crores in FY25. So currently our net debt stands at about 310 crores.
Okay.
Post the IPO, we are also repaying close to about 114 crores of high cost debt. And the company is in fact going to turn net positive right after IPO. We will be net debt positive, so we will be debt free.
Debt free. And what about at the bottom line?
So our bottom line, just to give you a perspective, has actually grown by more than 3.5 times in the last 3 years. So the last year's numbers in FY25 was 176 crores. And technically, if we exclude the accounting impact.
So could you give us those numbers? Now I can see FY25 revenue, operating revenue was about 1374 crore rupees. Your EBITDA was about 857 crore rupees, and you come up with an EBITDA margins of 63% thereabout. Break it down for us line by line after this.
Absolutely. So once we take the about 850 crores that you just mentioned, the first adjustment that you would basically make is for the lease rentals that we end up paying, which is close to about 650 crores. Then you have the additional 40 crores that we pay as financing cost. The balance is the amount. Once that is adjusted, you derive the number of 177 crores.
Okay. So debt from 310 becomes
close to about 220-ish.
Okay.
But the cash
I'm still trying to
is
get the thing right at the bottom line. X of all the adjustments, what I can see on my P&L, when do you think you will turn profitable?
So while I will not comment on the exact timeline, what I can give you a perspective on is that our revenue has grown by more than 2 times in the last 2 years. In spite of the massive revenue growth, our EBITDA has grown by more than 3.5 times. So it is going to be very imminent in the near future.
Imminent in the near future, okay.
Where the company is
so 15% margin
performed.
Sustainable, or can you expand on it?
So it has been expanding over the last 2 years. I can't comment on the future numbers, but if you look at our trajectory in the last 3 years, we've significantly expanded 4x our adjusted EBITDA to get to that 177 crore mark. And we've grown significantly in this time, both in terms of square footage. We were at about 6 million square foot at that point of time back in 2022. We've grown to almost more than 10 million square foot today in 2 years. So our base has increased, our revenues have almost doubled, and our EBITDA margins have increased by 3.5 times.
Okay. And this revenue CAGR, I think I can calculate it close to 40%, 38, 39%. Is that the run rate? Do you think that's possible going ahead as you continue to scale and add capacity?
See, India definitely has the opportunity right now. If you look at the market, flex space market in India was significantly small back in 2016 when we started this business. In a short span, it's grown to almost 80 million square foot of space across the country. If you look at CBRE's report, they've projected this number to go up to 145 million square foot. So the base of the industry itself is growing significantly. India is actually becoming a large flex market. It is one of the largest flex markets in APAC region today. So you'll definitely see the market evolve further, but we can comment on the last 3 years where we've seen a significant jump, as you rightly mentioned, almost 40% on a CAGR basis.
And today, I think you've got 10 million plus square feet in terms of what you're operating.
Yes.
How will that number change? I mean, what are your ambitions 2 to 3 years down the line? And even geographically, would you be looking to expand into tier 2 cities or go deeper in Singapore or add any other international markets?
So our strategy is obviously to keep growing the base. We have been able to grow at a certain pace in the last 2 years, which is 1.5 times that of the industry. Industry has only grown at about 23-24%, while we've grown at almost 1.5 times of that at about 38%.
And of that 147 million square feet of space which is going to come up, how much do you think your share would be? From 10 million, where do you go?
So I think I can't comment on the future numbers, but what we can say is that we have grown faster than the industry.
1.5 times.
Again, 1.5 times faster than the industry. It is because of our model choice of what SmartWorks really does. we have created a true platform. SmartWorks today is India's largest managed campus platform. We take up buildings from non-institutional landlords. We don't take a floor or a part of a building. We take mostly full buildings. We convert them into large campuses with all the amenities that today's day and age employee requires. So we'll have outdoor and indoor gaming zones. We'll have multiple, we'll have gyms, creches, cafeterias, collaboration zones, medical rooms, all of this designed within our common spaces of the building before designing, custom designing, building and maintaining the space for our large enterprise clients. Our focus is on mid to large enterprise clients. Almost 90%, 88 to 88% of our revenue comes from enterprise clients who are committing to more than 300 seats. 65% of our revenue comes from clients who are committing to more than 300 seats. If you look at that, our ability to take up such large buildings, which is unique, we take up on an average about 180,000 square foot of building, which is significantly higher than the industry average. We give it out to large enterprises who are looking on an average, about 65% of our revenue comes from clients who are taking more than 300 seats. So they are taking that much.
Very quickly, so tell us, promoter holding is 65%. Y'all are selling partly in the offer for sale. What would that number come down to? And what are the plans? Are promoters going to stay long-term? I mean, are you long-term committed to the business? And even the big investor selling is Keppel Land, and they were early backers of yours. So what's the signaling there?
No, certainly. So Keppel Land has been a very long-term strategic investor in the company, and in fact, they've reinvested in the company as well. They, in fact, took a call to reduce their selling and reduced it by half.
Okay.
Taking cue from their longer-term orientation, we also reduced our OFS by half. So they will, after the IPO, continue holding about 15%.
From 19.
From 19. As promoters, we'll continue holding close to about 59%. And the relationship with Keppel is such that we last year acquired both of their co-working spaces in Singapore. And happy to share with you that today they are both profitable.
Who are some of the other big investors in the company?
So today we've got a very good set of marquee investors, which include high-quality family offices such as Ananta Capital, Hexaware, Jagdish Master from the Inam Group. We also have Deutsche Bank, who owns 1% stake in the company. And we do have angel investors. So Mr. Madhu Kela invested in through Mahima Stocks, which was back in 2017. And he has continued to reinvest in the company.
Okay, so that is SmartWorks hitting Dalal Street on this Thursday. So do watch out for that one. We need to take a short break, but here is some good news for our viewers. India Business News Leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen. Welcome back. Well, quiet for the markets. No real updates coming in. Wait and watch mode. So we need to get you an exclusive conversation. As we do that, we'll also wrap up on the show. It's an exclusive conversation where CII members don't want 26% additional US tariffs. That's the word coming in from the newly elected president of CII, Rajiv Memani. In conversation with Shireen Ban, he talks about trade deals with us, India-UK free trade agreement, and concerns around the rare earth magnet supplies. Listen in to excerpts of that conversation. We'll be back with Business Lunch.
You know, you were talking about the FTAs that India is inked. UK is done. EU is a work in progress. The US, any time, at least an interim deal, a mini deal is likely to be inked. So one, how is industry looking at it? You know, is there a feeling that there needs to be a harmonization of sorts across these various FTAs? Because I'll ask you this in the context of the EV manufacturing policy that the government has put out. Obviously, people are waiting to see what the FTAs will say before they actually go ahead with the EV manufacturing policy and apply it through that route. So what's the sense that you're getting from industry? Secondly, you know, let's bring up the EU FTA, for instance. European companies are sitting on large unutilized capacity. Will they use that, or will they choose to manufacture in India?
Yeah. So, I mean, let me first just the overall FTA. I think we must compliment the government, whether it's the Ministry of Commerce or other wings of the government. I think they've spent a lot of time, as compared to when the earlier FTAs were signed. They've spent a lot of time in engaging with each and every part of industry to understand what the issues are and where things stand. And I think that, I would say, their knowledge, the level of engagement that they have has been absolutely fantastic. Now, if you then take it to the second level, to say whether industry by industry, how does it pan out? I think, you know, FTAs are a negotiation. So I don't think every industry is going to be supremely happy about the FTAs. And in particular, I would say, and as far as EVs are concerned, I think the most important FTA I want to be direct is US. And I do hope that, you know, it gets signed on time, because if we talk to the members of CII, they don't want the 25% tariff to kick in on 8th of July or whenever. So
it might even be August now. We don't know.
So we don't need.
Don't know.
So I think they're keen that and it's also about relative competitiveness. Yeah. So, you know, if Vietnam signs something, if someone else signs something. So a lot of this is also about relative competitiveness. It's not just country to country, but it's also in the global order. And it reflects, when you sign an FTA, it also reflects to the industry that there is a level of confidence between the two governments where you're working together to increase trade between the two countries. So I think that strategically is very, very important. You know, there is surplus capacity in some parts of the world, and there is a worry that, you know, if the duty rates are reduced, whether rather than manufacturing in India, those surplus capacity will be utilized outside. I think the government is well aware of this. I think industry has done, again, a lot of engagement. I think they've provided a lot of details in, you know, what are the surplus capacities available, what has happened after FTAs and everything. And I'm sure in particular, when government is looking at negotiating the FTA with EU, they will bear this in mind. I think obviously India's interest is that, yes, these companies do come in, but they actually set up manufacturing bases in India, provide a better deal to the consumers, create greater value add in India for manufacturing. And I'm sure the government has the same in mind. So they will be focusing on getting that done. But as I would say, not every person would be, every industry would feel, you know, that they had the best deal. And the second thing is that
the spirit industry clearly doesn't feel so.
The second thing is that, Shireen, that this, you know, if you have a duty drop, depending on what the industry is, of 5% to 20%, I think where industry and government, and this is where what we are talking of in CII, where we have to work together is to try and see how does Indian industry become more competitive.
Right.
Which are the areas? Is it the customs duty on raw materials? It's the accumulation of GST that happens. It is energy costs. Can you provide easier open access? Can the Indian distribution structure be more efficient so that, you know, the cross-subsidization reduces? Land, and can greater pools of land be available? can we build a vendor ecosystem where the land that's being provided to them is at much more affordable cost? And also just the speed of doing business, the ease of doing business. And finally, in some cases, it may have to be supplemented with PLIs. So I don't think it's the end of the world. Once you have these kind of duty breaks, how India becomes more, because India is fundamentally, I do believe that the innovative spirit, the entrepreneurial spirit, the cost structures that we have in broad, and the way industry and government are engaging, I strongly feel that maybe in some industries it is a question of some time, but competitiveness is very inherent in most industries. I think where we don't have technology, where it's rare earth, where it's advanced manufacturing, I think those are more challenging.
Has there been any forward movement on the issue of rare earth? For instance, I mean, China and Europe have now managed, US and Europe have managed to get supplies started from China as far as rare earth is concerned. Any forward movement on that? Have you heard from the government or whether there are talks underway, likely to be?
We haven't heard from the government, but I think India, as you probably would have read, I think in Quads there's been discussions around it to say what is happening. Various other countries like Japan in particular and others are engaging with Indian industry to try and see what can be done to supplement it. But it's a serious issue, especially for the auto industry, the EV industry. I think it's a serious issue, and it is something that will have an impact in the next few months in production and everything else.
Stocks trade ranged ahead of a likely India-US trade deal announcement. FMCG and crude oil users gain while metals and industrials drag.
India and the US are close to striking a mini trade deal in the next 48 hours. Negotiations on the pact are mostly complete and offer a fair deal for India's labor-intensive sector with some concessions for select US agri products and pencil in an average tariff rate of 10%.
Godrej Consumer, Dabur and Nykaa point to consumption ticking up. Jewelry makers Kalyan and Senco post strong Q1 growth and QSR major Jubilant Foodworks clocks healthy pizza sales.
The OPEC and its allies have accelerated the hike in production, pointing to a stable global economy amidst low oil inventories. August output will now be upped by almost 5.5 lakh barrels a day compared to the 4,11,000 barrels hike between May and July.
Defense Secretary R.K. Singh says the contract for 5th generation advanced medium combat aircraft will be awarded in 3 to 6 months, even as developing a 5th gen jet and taking it to the skies can take 10 years.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Vamakshi Dhoria. Vamakshi, good morning. Continuing to remain on the edge, as was the story last week as well, and all eyes will be on Donald Trump at 9:30 this evening as to what announcements will he make.
Well, absolutely, Hormuz. The markets for now are on the wait and watch mode. There's absolutely nothing going on as far as the major benchmark indices are concerned. Take a look at Nifty 25,430 thereabouts is where the Nifty is at. The Sensex too is quite subdued in trade today. Let's take a look at how the advance decline ratio is panning out. Last I checked, the advance and decline ratio, the gap between both of them was expanding. It continues to do so even now, and that is reflecting in the broader markets. Take a look at the mid-cap index. It's down almost 0.4%. The small-cap index too down almost 0.5%. So both of the broader market indices are underperforming the benchmark index. Now let's also take a look at what specific sectors are doing then. Nifty FMCG is doing quite well on the back of several Q1 updates. Let's take a look at Godrej Consumer. That stock is up almost 6% now, trading close to the day's highest point. Dabur, Hindustan Unilever, Imami, Jyoti Labs are just some of the other FMCG names that are doing quite well in trade today, Hormuz.
It is the sector of the day is FMCG, and if you take a look at all of these names, be it GCPL, Dabur, Imami, the only one that's not doing well though is Jubilant Foodworks, and that is continuing to remain at the lowest point of the day. And this FMCG business update move has reflected on a lot of other names that have not reported numbers so far, which is HUL is one of them among the top gainers on the Nifty today, and the other one of course being names like Jyoti Laboratories and Imami. They too are continuing to do fairly well for themselves in today's trading session. So that is the sector of the day. But the big conversation that we had earlier in the day was with the Defense Secretary Rajesh Kumar Singh, who spoke exclusively to CNBC TV18, and Parikshit spoke to him, and he's joining us with the key highlights from the conversation that he had with the Defense Secretary. Parikshit.
Well, perhaps the most important takeaway is the fact that the Defense Ministry is going to be seeking an increased expenditure on a sustained basis for India's defense sector. In fact, Secretary R.K. Singh told us that they would be asking for an increase in defense expenditure share in the GDP from 1.9% currently to 2.5% for the 16th Finance Commission. So this has a cycle for 5 years till 2031. And for the next 5 years, they would be seeking an increase in defense expenditure as a part of GDP. They may also seek an additional allocation in the revised budgetary estimates for FY26 for defense, for the defense capital acquisition. And this is because there have been a lot of emergency procurement after Operation Sindoor. There is a lot of acquisition for new technologies. The government is well on track to spend over 2 lakh crores this year as well. And considering the space, they may need an additional allocation, and a call will be taken on that very soon. The government is also looking to issue a large tender. In fact, when we asked them if there is going to be any kind of financial support for the industry to make combat drones. The Defense Secretary said that the order itself will be so large that the industry will not need any other financial support. So we're going to see emergency procurement and also long-term contracts for combat drones, swarm drones, UAVs as well. On our own indigenous 5th generation fighter program, or the AMCA program, the government hopes to complete the process of awarding this contract in the next 3 to 6 months. From building a prototype to having a 5th generation fighter in the skies would take about 10 years. In the meanwhile, the government is also looking to acquire the 5th generation fighter from one of our key allies, and conversations are on. According to the Defense Secretary, he did not comment on whether there are any formal proposals or formal talks ongoing with either US or Russia for that matter. Recently, Rajnath Singh, the defense minister, spoke to his counterpart in the US, Pete Hegseth, and raised the issue of delays in deliveries of weapon systems. So post that, we're learning that the Apache helicopter, 3 of them will be delivered this month. On the 404 engines which have been delivered for the Tejas fighters, there was a delay there as well. We're now told that 1 was delivered in April, 1 will be delivered in July. And going forward, 2 engines will be delivered to India per month till March. And therefore, the HAL will be able to deliver at least 12 Tejas fighters by the end of this fiscal. As far as the F414 engine is concerned, we're told that the technology transfer agreement is done and the pricing negotiations could be completed in the next 2 to 3 months. The US and India are also holding negotiations on P8I reconnaissance aircraft. So let's see what happens. But net, the government sending out the message that currently 75% of our capex is going towards domestic acquisitions, and we're going to focus more on indigenous manufacturing, technology development, and acquisition in the future as well.
So as far as we are concerned, yes, the nature of warfare changing the way it is. There is a large market for drones in the country, military drones. And I think industry recognizes that and is making investments. There are 1 or 2 promising companies with Indian designs as well. There are others, including some large industry conglomerates who've tied up with foreign vendors or OEMs with transfer of technology. So yes, from our side, the support will be there in the form of large orders, large RFPs or tenders that will be issued. And it will be under Indian, by Indian and IDDM categories, because the intent is to make it in India. But it could be at fully Indian design and manufactured. It could also be one where the technology is from outside, but the construction or the manufacturing takes place in India. As of now, we are looking at establishing an MRO here in the first place, and thereafter we'll see. The numbers may not be sufficient to have a co-development and co-production. It's very early to talk about that. Right now, I think there is a suggestion that we might go for some additional orders of the S400. Out of the 5 batteries that we've already ordered, 2, as you know, are still to come. They'll come next year. And by the end of next year, all 5 will come. So yes, maybe there could be some additional orders that could be considered. But generally, in terms of production, normally you start with an MRO, and over time, depending on the volume, you could look at co-production. But it's probably a little early to be talking about that.
Well, we also spoke with D.K. Sunil, the CMD of Hindustan Aeronautics. He shares their outlook as well. Listen in.
This will be a very big R&D effort for the Sukhoi 30, which will take about 5 years to complete. And 84 aircraft will be upgraded, and that will, production will, the overall and repair and the upgrade will pan out after 5 years. And it's expected to be about 65,000 crores. Helicopters will be built predominantly in Tumkuru. We already have started producing the LUH there. So the facilities are up, and that will be expanded to cater for the LCH also, which is the Prachand. So we expect to close it in 6 years from FY28 onwards.
Well, there are plenty of stocks that are moving around in the broader markets, and let's get you those now on the back of their respective news flows. Ria is joining us with that. Ria, tell us which are the stocks on your list?
Well, yes, Hormuz, a lot of stocks in focus today. A lot of companies have come out with their Q1 updates. The first one is Godrej Consumer. The standalone business, the company says, is likely to deliver high single-digit value growth on the back of mid-single-digit UVG going ahead. And they've also said that volume growth this time around has been strongly competitive and is improving on a sequential basis. Moving on to Dabur for their Q1 updates. Now, on this front, due to a decline in the beverage space, Dabur's consolidated revenue is expected to grow in low single digits going ahead, and the consolidated operating profit growth is expected to marginally lag the revenue growth this time around. Moving on to Senco Gold, the Q1 retail revenue has gone up by around 24%, and in terms of the outlook for the second quarter of FY26, the company is on course to achieve their annual target of 20 showrooms. IndusInd Bank has also come out with their quarter one business update. The net advances have gone down by around 3.9% on a year-on-year basis and down by around 3.1% sequentially as well. Deposits have also been muted on a year-on-year basis and on a sequential basis are down by around 3.3% this time around. Moving away from the quarter one business updates, Mahindra Lifespaces has also been in focus today. The company has launched a new tower at the Mahindra Citadel in Pune with a total GDV of about rupees 2,500 crores. BEML is in focus since the company has secured 2 export orders from CIS and Uzbekistan for heavy equipment, and the order is worth about $6.23 million. The last one that is in focus today is a defense stock, DCX Systems. The company has received the industrial license for the production of radar and electronic warfare systems, and also for the manufacture of avionics and defense electronic equipment in Karnataka.
Thanks so much for that, Ria. But as we slip into a very short break, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m. Welcome back. Thanks for staying tuned into Business Lunch on CNBC TV18. The big trade story this afternoon is Trump's tariff deadline. The US president has said he had signed several letters detailing the tariff rates the countries would face on goods exported to the US. Describing them as take it or leave it offers, Donald Trump said the letters would be sent out on today. Here's what he had to say.
Sending letters out on Monday having to do with the trade deals. It could be 12, maybe 15. You know, Secretary of Commerce right here. And I guess, Howard, I would say it could be maybe as many as 15 or so. And they'll be going out on Monday, and some will go out on Tuesday and Wednesday. And we've made deals also. So we're going to have a combination of letters, and some deals have been made.
Who was alongside the US president also told reporters that the higher tariffs would take effect on the 1st of August. Listen into what he said.
But they go into effect on August 1st. Tariffs go into effect August 1st, but the president is setting the rates and the deals right now. Well, the president is right in the midst of discussing all sorts of deals with all sorts of countries, and the gentleman to my right is going to decide, and I'm going to be with him when he makes that decision.
Well, sticking with the tariffs then, sources tell CNBC TV18 that India and US are set to take a final decision on a mini trade deal in the next 2 days. Parikshit joins us with more details. Parikshit?
Well, yes, a final decision on the mini trade deal is likely to be taken in the next 24 to 48 hours. The negotiations are now over. There's going to be no further negotiation on that mini trade deal. We're told by sources that India has proposed from its side a very fair trade deal which would give access to India's labor-intensive sectors, SMEs, especially those in areas such as textiles and footwear. And it would be a win-win for both US and India. At the same time, we've drawn our red lines in the negotiations. There will be no concessions on wheat, rice, maize and dairy products in the deal. We'll offer no concessions or compromise on areas which are important for our farmers. And no access for GMO crops either. Certain US agricultural items such as pecan nuts, blueberries, which are not used or not consumed in India in a very big way, those may be allowed access on lower tariffs. On the question of automobile tariffs, which are a very important part of any trade negotiations, keeping in mind India's automobile industry, we're told that India has proposed the same tariff arrangement as has been done with UK, European Union and other nations. So we're now waiting for both sides to take a political call, that is Prime Minister Modi and Donald Trump. Currently, the talks have only been concluded on the mini trade deal. On the larger tranche 1 of the bilateral trade agreement, which has to be concluded by fall when President Trump comes to India, those negotiations are yet to begin and will begin after the 9th of July. What we can tell our viewers that if this deal goes through, then the average tariff would be around 10%, and US will also continue imposing the steel tariffs on India. They are not likely to provide any exemption, but for the moment, we're awaiting a final nod from both the White House and the Indian government.
Parikshit, thanks a lot for that update. Now, in an CNBC TV18 exclusive, my colleague Abhimanyu spoke to Commerce and Industries Minister Piyush Goyal on the FTA negotiations. Listen into his comments.
We are trying to create a trading environment and trading arrangements and agreements which will help two-way trade. Our handicrafts, our handlooms, our various agri-products from here will also get a market worldwide. So it's always a benefit on both sides that is being balanced in a free trade agreement. After all, there are lakhs of handloom and handicraft persons here also. So we will be balancing everybody's interests when we are looking at free trade agreement.
So my final question to you, any new markets or products being looked at for exports?
Oh yes, our government at the center and the state is focused on new products, new exporters and new markets, and we will always be wanting and will encourage newer and newer exporters to come into this field. We'll try to encourage new products being exported. We just saw cherries being exported, Kashmir cherries being exported to other parts of the world. We would like to encourage newer markets opened up for the delicious products of Kashmir.
Sir, you spoke about encouraging agriculturists, growers of the country with respect to apples, walnuts, cherries. What kind of protection do you feel is needed as far as minimum import price is concerned?
Well, prima facie, I think we have already increased the minimum import price to 50 rupees. There is a 50% import duty on that. So effective, plus some cesses and taxes. So it becomes 75, 80 rupees. On top of that, when you add clearance, marketing, branding, transport, distribution, in the marketplace, apples are sold at between 125 to 150 rupees per kilo. I think that's a very significant protection level because we also have 140 crore consumers. And if we make it very unviable or very expensive, then beyond a stage, the demand for apples will fall. Right now, also the amount of apple production falls short of the national demand. We still have to import about 4.5–5 lakh tons. And we'll work with the farmers to see how we can improve their production, how we can take their produce to the remotest parts of India. But along with that, we have to balance the demand of consumers also. But I have assured them that I will examine it in great detail. We have already given a very high level of protection. We will see what more can be done so that our farmers here can get even further protection.
Well, on that note, let's slip into a very short break. But before we do that, here is some good news for our viewers. India's business news leader is now only a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
You're still with us here on Business Lunch. The benchmark indices continue to remain choppy in a very, very narrow trading range. The Nifty bank that had slipped into the green at one point is now back in the red. It is now down around 70 points. The Nifty continues to remain at the flat line, while the mid-cap index, though, is the one that is seeing some bit of selling pressure, 150 points lower on the mid-cap index. But with that, we take your leave on this edition of Business Lunch. From Amakshimi and the team that put this show together, thank you so much for watching. Mid-cap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Good afternoon, Vivek. For Midcap Radar today, midcaps actually are under pressure. Very specific stocks which are moving around, and a lot of it on the back of quarter one updates as well.
That's right. Good afternoon, Sonal. Absolutely right. Overall benchmark indices, markets largely range bound, but the quarterly updates are what are keeping the stock perked up, and in some cases under quite a bit of pressure. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks trade ranged ahead of a likely India-US trade deal announcement. FMCG and crude oil users gain, while metals and IT drag. Mid-caps lag.
Godrej Consumer Product rallies over 6% as the first quarter business update indicates strong volume growth. The company also expects revenue to grow in double digits going ahead. Jubilant FoodWorks' good performance continues in the first quarter, registering 17% growth in consolidated revenue. The stock, however, is trading lower.
Metropolis Healthcare gains after reporting their Q1 business update. Company's total revenue surges 23% versus last year, while specialty segment's revenue grows 35%.
Borosil Renewables in focus after its German subsidiary files for bankruptcy. This comes due to a slump in demand for German solar panels as China has been dumping products at a lower price.
InfoEdge under pressure despite a good Q1 business update. The company saw its billing surge 11.2% on a year-on-year basis, while recruitment billings gained 9%.
Okay, those are the top headlines. The markets range bound right now. Mid caps under pressure. That index is down around 160 points. We have the Bank Nifty too, which is not doing so well, though in the last couple of minutes there was some recovery across the board. If we talk about sectoral movers, it's the FMCG space which is topping the charts right now, and also Nifty Realty in terms of the moves today. We do have the IT space which is under pressure. The metals not doing well. The small caps also down around 0.5%. So all these movers in the markets right now. We do have the IT numbers which are expected this week, so watch out for the IT space. That continues to be on our radar.
That's right. FMCG under the spotlight on the back of so many quarterly updates. What's not doing well? Like you mentioned, the pharma pack. Look at names like Biocon, Syngene under a bit of pressure. And even a name like Inox Wind from the renewable energy pack. That stock too under pressure. And it's been under pressure for the last week or so. But this is our special segment, Midcap Movers. Hormaz is standing by the wall to take us through the midcaps that are moving around in the session.
Well, you mentioned FMCG, and that continues to be the sector of the day. And the business updates aside, the other names that have not reported business updates have too seen a rub-off effect because of those who have. And look at Godrej Consumer now. The initial dip got bought into very quickly. Now at the highest point of the day, 6% higher there. Dabur too. It's a fairly weak update, but then still on the hopes of a recovery going forward is now up 4%. Jyoti Laboratories, Imami doing fairly well for themselves as well. The others that have reported business updates other than the FMCG names, of course, Jubilant FoodWorks is one of them that did not have a good, despite a fairly good update, is down 4%. Metropolis reported updates on Friday, that's up 4%. And Equitas Small Finance Bank at the lowest point of the day, now 6% lower on that stock. And InfoEdge, of course, reported business updates just a few minutes earlier. Now, stocks that are at a 52-week high today. Now, take a look at these names. Look at Hawkins Cookers is up 6.5%, as is Sirca Paints, and Axis Gates Technologies continues to make new highs every single day. And volumes, stocks that are doing well on the volumes front, Petronet LNG being one of them. Positive brokerage note coming in earlier in the day. Alkyl Amines, IIFL Finance too doing fairly well on very strong volumes. And look at the flip side then, stocks that are not doing well in the broader markets. Deepak Fertilizers among the top losers in the broader markets today. Endurance Technologies, KPR Mills, Indus Towers, all of them not having a very good day at the office in today's session. Back to you guys.
Okay, all right. Thank you so much, Hormaz, for joining us with that list. It's time to welcome Ruchit Jain from Motilal Oswal Financial Services for a quick technical check on the markets. Ruchit, good afternoon. Thank you so much for joining in. Well, it's been volatile. In the last couple of minutes, we've seen some recovery from the lows as well. Do you think the markets would continue to consolidate at these levels? Will we see heightened activity towards the last hour of trade?
Yeah, hi, very good afternoon. Well, if you look at last 3 or 4 trading sessions, markets on the index front seems to be going through some time-wise correction phase, or what we even call a consolidation. Because after the recent run-up, the momentum readings were in about zone, whether it be Nifty or even the mid-cap and the small-cap space. So such overbought setups usually get cool off either by some price-wise correction or some time-wise correction. Now, good thing is that the index has not breached its 20-day support also in this entire consolidation of last 4-5 trading sessions, which is now around in the range of 25, still in the range of 25,250. So downside price-wise seems to be very limited, but no, also it does not look that the markets would be in a hurry to show any kind of big moves on the upside as well. So we believe that markets still for a few more trading sessions would continue its consolidation phase before it starts the next leg of uptrend.
Ruchit, any individual names on the radar? Any buy or sell calls?
So I have a couple of buy recommendations. Since the broader trend does not look negative, one is IGL, where in last week, Friday's trading sessions itself, we had seen a breakout from a consolidation phase, which was supported by very good volumes. So the positional chart structures have changed good after a long consolidation phase in IGL. So short-term traders can buy with stop loss below 217 for potential targets around 238, what we are expecting. And CESC is another stock which is looking very positive. A higher top, higher bottom structure continues to get formed. Whatever small corrections that we have seen in between, we have not seen any kind of volume-based selling happening over there. So the stock which has given a breakout today after this consolidation. So CESC one can buy with stop loss below 175 for potential short-term targets around 194.
Okay, all right. Thank you so much for joining us with that, Ruchit. But remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Mid-Cap Radar. Well, we've been talking about how the consumer index or the FMCG index, that one is doing really well. Consumer staple stocks like GCPL, Dabur, they are rallying on the back of good Q1 updates. Mangalam is joining in to decode what's driving them and what is the management saying. Mangalam.
Staples are definitely having their day in the sun today. Good updates coming in from the likes of Godrej Consumer, as well as good improvement is expected for the likes of Dabur as well. The weakness are largely seasonal, and that's what these updates suggest as well. If you look at Godrej Consumer, on a standalone basis, the company is reporting a high single-digit underlying value growth led by mid-single-digit underlying volume growth, which has seen improvement both sequentially as well as on a competitive front too. Even though the company has, seen some weakness in their margins on account of deflation in palm oil prices and them sitting on high inventory, they believe that this situation is likely to ease out in the second half of this year, and the street is taking note of that. Growth for Godrej Consumer has been led by their home care businesses, which has actually grown in double digits, whereas personal care, which is largely the soaps business, has seen low single-digit value growth, and that's on account of the deflation that we've seen in palm oil prices, so that transition continues. On the other hand, for Dabur, their consolidated revenue has grown in low single digits, but that's largely because of the beverages portfolio, which has seen a weakness on account of unseasonal rains and a shorter summer. Beverages, remember, account for nearly 10 to 12% of their overall sales. The other parts of their business, which is home and personal care, along with healthcare, have seen a lot better performance, and the company believes that this is likely to continue going forward as well. Here as well, there is likely to be some margin compression, but the street is hopeful that the second half of this year, we will see improvement in the margins as well as the commodity cycle turns favorable. Remember, both these stocks have been underperformers in the past, and on the back of improving demand sentiment, we've seen these stocks do well. In fact, not just GCPL as well as Dabur, we saw HUL, which was the top Nifty gainer today as well, taking a leaf out of these updates and telling you that the demand sentiment is definitely improving.
Thank you so much, Mangalam, for joining in and telling us about Dabur as well as GCPL. But before we let you go, even discretionary names like Jubilant Food are doing quite well in the session. Jubilant, of course, cooled off significantly from the day's highest point. What is the update as far as Jubilant is concerned?
Well, Jubilant FoodWorks reported a good set. We had a consolidated revenue growth of 17%, domestic revenue growth of almost 18%, led by like-for-like growth of about 11.6% in India, Domino's India, that is, them having added nearly 60 stores as well. The stock is lower largely because of valuation concerns and discomfort out there. Remember, the stock, despite the outperformance that we've seen and despite a decline post that, trading upwards of 75 times FY27 earnings. If you look at analyst estimates, that leaves little headroom for growth, and the street is now looking at consumer staples as a shift from a portfolio standpoint, which is what explains the outperformance of GCPL and Dabur versus Jubilant FoodWorks. And at the same time, we got decent updates coming in from the likes of Nykaa, etc. as well. Those stocks too sold off from the highs.
Okay, that's the update as far as the consumption space is concerned. In fact, we also spoke to the management of Senco Gold on their Q1 business update. Listen into what they had to say.
To up the guidance, I would rather wait for another quarter. When we look at it, Q1 is one of those festive quarters. We have Akshay Tritiya, a lot of New Years in various states of the country, and the summer wedding season remains in the Q1 part of it. While in Q2, usually we do not have too many weddings and the festivities are on the lower side. But the focus of Q2 remains to be such that we build up for the festive season that starts in Q3. So I would be, more confident on the 19 to 20% guidance that I have given. But our efforts and endeavor will always be towards, making sure that the numbers becomes better than what we can guide the market. The diamond value growth, if we look at it, the volume growth being at 35%, the value growth has been upwards of 45%. So, it's been a good comeback by the consumers with regards to their interest on buying diamond jewelry compared to what we saw in the previous years, Q1 and Q2. When it comes to your EBITDA estimates, I would say that yes, around 7.2 is what we have said. And we have just ended Q1. While our efforts will be, and with the higher diamond sales, if it continues to happen, there is a probability of it going up.
Well, that was Senco Gold, but keeping in trend with quarterly updates, Metropolis Healthcare too gave a strong quarterly update. Ekta joins in to decode how exactly one should read the numbers?
Well, they started with the revenue growth, which is up 23% year-on-year. 13% organic growth is what they've indicated, with growth driven by higher patient volumes, better realizations, and favorable product mix this quarter by Metropolis. B2C segment up 15%, wellness segment up 20%, specialty segment up 35%, with growth led by their recent acquisition, Core Diagnostics, which is basically into oncology testing. Ex-acquisitions, the growth was around 15%. Core Diagnostics turned single-digit positive this time. Quarterly EBITDA, according to them, improved Q-on-Q but was flat year-on-year. The revenue includes a full quarter from Core Diagnostics, a partial amount from DAPIC, which was from May 23rd onwards, and Scientific from June 17th onwards. The company remains debt-free as per this quarterly update from Metropolis.
Okay, 4.5% higher. That's the update coming in from Metropolis. Thank you so much, Ekta, for joining in. With that, we'll slip into a break. As we do that, here's some good news for our viewers. India's business news leaders now click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You have to say it's a very stock-specific market, and it's quarter-one updates that the market is reacting to, or I would say stocks are reacting to. Info Edge is one of them. The stock is lower in trade on the back of the business update. Rima is joining us with the details. Rima.
Thanks so much for that. So let's get the key numbers first. For Q1, the standalone billings have gone up by 11.2% on a year-on-year basis to come in at 644 crore rupees. Now, the reason the stock is lower in trade is because there is a decline in the sequential momentum. In the prior quarter, growth was nearly 19%. The quarter before that, 16%. The quarter prior to that, it was close to about 14%. So, you know, it's just that the growth momentum, which appeared to be picking up towards the end of last year, has moderated in Q1. Now let's break up the standalone into their core recruitment business. It's basically like IT services, IT hiring, and then the other one is the real estate. So on recruitment, again, growth has come off sharply. It's a high single digit, 9% growth seen in the recruitment billings in Q1. Again, lower than the 18% that we had in the prior quarter, 15% in Q3. It's similar to the kind of growth that we had in Q1 of last year. For real estate, the momentum has pretty much sustained. 16% growth seen in Q1, which is largely similar to the kind of growth rates that we've seen in the prior 3 quarters. But on the whole, there is a moderation in the growth rate for the billings of Info Edge, particularly recruitment, and the street is disappointed with that.
Thank you so much, Reema, for joining us and giving us a sense of what exactly is driving the shares of Info Edge, or also known as Naukri, lower in the session today. Well, I've been tracking Borosil Renewables, and for a change, it's not a quarterly update that I'm tracking, but rather it's a material update that the company has given regarding its German subsidiary. So the company yesterday has told the exchanges, or informed the exchanges, that its German subsidiary GmbH has gone ahead and filed for bankruptcy at the German insolvency court. Remember, the company has constantly been telling the exchanges and investors that the operations over there were unsustainable simply due to the fact that there was not enough demand for the solar glass that the company was manufacturing due to significantly lower priced Chinese solar glass being dumped in the European market. On the back of that, the company had said that depleted market conditions forced them to go ahead and file for bankruptcy. Now, what is it? Is the way forward when it comes to this particular business. GMP, number one, will have an insolvency administrator to go ahead and run the business in the meantime, and also the company will be speaking to the German government in case there could be any sort of agreement that could be reached in terms of an anti-dumping duty. However, at this point of time, the company says that there is no visibility on that front, which forced them to take this drastic step up. Why are we discussing this? Well, look at the financial impact. Number one, the total exposure that the company has, and this is something that the management told us earlier today when they joined us, is 350 crore. There is no third-party exposure that the company has to its German subsidiary. It's all from the parent, which is Borosil Renewables. The company was making a cash loss of 9 crores per month, which ceases immediately given the fact that it's filed for bankruptcy, and expenses and cash flow now will be done by the administrator. In terms of top-line contribution, it was 22% of the total top line of the company as far as FY25 is concerned, so close to 330 crore top line in FY25. EBITDA as well as bottom line were both loss-making. So it's a material development. They may have to take a one-off hit, but the street is taking this positively because the focus now is on the Indian business where there is an ADD in.
The core business that the management spoke about as well. In fact, let's listen in to what they had to say on the matter.
The government probably needs some time to wrap its head around how they want to restructure the solar manufacturing in Germany. At this time, there's an interim administrator who's been appointed, and he'll make a report, and then he's going to go back with his recommendations, which might take about 3 months. Our exposure is €35 million altogether. We have funded about 20, out of this was 27 million was funded by us. So the exposure is not something which I can speak about now, because we have sizable assets. There's a very large plot of land. There's a very strong construction. There could be other uses to which this property could be put. Margin trajectory is only going to improve. It should not deteriorate from what I can see. The demand is very robust in our country, and we continue to meet the demands of our customers. So we're looking at a 60% expansion, and this will allow us to devote our full time to this. In the past, we have been devoting time to things that were not productive. The revenue has gone, but the profits have gone up. To the extent maybe nearly 27 crores per quarter is going to rise.
Okay, all right, that's the word coming in from Borosil Renewables. One more sector which is in focus is the city gas distribution space. Now, remember, on Friday, PNGRB had come out with some regulations with respect to unified tariffs. They have reduced the number of zones from 3 to 2. They also say that city gas companies will have to take the tariffs for zone 1 only. And now, brokerages have come out with a note which suggests that this could be positive for a company like IGL. City has raised the target to 270 rupees a share. They have also raised the EBITDA margin assumption assumptions from 6.5 to 7 rupees per SCM to 7 to 7.5 rupees per SCM. Why is that? Because IGL used to come in Zone 2 and Zone 3 in terms of tariffs earlier, but now since all of them have to take up tariffs from Zone 1, it would reduce gas costs for IGL. This would be a key beneficiary of unified tariffs change, according to Citi. Company has so far been in 2 and 3, and that's why the shift has come across as a positive for IGL. The stock, though, has come off from the highs of the day today. Even ICICI Securities says that changes in tariff zones would impact IGL's earnings positively by 15.5%. But for MGL and Gujarat Gas, it will be in the negative because they would come in the more expensive tariff zone, so to say. So we, of course, need, because there is a revision in tariff also which is expected, that would impact GAIL. All of these aspects keep these city gas distribution companies and GAIL as well in focus. But this is the preliminary impact that we could see on these stocks.
Thank you so much, Sonal, for joining us. So all eyes now on any tariff revision that may occur, and that will be something that the share price of GAIL and investors of GAIL will keep an eye out for. Well, a couple of stocks on the radar. First up, Godrej Consumer. We discussed it in detail. The stock now is surged to the day's highest point. And one stock from the pharma pack that's been on a continuous up move has been Glenmark Pharma. That stock, once again, near the day's highest point. But with that, we've completely run out of time on this edition of Mid Cap Radar. Your stocks when we return.
Hello and welcome to Your Stocks live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Thoria and let's take a look at what the markets are doing. Well, the markets are subdued, lackluster, rather muted. It's absolutely quiet as far as the frontline indices are concerned. The Nifty for now is trading close to the 25,450 mark. The Sensex too quite subdued in today's trading session. Let's take a look at what the broader end of the market is doing then. The mid-cap index as well as the small-cap index continues to reel under pressure today, underperforming the frontline indices. As far as specific sectors are concerned, it's a mixed screen, but mostly all of the sectors are in the red, being led by Nifty Media, which is down almost 1.2%. Nazara Tech is taking a hit today, down almost 3.5%. Z Limited too, down almost 2% in trade today. But on the flip side, on the back of some Q1 updates, we do have the FMCG pack in focus. Godrej Consumer continues to gain momentum in trade today. For now, it is up almost 6.5%. Dabur as well in focus on the back of its Q1 update. They're seeing sequential recovery in demand. That stock also doing quite well, up almost 3.3%. Hindustan Unilever, Imamiya, some other names that are doing quite well. Some jewelry stocks also in focus today on the back of Q1 updates. Senco Gold continues to surge higher. On the flip side, when we look at Kalyan Jewellers, that stock is taking a knock in today's trading session. Some rub-off effect on the back of some good Q1 updates on PC Jewellers as well, because that stock continues to surge higher in trade today. For now, PC Jewellers is also trading with a good gain of almost 16.5%. But it's a good time to welcome in our guest now. We're being joined by Ashish Kyal of Wave Strategy Advisors and Gaurang Shah of Geojit Financials. Good afternoon to you, gentlemen. This is Vamakshi joining in. And let me first start off with Ashish then. What's the technical view on the markets? Because so far it's been an absolute quiet and range-bound session.
Afternoon to you and all the viewers, and also to Gaurangji. The overall market trend, I think it's just a pause right now, and everyone is waiting for the big news that has to come from the US. But having said that, as far as the chart is concerned, I think this is consolidation. Nifty has shown a very smart move from 24,500 levels onwards, and it went towards 25,500, and it's now consolidating there. So that's a good sign. It's relieving the overbought zone, and right now it's forming a flat kind of a pattern with a resumption should happen on the upside. The upside, I would rather buy the dips over here because the overall undertone still remains bullish for the targets of 25,800. And on the downside, this immediate support comes to around 25,300.
Well, thanks for that, Ashish. And let's get started with some of the stock queries then. Raman Jain writes to us from New Delhi. He holds 550 shares of ITC at rupees 160 and he wants to know whether to hold or sell at current levels. Gaurang, what would be your fundamental view on ITC?
Thanks so much, Vamakshi, for having me on the show. Good afternoon to you, to everyone, to my good friend Ashish Kyal as well. So, well, you know, the FMCG pack has been a little bit underperforming given the kind of headwinds that they had in terms of higher crude oil prices, higher input cost, low volume growth, demand from semi-urban and rural India. But all that is likely to change in the next 3 to 6 months, given the good monsoon and, of course, spendable capacity of an individual. Diversified company ITC recently hived off its hotels company and listed it as a separate entity. We have a buy and a hold from a long-term point of view from our research team. And let me give a disclosure first. All the recommendations are a part of our fundamental research team. Our company, Geojit, or I do not have any personal investments or any monetary gains. There is no conflict of interest, but we give similar recommendations on similar lines to our clients. They might hold their investment interest in this. So ITC is a buy and a hold from a long-term point of view. And I think the earnings could be a major turnaround this financial year.
Sure, thanks for that, Gaurang. So buy and hold from a long-term perspective for ITC. But Ashish, what's your technical view on this counter?
Technically, also, I agree with the view. The overall undertone for ITC remains bullish. We can expect the stock to move towards the level of 440 over near term. And on the downside, the immediate support comes to around 410 levels. It has been drifting lower, but there is a positive divergence we can see on the indicators that shows that the overall undertone is still positive and there is a positive divergence, which means the downside momentum has reduced. So we can expect it to move towards 440 and maintain 410 as a stop loss.
So thumbs up from Ashish as well as Gaurang on ITC. But let's take the second query of the day then. So Shashidhar is on the line from Bengaluru with an investment query. He wants to invest in Tejas Networks for the long term. Shashidhar, please go ahead with your query.
Thanks. Hello all. So I'm Shashidhar from Bangalore. So first of all, thanks CNBC for helping youth to achieve financial freedom. And I'm currently looking for a long-term opportunity in Tejas Network, which is backed by a Tata Group. The stock here almost corrected 50% from its peak and looking attractive now. I know the reason behind is no Q4 negative result. This was first quarterly loss in 5 quarters and also the order book concern. So given the strong parentage and the long-term potential, so I'm looking to buy this stock at the current price and the level. So I wanted to know if I start accumulating or buy at this level.
Sure. Gaurang, your view on Tejas Networks?
So I think it's good to hear investor doing their own work, Amakshi. And this is what we always recommend. You should do a little bit of homework before taking a plunge into or deciding into investing to a particular sector or a stock from a long-term point of view. So our team has a hold stroke who can accumulate as Mr. Shashidhar is looking to accumulate the stock at lower levels. The platform and services that Tejas Network provides is going to be of very crucial importance. Again, if the time horizon is long-term, by definition, 12 months, 18 months, 24 months, then first of all, hold on. If you're looking at buying into it, don't put all your money at one time. Start at current levels and then, on lower levels, in a phased out manner, you can definitely accumulate the stock from a long-term point of view.
Sure. So accumulate from a long-term perspective for Tejas Networks. But Ashish, what are the charts indicating for this one?
From looking at the charts perspective, Tejas Network currently quoting at around 701 levels. The stock has underperformed given that it broke below that 850 and now consolidating in a very narrow range. I think it's forming a triangle kind of a pattern and we are yet to see a breakout which is awaited. So if it manages to move above 730, that would be a first sign of a positive breakout. So my suggestion would be can be bought, but let's wait for 730 to be taken out to get a positive confirmation. And on the downside, the important support for the stock is around 680 levels. So above 730, you can buy it and then hold for a target of around 900 levels on the upside.
Sure, thanks for that, Ashish. But moving on then, we now have Nitya, who is writing to us from Hyderabad. She holds 214 shares of Bajaj Housing Finance at 70 rupees. She wants to know whether she should book profits or continue to hold that. Gaurang, I think you don't cover the stock, but let me come across to Ashish then. What's your view on this counter?
If you're looking at Bajaj Housing Finance, we can clearly see that the overall space and the sector has outperformed. We can clearly see that the financial stocks has continued to do well. Bajaj Housing Finance anyways has shown some kind of consolidation, and I think there is a possibility that the stock can also move on the upside from here on. We are seeing some kind of pressure over short term, but if the stock manages to move back about that 123 mark, there is a possibility the target of 130 can open up. On the downside, one can maintain a stop loss of around 117 levels.
Sure, and let's move on to the next stock then. Tony Cherian writes to us from New Delhi. He holds 35 shares of HPL Engineering at 567 rupees. He wants to know whether to hold or book his profits and buy another stock. Ashish, this is for you again.
If he's talking about HPL Electric and Power, I'm not sure if that's the stock which is quoting at around 564 rupees. If that's the stock, then he can continue to hold on to the stock. And if the other stock that I can see is the HBL Engineering, and HBL Engineering currently quoting at 636. Overall, the undertone for the stock is positive for HBL Engineering, and we can expect the stock to move towards the level of 700. It's forming a higher high, higher low pattern post forming a low near 400 levels in the month of April, and the undertone is bullish. So 700 is the target. Hold on over here. And on the downside, price action support comes to around 618 levels.
Sure. So 700 target for HBL Engineering. That is the stock that the viewer was referring to. But we also have another query from Gurbinder Singh Bedi. He is writing to us from Noida. He holds 200 shares of Bharti Airtel at rupees 1,173 and 840 shares of Reliance at 1,048 rupees. He is a long-term investor and wants to know whether to hold or sell these stocks. Gaurang, what's your view on Bharti Airtel as well as Reliance?
Well, so unless you are in need of money, honestly, I don't think you should exit the investment. especially when you invested in large caps like Reliance Industries and Bharti Airtel. Bharti Airtel, incidentally, is one of the large cap stock which has recently made a new all-time high. Second largest dominant player in cellular service sector. Our view is, and the verbatim given out is that the ARPUs are likely to hit somewhere close to about 300 and maybe more as we go into the future. Voice has been contributing, large contribution coming in from data. We have a buy and a hold from a long-term point of view on Bharti Airtel. Reliance Industries, again, a diversified company now, has been on our buy list for a very, very long period of time as I can recollect. So unless you are in need of money, hold on to it on both.
So buy for Bharti Airtel as well as Reliance Industries from Gaurang. But Ashish, chartically speaking, how are both of these counters placed?
It's positive. Bharti Airtel, we can clearly see it gave a very strong breakout from 1880 levels, reached towards 2040, just consolidating there. So there is no sign of reversal that we can see here. The undertone remains bullish. And if you look at the overall daily chart, the stock has also managed to be closing above the prior day low. It has not closed below the prior day low yet. So the tone is positive. We can expect the upside targets of around 2100 over near term. And on the downside, the support for the stock is around 1990 levels. As far as Reliance is concerned, if you look at where is Nifty right now, major contribution has come from Reliance Industries. That one stock has managed to lift the prices to the higher levels. And even today, the stock is managing to do very well, up by more than 1%. So the overall undertone for Reliance is bullish. We can expect the stock to reach towards a level of around 1600. And on the downside, maintain a stop loss of around 1510 for the stock.
So green flag from both Ashish as well as Gaurang for Bharti Airtel as well as Reliance Industries. But let's slip into a very short break. But before we do that, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. Thanks for staying tuned into your stocks. We still have with us Ashish Kyal of Wave Strategy Advisors and Gaurang Shah of Geojit Financial Services. Let's first look at one query from Balasubramaniam, who's writing to us from Bengaluru. He currently holds 150 shares of Power Grid at 281.88 rupees. Since the last 1 year, the return has been very low, he says, and he wants to know whether he should exit and invest in some defense stock, or should he wait for another 3 to 4 months? Let me first go across to Gaurang for this. Gaurang?
Well, so we have a whole recommendation on Power Grid. And, one has to understand the nature of a sector when one gets invested. Now, when you got invested in a sector or a company like Power Grid, which is into transmission and distribution network, you need to give sufficient time for your investments to start making decent profits. It's one of the monopoly play, if you will, in terms of transmission and distribution of grid networks, enabling power transmission and distribution. If I'm not mistaken, almost about 70% plus is the grid network that Power Grid holds. The number of or the capacity of new power generation that is likely to come up in the next 3 to 5 years, you will need services and facilities and infrastructure provided by Power Grid. So I would recommend a hold. Give it some more time and give it a little bit of more patience for it to give you a fruitful return from a long-term point of view.
And Ashish, what about you? What's your view on Power Grid? And do you think that this particular viewer should hold on or exit his position?
Overall Power Grid showed a very good move from 250 levels to 320 by April 2025. And since then, it has been just drifting lower. I think it has retraced nearly 61.8% of that and should bounce back from there. So this looks like possibly wave to completion. We should see a third wave on the upside in Power Grid. Overall undertone remains positive, but my suggestion would be, instead of looking at only 3-4 months time horizon, extend the time horizon to at least a year. And we can expect the stock to reach towards the level of 340 or 350 on the upside. So the overall tone remains positive. Stay invested in the stock. On the downside, the crucial support for the stock is going to be around 280 levels.
So stay invested in the stock. That's the view coming in from Ashish Kyal. But moving on then, we now have Matthew VC, who is writing to us from Kerala. He holds 100 shares of APL Apollo Tubes at 1,915 rupees and 50 shares of Alchem Labs at 5,040 rupees. He wants to know whether to book losses or continue to hold or add more in both of these counters. Gaurang, I know you don't have coverage on Alchem Labs, but what's your view on APL Apollo Tubes?
Well, so we have a buy and a hold recommendation on APL Apollo Tubes. Again, patience is something that you need to have in stock markets. You can't be impatient with your investments in case if it is in a strong fundamental company and the visibility of growth looks quite positive in terms of the management commentary. So I would say, first of all, hold on to Apollo Tubes to your investment, either at these levels, or if my good friend Ashish has some lower levels, you can definitely add on to the stock from a long-term point of view, in case if Ashish has a similar view that I have. On Alchem, like you said, we don't have a coverage, so no comments on that.
Sure. And Ashish, so Gaurang says that it's, hold from a long-term perspective. And, what would be the levels that one would look at if they want to enter Alchem Labs as well as Apollo Tubes?
So if you look at APL Apollo, the overall tone from the weekly charts, if you look at it, that has been bullish. Definitely, the stock showed a very strong run up from the levels of 1300, made a high of 1900, and we are seeing some kind of a retracement of that. And that's a very healthy sign. When you see an impulse rise and then retracement on the downside, that's a positive sign. So over here, continue to hold on, can add more at these levels also, because there is a very important gap area between 1675 and 1720 levels, and stock is very near to that. So add more to these levels. We can expect the stock to move towards 1950 or 2000 again on the upside. And on the downside, the support for the stock is going to be around 1650. As far as Alchem Lab is concerned, the stock has underperformed drastically. Honestly, the stock moved down from 5,370, made a low of 4,750, and still there is no sign of recovery. I would suggest to be out from Alchem Labs, invest in something like Apollo Hospital, that is showing a very strong performance, an impulsive rise, possibly the third wave, and that would be a better choice. So be out from Alchem Labs and invest into Apollo Hospital.
All right. So out from Alchem Labs, invest in APL Apollo Tubes. Let's also take another query from K. Padma. She's writing to us from Andhra Pradesh. She holds 200 shares of Granules India at 150 rupees and wants to know the prospects of the investments that she's made. Now, Gaurang, the stock has not done much, especially if we look at the charts on a year-to-date basis. It's down almost 18%. So what's the fundamental view on this counter?
So I think each and every sector company goes through a cyclical period in terms of earnings because of certain headwinds from a short to medium term point of view. Earnings might not look all that encouraging, but from a long term point of view, we have a positive stance on Granules India. We have an accumulate stance. Again, I believe her investment is at a much lower level. So I don't think she should be impatient. Give it some more time, and I think earnings should improve.
Sure. And Ashish, what is your view on this counter, Granules India?
See, Granules India has a support at around 475. As long as the stock manages to sustain above that support over short term, there is a possibility we can again start seeing some kind of a positive traction. Right now, it's consolidating, forming a triangle pattern. We can expect it to reach towards 525, provided it manages to close above that 500 level. So overall undertone remains positive as of now, with 475 as a stop loss and 525, 530 as the target over near term.
Sure. And now let's also take a look at Mayank's query. He's writing to us from New Delhi. He holds 100 shares of Indian Hotels at 300 rupees. He asks if he can buy more shares at this point. Gaurang, what do you think of this stock?
Well, I think the entire hospitality sector is going to set for a major turnaround, to be very honest. If you just reflect upon the commentary given by the management of hospitality sector of any company, whether it is Indian Hotels or Taj GVK or a Lemon Tree, etc., they have huge lineup in terms of new additions of rooms capacity, including opening up of new assets at various places. Tourism sector is likely it has already witnessed a major turnaround and likely to see much more positivities as we go forward. On Indian Hotels, from a long-term point of view, this is the only stock that features in our coverage in the hospitality sector. We have an accumulator positive coverage on Indian Hotels. Room tariffs are likely to go up by another 15%. That is what the verbatim was. Along with that, you have contribution coming in from banquets. You have leisure travels. You have travel related to medical reasons. You have travel coming in from overseas. And along with that, you have business travel. So, and of course, the rates have gone up to a great extent in the last 6 to 8 months, 12 months, if you actually go to see. So hold is the stance, accumulate is the stance on Indian Hotels.
Absolutely. So, bullish from a hotel perspective that the tariffs are going up, but not so much from a customer point of view. So thank you so much, gentlemen, for joining in with your views as on the fundamentals as well as the technicals. Thank you so much, Gaurang, as well as Ashish. But that's all we have on this edition of Your Stocks. But do remember to email us your queries and we will address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
A slightly cautious tone that the Asian markets are currently trading with, 0.7% lower on the Hang Seng.
Sending letters out on Monday having to do with the trade deals.
But they go into effect on August 1st. Tariffs go into effect August 1st.
It's going to be a little quietish as far as markets are concerned, so I don't expect any big moves, big fireworks in that sense. Support for the Nifty 25,165, 25,460, absolutely flat. The Nifty Bank is down about 0.13%.
3 years is the start of production. So FY28, the aircraft will start rolling out.
100% of these are meant to be in the category of what we call indigenous design, development and manufacturing, IDDM.
Overall benchmark indices, markets largely range bound, but the quarterly updates are what are keeping the stock perked up and in some cases under quite a bit of pressure.
Well, a massive 2-point change on the Nifty is what you have. It's one of the...
Prashant, you started with massive? Oh, what have I missed? Was my screen
Should have given it a break. A massive... Keep quiet for 2 seconds, then go for it. Well, you know, it is one of those days. It's one of the quietest days we've had in a long, long while. 25,460 is what you have on the Nifty. Declines outnumber advances in the broader market. We'll get to all of that in just a bit. We are coming to you from the CNBC-TV18 Motilal Oswal studios. This is Closing Bell. I'm Prashant. With me, my colleague Surabhi, Rima in the studios. Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi, afternoon.
Oh, look at that, matching in shades of pink. Market may be in pink of health or not, we don't know, but yeah, we have a nice pink here.
No, absolutely. Nice pink here and maybe a little red as well, right?
Yeah, we got some red.
On the redder side.
Yeah, the reality check.
I think, but you know, it's a market. I mean, what do you say? Neither here nor there. Neither, and we put out very, very near-term levels in the morning, but it's so flat that it's not once gone to either the upper bound or the lower bound at all, except maybe just one index, which is the FMCG index, which I think is going to be the focus over the next 15 minutes or so. Nimish will join us, is something he alerted on Friday, and we will revisit that piece with him as we go along. But otherwise, that's the FMCG index, 1.5% high. Otherwise, I mean, I think at least at the index level, you kind of sort of struggle to find action in that sense. You know, just one other thing, and this is something we alluded to in the morning as well. You know, with how do I put it? With Jane out of the way, with Jane out of play, is our market's going to be a little more boring? I think maybe the answer is yes. And when I say Jane, I'm using that firm as sort of like a placeholder for the category of funds, right? Jump and Citadel and Graviton and et cetera. So many of those, that category of players perhaps will be pulling back, have already pulled back. Those big spikes and big moves that we saw, especially on expiry days, perhaps, at least for now, a thing of the past. So that's another thing to watch out for. But otherwise, for now, 25,452.
But you know, things have been quiet even while you were away. So
Yeah.
the whole of last week, from Monday to Friday, markets were consolidating. And today marks the 6th consecutive session where markets, have been in just a holding pattern. It's just that today's trading band of about 80 points is less than the trading band that we had even in the prior few sessions. Sectorally, defense is seeing profit booking after last week's mega up move. BEL is your top Nifty loser, a cut of more than 2%. Some IT stocks, a skittish earnings season, which starts with TCS on Thursday evening, is not supposed to be great. 4 out of the 5 large Nifty IT companies are likely to report a degrowth in the current quarter. Tech Mahindra particularly is getting hit. Last week when Macquarie downgraded Tech Mahindra, and the analyst told us that Tech Mahindra is one of the most expensive IT stocks now, 30 times FY26. So that's the reason why you are seeing a bit of softness. ONGC, Hindalco, Maruti Suzuki are some of the other names where you are seeing cuts of about 1.5%. On the way up, it's all FMCG, HUL, Nestle, ITC, These are the top 3 gainers today, and Reliance Industries once again is moving up, and now Reliance's year-to-date up move stands at about 18%, so outperformance.
Yeah, that's pretty much where the green is coming in from. On FMCG, and FMCG is really the only story, the only game in town, so to speak, and we'll get in Nimesh to talk about this in just a bit as well. Jubilant is probably the only number, the only stock that's reacting negatively to its update. Everything else is up. In fact, even Dabur, if you pull up the intraday chart of Dabur, it started a little soft in the morning because they're talking about the beverage portfolio still weighing on the company's Q1 performance. But then since then, it's recovered. It's managed to hold on to gains. By the way, must mark, though, that today the mid-cap market is falling a little more than the frontliners, which is a departure from last week. And we're seeing that play out in many stocks. For instance, Indus Tower is lower. Jubilant, I mentioned. A couple of other names like Info Edge as well. These are some of the names on the losers list. But Nigel, yeah, let's see. I mean, it's extremely quiet, at least as far as the headline index goes.
Well, when Prashant was talking about Jane, the song that came to mind was It's the Last Dance with Mary Jane.
Mary Jane.
Yeah, top Perry. All right. But interesting words, interesting meaning as well. But that for another day. Let's get to Mitesh. Mitesh, what are you making of today's trading action and what are the levels you're looking at?
So, Nigel, I think the action has been quiet, as has been for the past few days. The market is very slowly tapering off, but yet not giving a decisive breakdown below 25,400. We're just lingering around there. And my bet is that in case we break that, we might see another 200 points on the downside, but that's about it. So the index remains, more of contracting in nature, and therefore the index can be avoided. I think trading should be more focused on the stock side, and that's where traders will get at least some movement happening on stocks which are individually showing breakouts or breakdowns. I have a buy on Petronet with a stop at 301 for targets of around 315 to about 316 on the upside. And the other one which I like, that's a negative call on Shriram Finance with a stop at about 682 for targets of around 645.
Okay. All right. Got that, Mitesh. Thanks very much. We'll come back to you for some more trades and some ideas in just a bit. But now let's put the spotlight on the FMCG sector, which continues to really, run ahead. It's the top performing index on the street today. Remember, we had discussed this in Editors Roundtable itself. Nimesh, in fact, had flagged this off. Saying the market is paying full attention to FMCG stocks and hoping that this time is going to be a real turnaround. So since, I remember that conversation on Friday, Nimesh, clearly that's exactly the market's pulse. So why don't we revisit what your data had thrown up?
Well, Surbhi, as you said, we discussed is the tide turning for FMCG sector, and that's exactly what I put out as a piece on Friday as well. I'll talk about the tailwinds which are likely to come up in the very near future. But first, the facts and the numbers. Actually, the FMCG sector and the stocks have massively underperformed in the last 5 years. If I have to tell you that, stocks like HUL and Dabur have given negative returns, and that's largely because they've struggled with growth amid various disruptions. But now look at the stock prices over the last 5 years. As I said, the likes of Dabur and HUL have given negative to flat returns over the last 5 years. This is a 5-year stock return CAGR for the FMCG basket. And that's also because the numbers have been quite disappointing or weak over the last 5 years. So something like a Dabur or a HUL has given just single-digit growth over the last 5 years, whether it's a revenue CAGR, operating profit CAGR, or PAT CAGR. Just single-digit, 4.8% for Dabur in terms of top-line growth, 6% for HUL. So that shows that the numbers have been quite weak for these companies in the last 5 years, and that's showing up in the stock prices as well. So this is the first bucket. There are some FMCG stocks which have delivered 10 to 15% returns over the last 5 years. Even in that context, it has massively underperformed the overall markets in the last 5 years as to what the Nifty, the Bank Nifty, others have done. Now, 10 to 12% return is what the likes of Colgate, Dabur, Britannia, United Breweries and Tata Consumers have given over the last 5 years. And even here, it's essentially the growth which has been missing for most of these companies. Even in this bucket, most of the companies have reported a single-digit growth, barring someone like a Tata Consumer. All have reported single-digit growth over the last 5 years CAGR. So that's the second bucket. The third bucket, which has actually done well in the FMCG pack, as we call, is the sin stocks, the likes of ITC, the likes of United Spirits, Radico Khaitan, Cupid, Titagar. All these companies have relatively outperformed. And look at the stock price movement between 15% all the way to 63%. And this is backed by fundamental numbers as well. Most of these companies in this particular bucket has actually reported very strong revenue and bottom line growth. Look at something like Radico Khaitan, 10% revenue CAGR over the last 5 years. Godfrey Philippe, 18% revenue CAGR. So is the likes of Titagar up 17.5% revenue CAGR. And also the operating profit and profits have been quite strong for most of these companies, barring Global Spirit. So at least this is the space which has delivered in terms of numbers as well. Okay, so this is what the stocks have done in the last 5 years. But my whole piece was, are we seeing a bit of potential tailwinds for this sector? And the first big tailwind is going to be the GST rate rationalizations. We've been reporting about, a government thinking on rationalizing the rates, and many of those, FMCG companies are still in the 28% bucket, and that's where the first hope is likely to come. The second is going to be the good monsoon. Already the signs have been quite strong that there is going to be a good monsoon. So that's a potential tailwind for the FMCG sectors in the second half. Similarly, this is the first time in 4 or 5 years that the government has shifted the focus in the budget from capex to consumption. So clearly the government is also now focusing towards consumption. And the last but not the least, the income tax cut was again aimed to boost consumption. And all this is going to get played out in the second half of this year. So that's the potential tailwinds for the sector. But I guess today's up move, Surabhi, is clearly on the fact that a lot of the Q1 updates have been quite strong from the likes of GCPL and Dabur, and hence we've seen a bit of an uptick. But finally, it looks like the tide could be turning for the FMCG sector.
Okay, absolutely. I mean, the market's interest is fully there. And if the companies manage to deliver, and some of them actually, to be honest, are delivering better commentary and slightly better numbers, at least the updates for the first quarter. Thank you so much for that, Nimesh. We are going to discuss this, further with our guests. In fact, Deepan Mehta of Elixir Equities is joining in. Deepan, good to have you on. Good afternoon. Massive moves in the market, as Prashant said. But on a quiet day like this, what do you make of the market's interest in the FMCG space? I mean, this is a market very hungry for new ideas. But do you think FMCG can indeed be anything more than a passing trade?
Good afternoon, Surabhi, and thank you for having me on your show. I think I'll go with the latter argument. It's more of a passing phase because there is a secular growth slowdown in the FMCG sector. A lot of categories have reached maturity phase. Their volume growths are now more or less in line with population growth, and the entire expansion of the volumes was through distribution network into the rural areas. Now all that is over and done with. So I think any significant rise is there in the FMCG stocks. It's a great opportunity for investors to get out of these companies. And I know for a fact that many investors are intergenerational investors in HUL, Colgate, Nestle, Godrej. So if these investors don't take this opportunity to exit out of these companies, then again, there'll be an opportunity lost, like what they saw in the last 5 years. You could have 3 months, 1 year of outperformance. But when you're looking at a portfolio, managing a portfolio for 5, 10, 15, 20 years, the next generation, you have to be avoiding the traditional FMCG stocks.
Okay, nothing even the traditional FMCG stocks you would avoid, but what about spirit makers? You've spoken in the past about United Spirits. Tilak Nagar has done exceedingly well, Radico Khaitan. Would any of them be on the buying list?
So in our opinion, we are categorizing FMCG into 4 buckets. The traditional FMCG, and then there is new FMCG. And I would put that in that companies like Mama Earth, which is there. Then there is Nykaa over there. There is Zydus Wellness, which is interesting. And such select companies which are there, which are still into, there's Vadidar Industries, ice cream maker, and Varun Beverages. So these are the new FMCG companies where there is still decent volume growth because those categories are underpenetrated. And they could still have that 15-20% top line growth, 10-12% volume growth. Then there are the dairy product companies. The likes of Hudson is there, Parag Milk Food is there, and Heritage Foods are there. These are the companies which are actually into milk distribution, but they're moving up the value chain by getting into dairy products and branding them. And they have had some success over there. Particularly, we like the business of Parag Milk Food over there, usual disclosure. And then there are the Alcobev companies, which are also technically FMCG, but then they have various other challenges in terms of state-wise regulations, which do tend to cause volatility in earnings. But even within that space, our preference is for regional, homegrown, domestic Alcobev companies.
Okay, all right, got it. Deepan, just stay on. We want to discuss some of these defense names with you as well, which have been very, very active. I mean, once again, the market's interest coming back because of this procurement of orders worth over ₹1 lakh crore, which was announced last week. India's Defense Secretary R.K. Singh spoke exclusively with us today. In fact, he was in conversation with Parikshit, and Parikshit gives us now the key highlights from the conversation ahead. Parikshit, so tell us, what were the big takeaways for you, and what's the overall sense you picked up?
The big headline from the R.K. Singh interview to CNBC-TV18 was the fact that the Defence Ministry is going to seek an increase in defence expenditure as a share of total GDP. In fact, the Defence Secretary said they will be seeking an increase in defence expenditure as a share of GDP from 1.9% to 2.5% in the next 5-year plan, and this request will go to the 16th Finance Commission. So the cycle that we're talking about is 2026-2031. When it comes to spending, defence spending in this fiscal, the Secretary said that the government may consider requesting for additional allocation within the revised estimates for this year because there are emergency procurements taking place, there are large-scale orders that the government is making, and they're well on course to spend over 2 lakh crores on acquisitions, procurements, and domestic manufacturing. So all of that may point towards the need for additional funds in this fiscal, but a call is yet to be taken. He said it's still too early to decide. On drones, the Operation Sindoor highlighted the need for combat drones, UAVs, early warning systems. He confirmed on record that the government will soon issue a large tender which will make sure that the industry does not need any financial support, and this will be for drones, swarm drones, and UAVs as well. On the 5th generation fighter program, our own AMCA program to build a homegrown 5th generation fighter, he said that an RFP has already been issued. There has been a pre-bid meeting that has taken place with the industry, and they hope to conclude the process of granting the contract in the next 3 to 6 months. This will have a gestation period of about 10 years before India's own 5th generation fighter could hit the skies. At the same time, India will look for acquiring 5th generation fighters from key partners. He did not name the partners. We asked him whether there are formal proposals from the US or Russia. He did not comment on that, but said conversations are ongoing and we cannot give a ball-by-ball commentary. At the same time, Rajnath Singh has recently taken up the issue of delays in procurements from the US, such as the 404 engine, which is very important for the Tejas fighter, the 414 program, which has been delayed as well, Apache helicopters. So he said that 3 Apache helicopters will be delivered by the US this month, and as far as 404 engines are concerned, 1 was delivered in April, 1 will be delivered in July, and thereafter 2 engines will be delivered for the Tejas every month till March next year, which is going to make HAL comfortable enough to deliver 12 Tejas fighters in this fiscal. Then when we speak about the F404 engine, which was supposed to be manufactured at an HAL line in India, the Secretary said that the technical part of the technology transfer, that is done, and the commercial negotiations around pricing may take another 2 to 3 months. So let's see how that goes. India and US are also holding price negotiations on P-8I aircraft. That will soon be concluded. India will be acquiring more Javelin missiles. There are talks for collaboration on Striker armored vehicle systems. And more importantly, a 10-year India-US defense roadmap will be signed later this year. So lots happening in the defense sector, but broadly, this is the focus of the government.
On the capex side, there's never been a constraint, actually. There has been a constraint in terms of our ability to actually fully utilize our budget. And we've done it last year, and we are well on the way this year of ensuring that our quarterly expenditure targets are met. So based on a faster pace of expenditure, we can ask for additional money during the revised estimate stage if it is felt that the requirements are more. So I would say that we are, it's likely that we might need additional allocations in the long run. For the 5-year cycle of the 16th Finance Commission, we are going to be seeking additional allocation to the extent that our defense share in the GDP goes up from the current figure of about 1.9 to about 2.5. So as far as we are concerned, yes, the nature of warfare is changing the way it is. There is a large market for drones in the country, military drones. And I think industry recognizes that and is making investments. There are one or two promising companies with Indian designs as well. There are others, including some large industry conglomerates who've tied up with foreign vendors or OEMs with transfer of technology. So yes, from our side, the support will be there in the form of large orders, large RFPs or tenders that will be issued, and it will be under Indian, by Indian and IDDM categories, because the intent is to make it in India. But it could be at fully Indian design and manufactured. It could also be one where the technology is from outside, but the construction or the manufacturing takes place in India.
Well, we spoke with Mr. D.K. Sunil, the CMD of Hindustan Aeronautics, on the order book outlook. Let's listen in to what he had to tell us.
This will be a very big R&D effort for the Sukhoi 30, which will take about 5 years to complete. And 84 aircraft will be upgraded, and that will, production will, the overall and repair and the upgrade will pan out after 5 years. And it's expected to be about 65,000 crores. Helicopters will be built predominantly in Tumkuru. We already have started producing the LUH there. So the facilities are up, and that will be expanded to cater for the LCH also, which is the Prachand. So we expect to close it in 6 years from FY28 onwards.
Dipan, how excited are you about defense, and what is that stock that you still like given the kind of outlook? We know the runway is big, the problem is on valuations. So what's fitting the bill?
Yes, just valuations. I was doing a quick check because we also have a complete screener on as far as defense stocks are concerned. The cheapest at 40 times is HAL. Be it private sector or public sector, the P multiples are just too daunting. And I understand that these businesses can grow at a very fine clip, some as fast as 50%, 40%, others also minimum 15, 17% or thereabout. But look, I think they're highly fancy. There's some amount of froth also, I feel, that's happening in these stocks. And it's better to just wait and watch. Don't sell existing holdings, that's what I feel. But wait and watch to make a fresh investment, especially if you're underweight defense. And that a time will come when there is a kind of peace in the world, and all these, geopolitical events or these friction points are reduced. And when there is peace and there's, these news flow reduces as far as defense stocks are concerned, that's a good opportunity.
All right, Dipan, one more stock you had mentioned last time around was Orient Pro. You were saying that, it's looking like it's setting up well. I think from the time you highlighted the stock, I think around 10 days or so ago, the stock has gone up, gone up, I think 15%. Did you all get in, or are you all still evaluating it? Because today itself, it's moving up on very large volumes.
No, it was just a lucky call. We are not invested in the stock at all. We wish we had. And, again, I was just scanning through all the entire software stocks or the entire spectrum and just doing a simple analysis of where is the growth coming. And if you look at the entire spectrum, I think the growth has come from mid-cap, small-cap stocks like Orient Pro. Then you go deeper into the story, and it is very clear they're not a typical software services company, just, doing application management, development, deployment. They're into products and platforms. And truly, that's the way ahead for Indian software industry. If you want to create wealth, you have to look for companies which are doing products and platforms. Could be B2B, could be B2C. That's the only way forward. The traditional software companies, the likes of TCS, Infosys, they have got great challenges and many issues around them. So I would avoid them. So in same light of that, this stock came up. I think it's a good story. But again, I think after 15% up move, it seems to be reasonably valued. Maybe look at buying it at correction.
Okay, no, absolutely. Dipan, we'll leave it there. Appreciate you joining in. Great conversation as always. Thank you very much. We'll take a quick commercial break here. We'll come back with Pashupati Advani on the other side. More market conversation coming up. Okay, but the market is down about 30, 32 points, so not very much at all happening. It's absolutely flattish. General insurance numbers are flashing at the bottom of the screen, and we'll have Yash come up to explain, the company-wise details and put this in the context of what we've seen over the last couple of months. Maybe sort of look at, the data for June as compared to the, April onwards changes for some of these companies. Otherwise, 1,800 stocks lower, 1,000 and 1,100 stocks higher. It's the same old picture. Dream Folks is still down about 6%, so that's sinking one way. And it's lost quite a bit, 230, 240 rupees 4 days back, and stocks under 180 rupees at this point in time. Defense, of course, there are names like DCS, etc., which are higher, but you've got a few which are actually under pressure as well. Right now, Deepak Fertilizer down about 5%. Actually, lots of names and decent-sized volumes as well for this point in the day. Pashupati Advani is with us, founder and chairman at Global Foray. Pashupati, good to have you with us here. Thank you very much for your time. I don't know if you heard the piece that Nimesh put out on FMCG, but my question, of course, you can talk about FMCG if you'd like, but broadly the consumer name, which actually many on the street are also pushing as if, to say that its time has come. And then maybe, it'll start to do better. The latest kind of news which the market is excited about is potentially that GST slab realignment, that 12%. And how that perhaps gives another leg to consumption. We don't know if it will happen or not, but the FM herself has spoken about this. What is your sense? Do you think one will make money in consumer names from here?
Well, consumer names, as you rightly mentioned, have been a bit blah over the last, 6 months to a year, and that obviously is not been great news for the markets. They've kind of held in there. But again, consumer names tend to be bought in defensive markets. So I think we need some kind of move towards new investors being defensive. But in the meantime, they've not really sort of really performed fabulously. In fact, they've been kind of blah. But their time will come. I think obviously the cut in GST to 12% will be a big boost for them. And I think maybe they're just waiting for that.
Pashupati, hi, afternoon. Any new ideas, any new purchases that you guys have done?
Well, actually, what has been of concern has been the large number of IPOs that have come in terms of the volume. And I think that's basically weighing down the market. I have bought a couple of them around the offer price. Some of them are waiting for them to come back to the offer price, which I think will happen. Just because there seems to be about $7 or $8 billion worth of IPOs that have come in the last 30 to 45 days. So it's like a huge amount that the market has to absorb. And I think our market kind of gets driven by supply and demand, and there's been a lot of supply and a lot of PE people exiting and things like that. So that's not a healthy sign for the markets in general. It's showing that our markets are overvalued and people want to get out. So let's see.
Which recent companies did you buy?
I bought a couple of long-term ones. One of them is Aegis Vopak, which I think is a stock that it's not going to do anything now. I think it's trading about around the offer price, maybe 5 rupees higher, which is neither here nor there. But I think it's in a business that's here to stay. And a lot of it will be decided on what happens in the US. And the president has actually mentioned that anyone who sides with BRICS, we're going to have another 10% tariff. It's not come in yet, but who knows whether it'll come in tomorrow or day after. So I guess the last time I checked, India was part of BRICS, the center eye. So we're going to have some extra tariffs maybe, but let's see.
All right. Hi, Mr. Advani. Good afternoon. Good to see you, Ben. What about IndusInd Bank? What is the call? We were debating about this the last time around, and there's an equally bullish and bearish argument out there. Some would argue about the price to book, and some would argue what is in the book we don't know. What are you making of it?
Well, as I mentioned the last time, the IndusInd Bank is a bit of a trading stock. You trade in and out, either from the long side or the short side. I think the last time I was on your channel, it was around the same price. So I would not have made any money or lost any money since then. But I am, at the moment, not in the stock.
All right, got it. What about the infrastructure theme? That's something that you like, right, in the past?
Yeah, I think that's going to continue. I think that's here to stay. See, I look at infrastructure being a cheaper version of defense, because defense, as Dipin also said, the P's are very high, and it's very difficult for us to sort of traditional market players will look at fundamentals to say, hey, we should buy defense stocks, because they're all. I think the cheapest one is 40x, so it's a tough call. But infra is lower. Infra is also here to stay, and particularly if you're in the construction space, you've got the choice of redevelopments, new construction, RERA projects, roads. The world is your oyster. In fact, one of the companies, I don't remember offhand which one it was, actually mentioned that they don't want to even get into projects unless they can see 20% IRR. So, which means there's a lot more projects and a lot less infrastructure players chasing them. So for them, they can't raise the prices yet too much because everyone's still being very cautious. But the thing is, they've got as much work as they want to do. And I think that's very encouraging for the sector.
Give us some names, Mr. Advani. Jay Kumar is something that you liked. L&T is another one that you've spoken about in the past. Anything from the space?
Those are the ones. I mean, Jay Kumar is doing very well in the road space. But again, I think even the realtors are also, doing their projects. But I think as opposed to real estate, I am more comfortable in infrastructure, simply because I feel that infrastructure is where it's at, because the companies can actually move. The construction people are going to make more money than the real estate people, according to me, in this next cycle.
Okay, all right. So that's a thumbs up on infrastructure players and contractors, and they haven't actually, to be fair, these stocks haven't moved. A lot of other parts of the market like EMS and defense, they've all been soaring, going through the roof. By the way, on a side note, that was important update coming in on Selby Aviation. This was the aftermath of Operation Sindoor, where India had decided to revoke the company's security clearance. And Selby obviously was a major operator at big airports. And then they had gone and challenged that in the courts. And now it seems the Delhi High Court at least has not upheld their pleas. That's important news on a side note. But Pashupati, hi, great listening into you this afternoon. Tariffs and wars aside, the market's been actually remarkably resilient. The US market and, of course, even our market. What do you think the second half has in store? I mean, you've given us some pockets like infra where you can still incrementally add. But if you're out of the market, you'll always regret missing. If you're in the market, you're worried about valuation. So tell us some more approaches.
So I think you can't exit the market because India is still you hear from people that India is the bread of the month and the India market is doing fine. But you've also got people from outside saying, how do we make money in this country? And for foreign investors, of course, the funds and all and the insurance companies and the sovereign funds are sorted out. But if you are running a company and you want to try and make money in India, or you are an investor who thinks that they want to invest in India as an individual, it's extremely difficult and cumbersome. So I think that we need to figure out a nice way for people to be able to invest in and out. I mean, people don't want to put their money and get it stuck, and they don't want to go through a mutual fund because the mutual funds charge a lot of money. And there's no index India mutual fund yet that I know of that is a true index fund like Vanguard is in the US. So I think that, it's a quandary. But people are looking to try and invest in India. But the question is, how? And if you're a true Gora, you can't just walk into a bank and open an account. It doesn't work like that.
Speaking of Goras, there are Goras who walked in, did all kinds of trades, and now they have a tussle ongoing with the market regulator. You've seen, many cycles, Pashupati, but this is something new. The regulator taking on a firm of this magnitude and a firm that had very, very large trading positions. Now, do you see this impacting the market in any way? Maybe immediate volumes, day-to-day volatility, trade? And this is more on the trading side than, of course, fundamental buyers who wouldn't need to bother. Well, do you see any ramifications?
Well, of course, I think that this is a notice to others who are in the same game, and there are plenty of others who do play the same game, to be wary of the Indian regulator. The question is, I hope the Indian regulator is able to claw back some of the gains. I don't know what it'll do with the money once it gets it, but I think that it's worth, shaking them to see if they can give back some of it. I mean, I think they've asked for about 15% or 20% of what they see as
4,800 crores. Yeah, roughly 4,800 crores as of now.
Yeah, so ask for a portion of the gain back.
Yeah.
I mean, if I was, I'm not Jane Street, but if I was Jane Street, I'd probably, make noise and then try to settle with the regulator, because I mean, they do want to be in business here. And but what's to stop a Jane Street becoming? I said to someone, there'll be an April Street next week, or a July Street. So I think that, but our regulator at least has picked up the patterns, albeit late, but they picked up the patterns. It would be nice to see if they could pick it up earlier. And also, I don't know if they're going to be able to get any restitution from any of the brokers who've done the trades, because I don't think Jane Street had a brokerage company. So, I think those guys also need to try and persuade Jane Street to give some money back.
No, there will be there will be some money, in the custody of brokers, because I mean, they were a regular market participant, Pashupati. So that is there, and I imagine that those accounts are frozen.
Well, we'll see. I mean, I haven't heard anything. I mean, I hope you're right, but that I don't think would be a small amount. I mean, that'll be a small amount.
No, it's not a small amount. I think it's they're very large. That's the whole point, right? With Jane, it was all very large. If it was small, and the capital and the money essentially is what allowed them to do what they did. And from what I understand, I mean, it's pretty large. And those accounts perhaps would already have been frozen. But anyway, we'll see as we sort of look ahead at it. But points taken, Pashupati. Thank you very much for joining us.
Thank you.
Good speaking with you. It's always a pleasure. Let's take a quick commercial break here. And as always, we get you a check on what's happening in dealing rooms in our D Street chatter segment. Nimesh is back with us for that. Stay tuned.
Welcome back. A flattish session is what we're seeing today for the Nifty, but plenty happening in the broader markets. That said, it's time for our favorite segment, D Street Chatter. Nimesh is just to help us out with what is he picking up. Nimesh, a quietest day of trade, but plenty happening from the broader markets. How are you reading it?
I think it's largely happening in the FMCG sector stocks, right? That's been the big leader of the pack today. And that's the reason why the Nifty is flat despite, not much happening otherwise in the overall market, so to speak. Even the flows are quite muted. And the only space which continues to see buying interest is the PSU basket. And there the sector rotation continues. So again, my sense is there is a bit of buying in select PSU stocks, especially the bank stocks, as well as the OMC. So that's from a flow perspective. But otherwise, it's been pretty much quiet. I guess the market lacks two things. One, important triggers, and also a bit of buying interest from the domestic mutual funds and insurance companies. That's been lacking in the last couple of days. From a trigger point of view, I guess the positive US-India deal could be a big trigger to watch out for. And of course, the earnings season where I guess for Q1 updates, the stocks are reacting as well. So that's something to track in the very near term. But from a flow perspective, it's quite muted with only selective buying in the PSU names.
Okay, all right. What about individual stocks, Nimesh? What are you picking up?
Well, a lot of individual stocks are buzzing in trade. So the first stock on my list is UPL. For the last couple of days, that stock has been buzzing. There has been buying interest back from larger HNIs, is what I understand in UPL. And the general sense is that Q1 could be quite strong as far as earnings are concerned. So that's a trigger there. The second stock is Dixon Technologies. We saw a large block last week where Motilal bought from the promoters. And since then, you've seen a bit of uptick as well in that particular stock. There is a very strong indication that maybe the company is going to announce a big tie-up with a global firm very soon. That's a trigger as far as Dixon is concerned. The third stock is Cyient Limited. Within the IT name, this is relatively underperformed, but I understand a leading domestic PMS has been an active buyer in Cyient of late. Remember, there is a change of guard as well in Cyient. So potentially, what's the strategy going to be? That's going to be key for Cyient in the very near term. And the last is Uptown. We normally don't talk about this stock, but big mover in the last few days. In fact, if you look at the 1 week chart, the stock is almost rallied 35–40%. And again, there is an anticipation of a corporate development in Uptown very soon.
Okay, all right. Nimesh, thanks very much for that. Interesting list of stocks as always. And we'll keep a track of some of these names. Well, I think Mitesh is now with us to run us through what he'd like you to buy or sell today for a reverse trade tomorrow. Mitesh, go on.
So Britannia, in fact, the entire FMCG pack is buzzing well, Prashant, today. So I have a Britannia as a BTST. Recommend buying here or with the stock below 58.50 for a target of 59.20 for tomorrow. And CAMS is on the negative side. It's kind of giving a sell signal on the hourly chart. So maybe this will see more pressure. STBT here with the stop at 41.61 for targets of 41.10 or so.
Got that. By the way, just a quick word, if you will, on Equitas Bank. I mean, I don't know if you've tracked this. Big down move, 7% lower today.
I don't track the stock regularly, but yes, today because of that fall, it's come into focus. There is some good support around the 62 to about 61 zone, which is where we had a rising gap on the 12th of May. In case you break that, and there's a good chance of that happening, then I think the stock will decline further and possibly head towards 58.
Anything on Deepak Fertilizers? One-way move and now starting to correct a little bit?
Yeah, again, very extremely overbought stock. I think now is showing first signs of profit booking. The medium-term support is around 1520, 1524. I think that's the target these stocks should do, and then maybe we'll see some more.
I see. Got it. More later. Thanks very much, Deepan, for joining us with that. Now, let's shift focus. And this is, of course, the Trump's tariff agenda. Sources tell CNBC-TV18 that India and the US are set to take a final decision on a mini trade deal in the next 2 days. Parikshit is here with what he's picking up the latest. Parikshit, over to you.
Well, we're expecting a final decision by tonight. President Trump is likely to make that announcement. In fact, sources telling us that whatever negotiations had to happen on the early trade deal are now done. No further talks are taking place, and a political call has to be taken by both President Trump and Prime Minister Narendra Modi. We're also learning from our sources that India has drawn its red lines in the negotiations, that we will not offer any concessions on sensitive areas in agriculture and dairy. This includes wheat, rice, maize, and dairy products and GMO crops as well. So no market access in those areas. On automobile tariffs, we've conveyed that we would like to offer similar tariff arrangements as we've done with the European Union, with the UK as well. There cannot be anything different for the United States. We've been learning from sources that India has offered a fair deal, which would be a win-win for both sides, and would also give good market access for India's labor-intensive sectors such as textiles and footwear. We're told that the tariff deal is likely to be a mix of both quotas and tariffs. So, for example, in labor-intensive tech sectors like textiles and footwear, an annual quota could be set for lower tariffs, and anything that exceeds that could be subject to higher tariffs. But let's first wait and see if a deal happens also because the US is very insistent that they want lower tariffs in agriculture and dairy sectors. India has said no to that. Let's see in the next few hours if the deal happens, and we're expecting an announcement possibly by late tonight in India.
Okay, all right, got it. Pariksha, thanks very much. So waiting by as the hours tick, and let's see what contour this mini trade agreement or mini trade understanding perhaps finally takes. Thank you for that. Well, we just saw some numbers flash on the general insurance side. So let's see how the data for June is looking like. Yash, what are the early trends indicating?
Well, Surabhi, it's a tale of two extremes. On one hand, there's a sharp decline which has come through for ICICI Lombard. And this is not just in the month of June on a year-on-year basis, but in the month of June on a year-on-year basis, in the month of June on a month-on-month basis. And for the first quarter, as far as ICICI Lombard witnessing that sharp decline in premium collection. The other extreme is New India Assurance, where there's a sharp outperformance which has come as compared to the industry average, not just as compared to, of course, ICICI Lombard, but as compared to the industry average. And this again on a month-on-month basis, year-on-year basis, and for the first quarter. To speak about specific numbers, ICICI Lombard, the June premium is down 8% on a month-on-month basis. On the other hand, industry has seen a growth of 5%. ICICI Lombard in the month of, in the first quarter, the premium has grown by just 1%. The industry premium, on the other hand, has grown by 9% in the same period. Now, let's speak about New India Assurance. June premium has grown by 11% versus industry growth of 5%. This is on a year-on-year basis. On a month-on-month basis, June premium has grown by 13%. The industry premium has grown by just 5%. And finally, for the first quarter, New India Assurance, the premium has grown by 15% as compared to industry growth of 9%. So simple headline, ICICI Lombard experiencing a sharp downtick in premium collection on a month-on-month, year-on-year and first quarter basis. Other extreme, New India Assurance showing a sharp outperformance in its premium collection, again on all three parameters, month-on-month, year-on-year and for the first quarter as compared to industry average.
Thank you very much for that. Sudeep Bandyopadhyay, Group Chairman, IndiTrade Capital, now joins us. Sudeep, any thoughts on the data that's out?
Well, I think it's very difficult, Rima, to interpret from one segment of the data. I think for the general insurance business, the April month becomes very, very critical. So I don't have the April data readily in front of me. So I need to really see what happened in April to understand. Look, June is not a big month for general insurance. April is. So April data is more important. So I don't think we should decide one way or the other about ICICI Lombard or even New India Assurance based on this set of data. That's what my feeling is. Overall, I think in spite of the challenges which the general insurance industry in India is facing and some of the regulatory changes which are happening, I think the growth trajectory is uninterrupted. Overall, the industry is growing at around 5-6%. And I think this growth can significantly go up from here on as well.
No, absolutely. Point taken. Just a quick word. That's the insurance space, and life insurers also have done well. Actually, this year generally broadly has been pretty good. Like in most other sectors, in insurance as well, there is the expectation. SEBI's got a new chief. RBI's got a new chief. IRDAI hopefully will get a piece. I think Yash last week put out a story in terms of who some of the possible candidates, etc. as well. Here as well, we've seen a fair bit of tightening on many accounts. Will we see some relief now? At least that's the street expectation, both for life and for general insurers as well, things like bank assurance, etc. A quick word, on the Dreamfolk stock, if you will, Sudeep. Just a complete collapse from 230, 240 levels to about 178 now.
In fact, Prashant, I did comment, I think last week on this stock, and I advised investors to stay away. It's a falling knife, no point trying to catch it. Yes, they have been talking about, I did see the interview on your channel, and I think they're talking about international business, they're talking about other businesses, but these are all future, but as things stand today, they are in a very, very tricky situation. and things are not at all looking good as things stand today. So it's completely avoidable at this stage. One doesn't know where this fall will stop. It's been continuously falling, and as things stand, I think it's better avoided.
Okay, that's been an avoid. Even last week you indicated that. Stay on, Sudeep, need to get into a break. As we do that, here's some good news for all our viewers, because India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. You can get instant access to all our news, articles, financial world updates at your fingertips. So don't wait, download the CNBC TV18 app now from the Apple or the Google Play Store, or you could just scan that QR code on your screen.
Welcome back. Well, markets as flat as can be, breadth of the market in favor of a number of stocks declining, but stocks are moving around from the broader markets. And one such theme that's playing out is the steel tubes and pipes. You have smaller names like a JTL, Hariom Pipes. They have given volume growth in Q1 of close to around 25 to around 30%. So you see both those two stocks. In fact, JTL, the last couple of trading sessions, you have nearly 1 crore shares that have got traded. Even in Friday, even in today's trading session, volumes are very, very large and it has valuation support. So the bigger name in there is APL Apollo Tubes. That as well has given you no returns in the last 2 years. Sudeep, what about this space? You know, if there's going to be a big infra boost, a big spend, these companies will be able to deliver volume growth, which was actually lacking in the last few years. And the smaller names are getting it at fairly decent valuations, while the larger name APL Apollo Tubes, on a larger base, growth will be a little lower. What's your view on the space and what do you like?
You are absolutely right, Nigel. I think the opportunity for these companies are significant with the kind of infrastructure spending we are talking about, based on the government's commitment of spending 11 lakh crore during the current fiscal. And the money spending by the central government in the right earnest has already started. So, you know, there will be no dearth of demand or orders for their products. Now, the question is picking up the right stock for getting the right kind of returns. And I think APL Apollo is priced, richly, I would say, to an extent. And one needs to be a little careful while buying at these valuations. You can look at some of these smaller names, and you just mentioned JTL. I think, yes, that's probably the reason that these stocks are attracting investors' attention, and a lot of buying is being seen in these stocks. Yes, one can look at buying a stock like JTL, but remember, this is not a very, very short-term game. You have to have, let's say, about a 9 months to 1 year kind of time horizon if you are buying into, let's say, JTL at current levels.
Got that. Sudeep, a quick word on InfoEdge. The Q1 updates came out and growth has slowed down. The overall billings growth is at 11%, and it's down for both recruitment, that's the Naukri business, where billing growth is about 9% versus 18% in the prior quarter, and even for real estate. Now, considering the kind of upheaval the entire job market is going through on account of AI, what are the prospects of InfoEdge? Do you think it's going to disrupt their business greatly?
Well, I think it will be disruptive, and it is being disruptive in the short and medium term. But I think long term, the business is going to remain robust. We will see these kind of slowdown in growth because the volumes are coming down. You know, when it was only pure play IT outsourcing business, the numbers which they were hiring were significantly higher. Whereas in case of AI, the quality of job is much more enriched, but the numbers are not so humongous. So there will be a difference. I'm sure, will fine tune and adjust to the new reality, and they will start delivering. But this adjustment will take some time, and that's pretty much what we are seeing now.
Okay. By the way, looking at one more pocket beyond FMCG, healthcare, hospitals, diagnostic stocks, they've been doing well. Metropolis, which also came out with its first quarter update, is up 5.5%. Yatharth Hospital is up about 5%. There's ThyroCare, which is up about 6%. We should just get all these stocks in. Apollo Hospitals, anyway, I mean, it's far, far bigger name. It was the best winner from last week. Even today, Apollo Hospitals is managing a 1% up move. So, yeah, healthcare always in demand. Sudeep, hi, good afternoon. Do you like anything? Diagnostics, healthcare?
I do like healthcare. I do like the hospitals. And Apollo has been my favorite for last 1.5 year plus. And of course, this demerger, which they're doing now, will definitely make it much more sharper, focused business. And even the business which is getting demerged will get sharper focus and probably a better valuation independently going forward. But as far as diagnostic space is concerned, I'm a little concerned and I'll be a little careful. Yes, the Metropolis numbers I did see, and the numbers were pretty good for the quarter gone by. But I think the competition is going to be much more intense with Amazon announcing their intention to get into this space in a reasonably big way. And beyond Amazon also, I think overall the competition is hotting up. It doesn't take away anything from what Metropolis or Dr. Lal Patlab is doing. But the fact remains that the margins, we believe that in the medium to long term, margins will start coming down. And it will be a low margin, high volume business. And that's what I think the players also have realized to an extent, and that's why they're trying to increase the volume by different means, including smaller acquisitions, niche acquisitions, like Metropolis has done as far as the oncology space is concerned in the last quarter. So let's see, wait and watch. But at current valuation, I'm a little careful while recommending a buy on the diagnostic space.
Okay, Apollo Hospitals, by the way, 52-week high on the stock today. It hit a level of over 7,600. So it's been a strong move. Just allow us a minute or two as we recap the day, and then we'll come back to you, Sudeep. What a flat day it really has been. Let's pull up the Nifty. Look at the chart. It's all over the place. Red, green, red, green, red, green, and all in a tight, narrow band. Extremely choppy. And finally, we've got a red blink again, 1 point on the lower side. Let's talk about individual stocks. The lower end was being brought up by names like BEL, ONGC. These are stocks on the way down. Tech Mahindra was down about 2% as well. HCL Tech down 1%. Infosys down 1%. So it seems to have some nerves as the IT earnings season kicks off this week. Aside of this, Maruti Suzuki, there's Ultratech Cement, which has lost over 1%. Hero Motors, some of these auto stocks were doing pretty well last week, but they've cooled off today. Financials didn't really help the index. ICICI Bank, for instance, 0.5% lower. Let's look at HDFC Bank, slightly lower on HDFC Bank as well. And SBI was also down about 0.6%. What was up, however? Consumer, and more consumer. Lever, 3%. Tata Consumer, 1.5%. Nestle, over 1%. Asian Paints, long list actually. Eicher Motors actually did well as well. It was bucking the overall weak trend. And then, of course, there's Reliance. The reason why the Nifty did not fall too much is because of the big giants like Lever, ITC, and Reliance, all adding up on the green side today.
Well, the mid-cap index ends with a cut of about 1/3 percentage point, negative advance decline ratio. Some of the big movers, defense on the way down. So Paris Defense loses 5%, Bharat Dynamics 2% gone. In terms of the Q1 update, Jubilant FoodWorks, anyway an expensive stock, with trading at about 70 times forward multiple. Stock was down nearly 4%, but other FMCG names, whether it's Godrej Consumer, 6.5%, Dabur higher in trade. Senco 2 locked in an upper circuit, 4%, only buyers on that. Senco 2 had a pretty good session.
Well, lots of stuff to report on the broader market, but as far as indices go, nothing very much. Small cap index, by the way, out of the 4 indices, was the biggest loser with a 0.5% cut. Nifty ends almost unchanged. Bank Nifty, not very much by way of change as well. So wrap on this edition, a closing bell from all of us here. Goodbye, but markets forward will pick up on all the action in just a bit.
Well, the market remains in a consolidation phase. The Nifty and the Sensex end flattish. The Nifty manages to hold the 25,400 mark. Broader markets underperform the blue chips in today's session.
Godrej Consumer and Dabur points soar after they post strong Q1 business updates, and it points to an uptick in consumption. Other FMCG stocks gain. Index rallies 1.5%.
QS had major Jubilant Foodworks and Info Edge skid despite a good Q1 update. Jubilant clocks good pizza sales, while Info Edge seals a healthy rise in recruitment and real estate billings. Hello and welcome to Markets Forward, your go-to show where we get you up to speed with regard to today's trading action and we set you up for tomorrow as well. I'm Nigel and with me is Ekta Batra. Hey Ekta.
Hi Nigel. Well, yes, we've got you covered for the next 20-odd minutes with all of the big news and the key developments on Dalal Street, the top corporate voices and the events to track. But let's kick off the day with the market action. Well, it seems to be a breather that the markets are taking, a wait and watch at this point in time because of, possibly what could emerge when it comes to the tariff negotiations. But FMCG did well.
Well, that's right, Ekta. That was a bright spot in today's trading session. FMCG led the way, but otherwise the markets are quietish, waiting by for some clarity on President Trump's tariffs and also what the FOMC minutes will throw up later this week. So those are the global cues. On the back of that, some kind of consolidation on the headline index. Well, let's run you through what we've got lined up on the show for you. We start off with all the top movers and shakers. Hormas will be helping us with that list. FMCG stocks like GCPL and Dabur, they surge and trade following their Q1 updates, while Jubilant Foodworks shares declined despite a very good showing in their provisional numbers. Well, Hormas will also give us reasons why the stocks were buzzing in today's trading session. But as promised, first segment coming up. Hormas standing by on the big ball with all the top movers and shakers of the day. Hormas, over to you.
Well, it was a day when the markets were in snooze mode, still awaiting Donald Trump's announcements from later tonight. But the day certainly belonged to the FMCG shares, and almost all of them did very well. Those who reported results, and then the rub-off effect on those who didn't report provisional numbers as well. You look at Godrej Consumers, and HUL is the stock that I was referring to, but that had a rub-off effect on names like Jyoti Laboratories and Bajaj Consumer as well. So FMCG, in a way, had a very good day today. The one FMCG stock that didn't have a good day was Jubilant Foodworks, and that is among those names that also reported business updates today. The Equitas Small Finance Bank also is a reaction to that, almost 7% lower today. Info Edge's updates came out earlier in the day. That stock also was down 5% at one point. Senco was the other positive update that came in, and ESAF too ending at the lows of the day. Defense stocks predominantly were lower in today's trading session. Be it Paras Defense was up 10% on Friday, gave up half of those gains today. Garden Reach, BEL, Masgaon Dock, all of them ending lower, but DCX Systems was an outlier because it won a contract earlier in the day, so ending 3% higher today. Dreamfolks continues to grind lower. Fifth day of losses for the stock, 6% lower today. Metropolis, Nuvama Wealth staging a bit of a rebound after Friday's drubbing. Petronet LNG after a positive brokerage note that came in earlier in the day. And CE Infosystems too, after signing a contract with India Post today, doing well. And lastly, some stocks that ended at a 52-week high today. Now look at PC Jewelers. That was up almost 11%. Circa Paints, Hawkins Cookers, Thyrocare ended at a 52-week high today, 5% higher. And Axis Gates too, continuing to make new highs. Back to you guys.
Okay, all right, Hormuz. Thanks very much for that. Now let's go across to our guests this afternoon. We have Sudeep Bandopadhyay of Indie Trade Capital and Jay Thakkar of ICICI Securities. Sudeep as well as Jay, welcome to the show. Well, let's start with the technicals of the market. Jay, quiet day. Nifty just about consolidated. And we have the mid-cap index, which marginally underperformed. What was your approach to today's trading session? And what are you probably expecting in terms of stocks?
Good afternoon to you, Ekta and Nigel. Well, see, my take on the market is that it might just trade sideways, for the short term, because till we don't have a meaningful breakout again, the range is just quite wider. I would say 25,700, 750 on the upside to 25,000 the downside now. So, and we are right in the middle of the range, and Nifty closed almost, formed a kind of a doji candlestick pattern with almost no gains or loss in today's trading session. In fact, Bank Nifty has also gone sideways. My worry is that Bank Nifty relatively is underperforming since past 1 week now. We have seen that in past Bank Nifty was outperforming the Nifty. Each time it is giving a breakout on the upside, is not able to follow up. And it has sort of formed a rising wedge pattern, or you can say an ending diagonal pattern, wherein, each of the highs when joined, those are acting as a resistance. So now this time around, we again saw that, 57,500 is acting as a resistance for a Bank Nifty. So unless we are not seeing a breakout above those levels, there is a very high possibility that Bank Nifty too might trade within this range. And, Bank Nifty and financials were the ones which were, really in an upward momentum and supporting the Nifty's up move, and they have gone sideways. So unless we see a, clear reversal happening in the BFSI, wherein banking and financials now take forward or again move upside, we would not expect a breakout on the Nifty. Rather, it would trade sideways within this range of 25,700 to 25,000, unless we see a major kind of a move happening due to the result season. Stock specifically, yes, because we aren't seeing any major movement in IT or banking now. And we have seen now FMCG, in fact, providing a breakout, and we are seeing some good short covering happening there. So the stocks like Dabur, HUL might even perform from current levels, even for that matter, Marico, which has seen good long build-ups in past as well. So these are the few stocks which might do good from the current levels. I would not even be surprised if at all Pharma does a good comeback in this week. For that matter, Divi's Labs, Lupin, these are Glenmark is already doing good. But Divi's Lab and Lupin, these are the few stocks which can do good. Lupin can see some short covering happening, whereas Divi's Lab is already has seen a good long build-up, and that can continue. So Pharma and FMCG would be in focus unless we see a breakout on either side from Nifty.
Got it. Okay, all right, Jay. Thanks a lot for that. Well, let's get to consumer staple stocks. GCPL as well as Dabur, both of them rallied post their first quarter numbers. Manglam joins us to decode what's driving them. Manglam?
Staples are definitely having their day in the sun today. Good updates coming in from the likes of Godrej Consumer, as well as good improvement is expected for the likes of Dabur as well. The weakness are largely seasonal, and that's what these updates suggest as well. If you look at Godrej Consumer, on a standalone basis, the company is reporting a high single-digit underlying value growth led by mid-single-digit underlying volume growth, which has seen improvement both sequentially as well as on a competitive front too. Even though the company has, seen some weakness in their margins on account of deflation in palm oil prices and them sitting on high inventory, they believe that this situation is likely to ease out in the second half of this year, and the street is taking note of that. Growth for Godrej Consumer has been led by their home care businesses, which has actually grown in double digits, whereas personal care, which is largely the soaps business, has seen low single-digit value growth, and that's on account of the deflation that we've seen in palm oil prices, so that transition continues. On the other hand, for Dabur, their consolidated revenue has grown in low single digits, but that's largely because of the beverages portfolio, which has seen a weakness on account of unseasonal rains and a shorter summer. Beverages, remember, account for nearly 10 to 12% of their overall sales. The other parts of their business, which is home and personal care, along with healthcare, have seen a lot better performance, and the company believes that this is likely to continue going forward as well. Here as well, there is likely to be some margin compression, but the street is hopeful that the second half of this year, we will see improvement in the margins as well as the commodity cycle turns favorable. Remember, both these stocks have been underperformers in the past, and on the back of improving demand sentiment, we've seen these stocks do well. In fact, not just GCPL as well as Dabur, we saw HUL, which was the top Nifty gainer today as well, taking a leaf out of these updates and telling you that the demand sentiment is definitely improving.
Okay, all right, Manglam. But stay with us. While the market cheered for staples, it was not that good for discretionary names like Jubilant FoodWorks, which slipped in trade despite good updates.
Well, Jubilant FoodWorks reported a good set. We had a consolidated revenue growth of 17%, domestic revenue growth of almost 18%, led by like-for-like growth of about 11.6% in India. Domino's India, that is, them having added nearly 60 stores as well. The stock is lower largely because of valuation concerns and discomfort out there. Remember, the stock, despite the outperformance that we've seen and despite a decline post that, trading upwards of 75 times FY27 earnings. If you look at analyst estimates, that leaves little headroom for growth. And the street is now looking at consumer staples as a shift from a portfolio standpoint, which is what explains the outperformance of GCPL and Dabur versus Jubilant FoodWorks. And at the same time, we got decent updates coming in from the likes of Nykaa, etc. as well. Those stocks too sold off from the highs.
All right, Mangalam, thanks for that. Sudeep, what do you make of this move? Staples, do you think it's time for them, to start performing? If you look at some of these stocks, last 5 years, almost zero returns. HUL, Dabur included as well. And also, what do you make of the pizza maker? Numbers look good. Valuations are a concern. What do you like from this pack?
Oh, absolutely, Nigel. I think, look, what's happening as far as the staples are concerned, FMCG, core FMCG, I think last few years have been very disappointing. And, initially we had a, rural slowdown, kind of a rural demand slowdown. Then when rural demand started picking up, we had an urban demand slowdown. So I think, something or the other was not working right. Finally, when the Friday Marico numbers came out, we did see a pickup, sign of pickup, very clear sign of pickup. And today GCPL, Dabur and other numbers which are coming out, at least the business numbers which are coming out, very clearly shows that probably after a very long time, the green shoots of growth is visible. And of course, the market is cheering that. FMCG does play an outsized role in overall market sentiment. And, pretty much that's what we are seeing. You're absolutely right. These stocks haven't given investors good return over the years. And I think finally their time is coming. Consumption is being given a boost by the government. Government is very clearly realizing that consumption needs a boost, and they're trying to do a lot of things to ensure that consumption does get a boost. Capital expenditure, yes, that's happening, but consumption also is being given a support now, and that was necessary for FMCG to start doing well. As far as the Jubilant FoodWorks and some of the other names, Nykaa and others are concerned, I think in spite of good set of numbers, I think the valuation comfort was never there. When FMCG was not doing well at all, I think people were putting allocation there more and more. But now that there's a sign of FMCG starting to do well is visible, money is and will definitely move from the 75 FY27 multiple type of stocks to core FMCG stocks like in HUL, Dabur, Marico, and the likes.
Okay, all right, that's on FMCG. But now let's go across to the big IT deal. Capgemini has acquired WNS for $3.3 billion in cash. The deal is expected to be accretive to Capgemini's revenue and operating margin. While Capgemini reported global revenues of €22 billion for 2024 with 14% margins, WNS generated approximately €1.2 billion in revenue in FY25 with margins of 19%. Analysts stated if Capgemini can combine domain-rich BPO of WNS with AI-led automation, it can create a next-generation intelligent operations platform further. UBS highlighted this could transform Capgemini's positioning in a BPO space evolving from labor-centric to AI-augmented delivery. Sudeep, any view on this?
Well, this is definitely an interesting transaction, and this will give incremental, muscle power to Capgemini. WNS was a very well managed and run BPO outsourcing kind of an organization, having presence in multiple geographies across the world. Acquisition of WNS by Capgemini, I think should help Capgemini move into a different league altogether. Yes, absolutely, AI can play a huge role in changing the game for WNS and the entire BPO business.
All right. One stock I wanted to ask you a view on is Dixon Technologies. There is some buzz that, this one, in fact, there could be some more positive news flow that comes about. Sudeep, what's your view? At around that 13,500 normally sees a lot of buying, and then it bounces back quickly. I've seen this numerous times in the last 1 year. At around 15,500, best in the price or best to come?
Well, as things stand today, definitely it's a very full valuation. And unless there is a game-changing event happen, I don't see valuations moving up further from here on. But there are game-changing things being talked about. A major tie-up with a global major is being talked about. And if something like that does materialize, we can see new levels, new highs. But otherwise, I think it is richly valued.
Okay, all right, Jay, as well as Sudeep, thanks very much for taking the time out and speaking with us and giving us all of your views. Well, with that, it's time for a short break. We'll get you all of the top corporate voices along with key market events to watch out for on the other side. Stay tuned.
Welcome back to Markets Forward. Well, as promised, let's get straight to our corporate voices that we heard all through the day. Let's give you a gist of that. First up, Borosil Renewables. The company's German subsidiary has filed for bankruptcy. This comes due to a slump in demand for German solar panels as China has been dumping products at lower prices. The management of Borosil Renewables says that the German government will need time to restructure solar industry, adds that the interim administration will take over operations of the German arm. They also added that profits will improve by 27 crores per quarter due to this move.
Next up, Travel Food Services expects strong business momentum to continue going forward. In a conversation with CNBC-TV18, the firm says that it will continue to undertake efforts to improve margins. It adds that the SSLV launches will add about 1,000 crores to the top line.
Finally, DK Sunil, the CMD of HAL, expects to close the 2,000 crore rupee Dornier aircraft order this year. He also adds that it will take the firm 5 years to complete the Sukhoi 30 upgrade. That's not all. The firm expects revenue growth in excess of 8 to 10% going forward and will invest 7,000 crore rupees on R&D over the next 5 years. HAL has also said that it expects to significantly scale up its civil MRO vertical. As we go forward, we also had R.K. Singh, Defense Secretary, on the channel, during which he spoke about establishing an MRO for S-400s.
As of now, we are looking at establishing an MRO here in the first place, and thereafter we'll see. The numbers may not be sufficient to have a, co-development and co-production. It's very early to talk about that. Right now, I think there is a suggestion that we might go for some additional orders of the S-400. Out of the 5 batteries that we've already ordered, 2, as you know, are still to come. They'll come next year. And by the end of next year, all 5 will come. So yes, maybe there could be some additional orders that could be considered. But generally, in terms of production, normally you start with an MRO, and over time, depending on the volume, you could look at co-production. But it's probably a little early to be talking about that. So as far as we are concerned, yes, the nature of warfare changing the way it is. There is a large market for drones in the country, military drones. And I think industry recognizes that and is making investments. There are 1 or 2 promising companies with Indian designs as well. There are others, including some large industry conglomerates who've tied up with foreign vendors or OEMs with transfer of technology. So yes, from our side, the support will be there in the form of large orders, large RFPs or tenders that will be issued, and it will be under Indian, by Indian and IDDM categories, because the intent is to make it in India, but it could be at fully Indian design and manufactured. It could also be one where the technology is from outside, but the construction or the manufacturing takes place in India.
Okay, and that's the Defense Secretary. But before we wrap, we'll bring you some key events to watch out for. Gaurav is standing by with the key events for tomorrow. Gaurav.
Yes. Globally, when we talk about key events, first let's talk about US Treasury, because 3-year Treasury note auction will take place. Other than that, from the European region, Germany trade balances data will also be released, and that is something that we should watch out for. On the trade and tariff related data, we should watch out for US tariff, because as per Mr. Trump, US tariff letters deals will be delivered soon. At the same time, let's also not forget to watch out for India, because PM Narendra Modi will hold bilateral talks with President of Brazil. And lastly, let's also not forget that as per our exclusive sources, India and US is likely to take a final decision on a mini trade deal, and that is something that we should watch out for. On the stock specific, we should watch out for 5paisa, because company will come up with their Q1 results. On the other hand, let's also watch out for MCX, because company is going to announce and launch electricity derivative contracts. So definitely watching out on all these counters for a day tomorrow.
Okay, all right. Thanks a lot for that, Gaurav. But on that note, we'll have to wrap up on this edition of Markets Forward. You stay tuned. More news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. India and the US complete negotiations on a mini trade deal. A final decision is likely in the next 24 to 48 hours. President Trump promises tariff letters to nations starting today. White House delays the deadline for additional tariffs from the 9th of July to the 1st of August. President Trump threatens BRICS nations with an additional 10% tariff as leaders meet in Brazil. Also warns countries aligning with what he calls anti-American policies. BRICS issues a joint statement against trade restrictions without naming the US. Consolidation continues on Dalal Street. The Sensex and the Nifty end flat after a range-bound session. Mid-caps underperform. Days after the crackdown on Jane Street, market regulator SEBI is upgrading surveillance to curb manipulation in derivatives. As per the SEBI chief, Tuhin Kantapande, says there may not be many more such cases. Opposition leader Rahul Gandhi asked SEBI why it remained silent for so long. French IT services major Capgemini set to acquire India-based WNS for $3.3 billion as it aims to bolster its artificial intelligence offerings. The combined annual revenue of both companies is more than $23 billion. Defense expenditure as a share of GDP will rise from 1.9% to 2.5% in the next 5 years, says Defense Secretary R.K. Singh. A new contract to develop a medium combat aircraft will be awarded in 3 to 6 months. That's an exclusive. Prime Minister Modi cautions against weaponization of critical minerals at the BRICS summit. A veiled reference to China's curbs on rare earth exports, says critical resources must not be used solely for the interests of any one country. The Supreme Court agrees to hear a clutch of petitions opposing the Election Commission's voter roll verification in Bihar. Nearly 3 crore voters need to produce documents to establish the date and place of their birth. Association for Democratic Reforms claims lakhs of voters could be excluded. President Trump says Elon Musk has gone off the rails, calls him a train wreck. This after Musk's decision to start and bankroll a new political party as a third alternative in the US. Well, the top story this evening, the clock is ticking. A final decision on a mini trade deal between India and the US is likely in the next 24 to 48 hours. Sources say the government has refused to offer any further concessions on sensitive sectors like agriculture and dairy. But we also learned that India has put forward a fair proposal aimed at supporting labor-intensive industries. Now, the average tariff rate under the deal is likely to be around 10%. Meanwhile, the White House has delayed the imposition of the so-called reciprocal tariffs from the 9th of July to the 1st of August. But President Trump has promised to send tariff letters or deal letters to several nations starting today. So far, the US has only signed a trade agreement with the UK. It's also announced a deal with Vietnam. Now, President Trump has threatened the BRICS nations with an additional 10% tariff. Prime Minister Modi, by the way, is currently attending the BRICS summit in Brazil with leaders from Russia, China and South Africa, though President Putin and China's Xi Jinping are not at the summit. Trump said that any country aligning with what he called anti-American policies of the BRICS will face an additional 10% tariff rate. Take a look.
Sending letters out on Monday having to do with the trade deals. It could be 12, maybe 15. You know, Secretary of Commerce right here. And I guess, Howard, I would say it could be maybe as many as 15 or so. And they'll be going out on Monday, and some will go out on Tuesday and Wednesday, and and we've made deals also, so we're going to have a combination of letters, and some deals have been made.
But they go into effect on August 1st. The tariffs go into effect August 1st, but the president is setting the rates and the deals right now. Well, the president is right in the midst of discussing all sorts of deals with all sorts of countries, and the gentleman to my right is going to decide, and I'm going to be with him when he makes that decision.
Well, we are trying to create a trading environment and trading arrangements and agreements which will help two-way trade. Our handicrafts, our handlooms, our various agri-products from here will also get a market worldwide. So it's always a benefit on both sides that is being balanced in a free trade agreement. After all, there are lakhs of handloom and handicraft persons here also. So we will be balancing everybody's interests when we are looking at free trade agreement.
Well, that's the Commerce Minister Piyush Goyal. Parikshit Luthra now with us with more into what the India-US mini-trade deal could entail. Parikshit, the clock is ticking. 9:30 p.m. Indian Standard Time is when we're expecting those letters that President Trump has promised to start going out. And we don't know whether India is going to get a letter with tariffs or a trade deal. But the hope is that a trade deal will be inked. Negotiations are done for now. That's what your sources are telling you?
Well, our sources tell us that negotiations, of course, are over. There's nothing more to offer. We've drawn our red lines on agriculture. In fact, sources telling us this afternoon as well that agriculture and dairy are very contentious issues in the trade deal and trade talks with the United States and Donald Trump. Will it go through? Will Donald Trump accept India's proposal? That remains to be seen. Sources telling us that we've offered a very good win-win deal, a fair deal, which supports India's MSMEs, our labor-intensive sectors, such as textiles and footwear. This deal, if it goes through, will have certain quotas and certain tariffs, and labor-intensive sectors could be subject to quotas in the US as well and in the US markets. We have made it very clear that we cannot make compromise on our national interests in agriculture and dairy for the interests of our farmers, our religious sensitivities. It remains to be seen what Donald Trump will do now. On the Donald Trump threat for a 10% tariff, additional tariff on countries which are aligned to the anti-American policies of BRICS, sources say that if this happens, it will not be only for one country, it will be across the board for all countries affiliated with BRICS and BRICS partners. Also, they are linking this to the BRICS currency. And Indian government sources telling us that negotiations on the BRICS currency are at very early stages. Nothing is happening immediately. And even if Donald Trump were to impose tariffs, it would possibly happen after the 9th of July. So the next 24 hours are crucial for any deal to happen. The Indian government is saying that let's wait and see, fingers crossed. We've done our work and we've offered whatever we had to. No more room for negotiations. Let's see if both sides agree to the final deal.
Yes, we are waiting. And as I pointed out, perhaps 9:30 p.m. tonight is when we find out more from the US president. Now, India Inc. is hoping for a trade deal with the US, as we were just pointing out. The new president of industry body CII, Rajiv Mamani, says free trade deals cannot please every industry, but he's hoping for a deal with the US before the higher tariffs kick in. Take a look.
I think, FTAs are a negotiation. So I don't think every industry is going to be supremely happy about the FTAs. And in particular, I would say, and as far as EVs are concerned, I think the most important FTA, to be direct, is US. And I do hope that it gets signed on time, because if we talk to the members of CII, they don't want the 25% tariff to kick in on 8th of July or whenever.
Well, all about tariffs. Now, Prime Minister Modi attending the 17th BRICS Summit in Brazil, in Rio de Janeiro. This is US President Donald Trump has warned about a levy of 10% tariffs for countries that align themselves with what he calls anti-American policies of the BRICS. In a joint statement overnight, the BRICS bloc termed the rise of unilateral tariff and non-tariff measures as a serious concern. However, the group refrained from naming US President Donald Trump. Chinese President Xi Jinping and Russian President Vladimir Putin have not attended the two-day summit in person. Addressing the summit, Prime Minister Modi cautioned against the weaponization of critical minerals in a veiled reference to China amidst Beijing's curbs on rare earth exports. The Prime Minister said that critical resources must not be used solely for the interest of any one country. And on to the day's market action. The market's ending flat after a range-bound session, with the Nifty holding on to levels above 25,400. FMCG companies closing largely in the green, with 4 out of the 6 firms contributing to the Nifty today. So that's the Nifty absolutely flat. Nothing much to speak about for the Nifty Bank or the Sensex. It's the FMCG pack up by almost 1.5% today that was the star performer. Now, just days after the crackdown on Jane Street, market regulator SEBI is upgrading its surveillance to curb manipulation in the derivatives market. And that is the word in from the SEBI chief, Tuhin Kantapande, who was speaking at an event at the National Stock Exchange. Now, when asked specifically about Jane Street, the SEBI chief said, and I quote, "There may not be more such cases," end of quote. Take a look.
So can you confirm if
Anybody else will also be investigated about Hill Street on the allegation? Any other entities?
नहीं वो तो I've said yesterday also I've said that we are watching it is basically surveillance issue and obviously surveillance at both at the exchange level and SEBI level will continue and will also we will also upgrade those surveillance measures and I don't think there are very many other risks which you are posing.
Well, that's the SEBI chief. Meanwhile, the leader of the opposition in the Lok Sabha, Rahul Gandhi, has questioned SEBI over the jeans trade order. Citing his statement about retail investors losing money in the F&O market, Rahul Gandhi said, and I quote, I had clearly said in 2024 that the F&O market had become a game of big players and small investors are being continuously fleeced. Now, SEBI itself is admitting that Jane Street committed manipulation of thousands of crores. Why did SEBI remain silent for so long? At whose behest did the Modi government turn a blind eye? And how many big sharks are still shorting retail investors, end of quote. Now, day one of Travel Food Services IPO saw a 10% subscription as of 4 p.m. Retail investors' portion has been subscribed 13%, followed by qualified institutional buyer subscription, which is at 7%. The company's IPO is entirely an offer for sale of shares worth 2,000 crore rupees by the promoter. The company operates travel, quick service restaurants and lounge businesses across airports in India and Malaysia. Jio BlackRock Asset Management has raised nearly 18,000 crore rupees in its debut new fund offer. The three-day NFO included 3 open-ended debt schemes, liquid money market and overnight fund. The offering saw participation from over 90 institutional investors and 67,000 retail investors. With this, Jio BlackRock ranks amongst the top 15 AMCs in India by debt assets under management. So that's the latest on the NFO from Jio BlackRock. On to a CNBC-TV18 exclusive. Defence Secretary R.K. Singh has said that the defence expenditure as a share of GDP will rise from 1.9% to 2.5% in the next 5 years. Speaking to CNBC-TV18, Singh also said that a new contract to develop a medium combat aircraft will be awarded in the next 3 to 6 months. Take a look.
For the 5-year cycle of the 16th Finance Commission, we are going to be seeking additional allocation to the extent that our defense share in the GDP goes up from the current figure of about 1.9 to about 2.5. But that is sort of broader, longer term or rather medium term sort of request that we intend to make.
Indian military attaché in Indonesia had indicated we lost fighters in the conflict with Pakistan in the initial phase. The Indian military attaché in Indonesia went on to say that there was a decision not to strike Pakistan's air defenses, as this was not an operation against the Pak army but only against terrorists. Would you confirm that, and also how many fighters we may have lost in that exercise, because there have been inferences about Rafale fighters being lost?
Of course, I'm not going to talk about individual platforms, and you use Rafales in the plural. I can assure you that that's absolutely not correct. This business of counting our losses is an absurdity. I don't see the Pakistanis counting their losses and blasting it over the airwaves.
Well, that's Defence Secretary. In a bid to bolster its artificial intelligence offerings, French IT services major Capgemini will acquire India-based WNS for $3.3 billion. Rima is standing by with the details. Rima, big deal in the IT space. Take us to the contours and how this is likely to benefit Capgemini.
Thanks so much for that. This is indeed the big deal in the global BPO space, a segment which is getting rapidly disrupted on the back of AI. You spoke about the combined weight, the behemoth of Capgemini and WNS, but also this acquisition for Capgemini is going to be operating margin leverage. Let's just quickly break up the numbers. So WNS's revenues last year were about 1.2 billion euros. Capgemini was at 22.1 billion euros. So combined, we're looking at a company with a top line of 23.3 billion euros with operating margins of 13.6%. But this acquisition, as I said, will also boost Capgemini's EPS. So just immediately, EPS goes up by 4%. But when when you account for the revenue synergies and the cost synergies, then the EPS benefit will be to the tune of 7% by 2027. So the revenue synergies are estimated to be about 100 to 140 million pounds, while the cost synergies are anticipated to be about 50 to 70 million pounds. UBS had written a note in May, on the 2nd of May, this last month, because there was a lot of speculation about whether Capgemini will acquire WNS. And they're saying that while AI poses a structural headwind to much of the BPO landscape, WNS enjoys vertical process experience. If Capgemini manages to leverage its technology to drive automation, it could emerge as the successful provider in next-gen BPO. So basically, what WNS brings to the table is vertical depth across many key industries. They've got long-term contracts, recurring revenue growth. They've enjoyed about a 9% kind of a revenue growth over the last 3 fiscal years. So basically, it's a blend of WNS's domain-rich BPO capabilities with Capgemini's AI-led automation. And the question is, when you bring the two together, can this be a defining moment for Capgemini?
All right, Rima, many thanks for joining us. That's the latest Capgemini to buy WNS. Setback for Turkey-based Celebi Aviation. The Delhi High Court has dismissed the company's plea challenging the revocation of its security clearance. Remember, the Indian government had revoked the company's security clearance of handling ground and cargo operations after Operation Sindoor. We will head into a short break, but up next, the Supreme Court agrees to hear a clutch of petitions opposing the Election Commission's voter roll verification in Bihar. That and more when we return. You're watching Business 360. A quick check of some of the other headlines. Torrential rainfall has killed at least 78 people in Himachal Pradesh. The Met Department has forecast very heavy rains with thunderstorm and lightning across the state. The Chief Minister Sukhu said the state has incurred losses of up to 700 crore rupees. Rescue and relief operations are currently ongoing. Over 80 people, including 28 children, have died in flash floods in central Texas. Rescue operations are underway and dozens are still missing. Authorities indicate that the death toll is expected to rise. The unexpected flash floods were triggered by torrential rain along with the Guadalupe River, which rose 26 feet in just 45 minutes. President Trump has said he will probably visit the state on Friday. Israel has said that its army launched strikes on 3 ports and a power plant in Houthi-controlled areas of Yemen. The Israeli Air Force said the latest strikes on Yemen's ports were in response to the Houthi rebels' repeated attacks on Israel and its citizens. Israel's army has also intensified airstrikes across Gaza City, killing at least 14 people today alone. President Trump will host Israel's Prime Minister Netanyahu in Washington, D.C. The president has said the meeting will include talks on a permanent deal with Iran. This comes as Israel and Hamas resumed indirect talks on a ceasefire in Gaza after months of heavy Israeli military action. The Israel Prime Minister said that talks could help finalize a Gaza ceasefire and secure the release of hostages. Ukraine has withdrawn from the Ottawa Convention banning anti-personnel mines, citing urgent military needs amidst grinding war with Russia. Kyiv made the move as it struggles to secure U.S. military aid and frontline troops. Ukrainian commanders and analysts say the mines could help slow Russian advances, especially as Moscow reportedly uses them extensively. Russia is not a party to the treaty and denies deploying such weapons. President Trump has said that Elon Musk has gone off the rails. This after the tech billionaire said that he will start and bankroll a new political party. In a post on Truth Social, the U.S. leader also called the Tesla chief a train wreck for suggesting that a third alternative political party in the U.S. is possible.
US President Donald Trump had a biting response Sunday to billionaire Elon Musk's move to start a new US political party.
I think it's ridiculous to start a third party. We have a tremendous success with the Republican Party. The Democrats have lost their way, but it's always been a two-party system. So he can have fun with it, but I think it's ridiculous.
It's the latest in the widening rift between the world's most powerful man and its richest that began last month, when Musk started attacking the item at the top of Trump's legislative agenda, a sweeping tax cut and spending bill. That bill was signed into law on Independence Day.
Take over, Elon, just take over.
Musk spent millions of dollars underwriting Trump's 2024 re-election effort and had spearheaded the downsizing agency Doge, but stepped back in May. Around that time, he said Trump's bill would bankrupt the country and called it a disgusting abomination. Critics say the bill will significantly add to the U.S. debt load and damage the U.S. economy. As their feud escalated, the president threatened to pull billions of dollars that Tesla and SpaceX receive in government contracts and subsidies. There were signs in mid-June Musk was trying to repair his relationship with Trump. Musk posted on X that he had gone too far. But last week, Musk began criticizing Trump's bill again and vowed that in next year's midterms, he would unseat lawmakers who supported it. Then on Saturday, he said he would establish the America Party. A day later, Trump posted that he was saddened to watch Musk go completely off the rails and be a train wreck the past 5 weeks. Meanwhile, investment firm Azoria Partners said on Saturday it will postpone the listing of Tesla ETF, which was set to launch this week. It raised concerns Musk creating a political party posed a conflict with his full-time responsibilities as Tesla CEO. Azoria CEO James Fishback also reiterated his own support for Trump on social media and encouraged the Tesla board to meet immediately to ask Elon to, quote, clarify his political ambitions.
Well, the United Arab Emirates has introduced a nomination-based golden visa for Indian citizens, offering lifetime residency for a one-time fee of approximately 23 lakh rupees. Earlier, pathways required a minimum investment of 5 crore rupees in real estate or a business commitment. Shivani standing by with more. Shivani, now a golden visa for the UAE for all of 23 lakhs?
Well, yes, the UAE has rolled out the refreshed golden visa scheme for Indians, slashing costs and widening eligibility in a move that builds on the India-UAE Comprehensive Economic Partnership Agreement, or the CEPA. Now, signed in 2022, CEPA aims to deepen trade, investment and mobility between the two countries. And this latest golden visa reform is a big step in that direction. Indians can now apply for lifetime UAE residency by paying a one-time fee of 1 lakh dirhams, roughly around 23.3 lakh Indian rupees, without needing to buy any property or start a business, which were mandatory under the earlier route. This is a major shift from the existing criteria that demanded around 2 million dirhams, which is around 4.6 crore plus, in property or business investments to qualify for the golden visa. This time, the visa has been opened up beyond high net worth investors and individuals, now available to professionals like teachers, nurses, scientists, digital creators, e-sport players as well too, rather than just HNIs and business owners. Applications can be filed directly from India through designated centers or online portals, and candidates will be assessed on professional credentials, clean background and potential contribution to the UAE's economy and culture. Now, experts believe that over 5,000 Indians are expected to apply in just the first 3 months, which is the pilot phase, with more than 4 million Indians already living in UAE. This opens new pathways for tax-free income, business opportunities and full family sponsorship as well, including children, parents and domestic staff. Back to you.
Shivani, many thanks. The Election Commission's electoral roll revision drive in Bihar ahead of state polls has triggered a controversy. RJD MP Manoj Jha, TMC MP Mahua Moitra and NGOs have moved the Supreme Court against this, alleging that it may disenfranchise close to 3 crore voters. The court has agreed to hear the matter on Thursday. Ashmit joins us now with more. Ashmit, please allege that this special intensive revision by the Election Commission in Bihar is impractical and unreasonable. What is the basis of the plea that's been filed?
Well, the Supreme Court agreeing to hear a batch of applications filed by political parties like the RJD, the TMC, by NGOs like the Association for Democratic Reforms. The core concern that they've raised is the constitutionality of the special intensive revision order that has been passed by the Election Commission for verification of electoral rolls. Now, bear in mind, this SIR exercise has been done previously as well, now being announced. The concern that has been raised is the intensive manner in which it is being done under very compressed timelines. The Bihar elections are not very far away. The petitioner's estimates is due to be held in November of 2025, later this year. And therefore, this window makes it very, very likely that there are lakhs and crores of people who are likely to be disenfranchised and their right to vote is likely to be taken away. The figure that this petition puts forth is that as many as 3 crore workers who are working out of the state of Bihar could possibly get affected due to this SIR order. Now, under this SIR order, there is a requirement for people to go to the booth level officer and then subsequently establish their citizenship by proving their date and place of birth, and not only themselves but also their parents. Now, this is something which is argued to be arbitrary, to be unconstitutional, to be violative of multiple rights. The petition essentially argues is that this will unduly affect, disproportionately affect the marginalized and the poor community, that there are lakhs and crores that could get affected. In fact, just this morning, we had senior advocates Kapil Sibal as well as Abhishek Manu Singhvi address these concerns before the Apex Court. The Supreme Court, for now, not passing any orders, not issuing notice, but nonetheless has agreed to hear this case. The Apex Court will take up this case on July 10th.
Ashmit, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue here on CNBC-TV18. Stay tuned. We're back in a moment with more. Private final consumption breached the 60% mark in the last financial year, hitting the highest level in 2 decades. What does all of this mean if we strip down the jargon? Well, more than 60% of India's GDP share comes from domestic consumption. This is higher than many export-driven economies like China, Indonesia and Philippines. India's consumption story is often held up as a bulwark in a world riven by US President Trump's trade war and rising geopolitical uncertainty. But what's going on with India's consumption engine? Let's take a look at some data. Car and bike sales are soft, demand for steel and cement is slower than expected, and FMCG companies are struggling. Sample this, India's largest FMCG player, HUL, has seen its sales grow 6% in the last 5 years, but the stock is down 1% in the same period. Zero returns in a roaring bull market for India's top FMCG company is somewhat revealing. So what is plaguing consumption? Is the middle class getting priced out? Is the spike in household debt sparked by the pandemic taking its toll or continuing to take its toll? Is India's wealth and income inequality getting laid bare? This is the editor's playbook, where each week our team of editors will put the spotlight on the most compelling events across the world and try and decode what they could mean for India. I'm Shireen Bhan. Joining me in our studios, Nimesh Shah, Nigel D'Souza, Mangalam Malu, Surbhi Upadhyay and Sriram Iyer. Let's go to the FMCG man first. Mangalam, give us a lay of the land. As I said, we're dealing with this consumption conundrum. On one hand, the premiumization story seems to be evenly balanced, seems to be playing out well. On the other hand, the bottom of the pyramid continues to struggle. Now, pass through the latest set of data to tell us what we're talking about.
So a couple of things. Let's look at consumption in India, especially from the FMCG angle, like a tripod. A tripod which has 3 legs. On the one leg is the consumer themselves. On the second are all these FMCG companies. And on the third, you have the stock market, right? Let's talk about the consumption itself. The consumer, over the last few years, if you've seen the data, urban consumption has seen a big impact. Why is that? Because urban cost of living has increased by a lot, and that has been led by the increase in your power prices, increase in rent prices, and increase in housing prices for urban. In that, the incomes for urban consumers have not kept pace with the urban inflation that we've seen. On the rural side of things, the government SOPs have kept those consumption parameters pretty intact. So rural has been largely stable, but rural accounts for just about a third in terms of the value of consumption done in the country. In terms of volumes, it is 2/3. But where the real money comes from is urban. That has seen a bit of a consumer side problem. From a stock market point, over the last 5 years, HUL has given no returns. But the previous 3 or 4 years, HUL actually moved 4 times. And similar was the big run that we saw in all the consumption companies, because they came out standing tall amidst a time there was demonetization, there was the GST transition. So the organized players, all of them did well, and that was built into the prices. So some of the stock prices had run ahead of themselves. Those are the 2 legs. Now the third leg, the consumer companies itself. If you look at consumption over the last 2 years or so, the kind of disruption that we've seen across the board has been unprecedented. Why do I say that? Because consumption at the end of it all is a function of 4 things: price, place, product, and promotion. On the price side, the kind of raw material inflation, deflation cycles that we've seen, which is so compressed, that has caused a major disruption. On the place side, now what did HUL or Britannia or Nestle have earlier? The ability to place products in 9 million stores in the country. That ability, which was a strong fortress, was suddenly taken out by the pandemic-related, proliferation of quick commerce and e-commerce. So suddenly, you reaching 9 million stores in the country wasn't your strength. Your strength was the product, which allowed all the companies which did not have distribution to work on the product. That brings you to the third P, which is the product, where a lot of these, D2C players had better propositions, they had better, products which they had to only sell, make a few calls to the guys at modern trade centers, and they were suddenly all over the country. And that finally brings us to the 4th P, which is the traditional players were looking at promotion from a television standpoint. Whereas alternatively, all these guys, went to influencers, went via the web route, used better bang for their buck, and created brands in consumers' minds. So product, price, place, promotion, all of them got disrupted at a time when consumers were shortchanged because they didn't have enough money, and the stock prices were at a record high.
Net, before we get to the stock prices, Mangalam, the point that you're trying to make, and I think this is something that many people have alluded to, when you ask the question, does India really have a consumption problem? The answer may not be yes, simplistically, because the answer, as you're pointing out, is somewhere in the middle, that we are seeing this move away from incumbents or a shift away from incumbents to the D2C players. We're also seeing these distribution modes being disrupted with e-commerce, quick commerce, and so on and so forth. And perhaps we're not looking at the data that, that is coming in from these streams, which could perhaps give us a more holistic picture of the kind of shifts that we are seeing. But, let's talk about that other leg of the tripod that you talked about. And let me get Nimesh to come in on that. We talked about HUL, Nimesh, but, is it a consumption problem or is it a valuation problem as far as the FMCG stocks are concerned?
Shireen, it's a valuation problem, but more so it's a growth problem. Most of the companies have not reported the growth that they used to report earlier. Mangalam spoke about HUL in the previous, 4-5 years before this lull, had a very strong growth to report. That was missing in the last 5 years, and hence, so market is supreme, Shireen. Ultimately, they only go by the numbers and the earnings, and that's not been coming through. So let me talk about. So what I've done is I've classified the entire FMCG basket into 3 buckets. One, for the first bucket is where it's an absolutely zero or negative returns. From a stock price point of view, and I'll talk about the numbers as well. Lever stands out, absolutely zero return, as you also highlighted, in the last 5 years. But if you look at Lever's last 5 years CAGR across revenue, EBITDA, PAT, it's been mid-single digits. So 4, 5, 6% is what they've reported. Similar like a Dabur, negative return in terms of stock price in the last 5 years. If you look at the revenue growth or the profit growth, it's been absolutely flat. In fact, they've reported virtually zero profit growth in the last 5 years, and that's why that explains the move in stocks like Dabur. So that's the first bucket where they've negative to very flat returns. Then there is a pocket of FMCG companies where it's been average 10 to 15% kind of returns, which again is not great because the market itself has doubled in the last 5 years. So in that raging bull market, the stocks have not done well. But still, in that bucket of 10 to 15% growth in terms of stock price, there has been few instances which stood out. Like United Breweries had a very strong top line growth, bottom line growth, as well as EBITDA growth. But others have struggled in that bucket. Imami, or you call it Britannia, for that matter, Godrej Consumers, they all have struggled in terms of profit growth in the last 5 years or 6 years. Marico, for instance, a revenue growth of just 3.5% in last 5 years. So, that again explains that there has been a growth problem for these companies. The only bucket in that FMCG basket which has done well is what we call in the stock market the sin stocks, the cigarettes and the alcohol companies. So we have some, few of us contributing to that. But so ITC has done well in terms of stock price. United Spirits has done well in terms of stock price. Nigel will be very happy. Global Spirits has done well. So has Godfrey Phillip and something like a Cupid, which has been an outlier in terms of stock price returns. But again, for some of those companies which have done well, it's backed by earnings as well. There has been an earnings growth, profit growth, as well as operating leverage, which is played out. So clearly, market has identified where there has been growth and only rewarded those companies in the last 5 years.
Contributing to the sin goods, GDP, are they eligible for input credit?
No.
ITC stands for input tax credit, not the ITC that we're talking about here.
So as I said, Shirin, that this explains the whole FMCG basket. If you've done well in terms of growth, market is rewarded. Otherwise, something like a lever has been completely flat.
That's the important point that you make, that the markets are actually betting on growth. And where they're not seeing growth, you're actually seeing that being reflected as far as the stock prices are concerned. So what is the diagnosis of the growth problem? And let me bring Nigel into the conversation as well to try and expand this beyond FMCG to see if we can string straws together to understand whether we have a consumption problem, a growth problem, and how the two converge. Nigel, let's talk about what's happening on the steel side, what's happening on the cement side, to give us an understanding of what we're talking about here.
Well, Shireen, if I look at the cement as well as the steel pack, actually the first quarter has been disappointing. I'm talking about the April to June quarter. But the best part is the market is a forward-looking animal. So they're looking ahead. If you look at the steel stocks as well, they're making fresh highs even in today's trading session, stocks like JSW Steel. Now, a few factors that are played out here. Last year was a bit of a softish year, but there's optimism that this year is going to be much better. both for steel as well as for cement. And the data, the number that we're working with is around 8 to 10% growth in terms of consumption. Though the first quarter, if I look at the evidence, actually it's only mid-single digits, which is a little bit disappointing. But there have been a few one-offs that have played out, and that's why the street is choosing to look ahead. Now, for steel in particular, it's around 5 to 6% approximately. For the year, we're factoring in close to around 8%. I'll give you a data point. In the last few years, China's steel consumption hasn't gone up, while India has moved from around that 120 million tons to around 150 million tons. That's the kind of growth we have seen. Yeah. So India clearly is standing out in terms of a growth engine on the steel part of business. Even per capita consumption here in India, it's closer to around 100, 120 kgs approximately. In China, it's 600 kgs. And in the world average is around 220 kgs. So that's why the market is willing to look ahead that the first quarter was impacted by what? The early onset of monsoon. You had a liquidity issue. There was liquidity that was crunched in a lot of channels, and that's why we didn't have a lot of steel and cement that was moving around. That problem is fixed, remember. Monsoon also will get past it. Yeah. So that's why the second half of the year should look much better. And also the cost of borrowing will go down, which could spur various industries. Yeah. And in turn, we'll see a lot of demand. One factor that's disappointed me, though, in the first quarter is that this growth of 5% in cement is coming on a base where there was no growth. Because quarter one, FY25, it was election year. So, you didn't have a lot of activity. So actually, this 5% growth is coming on absolutely zero growth, which is a bit of a worry. However, the contra-argument is now the cement companies are getting their act together because now they're focusing on profitability. After a while, we have seen that in South India, prices have moved up by 8 to 10% and they've sustained out there. In June, there's been a bit of a pullback. But South India's cement companies will deliver a very strong performance on a relative basis. Because of the price increase that's been there, there won't be a big volume uptake, but you have input costs that are flattish. So profitability will stand out for this cement basket, though volumes will be a little bit disappointing. And for steel, the market is choosing to move ahead because the state government infra push, the central government infra push will come about. And also we know that the safeguard duties, they have come into play. So you had a lot of consumption that took place in February as well as in March. That was where stocking was taking place, restocking, and now destocking took place. Yeah. So that's why, in fact, the numbers don't look so good. So markets choosing to look ahead. Quarter one was disappointing. The remainder of the year, there is optimism that it will look far better.
I think I want to
mathematically summarize that the GDP growth is a function of consumption, investment, capex, government spend, and exports, right? Consumption, Shireen started by saying that 60% of our GDP is consumption. If consumption is not happening and you still need your GDP to grow 7-8%, or as per what the government is expecting, then the heavy lifting has to be done by government spends, which we've seen
in the last few years.
Which we've seen. The second part is exports, so we've seen the export boost as well, and the third part has to be capex, which Nigel is being alluding to. So all of that, eventually consumption, we'll have to increase that as well.
Just on a nuance.
On that note, as Nigel was saying, look, we've seen the RBI deliver bazooka as far as both liquidity is concerned as well as interest rates. So you've got the RBI doing the heavy lifting on that front. The government, of course, has ramped up after that sort of lull that we saw because of the election. The infrastructure push, of course, continues to be in play. So I'm still trying, and of course the expectation is that the second half will be better. But on this whole, and of course, there are two ends of the spectrum as we continue to point. Maruti sounding downbeat, Mahindra saying, look, SUVs are selling, and that's the story that's playing out across different sectors. This premiumization trend is continuing to play out across different sectors.
I just wanted to make one point on that, Shireen, and I think Mangla made extremely valid and relevant points on what's happening to consumption. It's just gone through intense disruption at a time when purchasing power has been curtailed. But, everybody's been talking about how HUL is flat over the last 5 years. Does anybody want to take a guess on what, not Manglam cannot take a guess on this, what the Indian hotel stock has done in the last 5 years? Or for that matter, what DLF has done in the last 5 years? These stocks, DLF is up over 400%. Indian hotels is up over 800%.
Exactly.
Yeah, correct.
So consumption has moved to
that's the point I was making.
So,
As even Manglam pointed out, that there has been a change in the consumption pattern, and that's clearly visible, like in Indian hotels or for that matter in DLF. The entire premium segment has done well, even for that matter ethos. Yes. Stock price has been on a tear in the last
I suggest, the
years.
only way to look at consumption now, the question isn't that is consumption in India slowing down. The question perhaps is is FMCG sales still the best barometer for consumption?
Indian consumption.
That is not the case because, FMCG sales have been flat, But at the same time, you've seen sales of a lot of these growth companies, and it very recently happened where, on a higher floor of a five-star hotel, there was a CNBC-TV18 event which was going on. I was part of that. And on the lower floor, there was a consumer D2C event which was going on. So I was shuttling between both of them. When I went upstairs on the CNBC event, we had all these listed players. They were talking about, the tension was a lot in the room. The most optimistic of them was, saying that, okay, we'll grow 10% this quarter or 10% this year. You go lower, on that lower floor, the D2C place, everyone's talking about 50%, 60%. No one's talking less than 1x, 2x
they're on a small
growth.
base. I mean, to be
Even if
fair,
it's
Also very small base.
But you put
Also very small base. Also very small base.
Shireen, you put all of them together, that becomes incremental consumption, right? So 100 crore on 1,000 crore would be 10%. But
I appreciate the point that premium consumption is growing. People are going to Taj hotels and buying DLF properties and Audi cars or whatever. But because of that, we can't change the barometer. We can't say that FMCG is not a reflection, because for the number of people doing these things are a very small portion.
And more importantly, to supplement,
and I'm saying from a growth point of view, I'm not saying it's not
exactly.
true.
The barometer
Is it going to reflect?
Is it enough for the economy?
Correct.
Selling
It is not.
Audis or
Who is this growth? Essentially, the question is, we all ask GDP growth. Who is this growth for?
For what India is known for.
And to which I think Mangalam, you only pointed out, right? The earnings have not grown for people. And if you here I want to highlight some data which is there, which is in the last 3 years, sales growth consistently has been like 22, 27%, 23%, 6%, 8%, even at a slower rate. But the employee expense has not grown at like less than half the rate at each time, which is not, if my salaries are not growing, if my rural wages between September and November shrank minus like 0.8%, at a time when inflation was so sticky, we all know. So when my purchasing power so Shireen, to your point on the question of whether it is growth or whether it is consumption demand, I'm saying affordability is the missing piece of the puzzle.
Which is why
whether it is from soaps to real estate.
But that is why you're saying that big difference, right? In terms of consumption, your 100 crore flats are getting sold. Your lower end housing is not getting sold. Right? So
lower end, right now the problem is there is no middle class housing. 2 points I want to add to one what Nimesh said about, because of these tax cuts and 8th pay commission. I think these are all acknowledgement by the government, like you said, Shri.
There is slowdown.
It's an acknowledgement that we need to do, because for many years, for a decade, they focused on the supply side. They said, let's build infrastructure, let's create, reduce the low cost of capital. It will eventually trickle down to, lower down the pyramid, but it hasn't. And the government is now acknowledged it and it's taking those efforts. Now the point is that, Nimesh, you said, right? I think the HSBC report estimates that number, consumption boom at $40 billion. Combining all of this, tax cuts, 8th pay commission, interest rate cuts, the combined impact on consumption, HSBC says, will be $40 billion. I don't think, I would like to call it a $40 billion balm, not a boon.
Got it.
Okay, it's like a balm on a very sore.
Let's ask Mangalam, because you're just making that point. He's been speaking to all these CEOs, and the ones that are saying, double-digit growth is coming back. What is the premise? Is it all rural because monsoons are better?
So again, it's the 4 Ps once again, right? We spoke about disruption across the 4 Ps. Now, because the last 2 years had so much disruption, all these companies have decided to, they've the one thing that all these companies do, they remodel themselves super fast. So they've now adjusted their production chains, etc., to be a lot more, nimble when it comes to inflation.
They're buying.
The prices have, gone up. You have all of them, even they're on quick commerce platforms, they're on e-commerce platforms.
I get that. I think the remodeling, as you point out, Mangalam, that's happening at the product end, at the portfolio end, at the pricing end, at the positioning end, that's one thing. But it comes back to Sriram's point on whether there is going to be more discretionary income for people to be able to use, especially at the bottom end of the pyramid. At the top end, it's been gangbusters across different segments, from bags to houses to luxury cars. I mean, everything's been flying.
I reckon, Shireen, you're best placed to answer that question, because you're the one who will be signing our checks by the end of every month.
I heard
you increase that.
I heard Shireen's taking.
I don't sign the checks.
I heard Shireen's taking a cue from Trump this time. It's going to be handwritten letters.
Handwritten letters to everyone. The onus is on all the employers.
I'll send the handwritten letter, but I don't sign the checks. I have no control. I have no control on
I have a suggestion to make. I have a suggestion to make, and this is not my suggestion. It's kind of based on multiple opinions like that of Nilkant Mishra, etc. And since he is playing a very important role in the government advocacy, and I've heard him say this in multiple, or at least hint at it at multiple platforms, where he's pushing the next push for growth, especially for more consumption in the middle class, has to come from housing. Especially middle class housing, because that is completely missing.
Maybe more so in Mumbai. I think
no, even Gurgaon, Delhi, Chennai,
NCR.
Bangalore, everywhere, because the margin is so much higher in building luxury housing.
So then my sectors are in focus.
Yes, exactly. Your sectors have to be in focus, and if anybody is listening to Nilkant.
And he has a logic to say this, because housing is the only space which has a huge trickle-down effect across many sectors and many companies. So
a huge multiplier.
That is why
a huge multiplier impact.
He's been saying that low-cost housing is something that
I think in most people in Bombay will save more if the rents go down than the income tax cut.
But also, this is the first time in the last many years that the government came out to acknowledge and offered a meaningful income tax cut.
Absolutely.
Otherwise, it was tinkering at the margin, getting people to move to the new regime. This is the first time there's a very meaningful sum available.
Which is why I'm saying, the second half could be
guys,
quite better
go back to the budget. Go back to the budget day. I mean, this was the headline, right? That the government has finally moved or shifted from the investment push to the consumption push, and that was exactly. But and I want to sort of go back to Nigel's point. I think I was talking to a CEO of a large conglomerate yesterday, and the feeling is that H2 is going to be better. On the back of all of the many reasons that we've pointed out. So that's the hope at this point in time. The question is, will we start to see growth being delivered? We will, of course, keep continuing to take stock of that. But let me end by asking each one of you. I know we've run out of time, but let me end by asking each one of you, what's the one thing that you're going to go out and buy to do your bit as far as consumption is concerned? Mangalam, we'll start with you.
I think I'll have to buy a pair of shoes. Unfortunately, none of those are in the listed space, but definitely a pair of shoes. Yeah, that's the one thing I'll buy.
100 pair of shoes, man. How much you going to...
Consumption, you have to increase consumption.
No, but
you do it the way you can.
I think we have to do a separate podcast on this because on the shoes bit, because you said, right, people moving to D2C has disrupted, etc. Nike's story is exact opposite. We know they killed the brand by going to D2C. I think we'll have to do this separately on another day.
That's a separate.
Yeah, that's a separate topic. But I'm not revealing what I'm consuming. All I'll say
everybody
is...
knows.
It fell out of your pocket as well.
Showed it in the last 5 years. Don't worry.
The thing is that in that data that you showed, Nimesh, also has a great lesson for us, which is that we have a sin tax on all of those products, right? But they are still growing. And where the point is that, and this is the lesson, that the investment driver is not taxation, it is demand. If there is demand, no matter how high your capital gains tax, how high your investment tax, no, you don't need PLIs, etc. as long as there is demand.
I have only one pitch to all the corporates out there.
Guys, we are going to have to wind up. We're completely out of time. And of course, the one factor that we didn't talk about is the GST, because remember that rate rationalization, long awaited, much anticipated, that could perhaps also play out as far as
just one more point.
The government choosing to offer some relief. Yes.
Just one more point, Shireen. One more, headwind for my sector in the past quarter was the skirmish between India and Pakistan. So the entire western belt, there was a bit of a demand hit, particularly for cement as well as steel. So that will be an additional reason that things should improve. Just forgot that point. Just thought I'll put that.
And Shireen, please, we're putting out a plea here. Maybe corporates can take one headline from this discussion, that good increments are a part of nation building.
Yes,
so maybe
amazing.
In that spirit.
Pagar badao.
Completely agree with you. I'm in 100% agreement with you. I support you fully on that.
You have to agree and you have to demonstrate as well in our paychecks.
No, I don't have to demonstrate, boss. Mere haath mein nahi, well above my pay grade. Well above my pay grade. But we will leave it. We will leave it
on
there.
That note,
the consumption conundrum. On that note,
let's sign off. Yes.
Let's sign off. Mangalam, Nigel, Surbi, Sriram, and Nimesh. Many thanks for joining us on the Editor's Playbook. We'll see everybody again next week from all of us here. Goodbye. Thanks for watching. Visit us on CNBC-TV18 Access and CNBC-TV18 Prime.
Hello and welcome to this special broadcast on India's defence roadmap. The Ministry of Defence has cleared 10 capital acquisition proposals worth rupees 1 lakh crore. These will be carried out through indigenous sourcing from Indian companies. The Defence Ministry is set to procure armoured recovery vehicles, electronic warfare systems, surface-to-air missiles and a common inventory management system for the tri-services. The government is also looking at increasing the capability of the Indian Navy by acquiring moored mines, mine counter measure vessels and super rapid gun mounts. Post-Operation Sindoor, India is set to increase its focus on acquisition and domestic manufacturing of combat drones, UAVs, early warning systems and satellite systems. To get a sense of India's defence acquisition and manufacturing game plan is R.K. Singh, India's Defence Secretary. Mr. Singh, thank you very much for joining us on the program. Let me begin by asking you about the latest capital acquisition proposals which have been cleared worth 1 lakh crore. How do you expect the public sector units and the private sector to benefit from this?
This particular tranche of approvals, or accord of necessity as we call it, is, the unique thing about it is that all of these, 100% of these are meant to be in the category of what we call indigenous design, development and manufacturing, IDDM. All of these projects rely on domestic technology, domestic design, and therefore the entire IPR will remain with us. Many of these are with DRDO, based on DRDO technologies. Others are with different technology sources. So yeah, it's an important sort of reaffirmation of our belief in self-reliance. Increasingly, you will find that IDDM is where most of the procurement will come from. And more importantly, increasingly, you'll see that most of these DRDO technologies will be utilized by the private sector through its DCPP model. Many of these projects are also in those categories. And most of the projects, therefore, will be done by a combination of public sector and private sector industry partners, but using domestic technology, as I mentioned.
I would also like to get a sense from you on the AMCA program. An expression of interest has been issued. By when do you want to conclude the awarding of contract?
Well, you are correct. The RFI has been issued by ADA, our Aeronautical Development Agency, and I think they've had some preliminary rounds of discussions with prospective bidders. The timeline is a little difficult for me to say because, frankly, I have not checked with them. But I would imagine it will take something between 3 to 6 months to reach the contract award stage. Thereafter, the project itself of development and of an AMCA prototypes, actually taking to the skies, it should be about a 10-year program, I would imagine.
Right. As you speak about a 10-year program, sir, there is also an urgent need of the Indian Air Force to meet the gaps in our fleet. The reason why I'm asking you is because there have been a lot of reports about how Pakistani pilots have been training in China on 5th generation fighters for more than 6 months, and Pakistan may actually get 40 5th generation fighters by the end of this year from the Chinese government. How serious is this challenge according to you?
Well, first of all, I don't know about the facts of this, the matter that you mentioned about 40 5th generation factors, pilots being trained. There's a lot of internet chatter. I don't know how much of it is actually true. And because there have also been cases of denials by responsible people there about any such moves, or at least about the timelines that are being mentioned. So let's leave that aside for the time being. As far as our steps in this regard are concerned, we are talking to our partners on the 5th generation fighter aircraft program. As of now, those discussions have not reached a stage where we can start sharing this with the media. I don't think we can do a blow-by-blow sort of accounting of what we are doing when it comes to these things. These are sensitive negotiations. When it reaches some kind of a tangible stage, whether it is through an AON or through an RFP or ultimately through a contract, that is when the media will come to know.
Right. So if I'm right in understanding, sir, there is an AMCA program which will continue as it is. And in the meanwhile, India will speak to key allies and partners to see if there can be a solution found on getting fifth-generation fighters in a shorter period of time.
Yeah, you could say that without getting into too many specifics, because as I said, these things need to be done outside the media gaze.
Okay. There are proposals, sir. The US government has made proposals in the media for F-35s. Russia has made proposals in the media for Su-57 fifth-generation fighters for India with full technology transfer and manufacturing collaboration with HAL. How do you see, number one, Russia's proposal to transfer technology for fifth-generation fighters to India and build them in collaboration with HAL? We already have an existing Sukhoi line here in India.
Parichita, I've already made it clear that I'm not going to give you a running commentary on what we are doing on this. We will do it. You will come to know when we take decisions. While discussions are ongoing, there is not going to be any, a running commentary on what we are doing.
Any formal proposals from the US or Russian governments on offering fifth-generation fighters?
I don't know, frankly, because some of this would take place at the service level. But again, let's leave this topic. This is not something that is going to be discussed in public before we come to any decision.
Could you also list out the major investment opportunities for the private sector and the public sector right now in areas which are going to be a priority for the government and will remain a focus of government capex, according to you?
I think we've made it clear through our budget allocations that we are going to do 75% of our budgetary outlays are going to be spent within the country. And these will cover vast areas of our defense domain, including aerospace and aviation, naval shipbuilding, where out of 60 odd ships under construction, 59 are being built within the country. Land systems of various types where we have good capacity already. Missiles and munitions where a lot of the systems integration is done by the public sector, but there are a large number of private sector players who play a role as component manufacturers and vendors. Also in areas like electronics and communication systems, emerging technologies like artificial intelligence, robotics, and of course drones, where there is a significant allocation available for good Indian private sector companies and public sector companies for that matter.
Right. We've also been reading reports how government may go ahead and procure more airborne warning and control system aircrafts, mid-air refuelers. Could you give us a sense if there is a plan to do so? Is there a formal plan in place now, sir?
Yes, so for both for refuelers and for AWACS and early warning and control systems, we have ongoing procurement processes that are at different stages. Some are at the stage where AON has been accorded and RFP is being issued. There are others where AON has been, in fact, there are others where RFP has already been issued. So yes, these are well underway. There is one for the refuelers. Again, there's one where we have taken on a lease, whereas there's another larger order where the RFP has recently been issued. So yes, these are force multipliers, and we are actively in the midst of a procurement cycle for ensuring that these platforms are made available to the Air Force in the quantity that they need them.
Right. Could you give us any numbers?
I think I wouldn't be able to. We've leased one refueler already. I think the RFP has been issued for 6 refuelers, also for half a dozen AWACS. So yeah, those are all ongoing procurement, ongoing in the procurement cycle. Let's see where it goes. Hopefully these will succeed and we'll get good bids with good competition, and we'll be able to, ensure for sign-up contracts quickly during the course of this year.
Right. Now, speaking about the defense budget, considering our experiences from Operation Sindoor and how India will now focus a lot on cutting-edge technology in the defense sector. Are we expecting the Defense Ministry to make a recommendation for a significant increase in the defense budget, in the next union budget?
I think the short answer to this is that on the capex side, there's never been a constraint. Actually, there has been a constraint in terms of our ability to actually fully utilize our budget. And we've done it last year, and we are well on the way this year of ensuring that our quarterly expenditure targets are met. So based on a faster pace of expenditure, we can ask for additional money during the revised estimate stage if it is felt that the requirements are more. So I would say that we are, it's likely that we might need additional allocations in the long run, but it really depends on absorptive capacity of the industry, of our own ability to spend money quickly, to sign contracts faster, to take procurement decisions faster. So that process now we've kind of improved significantly last year. I keep saying that we did 2 lakh crore of contract signings last year, which is the double of any previous year, and the highest previous year rather. And we intend to keep up that pace. And if we keep up that pace and we ensure that there are enough committed liabilities and ongoing purchases, then I'm sure we can persuade the finance department to give us additional capex. They've promised to do so always.
Right.
If you're asking as a longer term issue, as far as the Finance Commission is concerned, for the 5-year cycle of the 16th Finance Commission, we are going to be seeking additional allocation to the extent that our defense share in the GDP goes up from the current figure of about 1.9 to about 2.5. But that is sort of broader, longer term, or rather medium term sort of request that we intend to make.
Right. And in the revised estimates, are you going to seek additional allocation, keeping in mind the current procurement cycle?
I wouldn't be able to say right now, but since we've done some additional, some quick procurements in fast track under the emergency procurement, and there could be some other fast track procurements as well. So if our pace is such that we need additional allocation at the RE stage, we'll think about it. As of now, it's a little early to say.
Just to also ask you about joint production that we are looking at. Let me begin with Russia, sir. On the S-400 air defense system, are we going to be looking at manufacturing S-400 jointly with Russia?
No, as of now, we are looking at establishing an MRO here in the first place, and thereafter we'll see. The numbers may not be sufficient to have a, co-development and co-production. It's very early to talk about that. Right now, I think there is a suggestion that we might go for some additional orders of the S-400. Out of the 5 batteries that we've already ordered, 2, as you know, are still to come. They'll come next year. And by the end of next year, all 5 will come. So yes, maybe there could be some additional orders that could be considered. But generally, in terms of production, normally you start with an MRO, and over time, depending on the volume, you could look at co-production. But it's probably a little early to be talking about that.
About BrahMos, any plan to build advanced BrahMos missiles?
I don't have, frankly, an update on this, but I think there is a continuous upgradation program for the BrahMos in terms of making it lighter, more lethal, more suitable for the Tejas in the long run. So all those steps are ongoing, but I wouldn't be able to give you a kind of a, real-time update of what exactly is happening. But yes, these all of our missile programs do go through continuous upgradation, and I'm sure the BrahMos is doing so as well. And of course, I want to shout out to the scientists who designed it and developed it, and our Russian partners, because as you know, it performed really remarkably during Operation Sindhu.
All right, we're going to take a short break here on CNBC-TV18, but don't go anywhere. This conversation with the Union Defense Secretary continues on the other side. Welcome back. You're watching CNBC TV18 and we are in an exclusive conversation with R.K. Singh, India's Defence Secretary. Mr. Singh, let me also ask you about combat drones. Considering we don't have technology for combat drones in India right now, is there a plan to bring in a incentive scheme? Now, there have been reports that India may bring in a $234 million incentive scheme to support civil and military drone makers. Could you throw some light on this, sir?
I'm not sure. I mean, there used to be a PLI, a production-linked incentive scheme for drones, which I was aware of when I used to be secretary in DPIIT. I think that the first phase of that scheme is probably over, and if there's a second one on the anvil, I don't have an update on that. The Defense Department is not a developmental department. We don't do programs to support industry in that sense. Our support to industry is through orders. And the volume of orders is such that industry will not need any other support. So as far as we are concerned, yes, the nature of warfare changing the way it is. There is a large market for drones in the country, military drones. I think industry recognizes that and is making investments. There are one or two promising companies with Indian designs as well. There are others, including some large industry conglomerates who've tied up with foreign vendors or OEMs with transfer of technology. So yes, from our side, the support will be there in the form of large orders, large RFPs or tenders that will be issued, and it will be under Indian, by Indian and IDDM categories, because the intent is to make it in India, but it could be at fully Indian design and manufactured. It could also be one where the technology is from outside, but the construction or the manufacturing takes place in India. But yes, from our side, there will be the support with large orders, both under the emergency procurement process that we've initiated, as well as the long-term processes that we intend to do. In all of these, you'll see large tenders coming when it comes to drones of different types.
Rajnath Singh, the defense minister, concluded a very important visit to the US. He also had a conversation with Pete Hegseth, the US Secretary of Defense. Could you give us a sense of what was discussed in terms of delays in delivery of weapon systems from the United States?
Well, the Raksha Mantri took up all of those delays, including the engine delays, both of particularly of the 404, and also the fact that we need to finalize the 414 agreement, the technology transfer and the commercial agreement quickly. We also raised the issue of delays in the Apache deliveries, which now are on the anvil. We're expecting at least 3 this month. We've also discussed a little bit about the P8Is, where there is some discussion ongoing. There, the price negotiations are still ongoing, and depending on that, we'll see whether we proceed further on that. Honorable RM also mentioned to him about Operation Sindoor and our compulsions in taking effective action against cross-border terrorism. And finally, he expressed the sort of willingness from our side, which is also affirmed from the American side, that the 10-year defense partnership agreement will be finalized soon, and hopefully it will be signed during the next physical visit that our defense minister has with the defense secretary of the US.
Right. What I would also like to ask you, sir, especially on the 414 technology transfer and commercial pricing agreements, after this conversation between the defense ministers of both sides, are we expecting some conclusion on that, some movement on the manufacturing of 414 engines in India?
So the manufacturing will start after we complete the TOT and the commercial agreement that HAL is negotiating with GE. My understanding is that the technical part is completed, the commercial is ongoing. The last I heard, they expect to do it in the next 3 to 4 months. But this is really something for the HAL to speak to. I don't have the latest on this. If I had known, I would have asked the chairman HAL before talking about this. But my understanding is this, that the last I spoke to him, he was saying that the technical part is done and the commercials will take a few more months.
Right. When it comes to the delivery schedule of 404 engines, what is the timeline that we're now looking at? What is the assurance that we've got?
Assurance, I think, is that they will deliver one more engine after the one they delivered one in April, one more in July, and hereafter they'll be delivering 2 every month till March, which is why HAL chairman has promised that 12 Tejas aircraft, LCA aircraft, will be delivered by the end of this financial year. So we are hoping that this will stabilize the LCA production lines for by HAL. But let's see how it goes. As of now, this is the delivery schedule that has been committed to by GE.
Any discussion with the US on acquiring or manufacturing land combat systems or Stryker vehicles, at the same time Javelin missile systems?
I think we are intending to buy some Javelins straight away under the emergency procurement route. On longer term orders, I think negotiations of some kind are going on between the two sides, and we'll let you know when they come to a conclusion. On the Stryker, the initial field trial that they had done, they had fielded a category that was not a type, which was not a version which was not suitable for us. We asked for an amphibious version. I think they are fielding that in the next joint exercises that India and US do. Depending on the trial there, or our, after we see that for ourselves during that exercise, I think the Indian Army will be able to make a statement of case and thereafter move forward on that.
On Operation Sindoor, the Deputy Chief of Army Staff recently said that China was actively supporting Pakistan during Operation Sindoor. Would it be possible for you to confirm, sir, how China exactly supported Pakistan?
I wouldn't be able to say exactly what. I think there is an inference that some intelligence sharing, some satellite imagery sharing was going on, given some of the conversations that the DJMOs had with each other. So yes, it's more of an inference. There's no conclusive proof one way or the other. But yes, if our Deputy Chief has made such a statement, I would imagine it is based on, on some combination of intelligence and deduction from that intelligence. But it's not a secret, really. There is a collusive sort of, an element of collusivity is built into this relationship between our two adversaries. And we should be prepared for that and, take action accordingly.
Right. The CDS in the Shangri-La dialogue, sir, and the Indian military attaché in Indonesia had indicated we lost fighters in the conflict with Pakistan in the initial phase. The Indian military attaché in Indonesia went on to say that there was a decision not to strike Pakistan's air defenses, as this was not an operation against the Pak army, but only against terrorists. Would you confirm that, and also how many fighters we may have lost in that exercise, because there have been inferences about Rafale fighters being lost?
Of course, I'm not going to talk about individual platforms, and you use Rafales in the plural. I can assure you that that's absolutely not correct. This business of counting our losses is an absurdity. I don't see the Pakistanis counting their losses and blasting it over the airwaves. We are not here to talk about losses. We are here to talk about what happened in this conflict. And as I made it clear a few days back in another interview, what happened in this conflict was that they lost, both in human terms and in material terms, significantly, manifold more than us. They also lost 100+ terrorists who are also their assets. So I can only assure you, take it from me, that in terms of material losses, in terms of asset losses, and in terms of, including and in the terms of terrorists killed, they've lost many times more than what we have. But this trap of talking about our losses or talking about individual platforms, that's not something I'm going to fall into, and I think it is absurd to also link it with other things like political constraints. There are no political constraints when it comes to our services. They have full freedom to, in operational terms, when it comes to conflicts of any kind.
Right. My final question to you, sir, would be about the Rafale systems that we have. And You know, after Operation Sindoor, there have been some reports about some sort of review in the partnership. Is anything of that sort being undertaken?
Pure speculation and not worth responding to.
All right, Mr. Singh, thank you so much for joining us here on CNBC-TV18, giving us a complete overview and update on India's defense acquisition and manufacturing roadmap. That's all we had time for here on CNBC-TV18. Goodbye and thanks for watching.
HSBC presents CNBC-TV18 Future Female Forward, the Women's Collective, co-presented by Cognizant.
Inclusion isn't just an agenda, it is a mindset. It is about creating environments where leadership is nurtured, diverse journeys are supported, and every individual has the opportunity to thrive. This is a story of transformation that is driven by purpose and empowered by people. Welcome to HSBC Presents CNBC-TV18 Future Female Forward, the Women's Collective, co-presented by Cognizant Season 3, where we bring to you stories, voices and visions that are shaping inclusive workplaces. Now, in this special edition of the show, we shine a spotlight on HSBC India's journey and their commitment to building a future-ready, diverse and equitable workplace. And joining us today for this enlightening discussion are Amitabh Malhotra, the Vice Chairman, Investment Banking at HSBC India, Ajay Sharma, MD and Head of Banking at the bank, Anita Mishra, MD and Head of Markets and Securities Services, and Sandeep Batra, the MD and Head of International Wealth and Premier Banking at HSBC India. Anita, gentlemen, thank you so much for being with us here today. And Ajay, if I could start with you. It's been 3 years of partnership between HSBC and, at CNBC-TV18, the Future Female Forward Women's Collective. What does the platform really stand for you? What does it signify for you?
First of all, thank you for inviting us all here.
Our pleasure.
And this is really strategically important for the firm, making sure that we really work through the gender questions, the issues that we face and how do we really progress in a long-term, committed, strategic manner. For me and for the bank, I think, one, does our population reflect what the general population is out there? And it doesn't. And therefore, globally, the bank has taken a decision that we have to do more than what we've been doing so far. This is, I think we are probably year 5 or year 6 in the journey, even globally as a bank. And we have made great progress. For me, the strategic reason is that how do you drive change in the organization, and how do you drive change without diversity of thought, of gender, amongst other things. So this is really one of the critical reasons that the bank has embarked on this journey.
All right. Anita, to you personally, what does the platform mean? And to you, what is real diversity?
So yeah, I completely agree with Ajay. This platform has allowed us to find a conduit, through which what the journey that HSBC has done, in diversity and inclusion for the last 5-6 years, as Ajay pointed out, to form a conduit to, bring it out to a wider set of people, set a lot of dialogues, around this issue. And I think if you look at it, the BFSI space is absolutely the right space to have these conversations. If we can make a change here, this really means something in terms of a paradigm shift, and to me, diversity is really about all kinds of people, whether it's gender, whether it's age difference, and we see a lot of diversity, by the way, in terms of the younger generation joining banking today and having such different thought process and approach to, how we were 20 years ago. And I think that leads to better decision making. When you hear the voice of all, it's instead of just one type of navy blue suited investment bankers or rolled up sleeve traders.
Yeah. Well, as Anita put it, Amitabh, I mean, especially in BFSI, which traditionally has been a very male-dominated segment of business. What has been the significance of a platform like this that we've built?
I mean, male-dominated kind of workforce was something of a past now, and I would say that has changed fast and changed in a very strong footing kind of approach where you have representation from people from all walks of life. So it's not just about gender or thought, even in terms of background. There was a time when it was felt that banking, especially investment banking, was reserved for only people of certain texture and background in terms of family affluency, and that is no longer the case, whether it's talking about tier 1 city, tier 2, 3 city. You have representation in banking from all kind of sections of society, and to kind of embrace that and to adopt that and make sure that your policies, your decision making, your benefits, it accrues to all kind of folks, all kind of employee workforce.
Well, Sandeep, you think HSBC is walking the talk?
Clearly it is, but we've been around 170 years in India. And just imagine the amount of change the country has been through those 170 years, how much we would have changed with that change to be here with the country and working with the country. I think this clearly is an investment working with you, working with clients, working with communities, which actually prepares us for the future. So clearly the firm is walking the talk, but also getting ready. This is the start of what I would believe the next 170 years for the bank, and which means that this is a strategic change, getting the right number of people in and resembling how the communities look and feel like.
All right. Well, Ajay, let's get into some of the specific programs that you have at HSBC when you talk about diversity. I mean, there's talent pool, there's short-term assignments, and high visibility leadership really, to make a real difference. Tell us about these specific programs and the kind of work that you've done at the bank here.
So the programs are at all levels, right? So there's a talent pool for some of our senior folks.
Yeah.
And it goes a certain level. Then at even more junior levels, I sponsor a program called YouGrow, where again we give very specialized training for people who are probably becoming managers for the first time, for example. And then as we develop leadership plans for our lots of people that we have, we work through saying, okay, here are areas that you need to get better at. And it could be, how do you embrace data? Right? Because that's the new fuel in the way the banking works. What is it that you want to learn about AI? And then we send people overseas for short-term assignments. So we've had really great success as a bank in certain areas like startups and financing programs. So we've sent our people, one, to learn, to Singapore, to Paris, to learn what is it that they're doing there, but also to teach. And then finally, I think, as an international bank, we pride ourselves on providing mobility to people. So, I mean, we just had our head of trade move to Singapore, and she's going to run a regional role out there. So we're very proud of our best talent, who we have nurtured and grown to the next level, moving internationally.
Well, that is one thing to talk about. But, you know, in banking, interpersonal relationships are very, very important. Give us a sense of the kind of role that having diversity, you know, in your own organization plays when it comes to strengthening your relationships with your clients.
What diversity does for a bank like us is it brings different ideas to the fore. So I have this small team, and they're focused on data. And I really think the asset that they have created creates a competitive advantage for us. And it helps me serve our customers better because we exactly know what they need. So we walk into clients, we know the products that they require, so we're not generally randomly talking to them about things that they don't need. What facilities they require, what do they look like from a credit perspective. And this was really possible because we had a bunch of people who just thought differently from most of us. And these are the younger lot who are so data literate. It's amazing to work with them, right? Because they generally walk into your room with bubbling with ideas, and you know what we help is then help them shape and define what will make the most impact. But it's amazing to work with people who think so differently from me and everybody else.
Amitabh, let me ask you, there are more programs. He's spoken about You Grow and some of the mentorship programs, but you're specifically looking at something called Launchpad. At HSBC, you're also looking at Mentorverse. Tell us a bit about these programs first.
Mentorverse, let me pick that first because I actually volunteered for that program myself, so I've been through it. So I'm a good case study if you want to refer to it. But basically, this is all about reverse mentoring. It is targeted towards senior leadership and EXCO members out here as well. And what it does, it pairs you, i.e. the senior leadership, with a younger employee in the firm. And basically, the purpose is to understand the generational difference between various age bracket, how to have open communication, what are the drivers, what does work mean to them in terms of value, because they all have purpose, they have goals from that. And that creates bridges and in communication and better understand your team members. But you talked about Launchpad. Now, this is the other way. This is the program that caters to campus hires. And this is to help them with their development, create a path of growth within the organization, pretty much caters to second or third year of their stay. And what it does, it creates various platforms, opportunities, like there is a boot camp organized which gives them executive presence. If you were to kind of, look at some of the other mentorship is certainly a program that they embrace and they enjoy. And a whole lot of such opportunities where they feel a sense of belonging and they don't get lost in an organization.
What we hear often from many organizations at HSBC as well, carer leave. Allowance for childcare, you're talking about flexible working hours and so on and so forth. Are these just good to have, or have they ensured that there's a real, shift when it comes to retention, when it comes to efficiency of the workforce?
No, this just makes good business sense as well. It's the right thing to do for the people who work for you, work for the organization. It enables to build a certain kind of culture that is conducive for creating future leadership. Retention is certainly one of the benefit that comes out there. There is a loyalty aspect to it as well. And a bunch of programs that you mentioned out there. So whether these are allowances that have been created for a returning mother, and you do imagine that a new mother who's just got an infant at home is torn between career and personal life.
Yeah.
And things that we have done out there, and not just right now, I think 2019 we started this program whereby we created monthly allowance for young mothers who have children to the age of 2. And then we kept improvising on this. The next year, we expanded it to all primary caregivers, which could include single male parent. And whether it's for child, whether it's for older parents, we've got various benefits that address even to a pet if you need to look after.
That's lovely to hear.
Oh, we are very inclusive in our approach and open-minded, and that's really the purpose out here.
Well, hold that thought. We have a lot more to talk about, but I have to take a short break on that note. That's it for this segment, but do stay on with us because we're going to dive deeper into HSBC India's inclusive strategies right after this very short break.
HSBC presents CNBC-TV18 Future Female Forward, the Women's Collective, co-presented by Cognizant. HSBC presents CNBC-TV18 Future Female Forward, the Women's Collective, co-presented by Cognizant.
Welcome back to HSBC Presents CNBC-TV18 Future Female Forward, the Women's Collective, co-presented by Cognizant Season 3. Well, let's continue our conversation on building a future-ready and diverse workplace with our distinguished panel. Gentlemen, Anita, thanks very much for staying on. You know, just before the break, we were talking about the carer leave. You were talking about leave not just for taking care of children, even for pets. So that's a pretty inclusive workspace that I'm hearing about. And Ajay, the role managers would play in something like this.
Yes, I mean, our role and all the managers' roles are super important. So I had this gentleman walk in, very happy with sweets. And I said, what's up? And, oh, baby boy. And so I said, what are you doing in office? Don't you have paternity leave? And we shooed him out of the office very quickly. So I'm very proud to say that as managers, we want this embedded. And I think maternity leave is easy. The paternity leave aspect is something that we have to reinforce.
Anita, let me talk about the space that you're in, and that is, market securities. You spoke about these blue-suited men earlier. Traditionally, again, something that you'd associate with, a male gender, the kind of roles that would create. But what are you at HSBC doing to encourage more women to come up in the field?
First of all, the environment itself, I would say, has become a lot better. The second thing we really do is we try to demystify. We try to demystify the trading floor, right? And I go to campuses, we do a lot of hiring from campuses. So for me, that is an annual feeder thing. So we go there, we try to, demystify, what we do and how it's actually a very collaborative environment. How, the different roles of trading, sales, research, how it all comes together, We try to always scout for talent, both internally as well as externally, We also do a lot of financial literacy. So I think it's important to do indirect marketing as well. As women get more comfortable with stocks, mutual funds, interest rates, etc., they'll realize, the trading floor is no real different from any other place in the BFSI.
But, tell us about the kind of work you're doing at HSBC. You have a program that is called Power to Her. Has that really helped retain women, help them stay in the workforce for longer periods of time than you would have without something like it?
Absolutely. I think Power to Her is absolutely, for me personally, the most flagship program we have out there in terms of telling women who've taken a very long break. So it's not just women, who've gone on a maternity break that's turned into 2 years. It's women who've gone into a break of 5 years, 10 years.
For any sort of reason.
For any sort of reasons, right? Singh, we get them. And initially when we started this program, it was a 12-week thing. But the demand for it was so good because the quality of women we got was so good that we extended it to become a 6-month program.
Sandeep, let's also talk about other kinds of diversity. Let's talk about disability diversity at HSBC and the work you're doing there.
Sure. I think one, becoming disability friendly is not just for the workplace, it's also for our clients. So we're doing work for our colleagues where we've done extensive work, whether it's a workplace adjustment, just making sure our physical form factor is ready for people with different levels of disability. We've had wonderful examples of staff come in. I have a colleague in the overseas international business who came in as an analyst and just became a new manager, but has been leading. She traveled with us in the most recent award ceremony. It was an international trip. We wanted to make sure that it was possible for her to be able to join her, but she rocked that, and in her new role, she's doing very well as well. So making the physical premises is one thing, but our ERGs, our employee resource groups, our ability ERG is making sure that the mindset is also changing.
These policies you've put in place, whether that is for differently abled people, whether that is for gender diversity, give us metrics if you have any as to how it has helped retain, your workforce for longer, what kind of efficiencies this has brought in.
I think this is good business. I think any data, whether you see consultants talk about it, whether it's our own P&L, diverse workplaces create a lot more innovation.
And they make economic sense?
They definitely make economic sense. And when you see attrition levels, see, people leave the firms when they are not seen, heard, or just the fact that this firm is making sure that you're making those changes and you're acknowledging all forms of diversity is definitely appreciated by the colleagues who have that disability, but much beyond that.
Anita, all said and done, while there are policies that at least aspire to bridge these kind of gaps, are there challenges that still exist you wish, organizations would do more to build?
No, of course, see, there are challenges. I mean, I think legacy is the biggest challenge. You're fighting against what's been considered social norms for, hundreds of years, and, saying like, I think the question's still rife, and it's not just the metros and tier 1, tier 2 cities. Should women work? Should women not work? Etc. kind of a thing. What kind of jobs should women do? Kind of a thing. There are still lots of unconscious biases. I think women generally feel more guilty. I feel that there is a lot of shift that needs to be done in making them belong in the place they are in, because very often a woman is in two places. She's at her work and at her home through that 24/7. So I think making that change and getting women to feel more confident about themselves is a big thing. The journey is far from over, but you got to start somewhere and you got to keep going. And I think that's what we are very good at doing.
Well, Ajay, of course, we know that leaders play a big role in bridging some of these gaps, but any 2 to 3 lessons you'd have for your peers who are watching this to keep in mind to ensure that the workplace that they're building is more equitable, more just?
So I think leaders need to be very flexible in the way they treat employees. And, especially many of our employees join us because many of the policies are very friendly. I think we have to be very flexible in accepting that people come to office to work. It doesn't have to be outside your office anymore. So flexible working, the policies exist. How do we get out of the mindset that I need to see you every day to make sure that you're working?
For some of the young, impressionable minds that are looking to join the workforce, would you have a few things to say?
Well, all I'll say to the younger folks is that embrace the environment, be the ambassador of change, provide enough time to yourself to go through this experience. Watching is one strong element of learning with all the kind of flexibility put out there in terms of working from home, working from office, time in terms of ability. The job itself tells you where you need to function in what format. The leader's job is to make sure that that is transmitted in a way that there is energy level that kicks in with the youth that is there as part of your workforce, because these are your future leaders. Simultaneously, the youth in the workforce can do a lot bit on their side. So it's a partnership and collaboration.
Well, you know, we've heard plenty from all of you folks about the work you're doing to ensure that this is a more equitable workforce. But one final thought from everyone, starting with you, Amitabh, about the next big thing you think HSBC would be focusing on to ensure that this is a reality?
The next big thing, I think I'll just put it this way, that while our business is growing on a tremendous pace, and Sandeep particularly is going to be opening a lot of branches in the near future, our policies, our plans, our philosophy about equity should just trickle down into the lowest common denominator. And I'm talking about not just a Mumbai or a Chennai branch or a Bangalore branch, but it kind of spread out across the organization and is embraced by everyone. Success comes together.
All right. Ajay?
So I think the country is going through tremendous change, and we therefore need to also embrace change, right? So leadership and managing change are going to be the two big defining principles for successful organizations.
All right. Anita, your two bits.
I think this is a firm that's going to come out very clear about what are the views, what does it want to do. It's not going to be a firm that's going to be impacted by too many external factors, etc. And we're seeing that clarity come through now, you know, very easily. And I think we will have our own identity in terms of what HSBC means for diversity and inclusion, and that identity is going to be known, and it's going to be a very strong identity of us. That's definitely my view.
Sandeep, you have the last word.
I think the 40,000 colleagues of HSBC India make HSBC India the place it is. So, but I think one of the things we did not speak about is artificial intelligence. So while that will power technology, while that will power productivity and innovation, I think it will also be an ally in diversity and inclusion. I think it will allow us to create the tools to be able to bridge some of the inabilities we deal with. So clearly excited. I think we have multiple pilots going on. So more to come.
On that note, Amitabh, Ajay, Anita, Sandeep, thank you so much for candidly sharing these thoughts, and we hope the audience has a lot to take away from everything that you've shared with us. Thanks so much.
Thank you.
Thank you.
Well, these stories aren't just inspiring, they are transformational, and they are proof that when inclusion is intentional, everyone rises. From restarting careers to building them from the ground up, HSBC India's inclusive ecosystem is paving the way for real sustained change where policies meet empathy and ambition meets action. As businesses evolve, so must the workplace, and HSBC India is not just keeping up, it is leading that change. With inclusive leadership, bold programs and a culture of care, the future is not just female, it is forward. On that note, it's goodbye and thanks so much for watching.
HSBC presents CNBC-TV18 Future Female Forward, the Women's Collective, co-presented by Cognizant.
Hello and welcome to On the Report with me, Shireen Bhan. We've got a new change at the Confederation of Indian Industry. Rajiv Mamani takes over as the president. Joining us now to talk about what he has lined up in terms of his agenda for his presidency is the man himself, Mr. Mamani. Many thanks for joining us here on CNBC-TV18. Congratulations and appreciate your time today. Let's start by talking about what you have lined up for the year ahead. What would you like to prioritize, given the many opportunities, but equally the challenges that we see?
Yeah. So, Shireen, if you look at what's happening globally, if you start from there, we have a complete change in the world economic order, trade order. Also, geopolitics is also going through a lot of churn. And as a result of that, a lot of countries now are focusing. There's a flurry of FTAs. They want to work with countries that they can trust. We are seeing a lot of them focusing on reforms and trying to see how they become more competitive, looking at manufacturing and supply chain in particular, and how they manage that piece. So I think that's what we are seeing globally. And if you come down to India, I would say the Indian economy is growing well. I don't think it's right now, given the global headwinds, it's growing at its full potential. But it's relative to what's happening in the world, I think it's still going very well. But more importantly, it is demonstrating a very resilient picture.
Yeah.
It is in this world of almost chaos. I think it's the stable hand that you can see in India. So, if you look at this and if you look at what CII's theme has been, I think if India has to go to the next level of growth, I think the most important things are we need to have more significant reforms. And these reforms are not necessarily big reforms. These are much smaller reforms, nitty-gritties, both vertical and horizontal. When I say a lot of that relating to particular industries, number of approvals that are required, and then a lot of around, whether it's on environmental, whether it's NOCs, whether it's land.
So it's more compliance and
I won't say it's compliance.
Ease of doing business.
It's ease of doing business. There are some big reforms, but I think that probably is one. The second is India's manufacturing to GDP ratio has been stagnant.
Yeah.
India has to move to the next level of manufacturing and increase the manufacturing to GDP ratio. Even if you look at a gross value added, it's globally, it's 2.8, 2.9%. China is 28, 29%. We have to move that up.
So what's the problem there? Let me stop you there and address the issue of manufacturing, because, we've been talking about how this is going to be the breakout moment for Indian manufacturing for over a decade now. The government says that, look, we've done the heavy lifting, we've put in schemes, including the PLI schemes and so on and so forth. But why is it that the needle is not moving? What's the problem?
I think I won't say the needle is not moving. I think the needle is moving. I mean, in some sectors, we've had lots of success, like electronics. There is stuff happening in semiconductors, in drones, in other areas. So it is moving, but it's not moving at the pace at which everyone would want it to. And I don't think, there are lots of smaller little issues that need to be resolved. And I think the government setting up, for example, the Manufacturing Commission, the group at the, which the Nifty is driving, getting all the stakeholders of center, state, different ministries of center, all the state governments together to resolve issues. How in terms of factors of production, whether it's to do with land, whether it's to do with logistics, whether it's to do with energy, these costs have come down, but I think they need to come down faster. So I think it's the ease of doing business, it's the reforms, and it's how, the cost levels that we are looking at, and I can get into details if you want me to.
Yeah.
I think those things, we need to find a way that the government can reduce. The PLI schemes have been effective. I think if you look at the total amount of money allocated to PLI, it's about 3 lakh crores, 3,10,000 crores, obviously over a period of 5, 6 years, 7 years. But in the last 3-4 years, the total amount that dispersed is about 35,000 crores. So some PLI schemes have been very successful, like electronics. Semiconductor is a big one that started, is looking very good. Drones, as I said, is doing very well. We've had some success on the pharma side, but they're still where some of them have not taken off. And it looks like they're now taking off, whether it's on EV, whether it's on hydrogen, whether it's on textiles. I think we need to do. So as PLI is a great initiative, and I think the government has been very proactive there. But I think we need to ensure that we follow that momentum. And when we need to tweak so that the impact of that can be fully fully absorb it.
So of the 13 schemes that we already have in place, as you pointed out, a few have been successful, including the electronic scheme. Which are the ones that you believe require modification, that require changes at this point in time? And you talked about disbursals. You know, there is an allocated amount, but the disbursal is much smaller in comparison to that at 30,000 crore, as you pointed out. What's the issue there?
No, I think it's the way it is. It's linked to production. So I think it'll go over a period of time. But I think in some of the segments, the uptake has not been that high. Plus semiconductor, which is the largest, which I think is about 70,000 crores, has just started. And we have seen 4 big announcements happening there. So I think that'll pick up. I think the ones where we are looking at labor-intensive manufacturing, I think those are the PLIs that we really need to see that they get off the ground. Electronics is definitely one of them. But if we look at textiles, if we look at areas like shoe manufacturing, leather manufacturing, and also the entire renewable supply chain.
Right.
There's been some success on solar, but if we can look at other pieces as well, I think that will be very critical for success. And for manufacturing, to go back to your earlier question on manufacturing, how India links with the global supply chains is very, very important. And, you know, we have had a great success in electronics. I mean, Apple came in, all the state got very active, the center got very active, and you can see month after month.
There is an improvement.
There has been improvement, and if you talk to the companies who are doing the manufacturing, when the government wants to do something, they get it done.
Yeah.
And likewise, if you look at 4 or 5 products, if you look at shoes, if you look at textiles, if you look at aerospace and defense, if we can get the anchor large global manufacturers in, either directly or through joint ventures or through some other form, and get them, they will open up the entire ecosystem. And I think that's one area that we really, if we want to get manufacturing going, that's one area that we really need to focus on. And the other is, you know, this supply chain is becoming very, very important. And we've seen the rare earth crisis.
Yeah.
I think the government needs to identify some products and put the PLI schemes behind it, or find some ways of funding. So for example, if I look at compressors, India is going to be one of the largest manufacturers, consumers of air conditioners over a period of time. But we largely import the compressors. There are few manufacturers around the world. We should ensure that we are manufacturing those compressors in India, whether it's the global companies, whether it's joint ventures, whether it's Indian companies, whether it's technology transfers. But we need to ensure that things like those are manufactured in India.
If I can flip the question to you, that if this is such an opportunity, such a large opportunity that you speak of, why is the Indian private sector shy of it?
No, Indian private sector is not shy of it. I think the cost structures that we have in India relative to some other countries, and in particular 1 or 2 countries, doesn't make it viable to manufacture it in India unless you have specific PLI schemes. And the ecosystem, by the time the backward integration happens, the ecosystem develops, it takes time. Plus the technology is also restricted in many phases. So I think where the government has to really see is to identify the 1 or 2 players. See what's the what is the PLI scheme that's affected. Also, in some cases, they may require some duty cover for the next 2 to 3 years, 4 years, 5 years, or you do that through PLI. So before these things stabilizes, because once it stabilizes, the experience of most of the global players who have operated and manufactured in India, the experience of Indian companies who are facing the global market, once things settle down in India, India is becoming increasingly a more and more competitive place to manufacture. Our energy costs are coming down, our logistics costs are coming down. Once the labor is fully skilled, it's very competitive, very efficient. I mean, company after company that I've talked to, whether it's global companies or Indian companies, I think the setup is where the challenge is. Once the setup is done, I think once they are settled in, I think the opportunities really compound.
You were talking about the FTAs that India is inked. UK is done. EU is a work in progress. The US, anytime at least an interim deal, a mini deal is likely to be inked. So how is industry looking at it? Is there a feeling that there needs to be a harmonization of sorts across these various FTAs? Because I'll ask you this in the context of the EV manufacturing policy that the government has put out. Obviously, people are waiting to see what the FTAs will say before they actually go ahead with the EV manufacturing policy and apply it through that route. So what's the sense that you're getting from industry? Secondly, let's bring up the EU FTA, for instance. European companies are sitting on large unutilized capacity. Will they use that, or will they choose to manufacture in India?
Yeah. So, I mean, let me first just the overall FTA. I think we must compliment the government, whether it's the Ministry of Commerce or other wings of the government. I think they've spent a lot of time as compared to when the earlier FTAs were signed. They've spent a lot of time in engaging with each and every part of industry to understand what the issues are and where things stand. And I think that I would say their knowledge, the level of engagement that they have has been absolutely fantastic. Now, if you then take it to the second level to say whether industry by industry, how does it pan out? I think, FTAs are a negotiation. So I don't think every industry is going to be supremely happy about the FTAs. And in particular, I would say, and as far as EVs are concerned, I think the most important FTA I want to be direct is US. And I do hope that it gets signed on time, because if we talk to the members of CII, they don't want the 25% tariff to kick in on 8th of July or whenever.
It might even be August now. We don't know.
So we don't need.
Don't know.
So I think they're keen that and it's also about relative competitiveness.
Yeah.
So, Vietnam signs something, if someone else signs something. So a lot of this is also about relative competitiveness. It's not just country to country, but it's also in the global order. And it reflects, when you sign an FTA, it also reflects to the industry that there is a level of confidence between the two governments where you're working together to increase trade between the two countries. So I think that strategically is very, very important. On EU and commenting on specific industries, I think both the questions largely relate to one industry, which is EVs. I think the
auto in general.
Yeah. Auto in general, you're right. So there is surplus capacity in some parts of the world, and there is a worry that if the duty rates are reduced, whether rather than manufacturing in India, those surplus capacity will be utilized outside. I think the government is well aware of this. I think industry has done, again, a lot of engagement. I think they've provided a lot of details in what are the surplus capacities available, what has happened after FTAs and everything.
Has there been any forward movement on the issue of rare earth, for instance? I mean, China and Europe have now managed, US and Europe have managed to get supplies started from China as far as rare earth is concerned. Any forward movement on that? Have you heard from the government, or whether there are talks underway, likely to be?
We haven't heard from the government, but I think India, as you probably would have read, I think in Quads there's been discussions around it to say what is happening. Various other countries like Japan in particular and others are engaging with Indian industry to try and see what can be done to supplement it. But it's a serious issue, especially for the auto industry, the EV industry. I think it's a serious issue, and it is something that will have an impact in the next few months in production and everything else. That's what we gather from the members.
Absolutely. I mean, we've had several of them speak to us saying that production will come to a standstill, if this issue isn't sorted out in the near future. We will head into a break, but continue our conversation with the new president of the Confederation of Indian Industry, Rajiv Memani. Welcome back. You're watching On the Record with me, Shireen Bhan, and we're in conversation with the new president of the Confederation of Indian Industry, Rajiv Memani. But, you're going to now have to address two specific questions from the government. One, why is the private sector not investing as fast as the government expects the private sector to do so? And second, I think this is a concern that the government has put on the table, wage growth. And I think the chief economic advisor has been voicing this concern very publicly across different forums. On both those counts, what is the view now as far as industry goes?
So I would say, if I look at data and statistics over the last 3-4 years, private sector investment is happening. It may not be happening at the speed, as I said, but as relative to what we saw in 18, 19, 20, obviously COVID years, then the 22, 23, 24. I think 23, 24, 24, 25, private sector growth has been, investment growth has been very strong. The challenge that I would say in the last 4 to 5 months has been that when you have so much of uncertainty around in the world, whether it's, because of geopolitics, prices of crude or other critical raw materials fluctuating that much, whether it's around tariff, how do countries react to each other?
Yeah.
That people, my guess is some of the entrepreneurs would have said, let's wait for a few months. Let this thing settle down. And then let's try and see how do we do. But I would say the balance sheets are very strong.
Exactly.
The posture of entrepreneurs, all the members that I meet of CII is generally very forward-looking. A lot of them are looking at investing. Obviously, the risk-taking appetite from a debt standpoint has come down.
Yeah.
So they're leaning much and more towards equity, towards IPO, towards capital markets, to try and see how they can fund. And as I said, the balance sheets are very strong. Everyone is wanting to grow because the markets are rewarding growth.
Yeah.
So I think people, and the only way you can grow after a certain period of time manufacturing is when we put on more capacities. Some level of consolidation that had to happen has happened. Obviously, it will continue.
Yeah.
But there is clearly an intent. There are 2 or 3 things I would say which are a bit of a challenge in this, apart from what's happening globally. Second is that just the time frame that it takes to get approvals.
Right.
Just a time frame to get land allocated. Then after that, if you have to get environmental clearances, it takes another 12 months to get environmental clearances. Then, if I'm setting up, just a simple case, if I'm setting up a hospital with a diagnostic and pharmacy, I need 350 approvals for doing that.
350?
Yeah. I mean, I'm just giving you a number. It could be 325, 300, in that range. If I'm setting up a manufacturing company, which is in the metals and everything, it takes me 175 to 200 approvals. So, and the government is very conscious about it. I think we have set up a high-level committee. They're looking at each of these and then trying to see how we can reduce. Obviously, most of it is to do with states. It's not so much to do with center. Most of it is to do with states. And I think a lot of state government, those state governments which are proactive, which want to attract investments, are working on that. That's one. The second is availability of skilled manpower.
Yeah.
So I think that a lot of companies that we talk to, a lot of CI members, they want to grow, they want to expand, but the capex spend is getting slowed because the availability of skilled manpower, or just availability of manpower in some cases, is not there. And I think that's where the government and the private sector have to work to say, how do we accelerate the entire skilling process?
Income inequality and around every budget, and we're now getting closer to that process where the budget consultation will start. What should the government do? Can the government do anything beyond taxation? Should there be an inheritance tax? Should there be a wealth tax? These are things that we've discussed for several years. I know industry doesn't like any taxes, but do you believe that there is a feeling within government that this needs to be addressed? The question is, how do they intend to address?
See, I don't think these things in India's current situation are going to help. If anything, it will reduce the entrepreneurial energies to grow. So I know there are some pockets that talk about it, but my personal view is that, companies are in good shape. As I said, mindset is positive. People are looking at investing. I think at this stage in India to put this will be a big dampener, and I'm pretty certain that we will not be looking at that. And you're right that the government has done. I mean, even if you look at the last year, the budget on the direct tax side, I think they gave relief to middle class, middle income India, and hopefully that the consumption starts showing up in some time. And as I said, rationalizing the GST structures is important. But I think we have to create quality jobs. And manufacturing is definitely one area. Services has been a big anchor point for India, a big driver and everything. That in itself is going through some level of change with the AI case coming. And that's another big focus area for CII this year. And how India, becomes the global capital of the world. How do we ensure that we become more competitive as an economy using AI and leveraging AI. But definitely it will have an impact in some sectors on jobs, or the quality of jobs will change.
What is the ideal rate structure that CII is proposed?
So I would say that firstly, I must, 8 years of GST, we take it in our stride. But the government has really done an outstanding job of implementing it, the way they put technology in it, infuse technology in it, and the adoption, and the benefit that it has provided to the economy in the way of how formalization of economy has happened, apart from obviously the overall tax revenue collection. I think has been really excellent. What I would say on GST is that obviously GST requires both center and state to work together. I think the centers may be wanting to move faster on some of the things, but they need to ensure that the states also. One of the things we are doing in CII is also trying to engage a lot with states to try and see how do we look at rate rationalization. And so I would say there are 3-4 elements for GST 2.0, which are from a CII standpoint where we are talking to central government as well as state governments. One is obviously rate rationalization, which is one element. So try and see if we can have lesser number of rates, and especially at the lower income products that go into lower income. There the rates are in the 5-6% kind of ballpark. And the products which we define as sin products, like JE products and others, are 28%. And then have the rate sort of in between, where we can get a lot of products. And some products, like, for example, I don't want to name any product, but this comes up, says that use the products like cement and other
28.
28.
There's many.
Massive So I think those we just need to rationalize. So that's one. Obviously, in all of this, the government has to look at the revenue impact, how they land the whole thing. But I do think that the demand side gain, the manufacturing gain, will make up a lot of the revenue impact. Yes, there could be a time lag issue, but I think that gets made up. The second issue is, the income tax, the input tax credit that happens. I think there are lots of points of accumulation. Again, they are adding to the cost structure. They are not encouraging capital outflow. I think the government needs to look at it. They are very aware of what it is. I think, again, it's a balancing of, because GST was formed with the setup that there shouldn't be cascading tax. But how they manage the revenue neutral rate, and how they ensure that there's equity in the system, where companies that are doing a lot of capex or in certain sectors, they are not unnecessarily penalized. And in that you would also include that the sectors that were kept out, 3 of them earlier, I think if not all, some of them are brought in. And real estate will be an important one to bring in if you can, because especially on manufacturing and others, it has an impact. The third piece is the entire audit process. I mean, I'm operating in 8 states. I get 8 audits done. Then there are investigations. Orders are issued with impunity. I think that piece needs to be really strengthened. And CII's recommendation is, why can't you do the audit once? For larger companies, maybe you can do the audit once, and one state can be the lead state that does it. And then those are followed by all the states. And I think we've made, and there could be checks and balances to that. And likewise, if the quality, also to look at the quality of orders that are coming out to see, then different courts taking different positions. So at the National Appellate Tribunal, can that be set up quickly? So that's the third layer, which is really ease of doing business. And I think MSMEs are really getting impacted by that. And fourth is some level of procedural simplification, especially for the smaller companies. I think they are facing the burden of the level of compliance that is required by GST. Obviously, the government is trying to best to protect that all leakages are stopped. But I think what's the fine balance between stopping all the leakage
and easing
this thing? Yeah, you'll always have some violators of traffic, but you don't completely slow down the traffic for that. So so I would say, especially to the MSMEs. So I think I feel confident that there will be a GST 2.0. These reforms will come. And I think how it's incumbent on industry and chambers of commerce like CII that we also engage with the states, because they also need to understand how this.
So what's the ideal rate structure? 5, 16, 28?
In that
5, 18, 28?
Yeah, in the 16 to 18, you have to do the math in this to say what is the revenue neutral rate. But 5 and 28 at the 2 borders, and then between around 16% is something that you would go. Question is, what would you think will the demand offtake be once you rationalize the structure? So when you do the econometrics on this, that becomes very critical.
No, absolutely.
And I would say, again, if we can have a more aggressive posture on it, that'll help. I think there are lots of areas where in the short to medium term where the government can raise revenue. We've talked a lot about that. I won't get into that, but
On wage growth, because that continues to be the nudge. What's the expectation? I mean, the government's point of view is that that's actually nation building on part of industry as well.
See, I think there are two elements. One is the minimum wages and how we look at it. And I think some of it, some of the states are starting to alter that. So as you build in other elements of competition, as you reduce energy costs, as you reduce logistics costs, if land is being done on a more competitive basis, I think there is definitely room for growth on the wages side. And I think that's a good balance. You achieve this through competitiveness, you pass more income to the people, and you see how that grows. The analysis to say that profits have grown faster than wages, I don't entirely believe that there is enough correlation, because a lot of it could be because of commodity price movements, because of competitive force movement. So profitability linkage to wage growth I don't think it's the right way to look at it. Yes, you can say that, this is what is happening, but I don't think that's the right way to look at it, because, in years when you don't have profits, when you have losses, I don't think people will say, okay, we'll cut the wages by 20% or 25%. Or the profit growth is just 2% or 1%, but you don't have that. So yes, I think maybe the profit growth has been very strong in the last 2-3 years.
Yeah.
Indian companies have been very focused on ROEs and ROCs and trying to eke out competitive efficiency. And because of that, that's been there. And as I said, hopefully that gives the balance sheet strength to invest more and go forward on that.
Rajiv Bhimani, we wish you the very best of luck. Thank you very much for joining us here on the record on CNBC-TV18, and appreciate your time. And we look forward to seeing much more of you through the course of the year.
Thank you very much. Hopefully you'll grill lesser, but thank you.
With that, it is time for us to wrap up this edition of On the Record from all of us here. For now, many thanks for watching. Do stay tuned. The news will continue on CNBC-TV18.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. IT services giant Capgemini to acquire business transformation services firm WNS for $3.3 billion, excluding debt. The move will expand the company's generative AI and agentic AI capabilities.
In Prime FinServe, a tech-enabled platform, has bagged 50 crore rupees in a Series A1 funding round led by Pravega Ventures. The capital will power InPrime expanding into deeper geographies. Since inception, InPrime has served over 7,500 households by providing nearly 100 crores of credit.
Wise Life, one-stop solution for all yoga and home fitness essentials, has raised 8 crore rupees in a pre-Series A round from Rukum Capital. The company plans to launch new product lines and expand distribution in the coming year.
SmartWorks Co-working Spaces, which plans to launch its IPO on the 10th of July, has posted a net loss of 63.17 crore rupees in the last financial year. Despite rise in income from operations, its net loss stood at 49.95 crore rupees in FY23 to 24. The revenue from operations rose to 1,374 crore rupees from 1,039 crore rupees in the preceding year.
Big Basket announces the appointment of Manish Bajoria as its new Chief Financial Officer. In this role, Bajoria will oversee all aspects of the company's finance function and play a key role in shaping Big Basket's financial strategy as it enters its next phase of development and innovation. Well, those were the headlines we've been tracking for you this evening. On What's Brewing today, Apps for Bharat, the parent company of devotional platform Sri Mandir, has raised 175 crore rupees in its Series C funding. The round was led by Saskena Asia Venture Capital, with continued backing from Nandan Nilekani's Fundamentum, Elevation Capital and Peak 15 partners. With over 4 crore downloads and a user base that spans temple towns across India and the global diaspora, Sri Mandir now plans to scale operations in 20-plus temple towns across India and to decode how this faith tech startup is turning rituals into revenue, temples into tech-enabled ecosystems, and tradition into a 3 lakh crore rupee digital opportunity. I have with me Prashant Sachan, the founder and CEO of Apps for Bharat. Prashant, welcome to Startup Street. First, tell us what kind of growth will this capital unlock for Sri Mandir? And from, Saskena to Nandan Nilekani's Fundamentum, what convinced these investors to back this faith tech journey?
Thank you, first of all, for having me. It's a deep behavior which has been there for generations. And every behavior has found digital touch points, and this was the only touch point. This was the only behavior which did not have a digital touch point. And with the way we were building this sort of helped investors gain the confidence that this is one large category in the making, and we are doing it right. And that led them to invest in this particular company. And the way we think about this is right. I think it's all about investing in the user, in the users, on building a great platform, and also helping them with all kinds of things that we can do.
Okay. Prashant, India's religious economy is pegged at 3 lakh crore rupees annually, yet remains largely offline and fragmented. So the opportunity you're solving for is huge. In fact, Sri Mandir doubled down its growth in the last 6 months. So tell us what's driving this momentum, and if you could take us to your current scale and business metrics.
Sure. So in the last 12 months, roughly 12 lakh people have done 52 lakh of these offerings through the platform. Now, this is happening not just from India, from outside of India. 20% of our demand comes from outside of India. And with 70 plus temples right now on the platform, we would aim to scale it to 500 plus temples on the platform. This is what we would aim to do. Now, the larger part that we're thinking about is how do we solve for the experience of temple partners and also solve for the experience of our devotees through what we do. And that's how we would put everything together.
Okay. Prashant, you're digitizing devotion, which is a space that is deeply rooted in tradition. How do you preserve the sanctity of the experience while scaling digitally? And if you could give us a peek into the AI-led features that you're building to enable personalized spiritual journeys.
Sure. So we are a platform. The idea is to be able to matchmake the temples which are enabling the access with the users who want this particular access. And can we give enough proof points where it ensures that whatever the devotees wanted these temple and temple partners to do, it's done well. So in part of the whole process, we ensure that enough touch points are maintained. So when you tell when a user tells us that, hey, can you make this offering on our behalf, we make sure that there is a video that is given to him which carries all the details that how this whole process was done. The priest will come in front of the camera, tell what all things he has done, where this offering was made, and so on. So that's the first part. Second part is we have enough touch points that we have ensured that when you do some of these things, prasad box or some of these items are shipped from that particular temple to your household. There are enough things that we have done which ensures this trust. Now on the AI, what we have ensured is this agent is built in a way where it leverages all the historical and cultural information that is there, and it is also validated by institutions. So we are doing enough partnerships to ensure that we have a state-of-the-art model that answers all of these questions. And can we create this AI Panditji for everyone, where they can ask all kind of questions, from when is Ekadashi to what to do in Ekadashi, to asking questions about all kinds of things that they would do on that day.
Sure. Let's delve deeper into what you just said. You're now expanding to 20 plus temple towns from Varanasi to Ujjain. So what does this on-ground rollout entail? From setting up logistics hubs to enabling prasad delivery, how complex is this hybrid model of tech and fulfillment?
So today what happens is when you tell us that, hey, can you make this offering, or can you get this puja done for our for us at this particular temple, we actually work with our temple partners to ensure that all of these things are done. Now this investment in those local hubs will ensure that some of these processes are done very, very well, which ensures that, let's say, when some of these pujas are done, we will be creating digital enabled rooms where there'll be cameras set up where people could do these pujas too. When the pujas get done, they'll think of this, right? All the items that are procured from the temple, they'll be packed, shipped from there. So these will be very essential for users to be able to feel the vibe of what it feels like to be able to connect digitally to fulfill some of these things.
Okay. Finally, in the last year alone, Sri Mandir enabled over 52 lakh pujas and chadavas. Prashant, tell us, what has the temple response been like to this digital shift? And with claims of increasing temple incomes by up to 30%, how are you planning to make this a sustainable revenue stream for priests, vendors, and the local communities?
Think of this as an incremental income for them, where can we give them consistent incremental income? Can this income support the household of priests? Can we make it consistent? That's the larger part to this, right? And as we will open up the platform for and enable more services for temple partners, it will benefit them more. The larger idea is that there are so many culturally and historically important places that might not be popular. They don't get the right kind of support from their community. Can we create enough infrastructure for them where they get financially sustained and be supported by the community, and the community gets access? So the idea is, can we matchmake the community which believes in that particular institution and the institution, and they together serve each other?
Okay. On that note, we'll have to wrap up our conversation. But many thanks, Prashant, for joining us today on Startup Street, and wish you the very best for all your growth plans.
Sure. Thank you. Thank you for having me.
Moving on, a building materials platform, Infra.Market, has secured $150 million in financing from Mars Growth Capital, a joint venture between MUFG and Liquidity Group. This includes an extension of its existing $100 million facility by 5 years, plus an additional $50 million in fresh capital. This makes it one of the largest structured debt deals in the Indian startup ecosystem this year. The IPO-bound firm operates across 15-plus product categories and 10,000-plus retail touchpoints. So with this backing, what's next for their growth and global ambitions? Let's find out. Joining me now to discuss this further is Shouvik Sengupta, the co-founder of Infra.Market. Shouvik, thank you so much for taking time out and being here with us on Startup Street. This is your second fundraise this year, right? So what does this $150 million debt facility mean for Infra.Market's next phase of growth? How do you plan to deploy this fresh capital?
First of all, thank you for having me. The $150 million debt.
Sure, go ahead.
$150 million debt, essentially, look, this is our second raise, like you mentioned. We already raised an equity round of $125 million, and now we're raising a debt round of $150. The essential idea behind this debt raise was to put in money in existing product categories where we're already growing, where we are highly profitable. Categories like concrete, categories like AAC blocks, where we really believe the next phase of growth is going to come in. We are one of the largest manufacturers in concrete, AAC blocks, and tiles in India. We have our own brands where we are going to put extra growth money into. And these are the key categories where we're going to put in money across the next sort of couple of quarters.
Sure, and you have spoken about global ambitions before. Does this deal sort of signal a push beyond India? What geographies or verticals are you eyeing for expansion?
Look, to be honest, I think while we are looking at global ambitions, the essential idea still remains to ship out of India. So I think making products in India for global clients, global companies, our distributors globally is what we're targeting. So while we have offices across the globe, we are still sort of aspirationally trying to take building materials manufactured in India to the globe. So we accept one manufacturing capacity globally. We're still going to be primarily an India-based operations company with revenue coming globally, but primarily manufacturing is still going to remain in India.
So while manufacturing remains in India, you're still eyeing, various geographies that you want to sort of export to. So what are these geographies that you're looking at?
No, so we have exports across the US, Europe. We export to the Middle East. Look, India is the second largest exporter of tiles. We are one of the largest exporters of tiles out of India. India is after the entire sort of Russia-Ukraine crisis, energy crisis globally, India has become from a net importer to a net exporter of tiles. And I think those are some of building material categories that we are focusing on are extremely, where India has an extreme cost advantage and overall product advantage. Those are the categories that we're looking at. We've also set up one manufacturing facility in the Middle East from where we are going to export globally. I think that will be active by sometime next year.
All right, so that's going to be active by sometime next year, which is your manufacturing facility in the Middle East. But, with the kind of scale and capital backing that you currently have, are you on track to file the DRHP this month? What's the IPO plan? Where are you on that front?
I really can't talk on many things because regulatorily I'm not allowed to. So I guess we'll update you when we reach a more conclusive situation on the listing plans. Currently, look, we are well capitalized. We are looking at we are growing into multiple sectors. I think in terms of capital, we are well capitalized for the next year and a half to put money in the growth areas. IPO is an eventual sort of roadmap in the eventual roadmap. But on exact timelines, I don't think I'm in a position to comment right now.
Okay, so can't comment on the timelines, but hopefully we'll have an update on that soon. You are betting big on the $255 billion building materials market, right? So what's been the demand across infra, industrial and real estate segments for FY26? Shavik, we seem to have lost you there. We're just going to try and reconnect Shavik at this point. So Shavik, can you hear me now?
Yeah, sorry, I think I lost.
Okay, great. So I could just repeat the question for you, since I think you might have missed that. You're betting big on this $255 billion market, right? So what's your reading, especially when it comes to what's the kind of demand that you're seeing across infra, industrial and real estate segments for FY26?
Yeah, to be honest, we see continuing growth, especially in infra and construction. I think the government continues to spend on roads, airports, bridges. I don't think you need for me to come out here and give you that. Most of the people who are listening to this know that the India is building more airports today in this year than they've built in decades before. I think on that front, they continue to be spending. On real estate, we are seeing that the demand that has come in for the last 2 years, the execution is still pending. So we are going to have the execution happen over the next couple of years. So I think on all that front, except consumer-oriented product categories, we don't see any sort of stagnation of demand or any way in the building material industry. I think consumer categories, I think there is some sort of pressure on growth. We are very nominal in that industry. Less than 10% of our revenue comes from consumer level goods. So apart from that, I think we are seeing good level of growth. Our growth rates continue to be unhampered. Whatever, we continue to grow on double-digit growth rates this year.
All right, Shavik. So double-digit growth rates is what you're looking at, but we're completely out of time. Thank you so much for joining us on the show, and we wish you all the best going forward.
Sure. Thank you so much for having me.
With that, it's time for us to head into a short break. But coming up next, student entrepreneurs in India are no longer just pitching ideas in classrooms. They are raising millions of dollars. Stay tuned to know how they do it.
Well, Max India recently raised 125 crores through a rights issue, allocating a significant portion to its senior care subsidiary Antara as part of a broader plan to invest more than 500 crores in it in the next few years. Now, with a focus on expanding both its senior living communities and assisted care services, Antara is aiming to quadruple its bed capacity and deepen its presence across India. Joining me now is Tara Singh Bachani, the executive chairperson of Antara Senior Care, to talk about how the company plans to deploy this capital, navigate the barriers and scale its offerings in a market that is only just beginning to mature. Tara, thanks very much for joining us here on Startup Street. Let's start with that 125 crore rights issue where we understand about 70 plus crores was allocated to Antara Senior Living and 148 crores to assisted care services. Could you elaborate on how this will be utilized across your business verticals?
Sure. So, Antara actually does three verticals. We have our residences vertical, which are retirement communities. So about 50 to 60 crores of that will go into the development of new projects. We have 1.5 million square feet coming up every year over the next 5 years. Our second vertical are care homes and care at home, which actually creates assisted living facilities between Delhi, Chennai, and Bangalore. So of the 100 balance, 110, 114, half of it will go towards that. And our third vertical, which is AGZ, which is our D2C business that does chronic products actually for chronic aging. The balance will be utilized to develop and grow that business.
Okay, and to just give our viewers a sense of the company, across the various verticals you operate in, could you give us a breakdown of the fastest growing ones, where the revenue contributions from each are, and how you anticipate the growth in them in the coming years?
Yeah, absolutely. It's something we've been doing for a long time. And we're excited to see the category and the sector grow. So in our residences vertical, the revenue comes from the sales of our units. If you look for this past year and the year ahead, we have 3 projects in the pipeline, and the revenue is upwards of 500-600 crores from those projects. For our assisted living business, as well as the AGZ business, we're forecasting about 170 crores of revenue to come from those 2 verticals over the next year.
Well, we understand Antara plans to invest about 300 crores in the next 3 to 4 years, including developing 500 senior homes in Bengaluru. What are the key markets that you're targeting, and what kind of factors are influencing these market choices?
Right. So for us, senior residences vertical with two, we're looking at essentially NCR market, Chandigarh, Bangalore, Hyderabad, Chennai. So those will be where we will create retirement communities. In our assisted living verticals, we're, like I mentioned, already in Bangalore, Chennai, NCR, and we would like to expand to a fourth city. And essentially the criteria for this is, where is there enough demand for people over the age of 60, 65 living alone who need either a lifestyle and life care solution or just a care solution? The demand in India is actually completely blowing up if you look at the fact that there are 150 million people over 60 already. So actually you could be in any part of the country, but we want to be where we believe we have a right to win and where there is a very solid healthcare network to support what we do.
You know, a lot of seniors in India may not be financially prepared for retirement. How are you at Antara tailoring services to cater to all sorts of varying financial capabilities among the elderly?
Yeah, so Ritu, the truth is we can't be all things to all people at this point, especially because, you know, we are category trading at this point in time and we are looking to be a financially successful and stable organization. So at this point in time, we are targeting Sec A, Sec B in terms of their income levels and backgrounds. And that's really the best that we can do at this particular point in time. And we also realize that it is that audience who has more freedom in their income, who actually also resonate with our concepts more. But of course, the aspiration is for Antara to be able to touch the lives of every senior in our country as we evolve and grow.
Well, reports suggest India's senior population is projected to reach almost 350 million by 2050. In that scenario, what kind of opportunities and challenges do you foresee in scaling senior care services across India?
We need more high-end quality competition because I think that as competition grows, the cultural barriers you touched upon and people's just education and awareness levels on this topic grow. And the second is just basically advocacy and the government, you know, really creating policies around land, around building, around quality and clinical services. I think the government is starting to do that and we're seeing a lot of traction there, but there's still a long way to go because the minute we have policies and guidelines in the space, I think the sophistication around the sector will grow. Opportunities, you've already touched upon it. I mean, with a population this size, any way in which you slice and dice, there is a lot of room for all spectrums in the senior care space. And we are really the only ecosystem provider where we go from lifestyle to life care, like I mentioned. So the opportunity is limitless as far as I'm concerned.
All right, Tara, that's all the time we had. Many thanks for joining us here today. It was a pleasure speaking with you.
Student entrepreneurs in India are no longer just pitching ideas in classrooms. They are raising millions of dollars and reshaping the future, both their own and that of the world. In the thick of this revolution is Campus Fund, India's only SEBI-registered venture capital fund dedicated solely to student startups. CNBC-TV18's Meghna Sen reports that with a fresh $100 million in its kitty at its disposal, Campus Fund is looking to fuel the next wave in Startup India.
The aspiring entrepreneurial community at IIM Bangalore is buzzing with excitement and anticipation. Over 60 new ideas may get the funding they are pitching for, and these young student entrepreneurs believe these ideas will get the impetus needed to make them the next big disruptive force. Driving this buzz is Campus Fund, India's only SEBI-registered venture capital fund that focuses on supporting and growing student and recent graduate-led startups from the pre-seed stage, often writing the first institutional check for student founders. Campus Fund has unveiled its third and largest fund yet, a $100 million corpus aimed at backing student entrepreneurs and college dropouts. Fund 3 will invest in up to 60 startups over the next 4 years, with initial check sizes ranging from 1 crore rupees to 8 crore rupees. Many of those investors who have participated in Campus Fund's third fund say the idea of finding the next big idea in India's educational campuses is late coming to India, which has big ambitions from its budding startup ecosystem, but better late than never.
If you look at the US economy, and the tech system is a very significant part of that. Every one of those tech founders, whether it's Microsoft or it's Google or anybody else, they all started in student dorms. So somebody believed in them, somebody funded them as students, and that's how they are. So we think the next big entrepreneurs, especially in the technology side, are going to come from students only. So it will help in India's growth.
What we need is risk capital. Believe me, even if 5% of the risk capital that is there in the American universities can be made available to the Indian students, this country will change.
Campus Fund's goal is to support unconventional entrepreneurs who mainstream investors often overlook. It has already delivered on this. Digantra, for instance, was born in a dorm room at Lovely Professional University. It is developing infrastructure to address the difficulties of space operations, and it owes a lot of its continued existence to Campus Fund.
Recently launched one of the first satellite on space traffic management, which tracks objects in the orbit from orbit. That was a recent achievement that we did on SpaceX.
Campus Fund is not looking only for the next big idea. It's also looking to reinforce its support to startups it has funded in the past and helped gestate and germinate from an idea into reality. Even in the new fund, half of the $100 million is reserved for follow-on investments. Backed by leading institutions, this fund isn't just about capital. This is about conviction. The conviction that the next Google, Infosys or SpaceX could be born on a campus today. One of the big areas in which Campus Fund believes it can make a difference is in making an idea fit to take it to market. The backers of Fund 3, who are a diverse mix of family offices, successful entrepreneurs, industrialists and financial institutions, are confident this is a big opportunity for the thousands of concepts waiting to transform into a mainstream business.
There's actually a lot of money available in the large institutions of the country, universities, but moving from R&D to commercialization is often a very slow process, and many great ideas get stuck. So for student entrepreneurs to have a chance to work with their professors, with the funding available, particularly in areas like robotics, AI, biotech, new energy, new battery chemistry, are real-life examples I'm seeing where students with their professors can create truly transformational companies for the future.
Another Campus Fund find, Sala Aviation, which is trying to change mass transportation with its low-cost flying taxis, says that funding is a big hurdle for many startups in India. But regulatory support, once a concept is taking physical commercial form, is just as important.
On the regulatory front, I think it's a whole bunch of different regulations that we're looking at. We need pilot training regulations. We need infrastructure, landing pad infrastructure regulations. We need the actual regulation for the aircraft itself. And I think on a lot of these things, we're making dramatic progress.
From flying taxis to satellites, student-led deep tech startups are no longer dreams. They are drawing and defining the next frontier and building something from India for the world. As India eyes $55 trillion economy by 2047, these early bets could be the engine that power that future. With camera person Manjunath, this is Meghna Sen for CNBC-TV18.
Well, with that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side.
From Instagram influencers to high-end wellness clinics, beauty and wellness isn't just about makeup and lifestyle anymore. It's also about IV therapies. From vitamin infusions and hangover cures to skin lightening and anti-aging cocktails, this booming market promises quick fixes in a drip. India's IV hydration therapy for wellness was valued at $38 million in 2024 and is projected to nearly double to $65 million by 2030. But as demand grows, so do concerns. Doctors warn of a rapidly expanding, largely unregulated IV drip industry, often operating without medical oversight, clinical screening, or even sometimes trained personnel. The risks: infections, allergic reactions, incorrect dosages, and unsafe administration. At the heart of this trend is glutathione, known as the master antioxidant. Medically used for liver disease, Parkinson's, and chemotherapy support, it's now being used widely and often off-label for skin lightening. In 2024, glutathione sales in India touched $13.4 million, growing at 12.7%, making it one of the fastest-growing markets in Asia-Pacific. It's apparently freely administered via IVs across salons, spas, wellness clinics, and even in home setups,
often with little or no doctor supervision. It's aggressively marketed as part of glow drips, anti-aging cocktails, beauty infusions, and bridal packages that promise fairness and radiance. In fact, over half of Indian dermatologists reveal that they routinely prescribe glutathione, even though 54% admitted there's a lack of long-term safety data. Side effects can include kidney and liver issues, allergic reactions, and in rare cases, Stevens-Johnson syndrome. So today, we ask some important questions. Are IV drip therapies safe? What should we know before trying IV drips? And how do we separate genuine health benefits from marketing hype? To help us unpack all of this, we're joined by Dr. Hemant Thakkar and Dr. Satish Bhatia. Welcome to the show, gentlemen. Well, Dr. Thakkar, let me start off by asking you about your overall take on IV drips in the wellness market. What exactly happens to somebody's body when they take an IV drip which has, maybe an infusion of vitamins?
So if the last decade belonged to pill popping, this decade is solely drip driving and delivery. I have known patients who do not have the time to come to the clinic because early morning they got up after a hangover and took a drip with inverted commas. Salons, spas, wellness clinics have, without regulatory approval and clinical supervision, blossomed at every nook and corner to deliver glutathione, vitamin cocktails, all sorts of drips, peptides, so that this wellness, and this is because the susceptible years of the impressionable young folks, even the middle-aged ones, who want to overnight blossom and look like angels after all that they have gone through, has continuously allowed this unregulated, unsupervised, dose not being maintained, and that is a real danger because that provides all the problems that you just listed. It is not US FDA approved, glutathione especially for cosmetic reasons. Remember, the cosmetic benefit was an incidental discovery when glutathione was given for true medical reasons. There are true medical indications, but those indications are left by the wayside and parlors, etc., get into this.
Can healthy individuals rather be prescribed IV drips such as these?
If you ask me, glutathione should be a Schedule H drug, which should be regulated for specific indications. It is great for cancers, Alzheimer's, Parkinson's, chronic inflammation, but that is medically supervised. How much to give? Glutathione is destroyed by the gastric juice. So oral glutathione doesn't work. They've started transdermal where you give creams, but because it doesn't work orally, they give it IV. And I've known where patients say, my daughter's wedding is coming up, or young ladies say, my wedding is coming up, let me take a few drips before the big family party, before the function. Now, this is unregulated. A doctor cannot write a prescription without an indication. The indication has to be medical more than social.
Well, Dr. Bhatia, you're in the thick of things, considering that this is one of the segments that you do operate in, injectables as well as surgery in dermatology. So just give us a sense in terms of how exactly this market for IV drips, beauty drips has flourished, and especially the unregulated part of it.
Yeah, thanks, Ekta. So the global IV market is booming. In India itself, you have clinics, and wellness centers, as we call them, with IVs and popping up. They are popping up in metros and two-tier cities. And it is estimated in India itself to grow 7 to 10% annually. Now, why this happens is because of aesthetic, promotion, celebrity culture, and social media influence. So all these three together make the common man want to keep getting these injections. And sometimes they end up not going to a medical professional. They end up going to salons and spas where either the wrong dose or an impure dose could be given by untrained technicians, which is definitely could be potentially fatal.
Okay. But can you elaborate a little bit in terms of the misuse of IV drips, especially for wellness and beauty? And how has it changed possibly in the past 3 to 5 years?
Much wants more, Ekta. So many IV drip centers, they are operating without any medical oversight, or there's no protocol, or any, for that matter, even there's no licensing. There's very little regulation, and it's more of a bulk treatment being done. And first of all, we don't know, Ekta, whether these sources where you're getting the glutathione, it comes in a 600 mg ampule, whether it is sourced legally. And this, if it's not sourced legally, this can create serious health and, of course, legal issues as well.
Okay.
So this is where I will interrupt.
Yeah.
The price of glutathione is phenomenally high. So people try to procure it in the grey market.
Correct.
And there was a lot of spurious stuff coming in. An injection, as Dr. Bhatia correctly said, of an adulterated 600 milligrams can produce immediate problems. The local anesthetic which is applied before the injection, because these people want pleasure, no pain. So the local anesthetic itself can be a cardiac stimulant to arrhythmias, drops in pressure, etc.
Or even the needle, right?
Even the needle, because there is, like he said, there is no licensing. Today, I am regulated. I have a license. Maharashtra Medical Council looks at it. There is no license. You walk down a rich avenue or a sprouting complex with skyscrapers, there'll be spas and salons delivering this. Because there are lots of people who after the vodka shot party or for the Friday night party are willing to go in and take a vitamin shot, a peptide drip, and of course the glutathione.
Well, Dr. Bhatia, that's exactly the point that, we're trying to get to the crux of how unregulated this market is. If you talk about, say, for example, untrained personnel, are these nurses who are moonlighting and say, come to your house and say, okay, you can buy the glutathione or you can buy the saline or the drip required from the chemist and we'll administer it for you. They see something on Instagram and they decide that this is the dosage that they want. Is that how unregulated the market is right now?
Absolutely. First of all, there is repeated use when there's no medical need. And also they're using unapproved whitening agents like NAD, peptides, amino acids, or for that matter, combining drugs. Like glutathione is frequently combined with vitamin C and steroids. There is no evidence-based protocol on this. And these are also like, as we may call them, cocktails, gluta cocktails or glow drips, which could be used weekly or even monthly. Because what happens is when you giving an IV glutathione, the results are seen much quicker than when you take any other oral vitamins, which may take even weeks or months. So this is what's being done. The bridal packages, like Hemant sir had said, it's basically the day before the wedding, they take these IV drips, which is done at home, which I find it potentially fatal. It could be potentially fatal.
But doctor, glutathione as a whole is not even approved by the regulators for cosmetic use at this point. But it is being prescribed by dermatologists as well.
Okay, it is, of course, done by me and my colleagues also. But we know the limitations what we have. We do a blood test before that. We take a proper history if there's any history of allergies. And only then and then we will give the right dose with the right medicine. What's happening is especially people are getting IV-based. They're getting over-influenced by these influencers, bridal packages, and even the teenagers we get. So when we get teenagers coming in, we tell them, Ekta, please get your parents and come along. We need someone, no matter they offer a lot of money. We just had someone day before yesterday said, please get your parents along with a written consent, then we can think about it.
Okay. Well,
Supreme Court can regulate when an abortion should be done, when it is medically or socially indicated. Why can't somebody regulate whether unjust amounts of adulterated glutathione can be given unsupervised by unqualified professionals and mixed with anything? This is not a bar where you can add a little juice, a little lime, a little soda and make it a cocktail. It's going into the system and that too directly. So it has to be.
But what are your thoughts, Dr. Thakkar, on the fact that this is not approved by the regulators and it's still being used widely?
So this is where I say that the regulators have to clamp down. So Schedule H has to come in. It's not only for tranquilizers and sleeping pills, but glutathione for cosmetic use, neither the US FDA nor the CDSCO in India has approved it. So I cannot see how they can do this.
Okay.
It's like those hawkers giving you Louis Vuitton bags at great discounts, which people strut around and wear so that they can fit into the healthy wannabe structure. I think this is a headlight and a tower to show people that when you go unwarranted and when you go unsupervised, the price that you pay can be with your organs, can be with your life.
Okay. Well, Dr. Thakkar, you know, we're talking specifically about glutathione, but do you strongly or do you have the same views about any other IV drips which are available in the market, say a vitamin C infusion or...
If you give too much vitamin C, you can produce kidney stones. So the dose has to be prescribed by the physician according to the indication. And quite often, you know, it's like going in the morning, acha thoda ye bhi dal do, thoda ye bhi dal do. So that Bhelpuri is ordered by people who are not qualified. So if you give IV multivitamin cocktails, vitamin C, vitamin E, glutathione, peptides, after all, it's like using a lot of creatinine in the gym. How many young people or wannabe muscle growers taking a lot of protein supplements come with compromised kidney function? So God made the body to take things in appropriate and apportioned doses.
Well, before we get to the side effects, Dr. Thakkar, you know, Dr. Bhatia, I wanted to understand that before you take an IV, what is the kind of pre-screening that needs to be done?
Glad you asked that, because first we do a complete blood check, which is your CBC ESR. We look for IgE, whether the patient's G6PD, which is a potential threat, fatal threat actually, and the bleeding and the clotting time, whether they're on blood thinners as well, any form of aspirin. If any of these criteria are met, Ekta, we do not inject IV.
Okay. Well, Dr. Thakkar, now tell us about the potential side effects. Say, for example, X person comes to Dr. Y and says, I would like an IV drip. What are the possible complications, or if it's at home?
So first of all, what is the need for the IV drip has to be seen. Do you have a liver dysfunction? Do you have chronic inflammation? Do you want it for the neurological problems like Alzheimer's or Parkinson's?
But what if you have no problem and you just want it because you want a boost in energy, you want to cure a hangover, or you want to look better for a certain
Hangover
stage?
cures are not satisfied by single shots of IV drips. You need to hydrate yourself. Yes, I am happy if he's vomiting too much and not able to take liquids after the hangover to give him IV fluids.
Yeah.
But what is the need for me to give him glutathione unless he has liver cell dysfunction, which would be manifested by blood reports, by sonographies, long-standing alcoholism.
But
and about looking nice.
Yeah.
Nobody has approved the cosmetic use of glutathione. You look so nice, you don't take glutathione. So the whitening does not come, it's a transient, incidental finding which has not yet been approved because the cure should not be worse than the disease.
Yeah.
So therefore that one has to be seen.
But what I'm trying to understand is that, say, for example, that anesthetic that you spoke about or the prick of the needle, where exactly are the possible risks that emerge from, say, the anesthetic to the air bubble?
Begin from the drip. What is put in the drip? How pure is it? Is it adulterated? Then when the IV line is started, is the needle autoclaved? So it is sterile, because today all needle stick inoculations can give you hepatitis, HIV, infections, etc. Then is the drip properly put? So there is no air bubble. Air bubble can travel into the system and cause cardiorespiratory problems. If it happens that you have an allergic reaction, is the center fully equipped with anti-allergic medication? If you have a severe reaction, is there a AMBU's bag or an endotracheal intubator? Is there a qualified nurse to look into it? So giving it at home, giving it in a spa, unless it is ordered by a qualified doctor who knows the patient, who knows the history of the patient. This is not a barber shop where somebody can come in and say, I want a Chakoti haircut or I want a V-shaped haircut. It's directly introducing something into your bloodstream which can reach within seconds all over the body in every nook and corner of every organ.
Absolutely. Well, Dr. Bhatia, would you like to come in on this?
Yes, I wanted to come in. And basically, like I said earlier, the cocktail regimes or the glow IV drips, usually they are overloaded or there's an overdose of fat-soluble vitamins in them. That is A, D, E, and K. And these may turn into a fluid overload or even an air embolism, like Dr. Thakkar was saying, especially in people with heart or kidney problems. And the other thing is a non-sterile technique, especially since we are dermatologists, the non-sterile technique can lead to sepsis or thrombophlebitis. And also there is another thing to be remembered, risk of cross-contamination in poorly regulated clinics.
All right. What do you recommend when it comes to, say, regulating this IV market, which is booming out of control, you'd rather say, Dr. Bhatia?
Yeah, so I see, sadly, we are now become a country where we are obsessed with skin lightening, and due to, like I said earlier, with the celebrity influencers, actors, actresses, and social media posts coming in, how to get a better glow, there should be a control over this. The DCGI should also do audits of clinics, whether they have a proper medical license as well, and who are the trained personnel, whether they are following the right protocol as well or no, whether the blood testing is done earlier, and find out if the patients are allergic to any substances. Then they should go forward. Not like the salons and spas where, come, like Dr. Thakkar said, come, we'll give you the glow cocktail.
What if you have an underlying condition and you take an IV drip, say
Dr.
epilepsy?
Bhatia was very clear and I liked what he said. If you have insulin resistance, if you have chronic inflammation, if you have hepatic, which is liver dysfunction, and you need the glutathione, definitely. But I would not give it in a spa. I would give it in a supervised clinic. I would give it in a hospital. I would give a finite dose. And I would not say, all right, go every time you have the vodka party and the binge, you come and take it. That's not medicine. That's quick fix.
Dr. Bhatia?
So sadly, there's an unregulated dose and frequency, and more of a, salons, they're creating a word of mouth. Oh, go over here, chalo, these guys are giving you a better rate. Of course, people are looking for another, better rate as well. Then it is administered by beauticians, which I shudder at the thought when, I don't know how they will be injecting IV, So the third part is it is sold and administered without any medical supervision. So these are all factors which can be potentially fatal. Okay. And no, sorry, may I please complete this? There's like I said, for the cocktail regimes, when it's combined with vitamin C and peptides and everything, these combinations can mostly affect the liver function, the immune response, and even the hormonal balance can be, affected. The long-term safety of glutathione is unknown.
Okay. Well, that makes it loud and clear that we don't know the long-term side effects of glutathione, or maybe, unregulated IVs is important to note. We do have some viewer questions, so I'll just request if we could just answer them briefly. Dr. Thakkar, do healthy people really need any of these vitamin injections?
No, not really, unless there is some ill health thrown in.
Okay. Is it safer to take vitamins orally as compared to, say, an IV?
So oral vitamins work, oral glutathione may not work because it is gastric problems as far as absorption is concerned. So you could take it IV if you have a medical indication.
Okay. And Dr. Bhatia, your advice to somebody who wants to look fairer ahead of their wedding, do you think you would recommend a glow drip?
First, before going into all salons and spas, I've got nothing against them, but talk to a licensed dermatologist first. Do your blood test. Avoid black market clinics. You should know that that glow factor is going to be temporary. And we, like I said earlier, we don't know the long-term effects or the long-term health risks of glutathione. The safest options would be take care of your skin, hydrate well, and stress management.
Okay. All right, Dr. Thakkar as well as Dr. Bhatia, it has been a very enriching conversation and very eye-opening as well. Thank you very much for joining in and speaking with us. And we do have a whole host of other topics to discuss as well. If you're talking about misuse of glutathione, I'm sure there's misuse of, weight loss drugs, which could probably be around the corner as well. Thank you very much for joining in and speaking with us.
Thank you.
From Instagram influencers to high-end wellness clinics, beauty and wellness isn't just about makeup and lifestyle anymore. It's also about IV therapies. From vitamin infusions and hangover cures to skin lightening and anti-aging cocktails, this booming market promises quick fixes in a drip. India's IV hydration therapy for wellness was valued at $38 million in 2024 and is projected to nearly double to $65 million by 2030. But as demand grows, so do concerns. Doctors warn of a rapidly expanding, largely unregulated IV drip industry, often operating without medical oversight, clinical screening, or even sometimes trained personnel. The risks: infections, allergic reactions, incorrect dosages, and unsafe administration. At the heart of this trend is glutathione, known as the master antioxidant. Medically used for liver disease, Parkinson's, and chemotherapy support, it's now being used widely and often off-label for skin lightening. In 2024, glutathione sales in India touched $13.4 million, growing at 12.7%, making it one of the fastest-growing markets in Asia-Pacific. It's apparently freely administered via IVs across salons, spas, wellness clinics, and even in home setups, often with little or no doctor supervision. It's aggressively marketed as part of glow drips, anti-aging cocktails, beauty infusions, and bridal packages that promise fairness and radiance. In fact, over half of Indian dermatologists reveal that they routinely prescribe glutathione, even though 54% admitted there's a lack of long-term safety data. Side effects can include kidney and liver issues, allergic reactions, and in rare cases, Stevens-Johnson syndrome. So today, we ask some important questions. Are IV drip therapies safe? What should we know before trying IV drips? And how do we separate genuine health benefits from marketing hype? To help us unpack all of this, we're joined by Dr. Hemant Thakkar and Dr. Satish Bhatia. Welcome to the show, gentlemen. Well, Dr. Thakkar, let me start off by asking you about your overall take on IV drips in the wellness market. What exactly happens to somebody's body when they take an IV drip which has, maybe an infusion of vitamins?
So if the last decade belonged to pill popping, this decade is solely drip driving and delivery. I have known patients who do not have the time to come to the clinic because early morning they got up after a hangover and took a drip with inverted commas. Salons, spas, wellness clinics have, without regulatory approval and clinical supervision, blossomed at every nook and corner to deliver glutathione, vitamin cocktails, all sorts of drips, peptides, so that this wellness, and this is because the susceptible years of the impressionable young folks, even the middle-aged ones, who want to overnight blossom and look like angels after all that they have gone through, has continuously allowed this unregulated, unsupervised, dose not being maintained, and that is a real danger because that provides all the problems that you just listed. It is not US FDA approved, glutathione especially for cosmetic reasons. Remember, the cosmetic benefit was an incidental discovery when glutathione was given for true medical reasons. There are true medical indications, but those indications are left by the